Ever wonder how CFO, investment banker, and finance analysts build financial models that drive billion-dollar decision? What if I told you you can learn the exact same skills faster, smarter, and more affordable than anywhere else? Welcome to Master Financial Modeling from Basic to Advanced. That course will transform your career. Hi, my name is Anavla. I am certified management accountant, ISB CFO program certified with 15 years of corporate experience as well as 5 years of teaching expertise. I have built financial models for global companies, raised $1 million funding, and help businesses to make data-driven decisions. Now I'm bringing all that expertise to you. Are you ready to master the art of financial modeling? Then this course is for you. This is complete and in-depth financial modeling journey. You will learn to build financial modeling from scratch, forecast revenue, cost, and cash flow, design master budgeting and scenario planning, perform variance analysis, ratio analysis, and horizontal and vertical analysis. Company using various different methods, including DCF method. You will also master the regression analysis, multiple regression analysis, casual forecasting, time series forecasting. This all will help you to build forecast. Automate everything using ChatGPT and Excel, making your work 5x more faster and accurate. Every concept comes from real case study with practical MCQ, so that you will not just learn theory, you will also able to apply those concepts, and immediately you will be ready for job. Already over 10,000 students has benefited. Plus, if you want to deep dive into FP&A financial statement analysis related courses, check out to our ibsedu.co for more in-depth program. By the end of this course, you will think, plan, and analyze like a CFO. You will build dynamic, clean financial model like a professional and automate all your repetitive tasks and make decisions that truly impact to the businesses. This is your chance to level up your career and stand out as a leader. Hello everyone, welcome back to IBS. Today we are going to learn about financial modeling. In this session, we will be learning more about Excel sheet. Before actually starting preparing a financial model, we should learn few things which is very much important and recommended to know before. So don't think that I'm going to teach you every single Excel function and very basic or something. I'm just going to give you about the basic which is basic for financial modeling, but this is not the basics for Excel. After making your financial modeling, it will be looking like this. So we are going to learn all these things today. So this is income statement, income assumption of income statement, okay, and then we will be learning about common size statement, okay, and also we will learn few scenario planning, okay. So these are the tools which are very much useful. So I will be teaching each and everything one by one. So I would highly recommend following every single step and keep your Excel downloaded and ready at your desktop, and keep working with me. So one by one I will teach you how we can do it effectively. It is not those course where you will be listening to me and you can learn. No, this is the course where you have to practice. Practice is the key to success for this particular session. So this course is purely for practice purpose. If you will not be doing practice, if you are keep on going without practicing, then you will not be able to achieve as much I am expecting you to achieve. So let's jump to this. So this is what we are going to prepare. So we'll take first our this raw Excel sheet, okay, so in which we will be converting this to this format, okay. So let's jump to the top. So first of all, we will do some default setting, okay. So for that, recommend you to not to use mouse. It is better to use as much keyboard as much possible. You will be more fast and efficient while making financial model. Okay, so now what I will do, I will not use mouse. I will click alt. Okay, you can see that this kind of thing has come, right? 1 2 3 4. So whatever you want to go, suppose you want to go to power pivot, okay, for that you need to click B. You can go there. Now if anything is there, if you want to go to setting, you can click on S, okay. So you can go to the setting. Now it is open. So likewise, you can escape it, but now we don't want to go here, so we will click again alt. Now you can see again all the option has been opened. So first I will go to file. I have pressed F and then click T. T will be your option. So again let me show you alt. Now I'm clicking F, okay, F. Now we want to go to option.
So for option, we want to do some changes for permanent setting for our X. So I will click T. So now you can see this general option has been opened. So first of all, make sure these all are cleverly. I have kept in standard, so that is why you are getting all this in the standard format. And front size is 11. We will keep it 11, okay, because 11 is the recommended and a standard for industry point of view. Everybody who is financial modeler, who prepare financial modeling, they use this same or similar standard. Okay, so this one we can keep normal, and this include this how many sheet. So how many sheet you want to keep it here. Earlier you might have noticed when we open Excel sheet, or still if you are opening your Excel sheet, so you will get 3 sheets, but now you will get 1 sheet if you keep it here. And if you change it to 2, okay, now if I close this, if I again open Control N, you can see this there is 2 sheet has opened, right? So but we want to change this setting. So okay, you can go like this, Alt F T. Now we will change it to 1. Okay, you can click by arrow, you can change it. Okay, I have kept it as a standard. One more thing, if you change this, okay, anything, if you change it, if you click OK, then it will ask you to close this and reopen. Okay, so then if you will click OK, close, and then if you have open again, go to file, F G. Now you can see that this has been changed, but again we will keep it same. We will keep it Calibri. Calibri has other variation also, but don't keep any other, keep it this one only. Okay, so once we are done with this, you can also in personalize your setting related stuff. You can change it if you want. Like I have kept it Indian Business School, name of my own organization. Okay, or if you want to change this in color, so this will be change your Excel sheet, etc. So you can play around it and try to understand as much possible, but this is purely personal. Okay, and then we have some startup option, so that we will be learning. Like always keep this untick. Okay, so basically if you will be keep this like this and press OK, and then if you open your Excel sheet, so they will be opening like this way. So now you have to either select, or you can, this will take a lot of time. To save all this time, when we are opening a particular Excel sheet, like how I click just Control N, and a new file will be opened. So it is saving our time. Look, when you are working professionally, you if you are saving a single click, that is also valuable. So learn to save your time. If you are able to save your time, it will help you to be more productive, more efficient in your organization. That will also give you a lot of free time for yourself. So be efficient as much possible. Okay, now we will go again to the same place. Okay, so this is not very difficult. If you stop using, like I am not using mouse or something, I'm teaching you through my laptop and I have not connected mouse. Okay, so now whatever I'm doing through my hand and keyboard. So now we can keep this untick and okay, like this. So now, since we have learned about our general setting, now we will go to formula setting. Okay, like arrow also you can go like this way. Okay, in this formula section, we will first select this one as an automatic. If you keep it manually, or so that will be a kind of problematic. Let me select manually and show it to you. Okay, for example, we have 50, and again 50. I have how I have calculated this. I have just pressed, let me show you, Alt and equal. If you press this, this formula will automatically calculate your. So this has been calculating. Now if I change it to 5, it should be 55, right? But it is not changing. Why? Because I have changed it here. So go to formula. Now if we keep automatic, now you can see again, if you keep 50 50, okay. Now if we press alt equal, it will automatically calculate. Now if we change it to 5, you can see that it is automatically calculating. So it is recommended to always keep automatic. Now again we will go to alt ft. You can, and data except for a data table. What they are trying to say, do the automation for our entire Excel sheet other than our data table. So data table we will learn in upcoming session. So he is saying when you have huge data, and whenever the system is automatically calculating all the formula, so there may be sometime Excel take time. So to save time, some people keep it like this. So don't touch my data table, I will do it manually. But I would recommend, or it is recommended by everybody, to use automatic. Okay, so that is the best way to keep the Excel sheet updated all the time. Now we are going to learn a new thing. Again press F, alt F, then T. Okay, so now we want to go down, click arrow, we will go there. You can see this enable iterative circulation. Okay, if you will enable, what will happen? Okay, if it is not enabled, then what will happen? Let me first check this one. Okay, so this suppose this is the 3 person, okay, who is contributing this into particular project. They all are contributing. Okay, so total 1000k they are contributing. Okay, 25k Ram, 24k John, and 30k is being contributed by Sita. So these 3 people are contributing to particular event or something. But what about Ram said, I will contribute 1/3 of this amount. So if what he will do, he will click like this and divide with by 3. So what will happen? The error message will come. So why they are saying? Let me read it out. There are one or more circular reference. So where the formula refer to its own cell. So you are using your formula from own cells. So the sum value is from these 3 people. Okay, sum of these 3 is 100k, and you are trying to use formula from this. So that is why they are saying this is not the right way. You cannot directly or indirectly use uh, on formula. Okay, so from on calculation you cannot use your formula. Okay, so if you click if you even force it to do it, then what will happen? They will say this is wrong. Okay, so now control Z and keep it like this. Now if you go to formula, if you enable this and press OK. Now if I do and use try to find some solution from my own calculation, then what will happen? They will easily calculate. So they will calculate and they will not touch this, they will just change this, and they will make it 33% of this total value. So they will change this formula, this total value, and this, and try to make it 1/3 of total value. Now I have clicked. Now you can say this has been 37.5k. Okay, this is what, this is 33%. If you can see this, okay, 33 point, exactly 33.33% they are making it, and now the amount has been increased by 12.5k. So this is why this has been recommended. Do not touch and do the changes from your hardcore entry and hardcore amount which you have calculated in particular table. So that is why, I hope it is clear to you. So nobody touches such kind of thing. So this is what the total fund. You cannot say I want to change, I want to pay 1/3 of total fund. So if you want to pay, then you have to calculate, don't, without touching this. So this is the main reference. 1000 is 1000k is our main total fund. If you want to pay 33%, then click it like this, 33.333. Okay, so now it has been changed. Then these guys will adjust their figure. They will say, okay, I will pay this much. Okay, now again they can say I will pay then I will pay this amount. Like this, maybe it will work. 266677, maybe this one. Okay. So whatever, so like this you can do the changes manually so that you can match it to 1000k. So like this you can change it, but don't directly change it by without changing this figure, so then that this figure will change. But if you want to change this figure, then you can use that formula too. So this is the okay. Alt F formula. So we are doing it untick because it is what has been recommended. If you tick it, it will be a huge problematic while creating financial model. We link so many different sheet with each other. If you enable this, then sometime it will give you the value which is not accurate, but it will automatically change it and make it correct. So you might feel it is correct, but it is actually not correct because of this enable option. Okay, so we will keep it as it is. Okay, now so now we want to learn about this working. So this after this you can keep all the setting as it is, as you can press space and check this and keep your system as it is. But this R1 C1 referencing style, I will tell you what exactly this and what their meaning is. If you I'm not clicking it here now right now, just see this. This cell is H8, right? You can see this here, it is showing H8. Manually we can make it Y6 or something. It is possible? Not possible, right? They are directly throwing you out to Y6. Okay, now if you want to go to A5, see this, you have thrown out to A5 like this. So if wherever you are clicking, that has some reference E and 3, E3 is coming. So this is something which everybody has in in their mind. Then when I'm clicking on G, then this line is 2 and this is G. So this is the reference. This is column 5, column 7. You can see this. We were understanding about formula. So now we will understand what is RC R1 C1 reference. Click tick and press OK. Then if you see that R1 C1, so this one is, they are considering row 1 and column 1. This one you will see row 1, this is row is always 1 till we are here. Okay, and if we when we go down, it will be row 2, and this one is C, column is been considered as in C. So earlier it was A1, A2, B1, B2 like this, and now it is R1, C2. So basically this is the issue, because we are used to understanding like this, maybe this one E or E5 or something like that, and this one would be F5. Now it is column 6 and row number 5, so that is why it is saying R5 and C6. So I think it is clear to you. Now we will go back to another topic. So formula setting is done. For proofing we will not touch anything. For save, keep it as it is, and if you want you can change this one. Save auto recover information, we want to keep normally. We all want our data should not remove, so keep the auto save as a 1 minute. So every 1 minute they will save your data. So whenever you close or somewhere your Excel got hang or something, you have to close this and restart. At that time data will not lost more than 1 minute. So normally it is recommended to keep 1 second. If Excel is not giving because there is no option to change it to second or something. So the minimum is 1 minute, so every 1 minute they will save your data, so your data will be always updated and saved. So auto save is very much important, specifically for financial modeling, because what we are doing is very important. If we miss anything, it take a day to find those kind of issue or something. So for that is why I'm also giving you all the industry standards, so that you will also don't face such kind of issue. Earlier when I used to create financial models, If I found some issue in particular sheet or something, it take huge time and irritation for finding those issue. So entire night will go out while finding that issue, so that is very difficult. So that is why I'm keeping you all my learning, and the mentor who taught me all these things. So I'm keeping all these things so that you can also learn and stop avoiding such mistake which we have committed. The leader and the person who is more effective and he want to do something great in their life, so it is better to learn from others mistake, no need to commit mistake. Okay, so that is why, so keep it 1 minute and just all the setting you can click a space and save it, or if you can review, you can review it whether it has changed or not. Okay, so keep this as it is. In language there is nothing English, whichever English you want to keep, you can keep. Okay, in advanced there is one option which is after pressing enter move down or not, like for example, if you will remove this right, so or up or left as you want, it will be happen. So what they are trying to say, let me show it to you. So for example, from here we are here, so we have written something, and then if you click enter, it will go down. Okay, so if you change there and select after writing something or adding number or something, if you want to press enter, then it will go this side. If you want to keep it as it is, so it will be remaining there, like I kept it, and then if I press it, so it will remain here only. So like this, wherever you cursor you want to keep, you can keep it. Okay, so this is the basic setting. So I like down because from day one I'm using this Excel. When I write something and press enter, it will go down. So this is what I'm used to. It is optional whether you want to keep it as it is, or you can change it as per your requirement. In custom ribbon, we don't want to do any changes. It is suppose if you want something in your new tab, so you can have to just click here and then add in, so it will be added to your main tab. Okay, so this is something I am assuming this all you all should know all these things. If anything out of this which is for example, insert table is here. If I click add, okay, add into where, if you want to click, these are the tab already available in the insert table. You can see insert table, insert illustration. So all this thing already available, so which is already available, if you click add, so this kind of prompt will come. Okay, quick access toolbar, you can also similarly like click here and then add, it will be added. Okay, so these are the things based on your requirement, you can add it. Okay, so now I'm not going to change anything, I will keep it like this. In add-in, normally analysis tool pack, okay, it should be available in your Excel sheet. Okay, since it has been already added, I don't need to do anything, but just you need to select this and click okay, it will be added. Data, I have data analysis already. Okay, I have what if analysis, etc. Everything I already have, I don't need this. But if you have not added your this data analysis, you just click here and press ok, it will be updated. Okay, one more thing, this analysis tool pack is in active application add-in. Okay, you can see this active application add-in, sometime it is not available here, so you need to go there. Okay, Excel add-in and click go. Here you have this X, this one all. So there might be, this might be untick at that time. If you have this, so you can say you can see this data analysis tool has gone now. Okay, so now it is not available, you can see this in active application. So for that you have to go there and select. Okay, this analysis tool pack is very much important for regression analysis. Since I have updated, you can see this, it has come now. Okay, so that's it for today. We will learn this Excel sheet into the next session. Thank you very much. Hello everyone, welcome back to IBS. So now I have taken one sample data of employee, and then we will learn few things so that we can get more user friendly with Excel, and few things which is might be very important for you. So if you click Control plus, just like this, select Control plus, then this column will be blank and new column will be added, and the rest all data will be shifted to right side. Okay, now one thing, if you want like a first name here, okay, and last name here, so what how easily we can do it? So simply for that, first name we have to write manually. First name if you have written manually, then all you have to do is Control E. You can see all the first name has come now, right? So you can also do it in different manner. You go to data, okay, or sorry, we are not supposed to use mouse. So click Alt, okay, then you can see there is a, and from A you have to go to flash fill. Okay, so click double F. First we need to delete this, then we need to select this, then click Alt, okay, Alt, then A for data, then for flash fill we need to click F. Okay, look, it has updated. You can see this, right? So similarly, if you want last name, for that first one you have to write Davis. Again, either you go by going this data and then click on flash fill, or you can directly select Control Shift arrow up. It will be selected all entire data. Okay, then just Control E. Okay, so you will get all the data. Also there is a control. So if in case there is, if you can see this is thousands of implied data, it is not easy if you manually write, or you use some other way like equal left. There is other option also left. And then you have to give some, suppose you want 5 digit of left data. So what they are doing, they are taking from left 5 digits. Since name has no compulsory that after 10 there will not be first, or if you can see there is 5 digit, there may be 7 8 digit, there is 4 digits, so there is no common option, so we can get this data like this. So that is why this one is a very simplest way to get accurate data. What, how it is working actually is, Excel has been designed to sense and understand the data and accordingly update. Okay, and one more thing, just a simple Control D if you want to paste above data, whether if you, even if it is written numerical, if you press Control D it will take it. Okay, Control D, just Control D. Okay, this is also one of the short form which I wanted to share. Okay, now if we want like there is employee and his job title and his department, if you want data department wise, you can also do like the Control Shift L, and then you can filter it by department and you will get your data, okay, like this. But if you want only employee ID, employee name, and maybe department, like this if you want, you can use VLOOKUP. Okay, so for example we have this data in hand. Okay, forget this. Suppose we have this data and we want how many of them belongs to particular department. For that you have to do this. So we have all the data now, almost 1000 line item. We want only who are the employee belongs to IT department. Okay, so for that we can use VLOOKUP. Is simply click equal VLOOKUP, it will come. You can select this and select unique number. So employee ID is unique, it will not be used twice or something. So like this you can also click function F4 if you are using laptop. Direct F4 if you click it will not work. Okay, so that is why we will click function F4. Okay, you can see there's double dollar sign has come, so it has selected the data. Now if you can go to that sheet, whichever sheet has all the information, so you can directly select like this, control space, it will be selected entire line, and then shift arrow right side. So this is the data D which we want. Okay, so which column it is number of column is 4, first, second, third, fourth. If you want this data, if you want this data, you can select 5. Okay, so since we have selected this, okay, and now again we will do function F4 to fix this. So since we want this data, so we know this is at the rank of 4th column, so we'll give comma and then click 4, and you can close the bracket, so it will find you the data for you. So also you have to select 0. Okay, like we have select given 4 is the row in which we want data. As you can see, this is the first, second, third, and fourth rank we want data. Okay, and then you give 0. Okay, 0 is true approximate match. If there is anything is approximately matching, then it will take that data. If you keep it 1, you can see that it will not pick few of the data. You can see this. We want to know why exactly what happened. You can see this is the data. Okay, now if you go and check, okay, there may be some reason it is not finding, maybe if they have a space or something like this. Okay, so that is if it is not exactly matching, it will not take. Okay, so for that reason we give 0. Okay, if it is 100% matching, it will take, otherwise it will not take. So that is why it is better to give always approximate match. If there is close match, it will also pick those data. If you make it 0, and then if you press Control D, they will automatically update. Okay. So now it is not matching. Maybe I have given a space over there. Okay, yeah, this one. So now you can see. So now if as we want only the data for IT, so you can deselect this. Sorry, select all, deselect IT, and we can remove those data. And simply shift space, it will select your all arrow, and control shift arrow down, so it will select all your below data, and simply control and minus, so they will remove entire sheet. Okay, now control shift L, it will deselect. Okay, and now you have only IT related data. Okay, so if you want to update there, now anything if you want, for example, we see, we go to that sheet. Now we want to know about their gross salary. So you can also VLOOKUP it for gross salary equal VLOOKUP like this. What we will do, we will click equal, then again VLOOKUP. You can select this, and you can select this one. Okay, or else you can go like this and control space. It will be selected. Then function F4. If you are using laptop, if you have keyboard, you can directly click F4. Then press comma. Now we can go to another sheet. In this sheet you can directly like this, you can click, or if you are going from here, you're going here, so somewhere your tab would be, so you can directly control and arrow, then control space. So from control arrow you can directly go to the left side completely, and then control space, it will be selected. Now you can go press shift and right side, so you will be going to this side, and left side, for that you can place arrow for this side. Okay, so this side for that, so based on arrow, whichever side you will click, it will go accordingly. So now we have data at J, as you can say annual salary. Okay, so it is 10C, so we'll place comma and then 10C. The column is 10, so I have to click 10 again, shift bracket close. So now formula is closed. Or if you want, you can again function F4, you can fix this. Okay, now you can fix it, or I can say freeze this, so that your formula will not be able to change easily. Now press 10, then bracket close and enter, so you will get this data. Okay, now you can directly control and arrow down, control and arrow up. Now all data has been updated. You can see there is NA. So why this NA is coming? Can we see this? Go there, find it. For finding also, you just need to control F, it will come, and then control V, and then press enter. They will find data for you. Now shift space, you can see what is the gross salary is 2,31,000, or we can say 231K somewhere around. So this is not updating. Okay, so why it is not updating, but when it is the same thing, so for that reason we can give comma and 0. Approximate information, if it is available, they will pick. Now press enter. Now if you go there, control D, you can see that they have picked the information. So what information it has picked up? Now we can see this 2,31,000. So 231K somewhere around 231K. They have picked the information. Okay, there was one more information, right? And this one. This one we can also check what information it has picked, whether it is correct or not. If you have this selected, they will not find. So deselect it. Sorry, control F, enter. They will pick you to that side. Okay, you can see 1,159K. So you can see 159K. So it is picking the right information. So this is how we look up work. Sorry. Now to understand H lookup, I have this sheet which we use in performance analysis. H lookup is very much useful as soon as we can change the date, like 31st March to June. If we select June 23, that will obviously easily they will update all your data. You can see all the data has been updated, or also your budgeted data has been updated, and your variance is also ready. All you have to do is you have to update your actual data and your forecasted information. If you update this and just change here, you will get all the updated information. All the variance and everything is ready in just updating your data. In just one click, your all the information, all the variances and their percentage, and what are the issue factor, they are also highlighting all those things. So this everything is automated. So everywhere you can see that HLOOKUP has been used. Okay, most of the cases. So why we are using this? So first understand the actual information. In actual, you can see we have yearly data. Okay, and then splitted this into all the quarter. So for India, from January to March, I am taking one quarter, but in India, from March to Feb is our April to March is our financial year, but other country there is January to December. So I'm taking it as in January to March, and March to April to June, and then July to September, and September. This is quarterly data, and this one is quarter one data. Only this data, as you can see this, you can click a space and you can verify this data also. For this one, June, from 1st January to June till then, whatever the data is, if you club together, you can see 11,167. This is the information it is coming. If you take 3 quarter data, it is 16,814. The same, it is calculating all the 3 month information. Okay, so like this, you have to update your data. Forecasted, we will do the same way. So whatever the annual budget we have here, and whatever the quarter budget we will have, we will update here, and then it will automatically calculate your year to year information till March, till June, then January to June, January to September, January to December, all the information. So here we have first annual data, and they have first annual data over here. Also we need to update the reference. reference is required for H lookup. So now if you go here, for example, we want to update the revenue for January, December. For December, if you change it to March, it will change. Okay, it will also change for this. So if you see this, one thing is common, which is the date. From date, it is picking all the information. This budget one is picking information from forecasted data sheet, and actual is picking information from this actual is picking information from actual data sheet. If you can see this. Okay, now I will click function F2 to show you the data. Now what I did, I have just selected H lookup, and then I have selected B3. This is the B3. B3 I have clicked function F4 to freeze this. If you can see that dollar sign is both the side of B, then B is completely fixed. Okay, then I will select the actual. So then he's asking from where you want this data. So this is the main reference for 31st March related data from where you want. So we want from actual, that is our master data. So actual D4 to G16. Let us check what is D4. This is the D4. Okay, this is the D4 data reference I'm giving them, and G16 till here. So from here to here I have given him master data. From here you will pick the data whichever is matching with 31st of December. Okay, and this 31st December belongs to, how he will understand, they will understand by this reference number. Here we have reference number 1 2. So if we click 1, suppose not, you not need to click 1, you have to give them column reference number O4. So if we select O4, he will understand for, based on this information I have to pick information from here. So likewise you can see. So master, this is the period from which we want the data, and this is the master data from where we want to collect our data, and this is the reference so that it will match. This is O5. Okay, let's go and check O5 in actual. Where is O5? This is the O5. So now he will pick data from this particular raw. So this particular raw has in March which data? This is the data of March. Okay, so that is why he is picking revenue amount here. Okay, so this is how we can work. For this one you can see this is O5 and this one is O6 simply. So O6 he will pick similarly for 31st March related data. So let me use this formula H lookup. It is working for me now. Now I will select this data for this particular period. Then I have freeze this. Then I have to click comma. Then I will go to actual. Then I will select this entire information. From this data we want my data. Then I will press comma. Before giving comma, I can again freeze this. Then I will put comma. Okay, now I need to give him the reference. He is asking which raw index you want data. So I want index data, this one. Okay, O6 is the data we want this data. Okay, we want 105. So that is why I will give him this index reference. Okay, then I will press enter. You can see it has picked up the information. So like this, pardon me please, like this you can control shift arrow down, and if you click control D, they will update all the information to below. For reference, I will see this 1588. Now control D, let's see it is coming same or not. No, it is not coming the same. Let me see. Okay, I found the issue. If you can see this D4 and G16, if you will not fix completely, if you fix partially, the information will not come. D4 also I have freezed, and G16 I have also freezed. Here you can see D4 is not freezed, G4 is freezed. So that is the reason it is not picking. And now you can see it is completely freezed. Now if I control D, you can see 1588 the correct information it has picked. Now see into the actual sheet for March 31st data. Actuals March 31st, actual gross profit 1588. It has picked up correctly. Okay. Now I will control Z to keep the same format. Okay. And also I have given this drop down. As you change this, okay, you can see this information has been updated. Now we can see whether it is correctly picking the information or not. For gross profit for 30th June, is it same or not? Go and check. You can see 2077 2077. So it is picking the correct information. This is how HLOOKUP works. Okay, so you can use as per your requirement. You can also use. Okay, I think I'm done for this HLOOKUP VLOOKUP. Now I will go and work based on our financial modeling, which are actually required. So now I have taken the blank sheet. First of all, what I will do. So now I want to change this some basic formatting. First I will click Alt, then I will go to data. I will go to view. For that I will press W. Now we can see we are in the tab of view. Now we want to remove this grid line, so I need to click VG. You can see it has gone now. Okay, and now if you want, you can update any picture or something. Okay, so any picture if you want, you can update it. I have my, okay, this one I will keep within the three column. Okay, like this. Now I will give the name of this company. Okay, and okay, remove this. We already have. And the most important thing I will do, I will select this, then right click and change the column width. It must be 1.15. Hello student, welcome. So now we want to plot this financial modeling. So first what we will do, first of all you need to update your currency, which is very much important. Our currency is INR, and in currency in million, billion or in CR. So for India we keep things in CR. First we will hard code this, okay, and then we will give the financial year 2020. Let's take it hypothetically, then add 1 like this. So if you do like this, then it is easy to drag down and you will get all the years. If you will change here 2019, so accordingly this all are being updated. So this is the method. So normally try to reduce hard coding as much as possible. We can also manually write it like this, but it is not recommended because these all are completely hard coding, so we want to remove this. And now we want to know whether we suppose we are in 2024, so till here we have historical data and these are our projection. So how our viewer will know whether these are the projection and these are their hard coding, these are their historical number. So if you write here actual like this, and then till here if you update actual and these are forecast, so this will not look professional. That is what I'm trying to say. You are not supposed to do in that way. Okay, so we have other method which we will use. What we can do is we can select this and just press Control 1, nothing else, Control 1 and arrow down, go down to custom. In custom setting you have seen this, after general there is 0. In 0 what we need to do, click here, after the type there is 0 has been written, give a space, then double comma, give a space, then write a, then double comma, like this. If you do and press OK or enter, whatever it is, you can see this has come now. Okay, so this is here you will see just written 2029, but in this section, in this tab, you will get a written automatically, like. So this is the indication, this is the actual data, okay, and these are the expected estimate or forecast. So we can do the same thing for this also. Control 1, custom, okay, 0. If you already have updated something, that will come here, okay. We can select from here also, comma, we'll keep forecast, F for forecast, okay, then double comma, close, just click enter, okay. And now you can see this format is not unique. Somewhere it is little bit high, these are in between, this is little bit wider. So we want to keep everything in same standard format, okay. So that is also one of the important things. So what we will do, I will press control space, okay. You can see this one column has been selected. So from here, control shift right arrow, it will bring you completely end. We don't want this, so we'll go shift arrow right one by one, like this. Once we have selected, there is two options, either control right click and column width, we can update 10 here, okay. And another option is press alt H, okay. Now you can see all the option has been opened. We want to go to format. For format, there is O, we click O. Now we have auto column width. If you select this, then whenever you have your line is higher than the column, it will increase, okay. So we don't want this, we want everything should be standard and similar. Here I will update 10, okay. So all column are 10, or if you want, you can keep it in 8 or whatever it is suitable, but I would recommend keep it 12. Sometimes we have a huge number of amount or something, and that time it might be difficult to keep on changing. So, and these two I will update 15. So like this normally we do it, okay. So point here is why I make these two column bigger, because in particular we are going to write about all the income statement related stuff like revenue and all. So for that reason, there is text, there may be chances it will need a huge, it will need some extra amount of space. That is why I kept it like this. And this one column I have kept blank, so that if you write something bigger than this text, so it will cover easily, okay. So you will feel it is looking good or something like this. So still we have not completed formatting, just we are trying to start our plotting. And one more recommendation, you and we should try to create our financial model from scratch by ourselves. If you are getting some financial model from somebody else, so you may not understand how he has plotted things, okay. So if you are creating a financial model, so this thing will be in your control, okay. So it is better to create financial model by yourself, okay. So now what we will do, we will select this, okay, press Ctrl B to bold it. So what I will do, I will select this, press Ctrl B to bold it, and now press Alt. And now we want to change the color of this heading so that it look visible, right? So we'll press H, home is open. Now press F, FC for text editing, color point of view, and H for, so we'll press H to change the color of that complete box. Okay, either you can go by arrow like this, okay, to select this. Suppose you are here, so you want to go like this, you can change whichever you feel good. Try to select darkest one as much possible. So I will go by M, more. I will select this, the dark one. This is also dark, but I normally prefer this or this, okay. You select this one, or you can also go by arrow like this also, okay. Now press okay. Now we got this. Now we want to change the color of this line. Alt H, FC. Now we want to change the color as in white, so it will look visible. Press enter. Now we have done with the formatting. So, and now we want to freeze or unfreeze this. In view you have freeze panel, first unfreeze. I want to freeze this because if I go down, so I want my format should remain same till heading at least, Okay, so I will select this. Okay, I will press Alt. Our option has opened. I want to go to view, then I will press W, and then I want to go freeze and unfreeze. I will press F, and I will select the first one, F. Now you can see this has been freezed. Also, they have freezed the right side. If you go this way, it will again available. Okay, so wherever your cursor is, accordingly it will freeze your data. So for example, if I keep it like this, okay, now if I go to freeze panel and select this one, I have unfreeze now. If I select to freeze this, you can see this is saying from the cursor from where I have selected to left side and above side, everything will be freezed. If I click here, now you can say there is a line for freeze. There is also one more line to freeze this. If I go this way, first column A will remain forever, and row from 1 to 7 will remain forever. So this is what exactly we want to freeze. Okay, so this is done now. Okay, so now we are ready. So we'll plot our income statement. Income. If you are if you know about the income statement, you can skip. I'm just writing it. First it will come revenue. Okay. After revenue we have cost of sales, or we also say this cost of goods. Okay, after cost of goods we got gross margin, or we can say gross profit. After gross profit we will get our operating expense. I'm not keeping it short. After operating expense, we'll have EBITDA. Okay. After EBITDA we have depreciation. I know many of you already know amortization. After amortization we will have, let me check, operating profit. Okay, we can copy this, we can paste it. So in when we are hard coding this, we should not directly paste it like this. Okay, this is not the right way to do. So what we will do, we will press, we'll go to that particular shell, Alt E S and V. We will always paste value. Okay, if you want to paste value, if you want to paste only format, then we will paste format. Let me show you how. So this is the income statement. Okay, remove this. You just need to control shift and minus to remove this. For example, if you want to control C, copy. If you want to paste as in format, Alt E S, and you can click F, it will go there. Okay. Formula. If you click OK, you can see there is 2 bold, so 3 bold has come. He is trying to copy the format as much as we have copied it. So there, when and later on it will come to you when we will be going to do this. I think expense we will keep complete name. Okay, so now our income statement is ready. We will plot some imaginary number so that it look like real income statement. For example, 50,000 is revenue, and our cost of goods is somewhere around 20, and then our gross margin is simply 50 minus 20. This is our operating profit. Now we have operating expense to manage this business, so maybe I'm assuming 10,000. Okay, so we'll reduce this gross margin, then EBITDA, you will get your EBITDA. Okay, then we are assuming our depreciation is somewhere around 2000. Then after depreciation, what is the profit? So EBITDA minus your depreciation and amortization expense. So this is your operating. Then we have some, maybe we did some investments, we are getting return. We have some interest expense where we are paying to interest. Then we are getting our EBT, in earning before tax. In this we'll add the interest income and we'll reduce the interest expense. So now we get our earning before tax. As we are assuming tax is somewhere around 30% or something. So either you can select it and like this, and 0.3 30% it will coming and will, but now we take a hardcore number as an imaginary number of income tax. So after tax deduction, we got our net income somewhere around 12,700. Now similarly, we'll plot this one also. What I will do, I will just put 5% higher side. Okay. Now I will. This is just an imaginary number. I have pasted as a value. So now we have 2 year actual data. We are considering this is our actual data. Okay. Okay. Now we'll keep this at 30%, because there is no data which is in decimal or something. Okay, so now if you select this, now you can see that there is okay, there is no decimal. Let me put it like this. So now we have some value in decimal or something, so which we want a standard conventional format. For that, what we need to do, we need to select this data. Okay, and then control 1, this format box will open. Then directly go to decimal, and we can also change it from here. We can change it to decimal to 1. So if you press OK, so they have converted this, but we want some another way. We have some other thing to do also. That is why I'm not using that. We are using this one. Okay, so in this you can see there is a semicolon and then a space. So what I have selected is for negative number, and what they have is for positive number. You can see this 50,000, it is coming. So after every 3 digit they are giving one comma. This is the US rule. So that the same thing we all follow here. So now I will press, but in minus whatever figure is coming, we want this into what you call is in bracket. Okay. So what I will do, I will remove the negative sign, and then I will press bracket. Okay, and will press dot 0 here. Also I will give dot 0. We want for 1 digit number, that is why I have given 10. If you click OK, so now they have selected this. If we make any amount in minus, okay, this interest income we can take it to minus. You can see this. Now just that we need to change this plus this. Now you can see that if it is negative, it is coming in bracket, and they are also taking 10 after the dot, and everywhere it is the same standard. So the similar standard is being followed entire industry. Okay, that is why I wanted to represent here. Okay. Okay, now this entire data is not hard coded. Few of them are having formula like this one. Okay, so we'll bold all those places. So as we are seeing, somewhere we have formula like this one, like this one. I'm making it bold. Okay, this one. Okay, copy paste this. Okay, now we have corrected this one. Okay, now this. So the industry standard is there is color convention. So whatever number we have in formula, so that will be in black. Whatever hard coded, that must be in blue color. So whatever it is, we will either we can do this way and change the color to blue like this, or we have directly we can do it through without using our mouse. So there is another method which is more effective and better. Select all and then give the color. Okay, simply we have color everything, but we want all the formula should be black. So what I will do, control G, your go to will open, go to special. In special we have formulas. Now click OK. So whatever formula is there, it is highlighting. Okay, so this is how when you create your financial model, industry, the person who is reviewing your financial model, they will use this matrix to audit your financial model. So now this way we have changed like without doing the laborious work. So manually we have not selected each and every column, and then we have updated one by one all the color coding and all. So there is another one more thing I forgot to tell you. When you are we are changing a particular color. Okay, so if you change this once, and now if you select this, and if you have keyboard, directly you can press F4. If you have a laptop, you have to select Control F4, sorry, function F4. So that will copy paste the format. So likewise, if you again select and create F4 like this is keeping the format and copying the format. So like this also you can do it, like if it was available like this over here, this is in black, and first one you have selected like blue, and now we have format is ready. So if you can select this second one and create function F4, this will change again. You can select this one, function F4, like this you can update your color coding convention. But I have given you another method which is more effective. Just select all and change the color, and then go to control F, control G, you can go to, and in go to you can go to special. Also if you click tab, it will go, it will take you. Now press enter. Now you can go to your formula and click OK. So all the place in the entire sheet, whatever sheet you have, the formula where formula is being used on, that is not hard coding, that has been highlighted. So if somewhere you have a wrong color or something, so it will like this financial model is being reviewed or audited. So now it is highlighting all the color which is has all the highlighted are in formula. So formula should be in black. So now you can directly go there and, as I told you, select black and it will be changed. So if you do this way, that will be helpful and easy to do it. Okay, so now since we done all this, now we'll go for a little bit advanced version. In this advanced version, what we will do, we will try to take some assumption, and we have data for 2023 to 24. Based on that, we will try to predict from 2024 to 2028. Maybe this is too much, we'll reduce one. Okay, so we are still running in 2024, that is why this should also be in the forecasted one. We are assuming in 2023 we are working for 2024 to 2027. Okay, so for as of now we'll delete this data. We have the similar data over here. We can copy paste. First of all, we have this is imaginary data. When you are actually preparing financial model, you will get data from various different method. Either in which company you are working, that company will provide you entire data first, and second, if you are working for particular client, that client will give you every single data. and if you want to copy this and if you paste it here, it is very easy to paste. Okay, but what if this line is similar in this case, right? If it is not similar when you are getting data from client or internet or from your company, so you have to plot one by one like this. Select and then you have to take data, which data this belong to, and then like this you have to plot each and every line item. Like this we can update data. Okay, so now again delete this. uh, we'll post this. We want to post this as a special. We don't want to just control C and control V. This will bring their formula, their color and everything will come, but we want to paste this as a number, as number only. No formula, no color, nothing. So for that, what you need to do, you need to select Alt ESV. Even though if I will paste it, it will take color. Why they are taking color? Because this format already have all the color enough. Okay, so for that, what we need to do, you need to, okay, you select this has this particular tab, or maybe anywhere you can copy. This tab doesn't have any format, so now if you paste this, so format will go out. Now we'll copy this. If I paste now since we have removed all the formatting and all, if you paste this, it will be directly coming and blank. Now you can see since we have removed all the format, so and as per US convention, our decimal must be for number in 1 digit, and our percentage decimal must be in 2 digit, and a number should be after 3 digit comma should come. This is the US convention which everybody is follow, so we will follow the same for that purpose. So this one just wanted to highlight you how can we remove format and all. So now you can take the same data along with format. I will not paste like this, rather I will copy the format and I will paste the format here. Okay, now we can check it. Control G, go to special and select the formula. It is okay. Okay, since we have no formula now, okay, that I have changed it just to make you understand about the how to remove format and how to paint the format and all, and how to do the paste special, etc. Now we can copy this. We want color, and we want the US convention, as well as the number should be in 1 digit after the dot, and percentage must be 2 digit. Okay, now since you can see that formula and all has been pasted, again we, if you check it, control G special, select formula and press OK. Now he is selecting. If you can see, all the formula, wherever formula is, they all are black. So we are good to go till now. Now we will do the plotting with regard to assumptions of balance sheet. Based on those assumptions, we will try to forecast. Okay. Okay, so now I have updated the assumption driver. One more thing I would like to talk about. This one, you are seeing everything is starting from left to right. When we write in book, we also write from left to right. Okay, so this column will remain like this, and numerical form, all this kind of data, that should be from right to left, like this, as we have. Okay, similar format we are going to follow. Okay. So now we will calculate about revenue for 2022. Sales growth or revenue growth would be nothing. So year 2023 we can calculate this. Simply this divide by this, then minus, we got it, 5% is the growth. Okay. Now cost of goods sold is percentage of revenue. So he is trying to ask what is the percentage. So cost of sales divided by your revenue, we got this 40%. Operating expense, it is not mentioned as a percentage of revenue or something, so we will hard code it. Okay, 10,500, 10,500. Okay. So this one also we can calculate similar way. This one 10,000. Okay. Now depreciation is percentage of sales, so we'll take the percentage of sales. Depreciation divided by revenue. Okay. We copy paste this. Now interest income, we'll keep it as it is. Okay. Interest expense is also not percentage, we'll keep it as it is. Okay. Now taxes, we are assuming taxes 25%. Okay. So now our assumption is ready. So did hard coding? Yes. So wherever we have not, we have linked or something, we'll change it. Okay. So we will try to link as much possible. We will always keep in mind to remove hard coding as much possible. Okay, like this, like this. Now both are not hard coded. Okay, these are linked. Again, this one is also linked one. This one is also linked. Okay, this one is also linked. This one is hard coded. Hard coded must be in color. So will directly you can select this or you can go from here like this. Alt H for format. There is a format painter. You can see. So you can directly click FP. Format is painted. Now you can paste it here. So this one has been pasted. But as per US convention, percentage always keep 2 digit. We can do it like this. Okay. But since we want to avoid using our mouse or something, so we'll not do this way. Okay, we'll try to do it using, okay, like this. It was like this. We want to change it without using mouse. Click Alt H. Home will open. Now we have percentage. If you can see, this is P. We click P. Oh, percentage has come. Again Alt H. Now we want to keep this 0, so that we will have a decimal of 2 digit. So if you press 0, you will get 1 digit. Okay. So like this we can update our format, and these all are must be into the right side. So now after decimal there is only 1 digit. Okay, so this is also correct, and minus is also coming in bracket, and all manually hard coded this one. So this one also be green, so we can directly copy the format and paste here. Okay, and then we can, so now the formatting part is done. Okay, we will try to estimate for future. So I will keep the same. Okay, so since why I'm keeping this same, because as I said, this is for learning purpose. This is not your actual forecast. I am assuming we have given data, forecasted data is been given to you. You are learning to how to plot based on given data. That is why. So forecasting we will learn, but not now. Forecasting we will learn later. Now our intention is to learn about the formatting. Okay, so that is the reason I am keeping it simple as it is. Okay, hello student, welcome back to IBS. Now we are going to learn about common size statement. I have created this format, okay, to save the timing. Okay, so let's delete this. As you know what we need to do for this, all this, right? Just we want to update this net income. Okay, just ESB, we want to paste value only. If you directly paste Control V, they will be pasted like this, like all the background information, like, so if you paste directly, then the header and all, it will come, like border and header, everything, and if it is bold, if it is not bold, so everything will come. So we don't want format, we just want simple data. Okay, so that is why I have pasted a special. What is common size statement? Common size statements normally try to calculate in percentage terms to all the items of income statement based on revenue. For example, cost of sales or cost of goods sold, how much this is the percentage of total revenue. Net income, how much the percentage of net income of total revenue. So this gives a lot of information. So let's take this. First I will take revenue. Okay, then I will divide by revenue. So revenue will be divided by revenue, so it will always come 100%. Now if we click this, this will be 100%, but we don't want this way. So what we need to do, so if we press enter, you can see this is coming 1 is simply 100%. So what we will do, we will change the by clicking function F4. Now we have blocked the revenues. It has been blocked row level as well as column level, but we don't want this. We want to block in this way. It should be blocked so that it, when we change a particular column, so it must change, but row level it must be blocked. Okay, so that is what we wanted to do. Also we will change their formatting, so we'll click alt h. For percentage you can see p. Okay, so now we want to give as per convention rule, percentage should have 2 digit, okay, after the comma or dot. So what we will do, alt h0, alt h0. Okay, it is coming now. So this format is correct. Now we have given correct formula or not, that also we will see now. Just control V. It is calculating correct. A percentage is also calculating correct. Somewhere it is doubtful. Let's see if we calculate manually whether it will come correctly or not. Interest income, yeah, this is something wrong. I mean, we have updated wrongly manually. It must be 800 in minus. Okay. So, okay. For example, we may check EBITDA this whether they have calculated correctly or not. Function F2. Okay, go up and check. So EBITDA, they are dividing EBITDA I14. I14 is above, and then they are dividing by I10. I10 is nothing but our revenue. So as you can see, when he is changing the column, but it is not changing the row for revenue, and other item they are keep on changing based on the table in which it is available. For last also we can see it is picking the correct net income and dividing by revenue. Okay, so I hope you understand it. If you put dollar in between D10 in between, if you put dollar, so they will hold a raw level. Okay, but column level it is keep on changing. Okay, so like this you can also try. While I'm doing, you can also try by giving dollar like this, function F4. If dollar is just a starting point before the selection of column, then what result is coming. So like this you can play around and understand more and more. Okay, now we are done with common size. So now what we will do, we will select this and we'll go alt, and we want to update this to group this, so we'll click W. You can see W is not the correct answer. Now again we'll click R. You can, if you place escape, so you can again change to home. Okay, like this. Like if this is where we can see these are the information is not matching, so now again we can keep a space and we can select A. Since we have checked W and R, now we want to check data. In data, can you see somewhere it is showing group or something? Yes, it is showing group. Okay, so even if you don't found here, so you can again escape, but still alt is active. Okay, now you can click on M. you can again go to your formula. So here you can also check. So like this, if you are you are not supposed to click this and again unselected information. Now don't need to escape twice. Just if you have press alt, it will remain as it is unless you press escape. If you have by mistake, if you have clicked on B pivot, power pivot has opened. If this is not the relevant for you, you can escape just one time. So again your alt is active. Okay, so now we want to go to data column. Okay, we have a group here. Okay, we want to group this, so we'll click G. Okay, and one more time G. So now you can see this has been grouped. Okay, to ungroup also you have similar format. You also want to group this, select this one like this. How we can do? Shift space and control shift arrow down. Okay, so if you click here this tab and then shift space and then control shift arrow down, you will go till the end. So okay, so you have to place your tab here. Okay, not in this place. Okay, if you press this, it will select till here. Okay, so we want to select this information only, so we'll keep our tab here, then shift space and shift control shift arrow down. So now it has selected. Now press alt A for data tab. To group we press G and again G, it will be grouped. Okay, if we want to ungroup this similar way, okay, alt A G, sorry, not G. To ungroup we press ungroup U and again U. Two time if you press U, they will ungroup. It has not ungrouped yet. Let me check. Alt A U. It is ungrouped now. Actually, I have grouped it two times. That is why. Alt A. Okay. Now it has been grouped. So it is very simple. Alt A G G like this. If you keep on practicing, it will be very smooth for you. Slowly you will be expert in this. So I hope you enjoy this. We are done for the day. We'll see you into the next session. Thank you very much. Hello student, welcome back to IBS. Now we want to do scenario planning in case of different situation. What would be the result, or we can say this change analysis. Okay, so what I need to do, I need my income statement. Okay, so I will copy this. Okay, then I will keep one row vacant and then I will paste directly. Okay, so now we got all this, but actually we don't need this. We only want formatting. Now if what we want to know, let me write it 10%. So this is hard coding. Again we will change this to this. Okay, so now this hard coding is in blue. Now we want, basically change analysis is we are trying to know in case 10% has increased, what would be our revenue, what would be our net income, what would be the impact of overall our income statement in case of 5%, in case of 10%. So immediately when we change this hard code number, instantly we will get all the result. Okay, so what we need to do, equal select revenue. Okay, okay. Now into bracket 1 plus this. Okay, this one we want to freeze, so we will click F4. Now press enter, or you can give bracket then press enter, whatever you like. Now copy this and paste this. Do you think this is right? No, we don't want to paste format everything. We just want to paste formula. So control Z, we copy this, we will select this. Now alt E S F. Okay, so now it is coming. If you change it to 5%, you can see this all information are changing. To cross check this, let's see whether it is 105% of total revenue or not. I mean total in net income or not. We will divide by net income. It's coming correct. Everywhere it is coming correct. Okay. If we change to 12%, okay, so this value is coming correct. Okay, based on net income. You can also one more time you can check it. I pasted here what the result has come. This is just 100 plus 12%. So we'll divide this 1.12. 112%. You can see same figure is coming. Like this also you can verify. So it means this is working perfectly. Okay. So this is our cross check. If you want, you can keep it. And you can, since it is cross check, we don't want to show this. We'll keep them like this gray, light gray, so that it will not be visible. Okay, so since it is reflecting what percentage you have selected and what is the result is same or not. If you want exactly same, you can update -1. Okay, you may not be able to see. You can see this is 12%. When your revenue is 12%, it is also 12%. Okay, you can see. Now we want to keep it gray color. Okay, so that it will not be visible while printing a particular statement. Okay. Okay, again we will group this. Okay. Okay, you can see without even showing anything, it has grouped. Since thing is hard coded, so it must be black. Now it is perfect. Okay. So now what we want to do, we want to check entire sheet is ready. Our change analysis or scenario planning analysis or common size statement is ready, assumption driver is ready, and also our income statement is ready. So we want to, so simply we'll go Control G. Okay, and you can click like Alt S, also it will open, or else you can Control G and then Control G then tab. If you click that, also you have to click 2 time tab. So, or if you directly click Control G and Alt S, it will directly open. Okay, so whichever you like. Okay, again I have told you before, you can see a borderline is F. So if you press F, it will go to formula. If you want to check constant, click O. Okay, so we want to check constant right now. So we have selected the constant and then press enter. So he has selected all the constant. Okay, so as we can see, everything is in blue other than this line. We want this to be black, and we'll see here we are getting error. We will check this place. All the hard coded are showing in blue, which is very accurate financial statement, financial model. We'll see this. This is hard coded. No, it should not be hard coded, because here I have to update this, and this one must be link. And that time I was having issue, right? So I have updated this. That is why. Now if we go Control G, Alt S, and constants, press press O, and then OK. You can see this now. Everything is, whatever hard coded are showing in blue color, which is perfectly all right. Now we want to check other item formula related stuff. So Control G, Alt S. Okay, for formula press F, then OK. So all formula are in black or not. If you can see, everything is in black. We have not have any mistake. We have not committed any mistake. Okay, so we don't have any mistake, so it is perfect. So I hope you enjoy this. We are done for the day. We'll see you into the next session. Thank you very much. Hello everyone, welcome back to IBS. Today we are going to learn about advanced setting of basic convention. Okay, so let's jump to the topic and understand it one by one. So first of all, as you can see, income statement, we want this to make it little bit automated, because if you are creating a financial model for IBS, now if you want to create a financial model for Reliance, Tech Mahindra, Microsoft, Google, any company, so for that time, if you will update here, all the heading of this model should automatically update it. And we don't want to update like this: income statement, Google, assumption, okay, Google, okay, like this we don't want to do, because we want to remove hard coding as much possible. That is why we will do something so that it will be automated and will be very easy for us. Okay, so now first of all I will copy paste here. I'm just pasted here like a value, not like this control C. If you do control V, it will be pasted along with their format, etc. Okay, so we don't want this. We just want to copy this and paste this alt es v like this. If you paste, it will be coming without any format. So now what I will do, I will press F2 and I will copy this. Now I want to update a formula here, equal, then double comma, in between this comma, okay, I will put income statement, okay, a space and dash, and then again one space, so that it will look good. Now I will just add and I will link with this tab. Okay, now you can see this is now showing as in Google. If I change this to Tata Motor, it will come Tata Motor. If there is TCS, it will come like this. Similarly, I will copy this, I will paste this as a special paste, then I will do, then I will copy this, okay, assumption driver. Now press equal and semicolon, okay, which is not copied now. So I will do function F2, then I will copy this. Now I will press equal, semicolon, and now give space, dash, space, semicolon, close, press and directly link with this step. So whenever we will change here, it will change automatically. Similarly we'll do for this. This is our scenario planning. Okay, so scenario planning we normally create to check if in case of a condition is changed, so what would be our net income and net profit, and what would be our revenue. So whenever we change here, we will get the result. I have already explained this to previous session. Okay, so it is working fine. If I press IBS, yeah, it is changing. So now you can see this is the financial model is looking so beautiful. Also, this has been created for that reason, like this. If you want to go to income statement directly, we can go by clicking control arrow down, like this. Like this we can easily switch. If you go like this way, it will take a lot of time. Okay, so okay, now we want to learn one more advanced setting, which is for common size statement. We want to check how many of item from here are below. For example, our income statement, out of all the common size, what are the item which are below 10%, below 5%, whatever it is. So we want to update and we want to apply conditional formatting. So now we'll go and check. Okay, for that you could press Alt H. Now you can see conditional formatting. For that we have to press L. Okay. So we want to highlight the cells. Okay, so what exactly we want to check? What below 5%, what are the item are below 5%? So we will select less than. Okay, now we have to update the amount 5%. Okay, also we want to do some custom setting. For that you have to select here and select custom format. Okay, now custom format will open. We want to change this to italic, and also we want to change the color of this. Okay, now if you press OK, you can see this. Have you seen this? These are still available as it is, just that their darkness has gone down and it is highlighting what are the items which are below 5%. So you can play around and try to apply different kind of conditional formatting that will be helpful to you. Now you can see these are all items which are not highlighted. They are showing in italic and brown, sorry, gray color, so which is that is what we wanted to do. Okay, all the percentage which are, you can check it if there is anything which is greater than 5% is picking or not. So it is not picking, so this is working perfectly fine. So there is a few more conditional formatting we can use. For example, if we want to use here, like we want to see how many of our revenue are greater than I would say 60%. Okay, so we'll select this data in which we are applying our conditional formatting. Or if you want to check our net income which is greater than 16,000 or something like this, if we will apply both the condition. Okay, we'll see this. Alt H. Okay, now again for conditional formatting we'll press L. Now we want to check greater than. Okay, so we'll select this higher, we want to highlight this. Okay, so greater than 15,000, whatever is the greater than 15,000 or 16,000, that will be highlighted. So we will give the value 16,000. Okay, sorry, we have selected entire format. We'll have to select particular format if you are applying into this. So select that particular format. Alt H, L, H again, then G. Okay, now we can select our figure, and if you want to give some conditional formatting or something, if you want to make it if you want to keep it as it is, that is also no issue. If you want to change or give him another color, like if you want to give them color like gray or something, or maybe blue. Okay, so you can select this. And okay, and then for font we want to change the color. Okay, so for that because if you are selecting a dark color, you should select white color. Now you can apply this. Okay, now you can see how it is looking. So whatever it is greater than 16,000, they are being highlighted. Similarly, if you want to apply into EBITDA or in revenue, you can play around and try to learn. Let me apply for revenue. Okay, Alt H L G H G. Okay, so now we want to give value 60,000. If whatever is greater than 60,000 will be highlighted. Okay, if you want to keep it as it is, or if you want to customize this, it will be automatically. So you can customize it as per your requirement. So I will go and will do the same thing. First I will fill the color as in white, and will choose the color same and press OK. Now you can see I think we have changed the color, so you can select the color as you want. Again we can go Alt H L H G. For customization we want to change the color. This was the color. Okay, Now this is working. Again we can go and check all the rule. Okay, you can manage your rule from here. So whatever rule you have applied this worksheet, all the rules are coming. This one we have applied twice, so we can remove this. Okay, delete the rule. Okay, since we have deleted this and applied this. Okay, so now we have only two rule we applied. Okay, one more important thing, when we are going, you can see clear rule. Clear rule you have to select very carefully. Clear rule from selected sheet, then this sheet, from this sheet entire rule will be removed, and if you select second one, clear rule from entire sheet, then even this sheet and whatever sheet you have, entire rule will be removed. So you don't need to do this, and you whenever you are trying to clear rule, you have to, it is better to go in manage rule and then select your current this workbook, and then understand it, and then accordingly edit or delete, or if you want to apply a new rule you can apply it. So it is better to carefully watch what you are doing and apply your rule effectively. Okay, so now we want to learn a very important formula which is very much useful while creating financial model. So learn it once and try to practice this more and more so that you can be friendly with this formula. So basically this is a date, the day when business has started or something. So we want to know the closing of this period. Okay, so for that, for April 19th, so first month would be uh, May 31st, but April 30 is the zero month. Okay, that is why we have given zero like this. And also we can manually we can update this, but we are supposed not to update this manually. Always keep as much link as possible. If you update here one, it will be changed. So similarly we have to try to make everything less hard coded. Okay, so now what we will do, we will try to apply one particular formula to calculate month end data. Every whatever the month, what would be the date of month end. Okay, for that we use equal e com eo month. Okay, then he is asking for start date. What is our start date? So our business or whatever the sheet, the start date we have given is 19th of April. So we'll select that. Okay, and then we have to keep it freeze. Okay, so like this we can freeze it, or also you can say we can anchoring this, absolute anchoring, so that it will be remain whenever you will drag the formula, that start date will remain as it is. Okay, now he is asking for month. So which month end you are asking for? So we are asking for zero month end, so we will select this. Okay, or you can give zero like this and close this, so it will work fine. So we need to change this format, date format. Okay, you can directly go to control 1. You can see this, we'll go to date and we'll select this one, or else if you want you can select something else, whichever you feel comfortable. That is also good, because this is giving the name of the month. Okay, now press OK. Now if you want you can drag it. Okay, so did you see this is not working correctly because we have hard coded here. Okay, zero. If you, even though if you change this one by one, 0 and 1 like this, it will work, but it is not recommended and it is not effective, because we want to make it automated as much possible so that data will be in our control. Okay, now if you drag this, okay, so basically we want to control the data, we don't want data should control to us. Okay, we'll change this again, control 1. This format is not very good, it should take shorter format. Let's select this and see. Okay, keep this way. That is better because it is increasing our font size. Okay, we'll change this font. We'll change this column width. Column width was somewhere around 12, so we again change it to the same. So this is how we can update monthly data. If you want to update annual data, that also we can do. Okay. Okay, one more important thing we have forgotten. If simply I will change this to 0. Okay, even though if you put 0, they will give you the same exact value end of this April month. Now this has been hard coded. Okay, if there is hard coded something, that will be highlighted. If you go like this, Control G, okay, Alt S for a special function, okay, constant. So wherever we have hard coded, it has catched it. Okay, you can see this. But what about this? Here I have hard coded right inside the formula. It is not being catched by this particular function. So that is the one of the demerit, I would say, or limitation of this formula. So that is why when we are creating this kind of formula, make sure, I am requesting you again and again, make sure not to update anything hard coded inside the formula. Try to link as much possible. So because later on if you go and find, or somebody else is auditing your financial model, they will also not able to find this. So but this is hard coded actually, so this should not be done. Okay, this is not accepted from you guys. Okay, so always keep this automated as much possible. So you can imagine how important it is, and I'm telling you frequently all the time. Okay. Okay, now we will calculate annual period and date. For that we will simply click data. Under data we will again select, he's asking for year. For that we will use year formula. Okay, so then he's asking for serial number. For that you have to select this function F4. You can freeze it, then close the bracket, plus then select the month. Okay, not select the year. So which year and you want? So we want the 0 year, the first I mean not first, 0 year, the year in which we have started our business. Okay, so we have selected 0 year, then again give comma, then give month. How many month you want? 12. If you put 12, that will be considered a calendar year from January to December. Okay, and if you put 4, they will consider a financial year for, in as per India point of view, April to March. Okay, 31st April, 1st of April we started our month, and 31st March we close. So they will give that way. But we want a calendar year, so that is why we will give 12. And now he's asking for day. So how many days of this particular month? Obviously 31st. You can close the bracket and press enter. Now you can see this, they have easily calculated your first year or 0 year ending date. Okay, so 31st 19th of April is our starting date, and end of the period for that 0 year is obviously 31st of December. If you drag this, they will calculate. You can see 31st December of 2030. So they have calculated 2024 plus 6, that is 30. Okay, so because of this, if you change this to 5, they will change again. You can see 29. Okay, so now we have manually updated. If you will change anything here, so every data will change accordingly. Okay, so that is why we want to keep this same streamline. That is why I have removed that. Okay, so now this is working perfectly all right. And one more important thing, why we are doing this, we are doing this so that we can, when we go further session, that time when we are going to create present value, that time this formula is very much useful. So I don't want to teach at that time. That is why I'm trying to give information as much possible at that time. Okay, we are trying to give this information at this time, so that time we will save our time while creating financial model. That time our focus should be more on creating financial model.
See you into the next session. Thank you very much.
Hello everyone, welcome back to IBS. Today we are going to discuss about scenario planning. Scenario planning, as per my point of view, this is also one of the very important strategic tool for financial modeling. So even it has been used for many other purposes. Imagine if your company's profit could change overnight. What if the raw material prices double or new competitor enter the market? Would your business survive? That exactly where scenario planning comes in. So scenario planning basically visualize all your potential outcomes, and that will give you an idea and edge before anything happen. In case of good situation, what would be your profit, or what would be your net profit, what would be your gross profit, etc., and what would be your expenses as well. And in case of worst situation, what are the cost you can overcome and try to balance your net profit, still you are having worst situation. So we use scenario planning to answer the what if related question, and it helps organization to prepare for uncertainty, not by predicting the future but by planning for it. So systematically we are planning, we are not just going blindly. In financial modeling, scenario planning are used to create financial model based on different what if related assumptions, like if sales grow by 5% or sales growing to 10%, or maybe sales is going down by 5% or 10%. So in those situations, what we are going to do, and also that will give you what are the other elements and item are going to be impacted in case of sales are getting changed. Now another very important question is why we use scenario planning. So basically financial model are purely based on assumption, and those assumptions may change. Correct. Scenario planning help you test the resilience of your model under different conditions. For example, base case market is growing very rapidly and you might predict your sales would be 50% and cost remain stable, because maybe your business have majority of cost coming through fixed assets. So that may be the reason, or maybe we are planning to keep our cost as it is. So that will give you good profit, right? And in case of market grow by 8% like average or something, so minor cost is going to be increased, or maybe it is still not increasing. So your revenue is only growing by 8%. So how you are going to manage certain expenses and bring the net profit, bottom line profit as it is what we have planned for above situation like 50% of sales growth. Okay. Similarly, if demand falls by 10%, so cost may rise sharply. So by running this kind of different scenario will help you to take systematic and calculated risk, that also we can say make an informed decision. So if you talk about use of scenario planning in financial modeling, so obviously already discussed like a revenue growth rate related stuff, you will be able to know about the cost of goods related information, what impact is going to be with regard to your cost of goods, and exchange rate, capital expenditure related stuff you can able to manage. So as a finance modeler, we use Excel to calculate this kind of risk and give company comfort zone before it actually incurred, or and try to monitor and uncertainty and reduce the risk as much possible. Because if you are actually in that risk, for example, demand is down by 10%, and if that time if you are going to reduce your cost and you are going to review all your line item and checking which are recurring, which are non-recurring, which are fixed costs, which can be avoided kind of answer if you are going to do at that time. So by the time you will review, 2 weeks will go away or 3 weeks will go away, and you will not be able to systematically understand every single expense and create fresh financial models. So that is the reason we are preparing ourselves before the situation and current situation comes, so that in case of emergency, in case of demand is going down and COVID has come or something like this, so we can immediately, we have identified all our expenses which are not going to impact our business, so we can suddenly go and reduce those costs. So that time you will not be hurry and you are just changing the growth rate, and that it will automatically change all your cost, and he will throw out all the budget to all the department if you are using Power BI and other similar kind of tools, etc. So that will inform everybody who are going to work based on their budget. So their budget might have been revised, so they will may ask to you why it has been revised, so you can able to answer the situation is not that what we have planned, so situation has changed, so we are accordingly we are adjusting all our expenses. So that is the reason we are doing all this activity, because in that situation situation we don't want to be in hurry and doing things and reviewing things at that time. So that is the reason we are planning for future before the situation come. So we are now having equipment and we are ready for all kind of uncertainty, as well as if their market demand is high or something, so we are also able to plan our inventory and supply chain and push the sale and bring good profit, right? So that is why we are doing all this activity. Okay, so now let's jump into the Excel sheet and understand this, how we are going to calculate. So we are planning, for example, our sales is somewhere around 1 million. Okay, so here what I'm doing, I'm going to link this. If you can see, it is not showing anything, so because I have changed the color, right? So you can also change this color so that when you are printing or something, so that is the reason we are keeping it gray or something else. Okay, and you can also make it completely similar color, so now it is almost not visible. So this complete column is for your sales growth related stuff. So we are planning if sales grow by 2%. Okay, similarly if sales will grow further 2%, then we want to know how much would be our gross profit, how much would be our sales. So this thing we can easily calculate using this. So now we are trying to know if our sales will grow by 2% till 24%, then what would be our gross profit related stuff. So this one we are trying to create all the situation, and out of all this situation we will pick three different model, like base model, average model, and highest peak with regard to sales. All those three cases, what would be our sales, what would be our gross profit, what would be our net profit. So how we can able to manage net profit in case of worst situation at the same level of profit when it is good situation, so that in case of volatility, in case of risk, we can still manage the bottom line profit as it is. So now I have updated the sales growth part. Now I want to update gross profit margin. So for that we can simply go and check what is our gross profit margin. So we can create line by selecting the line. How will you select? Shift space, it will be selected, and control plus your line will be created, and control minus to delete the line. Now this is my gross profit, right? And I will divide by sales, so I'm getting the percentage. So 30% is normally our gross profit. So all throughout the 4-5 year our gross profit is remaining same. So first I will update here gross profit. In normal cases we are able to manage 30%, so we are updating 30%. Look, I have already maintained this format and all, so that is the reason it is already coming as a percentage. Otherwise you need to change the format, etc. Then in case we want to know, are we able to manage cost and reduce our cost so that we can make more better profit and our profit margin will increase. So we are planning 31%, likewise 32%, maybe 35%, and 40%, and maybe 42 max. So we cannot go beyond that. So we are planning to reduce the cost as much possible related to cost of goods. And also we are seeing in case of your sales will grow by 2% and gross profit margin would be 30%, then what would be your potential gross profit. Okay, so this is kind of potential planning. So we are planning to know in all the situation what would be our gross profit. Similar way you can do it for net profit as well. So that would be your task, you will have to do. That is why I kept it blank. So now since you have all this information, so how we can able to calculate? For that there is a multiple option. First option is you can select this and go to your data, and then what if analysis. In that you have data table. In data table they will ask you raw input. So this is our column, this is our raw, so we'll give them raw input, correct? And then they are asking for column input, you can give this column input, then you can press OK. So he will update all this information. So I'm not sure is it working for my Excel sheet or not. So it is not working, I think so. I have tested it. So it is saying your information is not correct because I have linked this. So now I have pasted it as a paste special. So now it has been updated. Similar way I will update this. It is not required because it is manually updated. You need to copy this and paste into your ChatGPT. So why I'm pasting this, I'm also teaching you how you can use your ChatGPT while creating financial modeling, etc., so that you will be able to use this tool more effectively in your professional growth. Now I have given my sales growth and gross profit margin. I want to know further output with regards to potential sales amount. Let me check with him. So he will analyze this Excel model and he will give you the answer how you can do it. by yourself. So now as you can see, he is not able to understand what we are trying to say. So let me re-explain him. So this is how you can do the discussion with ChatGPT. So I'm asking him again, I want you to consider growth plus gross profit margin both, and then give me Excel formula. So now maybe he will understand what kind of formula I'm asking to him. So I think he has given me the formula. Yes. So you guys can pause this video and check this. I'm just copying this. Now you can paste it, but you need to do the formatting. So he might be picking the wrong information or something like that. So A4 they are trying to say B6. So I will select B6 here. B6 because 1 is stand for 100% plus this is growth, and then growth will multiply by your gross profit margin. So gross profit margin is this one. I need to select this one, C5. So I will correct this C5, and as you can see dollar sign is in between this selection, so that when we are changing right sides, so it will change, but you will go down when you copy paste your formula downside, it will not change. So he will keep this column freeze, and this side column level he will change, but raw level he will not change. So this is your raw level data, this level he will not change, but column level it will change. And then now I want to select the sales amount. Okay, so sales amount is this, and this one we want to freeze it. Why? Because we don't want this amount to be changed, because for this 1 million we want to check how much would be the sales in different case. Since our formula is correctly been calculated, so now I will copy paste this. Let's see. So now he is able to calculate. So I will check this one whether he has calculated correctly or not. So what is the meaning here? So 32% is our gross profit margin and sales growth is 12%. So let's calculate the sales growth. This is your sales, 1 million plus 1.12 is 112%. So this is your sales growth. Now he is saying your gross profit margin is 32%. Correct. So we'll multiply this into 32%. So let me see, this is the exact same amount it is calculating. So likewise, whatever your sales amount would be, maybe your sales is 25 million. Maybe I'm not able to see this, or maybe I'm updating the wrong amount or something. So let me correct this. So this is 25 million. So accordingly you can see their value has been updated. So this is how you can plan your gross profit. So now in number of, this is how many items? So this is 72. So now we are able to understand in 72 different situation what would be our potential gross profit. Simultaneously, if you reduce only this C5 is what? C5 is our gross profit. So gross profit if you reduce, so what would be the case? Now he is giving you the sales growth based on this data. Okay, now he is not considering this part. Okay, so if you want to know, you can also able to know this. Okay, in all this situation we don't need this information because this would be the same cases, because we are just considering the sales growth. If your revenue is 25 million and 2% it is growing, then your sales would be this much. If your sales will grow by 4%, then your sales would be this much. So this is how it is calculating only. So now if you want to know about your sales growth, for based on your sales growth related stuff, you can also able to calculate this. But now since we want to know sales growth as well as we want to know our gross profit margin based on different situation. In case of 31% gross profit would be if we are planning to reduce our cost, and 1% we are expecting that our cost of goods may go down. So what would be our sales? So these are the situation. Your sales, your net gross profit would be this much in case of different. If you are growing your sales by 10% and you are able to manage your cost reduction by 1%, your potential gross profit would be this much. So this is how you can create a number of different plans. So once you are done with that, then you need to create similar kind of format for just to calculate your net profit. Okay, so if I will do for you, let me do it. So just I'm trying to give you little bit information. Let me take the net profit exact value. This is my net profit. Okay, then we'll change this because profit margin is not same, net profit margin is different. Okay, so updating accordingly, then 17%, then updating 18%, 19%, and 20%, and 22%. So we are planning our gross profit in different situation. Maybe sales go down by 5%. Okay, then 0% growth, then 5% growth, then 10% sales growth, and then 15%. We are taking just this amount. Now if you use the same formula, you can able to calculate. You can check this whether it is calculating correctly or not. So they are not considering these things, so we need to correct this. Okay, B5 we need to correct this to B21. So where is B5? This is B5.
you can correct this to be 20. So now he is consider your net profit amount. Now C5 is your gross profit. Now we want to calculate net profit, so we'll update this to C20. Correct, C20. And the profit sales growth related stuff they are considering the same. This is not sales growth, I would say net profit. Okay, net profit either growing or getting down. So if your, sorry, I made a mistake, there would be your sales growth figure, sales growth. Okay, so I have taken the sales growth. Look, I have already considered the net profit. So if you are multiplying your sales with your net profit, so obviously you will get the net profit amount. Okay, so now we have different sales growth percentage. Based on that we want to calculate. If you can see, if your net gross profit you are able to maintain by 20% and your sales has grown by 5%, so you are able to maintain 195k revenue. Okay, in similar way, if you are able to increase your gross profit by 15% and you are not able to manage 20%, you are able to manage 90%, still you are able to generate good amount of profit. Still in case of 18% also you are able to generate profit around 192k if you are able to grow your sales 50% and net profit you are able to maintain by 18%. So what it is giving you indication, it is giving us the indication gross profit was around 16%. If we reduce some kind of expenses, either cost of goods, okay, this one is cost of goods, and this, if you consider this, out of this we are able to manage to reduce 1% of total revenue related amount. If we can able to reduce from this kind of expense, so we can able to bring good amount of profit. So these are the things we are getting from this different scenario. Okay, so this is how you can also calculate. Then we have scenario planning related another topic where we are going to learn about data validation. So data validation is also very important, because if I will ask you sales growth would be 100% or 50% or 200%, even 200%, it is possible, but does gross profit has potential to go by 150? Obviously not, right? Because if your sales is 100 and your gross profit is 150, then what would be the gross profit? 150. If you are selling $100 of rupees of product, how can you generate profit 150? So your gross profit would always be less than 100%. So for that we will be doing data validation. Okay, so how will you do? Select this and go to your data, and you can see this data validation tool. Here you can click, you can update the data validation. Now he's asking you what information you want to update. So I want to update this value, decimal value. So now he's saying in this tab what exactly you want. So I want this should not be more than 100%. So 100% is equal to 1, so it would be greater than 0 or equal to 0 or not more than 1%. So maximum would be 100%. So that is, even 100% is not possible, but it's okay. So we are maintaining this, and then you need to update input message. So what message you want? So we want to say that GP margin can not be more than 1. You can do it by yourself. What exactly you want to write, you can write it, so you can able to understand. Okay, GP margin will not be more than 100%. So we can't write this 100. Yeah, we can write it here, but not here. So I have written alert. Now he want you to stop. If you select this stop, so if you are putting information 150 or something, he will not accept, you will not be able to write that. So we are keeping it as an warning indication, so that still you can update, but later on when you are going to review your financial model, that time you will able to work on it. So how you are going to work it, let we can update this. So what warning message you want, so that you can update. Correct the information, I can write correct the percentage. Okay, so copy it and I paste it. Now you press OK. So now you can see it is saying, and if you write, for example, if you write here like this way as a note or comment, GP margin must not be greater than 100%. If you write in that way, now you can see whenever you are putting your cursor over here, this message is coming. Even though if you are not on that cursor, he is keep on giving you information that there is some kind of comment or something. So we want to keep our financial model clean and neat. So that is why I will be deleting this. So now when you go and click in that cursor, then he will give you the information. Now check whether if you want to update 110%, it is picking. If you want to update 100%, it is picking. If you update 120%, he is giving you the message. Okay, correct the percentage, or you want to continue. So if you will press yes, he will take. Since we have not updated as an stop, we have updated here as an warning. If we have updated this as an stop, then press OK. Then now if you try to do this, he will not take, he will not accept. Okay, so that is the reason we are updating this as a warning. So now when you are not in that cursor, that is not showing anything. Okay, when you have mentioned this, okay, then by mistake or unintentionally if you have pressed this, yes, continue, and then you work on another sheet or something like that. So when you want to come back and check is there any formula mistake or something we did, for that also you can do it. You need to go and click data validation and then circle invalid data. If you click that, he will highlight wherever this kind of logic you have applied in any tab, so that will be circulated. Okay, so you can also able to click that and check that what happened, what was the situation. So you can read it and you can understand, okay, gross profit cannot be more than 100%. So obviously what is my gross profit, so you can go and check, oh, it is 30%, not more than that. So you can able to update. So this is how you can work. So in scenario planning, what I did, I have linked this income statement based on our current income statement. So this one is as it is just being linked. If you see that income statement G911, so you can see G911. So G911 is this. Now we are predicting is for 2025. 2025 has 928. Let's see how much is here. It has different percentage because in this we have different rate for all the product, but here I have directly considered 10% increment. From this, if you add 10% increment, you will get the same value. Okay, 931, 700, same. So either you can link with this or you may create. This is just for education purpose, so don't go in that way. Similar way, I have linked this cost of goods. I have considered 70% of our revenue. Then we got our gross profit. Then we have linked the operating expenses. This is all are coming from income statement. Then we have our fixed cost and then our operating expenses, interest, income, and net income. Okay, then similar way I have created another assumption for assumption 2. In case if market is stagnant and are fixed, they are not growing, they are average or something, so we have considered in that condition our revenue will grow by 5%. So accordingly I have created assumption. So when you are creating assumption, that time you may consider what are the cost is genuinely required to run this business, and some of the cost, like I have told you, recurring nature, like painting, like furniture, premium furniture and infrastructure, good office location kind of a stuff doesn't matter when you are running with crisis or something. Like we are going to generate average profit. So in normal condition we are going to generate profit about 147k. So now in bad condition, even if in 5 condition we are generating not much less, right? So that is the power of scenario planning. We are systematically reducing all our recurring costs which are not important. Like without incurring those expenses, still we can generate profit, because ultimately business run based on the service or product you are supplying to that client or customer. They are paying for that thing, right? They are not going to pay you for your infrastructure or something else. Okay, so that is why those expenses we can cut down in case of average condition. And in case of worst situation, like revenue is going to 2%, maybe revenue may go minus 2%, so our revenue is going to reduce further. So in those conditions we will further look over all the expenses, because you don't have other option, because market is stagnant and there are multiple competitor. So you have two option. If in case the market is facing disruption, for example Tesla came into the market and then other automobile industry was struggling because he has come with new idea like EV cars and all. So you have two option. Either you cut down your cost as much possible and keep the same quality of product, and alternate option is you can take this disruption as an opportunity and you also invest a lot of money in R&D. So if company is doing that thing, then you might see here a lot of R&D related expenses keep on increasing. So company has, in case of disruption, company has only two option: either cut down the cost and jump into that disruption and do it more better than your competitor is working on those kind of thing. So any external force which is going to impact to your business, you should react to that, either invest in R&D or you cut down your cost. So if you are cutting down your cost, that means you are not fighting with the disruption and you are accepting it, and then you are cutting your cost, so you will not survive for a longer period of time. So you have only option is to cut down your cost and stay as long as much possible if the disruption will take over the entire market. So our topic is with regard to scenario planning. So in case of worst situation, situation, disruption and external force is impacting to your revenue, so you have to cut down your cost. And how you are going to cut down, I have considered different percentage. You can also consider based on your internal decision and management decision which cost you are going to completely wipe out and which cost, maybe salary of supervisor, you can see keep on increasing. The company may target to cut down some of the employees, so this cost may go down. Okay, similar way factory cost you can see keep on increasing based on the agreement. If we have signed the agreement that every year we have to increase revenue, increase the rent by 10%, so it is increasing by same way. But in case you are facing disruption, then obviously you will go for small office. You are also cutting down the heads, so obviously you need a small office. So this is how you can better plan in case of different situations. Since we have created 3 different pro forma income statements, similar way you have to create 3 different pro forma balance sheet and cash flow, because as I told you, cash flow and balance sheet will be important for shareholder and the fund investor or private equity who has funded you. They want to see what would be your ratio in case of worst situation. Will you be able to maintain the agreed term and condition or not? So that is why you have to prepare all 3 financial statement. But this is for education purpose, so I have just created for income statement. So now I have created this in case you feel that your business, so this is the place. This will be your backend data that you will kept it somewhere else, and this one you will be presenting in this live session. When you are presenting to investor or something, you are saying in case of condition 1 is 10%. As you can see, assumption 1 is 10% and market is good. So you are showing them that in case of good situation we are having 10% growth and our net profit would be this much, our EPS would be this much. As I have mentioned this manually so that you can see that it is matching. Then if we change the condition, if our market is stagnant and condition is not good, then the condition 2, if condition 2 will come, we will follow this budget, because this is income statement and this is your indirect manufacturing labor. So for labor, the person who is taking care of this line, they will be given this fund. If condition is 1, they will be given this much fund. If condition is worse, then he will be given even shorter fund. So this is what I'm trying to say. So you can see immediately budget is changing. Similar way this is created in Excel, but if you are using AI and plug-in software in your ERP and Microsoft Dynamics, so in real time you will see that everybody can see from those who required that information, like labor team need, indirect manufacturing related, their budget. So if you change this immediately, they will also notice that the budget has changed now, so there must be some problem, so he will know. And the equipment maintenance team or the person who is dealing with equipment maintenance, he will know. The utility, whoever is taking care of utility, so creating control that the person who is taking care of these 2, he will get the notification for these 2 that budget has changed. So you don't need to change it and then mail it to one by one individual, so that would be big task, right? For that you need team, because this is a company. If company is giant or something, so if you are changing based on the situation or scenario, so for communicating everybody is also equally important. And this is just a 5 line, but in company there may be hundreds of line item, and different company has different RC, so you cannot inform everybody. If you are informing, that is also one of the biggest task, I would say. So that is why if the same thing is plug in with ERP, then it will be very easy. So if you are changing based on the situation, everybody will notify and they will get the pop-up message. Anyway, so condition 2 is when the average revenue is going to generate, then your revenue is this and your bottom line profit is 138k, then your EPS has changed. You can see this is the average, so it is matching with this. So you don't need to show this, I just kept it so that I can show you. Okay, so management will see that our EPS, earning per share, would be this much. So he will calculate that how much share I have and how much money I am going to make. If the condition would be worst, then our profit would be this much. So they are prepared now. If we are sharing this kind of information, they are also reviewing and they are getting that. And then you can create data visualization so that they will know that in which condition how much revenue I am going to generate. So they will know by looking at this that in case of this situation, worst situation, I am going to get this much EPS and yearly it is increasing. And in case of average, I am getting this because it is mentioned average, and up situation is this color. So they will know that what going to happen. Okay, so how I have created this, for that if you can do it, I just let me show you. CHOOS choose, you select the choose, then select this plus click F4, so fix it. Now it is being fixed. Now I am selecting, this is first, and I am also picking the, this one is revenue, so I am picking the revenue. So first C4 will consider this as a first, then if you click comma This one he will consider scenario 2nd, and this one he will consider scenario 3. If you have further more scenario, you can select it. So they will consider different assumptions. Now if you click bracket close and click OK, it will pick. So I have actually updated the revenue, so that I will click, then I will cut it and I will paste it here. So revenue part will be updated. You can read this and read this. Now I want to update the percentage. Now it is being considered as a 10%. Now you simply drag down, it will pick. Also drag down, it will pick. So this is how how I have created, that I am showing you. So same formula is applied here, so you can calculate similar formula. If I will do it, then this line and all will, the alignment will be changed. So that is why I'm doing it separately for you. This is because I have linked it, right? If you change this to 2, so it will pick the average. Now if you change it to 3, so it will pick the worst case situation related income statement he is picking. You can see same amount getting, and you can also check in the worst assumption how much is revenue. 133k, 179k in 2028, 179k, and 2024 133k. So it is working fine. And also I have checked it by this way, this minus this, it will give you the information whether it is speaking the correct information or not. So obviously it is speaking the correct information. So this is how you can create a different scenario planning. You can also create your income statement, balance sheet, and cash flow, and represent it in front of management and try to make it more attractive, and use the standard of financial modeling. That also important. We will take 10 lecture to explain you how, what standard is being followed throughout the industry, what space you will have to keep it here, what space you have to keep it here, what format you have to keep it, and how, what thing would be bullet. These are all are standard which is being used in entire investment banking industry. So that is separate thing that I'm not going to discuss. But yeah, you need to create your financial model so that it look attractive and their alignment and everything look beautiful, because these are raw data, right? If you make it little bit look attractive and create data visualization as much possible, so they can understand these things, because visualization make more sense compared to sharing data, correct? So I think I'm done for the day. We'll see you into the next session. Stay tuned. Thank you very much.
Hello student, welcome back to IBS. Today we are going to discuss about master budgeting. So now the generation has changed and there is a lot of new development has come when AI and machine learning has come into the market. So now you can see the title of this master budgeting in the age of AI and automation. So there are a lot of big companies are using AI, robotic process, machine learning, automation for repetitive tasks. So these are the thing is going on, and you guys are not working on improving your skills and you are not learning how to use this AI, then you will be in danger of career point of view and growth perspective. Also, these are quite interesting if you will learn this thing and try to implement those into your day-to-day life as well as in your business. So that will definitely going to create a positive impact and it make you stand out in front of other people. So without wasting time, let's jump to the topic what we are going to discuss in this session. As you guys can able to read these 3 questions which I'm going to ask you, and pause it and read it and confirm whether you think is it possible or not. So I think you might have your own understanding whether it is possible or not. So let's read the first question. If your supplier in China or maybe any other country suddenly shut down due to political ban, can your budgeting system auto adjust procurement, inventory, cash flow plan within a minute? Or will you still rely on Excel sheet on manual firefighting? Or maybe your AI will give you an option other than that China, you can buy this product, whether you are in India, you are in USA, you have any other vendor list from where your AI can give you the potential new supplier who can provide you the same product. So my answer is yes. With the power of Gen AI, RPA and modern ERP like SAP and Dynamics 365, it is now possible to auto adjust procurement, forecast demand using seasonal indexes, and even realign your cash flow model based on the real-time market events without awaiting month-end reports and manual budget meetings. So basically this is possible, just that you need to know that is it possible or not, and you need to figure out which AI software can be plugged with your system and give this result. Maybe little bit manual
manual intervention might required, and you can use this kind of software to stay ahead compared to your competitor. So basically you are pushing your company forward compared to your competitor. So if you and your competitor having the same business, and if you as an FP&A guy bring this solution instantly and your competitor is not having that solution, he is working on Excel sheet and finding the another vendor and doing things and revising their procurement strategy, inventory based on number of inventory sold versus how much inventory required, they are calculating all those things. So it will take a lot of time. But if you are getting things done this through AI, so obviously you will the one who will win the game, and you will be considered as an upcoming leader for that company. So this course is not only to make you FP&A expert, this course will obviously going to boost your career till CFO level, and I'm trying to give you research based information so that you can upscale your mindset as well as your knowledge. So the second question is, imagine ChatGPT is integrated into your ERP. Can it read the market news, sense the demand shift, and recommend change to your master budget before competitor even react? This is one of the great thing, and this is also possible. And the third question is, why are the companies like Unilever, Nestle investing in RPA and AI to automate budgeting, while some firms still spend 3 months preparing next year budget annually, only to revise it again within 2 weeks? So this is really tough question, and the answer is these are all possible, which I'm giving you, and I want to tell you briefly how. So system today use historical data, machine learning, and even real-time news feeds to detect trend. So this is all machine learning is doing. AI co-pilots can suggest budget revision. So he is also suggesting you to revise your budget, while RPA can automate data flow across the finance. Now we are automating all the data flow across all the finance team, supply chain and procurement as well, all integrated into your master budget. So these all things which we are supposed to do manually and react and understand, and it take a lot of time and a lot of people who does all these things. So now system itself is doing while learning through your own data. But my suggestion is, take this all software as a base, don't make it final. Human intervention and human insights are very much important. So what are the benefit of this kind of AI and machine learning? So obviously this help you to foster decision in crisis. This is very important. In crisis you cannot have time to react and go for research and conduct research, and then after 2 weeks you take action. Within 2 weeks then issue will become disaster, a risk will be very much impactful to you, and fewer manual error and delay. So this is also one of the benefit. More accurate forecast for better resource allocation, and competitive edge through agility, and save hundreds of hours of rebudgeting and reforecasting and approval. I have seen in many company, even I am working in 15 years. So we create budget and then we revise it for almost 10, 12, 13, 14 times based on a scenario planning, based on another thing. These are keep on updating. But if the same thing will happen in system, so if you are applying scenario planning related predictive modeling, something if you are updating in system, so that system will auto correct other data as well. Like for example, if you are posting one entry in system, that is going to touch to your income statement as well as balance sheet. So once you post this entry and you save it, and if you will see that income statement and balance sheet, both the place the difference will immediately impacted in the real life. Another example is if you are going to DMart and any FMCG company where you buy something. So in DMart balance sheet and P&L, immediately that cell will recognize, and their impact will be on their income statement as well as balance sheet immediately within a second. As on when they will confirm your sales, and when you paid the payment entry will also be reflected immediately into their system. And this is all automation. These are all reconciled immediately. So all I'm saying is, similar way budget is also now possible to revise based on scenario planning, based on your seasonality factor. If you are updating your system, so it will auto update entire your budget, and he will recalculate everything. But the same thing if we are doing in Excel, again we need to keep on checking everything, income statement, balance sheet and cash flow, and we are still in doubt whether our Excel has calculated correctly or not sometime, because Excel is something which is doing through formula. Same formula is also being used in system also, but Excel is tool and Excel is not system. That is the difference. And in Excel we are applying the formula, so we are human, so we make mistakes sometime. When we need to link, instead of linking, many people update hard coded number and they don't link. So if you are changing one information, your entire Excel sheet will be updated or not. For that you will never be 100% sure. That is one thing I have learned through my career. Suppose we are creating financial model that has 20 sheets, and if I'm changing one input, then if it has changed and their impact has changed to entire Excel sheet or not, that we are not sure, because still we link everything as per our understanding, but still sometime we are not sure, we still have to check. So you might be listening from various people who is creating financial model. If you have little change or little mistake in financial model, then it will take 5 hour 10 hour to diagnose that and solve that. So this is what the Excel sheet has huge issue to solve a small problem. So that is not happening in system will always be automated and they correct itself immediately. And this is the difference between human and RPA. But still I'm saying RPA, whatever AI tools things you are implementing in your system, that is not your final version. You consider it as a primary source of draft version, and then you need to review and finalize it. I hope you find it insightful. So today let's go beyond the traditional budgeting and explore how can we use AI and automate tools to build living responsive master budget, and one that thinks, learn and adapt the changes. So adoption for changes is really important. If you are not learning and adopting yourself, so you are actually creating big problem for yourself. Next lecture we will be learning the actual master budget, which we use Excel sheet and create that master budget, because I'm considering you all are fresher who need Excel sheet to learn and create master budget and understand how to create, etc. Once you are master of creating budget, etc., then you can think of what I have discussed today's session. So thanks for watching. See you into the next session. Stay tuned. Please visit my website and also follow me YouTube, LinkedIn and Instagram. Thank you very much. See you into the next session. Hello student, welcome back to IBS. Today we are going to discuss about master budgeting part 2. In last session we have discussed the use of AI and machine learning and robotic process automation, RPA, that is useful for repetitive tasks and create automation in your budgeting and forecasting related stuff. It is also helpful for scenario planning, seasonal planning, and that will quick react based on your crisis, based on world events that is going to impact to your business. That will give you some of the idea how you can solve those problems. And if you have an issue with regard to supply chain, how you are going to solve. So these are the Copilot and ChatGPT AI and all these different AI. If you club together with your system, so they are going to boost your productivity, and that will help you to take instant action and solve big problem in your company. So this was the total discussion in last session. So now we are going to discuss about master budget overview. So what is actually the master budget and why do we prepare master budget? So I think you all know why do we create master budget and use of master budget. We have already discussed this in various sessions. We are discussing, we are creating budget to create control, create accountability, and also review performance and set target. So many things we have benefit of this, all the master budget. So master budget is basically combination of goal of the entire organization. So you can see at one place all the information, and you will see what revenue we are planning for upcoming 5 year, and what would be our cost, what would be our bottom line profit, and what are our strategic action we are planning for upcoming 5 year with regard to company. Like company has 6,000 customer, they want to create 3 lakhs customer they wanted to target, like this kind of thing. And company want to open their business in another country or another city. So all these information you will scan through your master budget. So these are the thing will be available, and that also will be in actionable insight will be there, that in numeric term how that is going to be achieved and in which period how much we are going to generate profit and revenue. So master budget is also a very comprehensive budget. It has a lot of schedule which is attached to this master budget. For example, if you are a company like Walmart and you have 20-30 companies, your business has been spreaded in that 30 company. Also you have spreaded, let's consider 5 city in every country, so almost 150 store you have. So every store will have their own sales prediction, and then 150 different schedule you will receive for sales itself, and that all you will club together, then you will get the total revenue figure. So this is how the master budget is. This is what we can say the big budget. The ocean of data is flowing to master budget. So if you dig down to master budget, you will get the layers of schedule and all. So that is what I wanted to make it clear to you before going further. So encompass a broader time frame and often includes multiple years. Already I discussed master budget normally for 5 years, and company may predict for 10 years based on taking assumption last historically if you are growing 10% or 5% or 8%. Similar when they will consider for other 5 year and a little bit they think we can grow faster or something, so they may add extra percentage. Based on that they will just drag down and understand that how much potentially we are going to earn in upcoming 10 years. So this is called the budget if it is being created for more than 5 year or something. It's also master budget are created based on summary. First year budget, the annual budget would be in detail, but apart from the annual budget, from second budget to till 9, 10, 8 years of period, that are all based on the percentage and assumption. That is being done by finance team, and that I will teach you how we do it. And summarize set of budget financial statements such as budgeted balance sheet, income statement and cash flow. So obviously master budget will have the summary sheet of this all 3 financial statement where you will see what would be our top line revenue and bottom line profit, and in balance sheet you can see how much asset we have and how much we are planning to buy every year, and also liquidity point of view. So all these things we are creating so that in case investor has some rule, you should have liquidity at least 1.5%. For example, quick ratio, current ratio, they have put some standard that you need to follow. So when we are creating this kind of budget, so when we are planning, that time also we are doing the ratio analysis and checking whether we are fulfilling the obligation which is been established by or settled by management or an investor, or maybe if you have company where you are raising fund from bank or something, so they also put some extra rule which is controlling your business, so that you should have to have some fund into your bank, and you should have your current asset versus current liability have some certain amount of percentage. So these things you have to take care when you are creating a summary budget. So that is why this is also aligned with the expectation of management, investor and the banks you are having relationship, and they are funding the company, they are giving the debt or something like that. So these are the things also be considered in your master budget. And if you are lagging behind or something, then again we have to figure out how we can meet the target, how we can, for example, if your cash ratio is lower than the set target by bank, then you have to think how you are going to finance or how you are going to manage your inventory and working capital, so that you can reduce your accounts payable, inventory, and keep your cash as much being enforced to you by the bank. So this is how we create budget, and we are trying to reduce the risk. If you're not fulfilling this, so there is certain complication will come. Bank will may impose extra interest, or maybe bank will ask for payback our debt or something kind of thing. Okay, now we'll discuss about what master budget is. So in master budget we have budgeted financial statement, whether it is balance sheet, income statement and cash flow. All this summary of balance sheet, income statement and cash flow are available in master budget, and that too in pro forma level of financial statement are available. Why we are saying pro forma? Because this is not actual income statement, we are creating based on our projection and forecast and based on our assumption. We don't have one pro forma statement of balance sheet, income statement and cash flow. Based on scenario planning, we have multiple pro forma income statement, balance sheet and cash flow, so that in case of worst situation, how we are going to cut the cost, and in case of great situation where we are planning to invest. All those things has been mentioned. And if you use machine learning and AI and ChatGPT kind of thing, so that will also be helpful to you. That will obviously going to reduce our manual task of working hard on Excel sheet, etc. So if you talk about the difference between performa versus master budget, so performa financial statement are projected financial statement that is based on projection and are used for a specific purpose. For example, scenario planning. What if the percentage of sales growth is 5%? What if the percentage of sales growth is minus 5%? What if the percentage of sales growth, if it is 20% growing compared to last year? So based on different scenario, we are creating different performa financial statement. But in main master budget, we will stick to one particular percentage, and which is we all agreed that we will be having this much of growth and we are going stagnant, or same revenue we are going to generate based on the market research and all, whatever being finalized. So that master budget you will keep. But apart from that, based on the risk and scenario planning, we will have multiple other performa income statement, balance sheet and cash flow. So in case situation won't change, accordingly we will switch to that budget, and that performa budget will become your master budget. I hope you are getting my point. So master budget is not a performa statement. Obviously performa statement are not part of formal budget process. Performa statement vary based on planning and decision making needs. So obviously based on the risk, based on the situation, we need to use this performa financial statement. Purpose of performa financial statement is to use in planning and decision making. Multiple sets may prepare for the same period for analysis point of view and decision making point of view and inside perspective, not used for formal variance reporting, contrary to master budget and flexible budget. I hope you are getting what we are discussing here. Now we are going to discuss about development of master budget. So master budget consists of two classification: the operating master budget and financial budget. So the operating budget may be your sales budget, production budget, direct material budget, direct material usage budget, direct material purchase budget, direct labor budget. These are the budget are your operational budget which is being used in daily basis. And financial budget are obviously your capex budget, your cash budget, your budgeted balance sheet, income statement and cash flow. So these are, but these budget are being created based on the information you have from operating budget. So financial budget are always depend on operating budget, but operating budget are not depending on financial budget. And also all the operating budget are dependent on sales budget. Sales budget is the unique budget which is not dependent on any of the operating budget as well as any of the financial budget. Okay, so sales budget is being created based on sales forecast. So once we have forecasted based on the different country, wherever our store is, wherever our factory is, or if we are giving service, so whatever service we are providing, which state, which country, based on that whatever we have calculated. So that analysis basis when we are predicting sales, so sales budget is not depending on this operating budget and input from financial budget. Sales budget get information from your historical financial data as well as market research and your marketing team inputs and the management expectation. So these 3-4 places the sources of information are coming and then finalizing the budget. So as a FP&A team you will create further production budget, or maybe the production budget RC may create that budget and you will help him to create the budget and guide him, providing him trackers etc. And finalized by you will calculate whether the creation of production budget is accurate or not. I hope you are getting the development of master budget. So I think I have given enough food for thought to you guys. So tomorrow we will be discussing freshly from the sales budget, how to craft a sales budget. So thanks for watching. See you into the next session. Please follow through this given links. Thank you very much. Hello everyone, welcome back to IBS. Today we are going to discuss about master budgeting in the era of AI and machine learning. So in master budgeting we have already discussed so many things. Now we are going to focus about sales budget. In sales budget, we are going with advanced level hybrid model of sales budget using AI and machine learning, as well as traditional approach of sales budget, which also I will be teaching you here in detail. So using Excel sheet, how we are going to forecast sales, and how machine learning and AI will help you to forecast sales real time. So imagine what if your sales forecast could revise itself before you even open your laptop. What if your ERP read market news, tracked weather and called out demand spike before your competitor even noticed? What if ChatGPT wasn't just answering question but actively revising your sales and procurement plan in real time? So this isn't science fiction. This is AI based hybrid budgeting, and today we will explore how it works. So what is sales budget and why it is so crucial? A sales budget is a financial projection of how much revenue a business expects from its product and services over the specific period of time. So we are looking toward the future, what specifically period of time we are going to generate revenue based on our sales, or if we are production based company, so based on product, how much sales we are going to generate. So it is based on sales forecast, operational goals, and production capacity. So these are the factor which is going to influence your sales budget and sales forecast. But here is the twist. It isn't just a guesswork. It is the foundation that influence every other component of your budgeting system, from production planning to cash flow to staffing and marketing strategy. So everywhere it is influencing interdependence with other budget. So let's see how this sales budget follow through your master budget. So obviously sales budget is directly going to impact to your production budget, procurement plan, staffing plan, marketing budget, cash budget. That is why sales is very crucial budget. If that budget is overstated, then you will be losing a lot of money in buying extra inventory, material, extra production planning, extra staffing planning, extra budget on Google ads and other Facebook or ads or print ads, whatever kinds of ads you are doing based on your business. So all are going to impact if you just overstated your sales budget, and those money you would have invested somewhere else, those you are putting into your business. So that is the reason sales budget is very crucial for any organization. And how quick business would be less riskier based on the political impact, like trade war is going on around the world. So you should have your eye on this political decision which is going to impact your business. For example, tariff, for example, tax has been increased, GST rate has been increased. So these all are going to impact to your business immediately. So accordingly, you have such capacity and capability to immediately act on and then change. So that is the reason I'm keep on telling you to use hybrid sales budget, in build and plug in all AI software into your system. What if your sales budget is underestimated? Then your production budget would be less, your procurement plan would be less, your staffing would be less, your marketing budget would be less, as well as your coming cash would also be less. But your demand is high. So if you are selling a product that demand is high and you have underestimate your budget, then you are not able to supply. And then what will happen? And the person who love to buy your product, he may not be happy because of stock out condition. Let's take one real life example. I normally go to one particular store for buying medicine, and that store always provide me all the medicine which I am looking for. And there are n number of other store available near to my house, and throughout the journey where I'm going to that store, that is 1.5 kilometer far from my house, so there are 10-12 shop which are supplying medicine, but I don't go to any of them. I just directly go there and buy. They take little bit extra time, but they never return me. There is no stock out condition, so I always get it. Very minimal time they are saying they don't have. But if I go to other store, so their frequency of time, whenever I go, they don't have the medicine, they say I will bring it for you for next day or something. So that is why, to avoid my unnecessary time, I go directly to that place. So this is how the sales budget is important. If you are underestimating and your product is not available to your store and the place where it should be available, even though people love your product, they will be unhappy with your supply chain management. So that is the reason sales budget, overestimate and underestimate, both are going to badly impact to your business. So when you created your sales budget and you have finalized number of quantity, maybe hundreds of product you are going to sell. So accordingly, you have to update your production budget, procurement plan, how much raw material required, how many production daily basis we need to do to meet that target. So everything is based on the target. A target is being set through sales budget. Okay, and staffing plan. For example, last year you are selling 80 product. Now you are selling 100 products. So whether you need extra staff or not, that also you need to do the planning, and you have to hire people before actually you have started based on your target. You have started working. Before that, you should have a number of staff so that he can support you. You should have raw material so that they can make the product. You should have given training. You should have budget for marketing. You have to sell also, not just we need to forecast we are going to sell this. For that also we need to have a marketing budget so that they will start doing ads. So everywhere this sales budget target is going to directly impact. So every other budget are dependent on sales budget input. I hope you are clear. AI and machine learning in sales forecasting. What is new? Traditionally, sales forecasts are rely on historical data and gut feeling, correct? Or maybe expert opinion and management expectation based on that. But today, AI and machine learning can detect the pattern which human can't. AI can do it much faster than human. So if you have designed your system that his job is to detect the pattern, so he will do that, but human may miss to find the pattern, correct? There is one thing come into mind just now, that SAP ERP system, you all know that they have produced one report and saying there are mostly big company are using SAP, not a small company or mid-sized company. So most of the bigger size company are using SAP. Instead of that, 1% of companies are using data which they are feeding in SAP. Their own company data is being used by only 1%. So you can say 99% of company are still not using their data to find pattern, predict sales forecast, predict the risk, and do the descriptive analysis and other data analysis related stuff. So you can imagine there is a n number of scope. If we learn this thing, so we will obviously cut the 99% of company, we will stand as a 1%. So that is the reason the power is data, and power of AI you should learn and use. For example, Amazon use machine learning model that consider the past sales, time of years, and regional buying trend and promotional effect, and even weather forecast to estimate demand. So this is how Amazon are using. So Amazon is 1% company, and this 99% other company who are not using it. So this is the reason Amazon become Amazon. You are getting my point. So what does AI do? AI analyze your seasonality factor, like summer, Diwali sales offer are coming. This we have to keep in mind that if in summer we will give bonus and discount to our customer like this, but AI will do it couple of week before, and they will give you the time to review and create that sales discounts will work or not. So AI will not miss it. We may miss it, correct? And also the use of AI is detect emerging trend from news and social media and competitive pricing. For that also you need to discuss and find on Google and ChatGPT, find that which AI software can help your company to find the emerging trend based on news, based on social media information, based on competitive pricing. Is there any software who can do this thing for your company or not? That you have to figure out. I'm just telling you that these are the thing is possible. Okay, so how to do it, that you have to learn by yourself and learn the AI and machine learn. Then suggest the real-time adjustment in procurement and inventory. So this is the power. AI can suggest you real-time adjustment with regard to procurement and inventory. If you have reduced your sales or if you have increased your sales quantity, immediately AI will revise your procurement and inventory. Build confidence intervals for expected demand. So you will be having confident on your demand if you are using AI. Now let's discuss what are the thing and component are being used for effective sales forecast. So obviously you need to have good understanding of your historical data, pattern, seasonality factor, demand, and the customer, what your customer wants, and whether your customer is happy with your product or not, your churn and customer retention ratio. So these are the things you should know already. And obviously seasonality indexing, in which your sales are spike like Diwali, like Christmas spike kind of thing. So that also been considered in your sales. When I will be using Excel sheet for multiple regression analysis, that time I will teach you how with the help of Excel also we can predict seasonality factor. So that time I will be teaching you how we can use Excel also. But still, why do we use Excel if there is AI who can do this for you? So we need to explore which AI software is actually doing. So you need to have a meeting with them and give them some small data and ask them to do this thing and do that thing, and then check whether they are actually calculating the seasonality indexing and they are considering the seasonality factor or not. So when you have trust, then only implement in your software, in your business or ERP software. Then the market trend and customer sentiment you need to understand for sales forecast. An AI tool like SAP integrated business planning and my MSD 365 use the social media and microeconomic indicators to predict your market trend and customer sentiment. Look, customer sentiment can immediately change, so you cannot be keep on asking your customer whether you like my product or not. And if you are CFO and FP&A head, and by the time when your month is being closed and then you are reviewing your customer data and noticing that there is high customer churn and customer retention is low, then only you will notice this customer sentiment or customer are not liking it. But if you are using real time data with the use of AI in SAP, so you will not have to wait for the month end or quarter end to review and find this. And also you have to keep list of activity which you need to do, and somebody from your team will be doing it. So instead of they will do, if the AI will do for you, and you will get the immediate information, whether it is pop-up message or maybe in your email, this AI will give you the information through when it is being integrated to your recipe. So that will give you idea if market sentiment is great, you can work on it and review the data, and then you can give information to management and your production and marketing team to take the opportunity and increase the production, or if it is service, increase the service. Correct? So you can get good return on this investment on AI and machine learning. Another component for effective sales forecast is obviously sales force estimate. A ground level insight from sales representative is still irreplaceable, because they know that if they are loving your product or not, because they are selling it. So they know how the customer reacting to your product or service. So marketing plan the campaign and or discount affect the short term demand, and new product launch and or capital project expected revenue from upcoming project must be added. So you know that how much cash you are going to have which can support to your new product launch or not, and the capital project you are planning, how much cash you are going to have. That cash budget also dependent on your sales forecast. So this is how I'm giving you detailed insight on why this sales forecast is important. So why the AI role in handling and credit sales and cash budget impact. Let's say you are a beverage company launching a new cold coffee in tier 2 city or tier 3 city. So what AI going to do the benefit for you? So AI will pull the local weather trend of hotter summer or high demand, and historical sales of similar product shows 30% surge in April and May. So all this information like sales representative intimate 15% uptake in cafe and colleges. So all this information based on other company and the market, AI will give you all this information so that you can take a right and accurate decision, and that will help you to solve a lot of your problem and energy. And by yourself finding this thing, you just need to type and ask him, he will give you the insight. So everything is now in the tip of your finger. Correct? So all these input flow into your AI enabled forecasting system, which adjusts your sales budget in real time and automatically feed and revise the target and production and procurement teams. So much things AI is solving now. So we don't know what would be after 10 years and 20 years. We all are very much excited and also fearful what will be happening in upcoming 10-20 years. Also you can read this what I have mentioned here. Let's say 60% of sales are on 30-day credit terms, and your sales budget feed directly into your cash forecast. Correct? And AI can not only predict sales but also payment. payment delay based on the customer behavior, economic condition, and even supplier disruption. He will calculate all these things. For example, sudden tariff hike by USA can be flagged by ERP, and if your business is going to impact, your business is directly linked with that tariff, so your procurement and working capital plan can be automatically revised by AI. So this is actually solving our n number of work if we use this AI in very smart way. So only who will survive in this era? The person who know how to use AI. So what did we learn today? We learned sales forecast, foundation of master budget, and machine learning and AI make the forecasting more accurate, dynamic, and real time and instantly changing. Effective forecast involve quantitative data and expert judgment. AI enable the scenario based planning and proactive reforecasting, correct? And leading the firm like Unilever, Microsoft, Google, Coca-Cola, Amazon are already leveraging this day to day ahead. Why are we waiting for? Why not we can also do it and boost our company? So you can bring this idea into the table of your boss, so that you will be noticed that this guys stand out as a leader. So in our next session we are going to actually creating a sales forecast using Excel, and we'll also learn how to do the different scenario planning, and based on different situation how our master budget will look alike based on different provisional income statement, budget, and cash flow, and why we prepare all of these, and use of different scenario planning for stockholder and investor. And also when you are preparing, then CFO will also review these things, and he will agree that whether this is useful to create a mindset in case of worst situation, how we will be going to handle this. So thanks for watching. See you into the next session. Stay tuned. My name is Sanaullah signing off. Hello student, welcome back to IBS. Today we are going to discuss about sales budget. This is the part of our master budget. So we have learned about the master budget, use of AI in master budget, and various other theory point of view. We have learned so many things. Now we are going to understand practically how a company create a sales budget, and then further they create all the financial statement and production budget, etc. So today's topic is obviously we are going to discuss about a sales budget, how we are going to create. And before that we have already discussed how to do your strategic planning and target setting, reviewing financial statement of 2-3 years, and finding trend, finding seasonality factor, finding scenario planning, and also based on the management guidance and all. So once everything is been decided, when we have come to the particular point that this should be our sales, so then we will be creating the sales. So let's jump and understand this. So this is a kind of manufacturing company. So your sales is being considered as an 847k. Since this example I have taken for manufacturing company, in case if you are in service company, how we are going to deal that I will discuss later. Now let's concentrate. So company has decided there is 3 product for this company: artistic sculpture and handcrafted jewelry and unique wall painting. So these 3 product they are selling. So they have targeted for this year total sales is for this product is around 3200, and this is 1800, and this one is 2500. And then they have their selling price. So the selling price they have also decided based on the research and pricing strategy based on competitor, and your product has marketable cost. They are considering that they can sell this product into this price. Maybe their competitor is selling little bit higher or lesser, whatever it is, but they have decided to sell their product in this price. So now we will do the multiplication for these 3 product, and then we will get the total revenue, and when we add together then you will get your total sales of this year, that is forecasted sales. Now what if your company is not a manufacturing, if it is a sales company, then you will have to change little bit based on the service. Okay, for example, your company has like Oyo, so maybe you are going to sell in India, have a contract with 3200 hotels, and then based on number of room or something, whatever is that, you have decided your earning for from one hotel. Don't go by number, just that this is total number of hotel and average earning per hotel. Okay, average earning you have calculated. Likewise, you have hotels tie up based on the contract. You have 1800 contract for another country, maybe USA and Europe. Similar way you will be deciding number of your hotel, and then you are multiplying by the average earning from per hotel. So based on that you are calculating your total revenue, and that may be different based on the company. Maybe this is just a summary, and in India maybe you have tie up with 10 different cities so based on city also you may be calculating in one city how many number of hotel we have and how many average revenue we are going to generate. So based on that you will calculate. So whatever the industry and business you are working, based on that it will be change, but ultimate standard procedure would be similar. So this is how you will be defining that either per day sales or per unit sales or average rent per day. So based on your business nature you will have to decide quantity and the price, and then you will get your sales total potential revenue for that particular year. Or if it is not year, you can consider this is for quarter 1. Similar way you will create and calculate for quarter 2, quarter 3 and quarter 4, and then you will club together all of the revenue, then you will get your total yearly revenue. So once you have calculated your sales, then you will be creating further your production budget. And if you are manufacturing, if you are service industry, you will calculate based on your business what service you are giving. So for that, what would be your cost of goods, what would be your direct cost, what would be your indirect cost, what would be your variable cost. Accordingly you have to calculate different cost and then prepare according to your sales. Sales will give you the input. Okay, now we are going to jump into the Excel and understand a different scenario planning. So first you need to take income statement for that particular company, and just I have taken for 1 year in quarterly basis, and then I have clubbed all the quarterly revenue into yearly, and this I have same sales forecast I have split it into quarterly basis, and then once you add all this quarterly budget you will get your annual budget. So based on annual budget, again you are going to forecast for upcoming periods from 2025 to 2028. So now again the same way you will do the sales forecast based on your research and study and the financial statement review, etc. So now we have decided our sales would be increased by 10%. So similar 10% I have applied for all the businesses, all the source of revenue, and maybe your company will have different source will be increased yearly by different percentage. So it all depend on company to company. As you can say, this one I have used a 12%, and for this one I have considered 10%, or in this one I have considered 8% growth. So accordingly we have calculated for 4-year budget. Let's think it these are also detailed budget, quarterly basis, quarter 1 to quarter 4 we have prepared detailed budget, and then once we have clubbed this become your annual budget. Based on your first year annual budget, we are now creating summary of forecasted 4-year plan. So now you have overall 5 years of plan ready in your hand. So this is how normally company do. Even if you want to create for 5 more years, so then simply you need to use the same formula and extend it to 5 years, you will get your 5-year value. But that is not much impactful. But if management wants, you want to see what would be our 10-year growth, so you can also create similar way. There is nothing much you need to do. You just need to copy this similar way, or you can simply copy this way. So now we have calculated budget for FY28 to till FY33. So now if you can see how much is our upcoming EBITDA in 2033, you get an idea. So this is how company create. If they are creating for 5-year or 10-year budget, so they just drag down and drag it and calculate it. So that will give an holistic and overview to management how much revenue they are going to generate. So they will see this total in 10 year we are going to generate revenue around 13 million. So this is what gives management some sense that our business will grow or not. So but this is not ideal idea to create 10-year budget, because you know the technology is changing so fast, so it is no point of creating 10-year budget anyway. But if management want, you can create it. I told you how we can do it. Then we have a cost of goods. This cost of goods how we have calculated in various budget. Then when I will be keep on teaching you how to create production budget and all, then you will know. But now focus on this. So from there we have taken data for cost of goods, then we have reduced that cost of goods, then we got the profit margin, then we have updated our all operations related operating expenses and fixed rent and other indirect expenses, everything updated. Then this has been reduced, then we get our EBIT margin and EBITDA margin kind of stuff. Then similar way we have reduced our interest expense, then we get EBT, or in India we say it PAT. Then we have reduced the tax would be similar based on your country percentage, and then we have received our net income. Then you can calculate your profit margin. Simply you can calculate by this way, equal net profit divided by total revenue. This is how you can calculate your net profit. So this Excel sheet I will be sharing you so you guys can practice it. So So once we have our income statement, then we will be going to do some kind of scenario planning. So in scenario planning, what I did, I have linked this income statement based on our current income statement. So this one is as it is just being linked. If you see that income statement G911, so you can see G911. So G911 is this. Now we are predicting is for 2025. 2025 has 928. Let's see how much is here. It has different percentage because in this we have different rate for all the product, but here I have directly considered 10% increment. From this, if you add 10% increment, you will get the same value. Okay, 931 700, same. So either you can link with this or you may create. This is just for education purpose, so don't go in that way. Similar way, I have linked this cost of goods. I have considered 70% of our revenue, then we got our gross profit, then we have linked our internal, then we have linked the operating expenses. This is all are coming from income statement. Then we have our fixed cost, and then our operating expenses, interest, income, and net income. Okay, then similar way I have created another assumption for assumption 2. In case if market is stagnant and are fixed, they are not growing, they are average or something, so we have considered in that condition our revenue will grow by 5%. So accordingly I have created assumption. So when you are creating assumption, that time you may consider what are the cost is genuinely required to run this business, and some of the cost, like I have told you, recurring nature, like painting, like furniture, premium furniture, and infrastructure, good office location kind of a stuff doesn't matter when you are running with crisis or something. Like we are going to generate average profit. So in normal condition we are going to generate profit about 147k. So now in bad condition, even if in 5 condition we are generating not much less, right? So that is the power of scenario planning. We are systematically reducing all our recurring costs which are not important. Like without incurring those expenses, still we can generate profit, because ultimately business run based on the service or product you are supplying to that client or customer. They are paying for that thing, right? They are not going to pay you for your infrastructure or something else. Okay, so that is why those expenses we can cut down in case of average condition. And in case of worst situation, like revenue is going to 2%, maybe revenue may go minus 2%, so our revenue is going to reduce further. So in those conditions we will further look over all the expenses, because you don't have other option, because market is stagnant and there are multiple competitors. So you have two options. If in case the market is facing disruption, for example Tesla came into the market and then other automobile industry was struggling because he has come with new idea like EV cars and all. So you have two options: either you cut down your cost as much possible and keep the same quality of product, and alternate option is you can take this disruption as an opportunity and you also invest a lot of money in R&D. So if company is doing that thing, then you might see here a lot of R&D related expenses keep on increasing. So company has, in case of disruption, company has only two options: either cut down the cost and jump into that disruption and do it more better than your competitor is working on those kind of things. So any external force which is going to impact to your business, you should react to that, either invest in R&D or you cut down your cost. So if you are cutting down your cost, that means you are not fighting with the disruption and you are accepting it, and then you are cutting your cost, so you will not survive for a longer period of time. So you have only option is to cut down your cost and stay as long as much possible if the disruption will take over the entire market. So our topic is with regard to scenario planning. So in case of worst situation, disruption and external force is impacting to your revenue, so you have to cut down your cost. And how you are going to cut down, I have considered different percentage. You can also consider based on your internal decision and management decision which cost you are going to completely wipe out, and which cost, maybe salary of supervisor, you can see keep on increasing. The company may target to cut down some of the employees, so this cost may go down. Okay, similar way factory cost you can see keep on increasing based on the agreement. If we have signed the agreement that every year we have to increase revenue, increase the rent by 10%, so it is increasing by same way. But in case you are facing disruption, then obviously you will go for small office. You are also cutting down the heads, so obviously you need a small office. So this is how you can better plan in case of different situations. Since we have created 3 different pro forma income statements, similar way you have to create 3 different pro forma balance sheet and cash flow, because as I told you, cash flow and balance sheet will be important for shareholder and the fund investor or private equity who has funded you. They want to see what would be your ratio in case of worst situation. Will you be able to maintain the agreed term and condition or not? So that is why you have to prepare all 3 financial statement. But this is for education purpose, so I have just created for income statement. So now I have created this in case you feel that your business. So this is the place. This will be your backend data that you will kept it somewhere else, and this one you will be presenting in this live session. When you are presenting to investor or something, you are saying in case of condition 1 is 10%. As you can see, assumption 1 is 10% and market is good. So you are showing them that in case of good situation, we are having 10% growth and our net profit would be this much, our EPS would be this much. As I have mentioned this manually so that you can see that it is matching. Then if we change the condition, if our market is stagnant and condition is not good, then the condition 2, if condition 2 will come, we will follow this budget, because this is income statement and this is your indirect manufacturing labor. So for labor, the person who is taking care of this line, they will be given this fund. If condition is 1, they will be given this much fund. If condition is worse, then he will be given even shorter fund. So this is what I'm trying to say. So you can see immediately budget is changing. Similar way this is created in Excel, but if you are using AI and plug-in software in your ERP and Microsoft Dynamics, so in real time you will see that everybody can see from those who required that information, like labor team need, indirect manufacturing related, their budget. So if you change this immediately, they will also notice that the budget has changed now, so there must be some problem, so he will know. And the equipment maintenance team or the person who is dealing with equipment maintenance, he will know. The utility, whoever is taking care of utility, so creating control that the person who is taking care of these two, he will get the notification for these two that budget has changed. So you don't need to change it and then mail it to one by one individual. So that would be big task, right? For that you need team, because this is a company. If company is giant or something, so if you are changing based on the situation or scenario, so for communicating everybody is also equally important. And this is just a 5 line, but in company there may be hundreds of line item, and different company has different RC. So you cannot inform everybody. If you are informing, that is also one of the biggest task, I would say. So that is why if the same thing is plug in with ERP, then it will be very easy. So if you are changing based on the situation, everybody will notify and they will get the pop-up message. Anyway, so condition 2 is when the average revenue is going to generate, then your revenue is this and your bottom line profit is 138k. Then your EPS has changed. You can see this is the average, so it is matching with this. So you don't need to show this. I just kept it so that I can show you. Okay, so management will see that our EPS, earning per share, would be this much. So he will calculate that how much share I have and how much money I am going to make. If the condition would be worst, then our profit would be this much. So they are prepared now. If we are sharing this kind of information, they are also reviewing and they are getting that. And then you can create data visualization so that they will know that in which condition how much revenue I'm going to generate. So they will know by looking at this that in case of this situation, worst situation, I'm going to get this much EPS and yearly it is increasing. And in case of average, I'm getting this because it is mentioned average, and up situation is this color. So they will know that what going to happen. Okay, so how I have created this. For that, if you can do it, I just let me show you. CHOOS choose, you select the choose, then select this plus click F4. So fix it. Now it is being fixed. Now I am selecting, this is first, and I'm also picking the, this one is revenue, so I'm picking the revenue. So first C4 will consider this as a first. Then if you click comma, this one he will consider scenario second, and this one he will consider scenario 3. If you have further more scenario, you can select it. So they will consider different assumption. Now if you click bracket close and click OK, it will pick. So I have actually updated the revenue, so that I will click, then I will cut it and I will paste it here. So revenue part will be updated. You can delete this and delete this. Now I want to update the percentage. Now it is being considered as a 10%. Now you simply drag down it will pick, also drag down, it will pick. So this is how how I have created, that I'm showing you. So same formula is applied here, so you can calculate similar formula. If I will do it, then this line and all will, the alignment will be changed. So that is why I'm doing it separately for you. This is because I have linked it, right? If you change this to 2, so it will pick the average. Now if you change it to 3, so it will pick the worst case situation related income statement he is picking. You can see same amount getting, and you can also check in the worst assumption how much is revenue: 133k, 179k in 2028, 179k, and 2024 133k. So it is working fine. And also I have checked it by this way, this minus this, it will give you the information whether it is picking the correct information or not. So obviously it is picking the correct information. So this is how you can create a different scenario planning. You can also create your income statement, balance sheet, and cash flow, and represent it in front of management and try to make it more attractive, and use the standard of financial modeling. That also important. We will take 10 lecture to explain you how, what standard is being followed throughout the industry, what space you will have to keep it here, what space you have to keep it here, what format you have to keep it, and how, what thing would be bullet. These are all our standard which is being used in entire investment banking industry. So that is separate thing that I'm not going to discuss. But yeah, you need to create your financial model so that it look attractive and their alignment and everything look beautiful, because these are raw data, right? If you make it little bit look attractive and create data visualization as much possible, so they can understand these things, because visualization make more sense compared to sharing data, correct? So I think I'm done for the day. We'll see you into the next session. Stay tuned. Thank you very much. Hello everyone, welcome back to IPS. Today's session is on one of the most powerful tools in financial planning, standard costing. Whether you are building master budget, setting up cost controls, or preparing for strategic growth, your ability to estimate cost accurately can make or break your decision making. So in large organization, one mistake in standard costing doesn't just affect finance. It affects pricing, production, sales incentive, and investor trust. This is why it is not just a number, it is an essential mindset. Before we deep dive into the calculation of cost flow of a standard cost, I want to leave you with two big questions. These are the kind of questions that get asked in the boardroom and B school case study alike. Question 1 is, if your standard cost is consistently lower than actual cost across the multiple quarters, it is a costing error, operational efficiency, or strategic pricing flow. How would you diagnose the root cause? Another question is, imagine if you are the CFO of rapidly scaling sales or FMCG firm, would you base your standard cost on ideal condition or practical capacity? What impact would your choice have on the master budget, team incentive, and investor expectations? So keep thinking about these two questions. We will go through the session and I will give you detailed real world answer at the end of the session, just like how it is tackled on top consulting project and CFO discussion. So if you guys has not opened your Excel sheet, so open your Excel sheet. The name of the Excel sheet is obviously master budgeting. So open that. In master budgeting, we have a sheet called various budget. So we'll go here. So now you can see we are calculating basically a standard cost. So in a standard cost, we have few things: direct material, direct labor, variable overhead, and fixed overheads. So these are the four things. If you able to calculate their standard price and add together, then you will get your standard price for that particular product. So since for this learning journey we are calculating price for these three products: artistic sculpture, handcraft jewelry, and unique wall painting. So for these three we are calculating their prices. So we have learned all those other things. Let me just little bit revise you. We have first calculated the sales budget and we have defined that how much unit we are about to sell based on sales forecast. Then we, based on this sales target or sales forecast, we have created our production budget, and based on production budget we can also able to create yearly production budget. So how we are going to calculate that we have already discussed in the last session. Then we have learned about the how we can split this project budget into monthly and per day basis, so you will know how much quantity we need to produce every day. Similarly, direct material usage budget is also we have calculated based on the taking input from your production budget, correct? And then we have calculated this, the unit of direct material to be used, that quantity we have considered for all the product, and then we have applied how much direct material is required to build or create one product. So every product have different quantity. This one is 2 and this one is 15 and this one is 1. Then we further discuss about the cost budget. Then we have calculated the average price for per unit of product. So it is 8 for sculpture and handcrafted product cost was coming for direct material only 12 and then 15. So likewise, then we have able to multiply with the quantity required and then multiply by this average price. Then we got the total cost of direct material. Then we have added together, then you will get the total direct material including all products, which was around 123k. Then we have already discussed about the direct material purchase budget, in which we have also again taken the same quantity and then we have adjusted our ending direct material. Then we have learned about the direct material, in which first we have considered the total quantity of direct material to be used. Then we have added the ending direct material, correct? And then we got the total unit required. Then we have reduced our beginning direct material, which was already available. So we don't need to purchase that material because we already have. Then we have got our final direct material unit required for each product. Then you multiply with unit required to produce one product and then you got your average price and cost likewise. So then we have discussed about the direct labor budget. In direct labor budget, we do not have any opening balance, correct? So then we have calculated our average direct labor cost for particular product based on number of hours he is going to serve, what salary he is taking, how much productive time he is going to invest in company. Based on that, in particular time, how many quantity of product he is going to produce. For this artistic, he is going to produce 4 product in 1 hour. For this one, the another labor or maybe same labor, he is taking half hour. For this, he is taking more than half hour to create one product. And then we able to multiply this timing required and per hour cost of direct labor. Then you will get your per unit direct labor cost. So this is how we have calculated our direct labor hour. Then we have multiplied this the direct labor per hour rate and direct labor hour required. Then we have calculated direct labor cost per unit rate and multiply with total unit to be produced. Then if you club all the product together, you will get the direct labor cost. Then we went down and understand about the manufacturing overhead related budget, in which we have fixed cost and some of the costs are variable, and then we have divided by direct labor hour, because this particular model is labor incentive, because direct labor cost is somewhere around 450k and direct material cost is around 125k. So obviously labor intensive production we are doing, so that is why we will divide the fixed cost by labor hour, so that we will get the per unit production cost. Similar way we will divide direct labor hour with your variable cost, then you will get the variable cost for that particular product. Now we are going to learn about the calculation of standard price. This is our traditional approach, which is still effective. Similar concept, since we are now exercising to build our concept. Once the concept is ready, you can apply similar concept in when you are going to apply AI and machine learning. For that, you should have this kind of expertise about the cost flow and cost calculation, etc. Then only you will be able to apply this learning into your AI and machine learning project when you are implementing this kind of automation in your system. So let's calculate the direct material cost for per unit of product. So obviously we have average price per unit, which was $8 or 8 rupees, and then we have multiplied by number of unit required, direct material required. So obviously 2 unit of material was required for every product. So then obviously 8 multiplied by 2 will be 16. So similar concept has been applied in handcraft jewelry and unique wall painting. Let's check it where it is referring to E27. As you can see, it is referring to us E27 and to E24. Let's see, this is E27 and E24. So this is your direct labor unit required from each direct material used to create one product. So obviously we have total number of product, then we are using 2 kg or 2 product of raw material to create one product. So as mentioned here, you can see per kg per unit. So this one we are getting from direct material usage budget. Similar way you can see here, if you calculate for handcraft jewelry, so similar price will be available in standard costing also. This price, then unit required, so we are getting 18. Let's check it out how much in the standard price we have considered there. Look, it is also saying 18. So similar method is applied for all the product. So n number of products you have, you will use the same concept. Then you need to calculate direct labor standard cost for every product. For that, obviously you will use the average direct labor hour rate, which was actually 120, and then you will multiply this with direct labor hour required, so which was actually 0.25 hours, which means 15 minutes it will take to create one product. So within an hour he will create 4 products. So cost was 120, so obviously 30 is the total cost for every product. So let's see how we have calculated here. Per unit direct labor cost is 30. So direct labor required for particular product was 120, and he's taking just 15 minutes. That is why I have mentioned 0.25, because 60 minutes will be considered as a 1, correct? So obviously if you divide this by 4, you will get 15, and if you divide this by 4, you will get 0.25. So we are calculating, so we will not use minutes, we will use quantitative terms. So that is why I have used 0.25. So if you multiply this 120 into 0.25, so you will get 30 rupees is the rate for one particular product. So now we got the standard price for direct material and direct labor. Similar way we are going to calculate variable overhead and fixed cost. So let's see what he is saying. So he's saying H66 into E48. So average direct labor hour required per unit. How much labor required in 1 unit of production? For this, obviously 0.25 is the required labor hour, and then variable cost per unit. So how much is our variable cost per unit? We can calculate it here. So if you can see direct labor required time, then we have multiplied this time with price where you will get variable cost price is this. If you multiply this, see, we got the same price. If you can bring this, so this is the exact same calculation, as you can see this. So what we are doing in variable overhead, we are basically multiplying a direct labor hour required for per unit. How much is the requirement? So obviously 15 minutes or 0.25 is the requirement, and then we are applying with variable cost per unit. So variable cost was obviously $8. So if you multiply this, you will get your variable overhead cost for per product. So similar way you can calculate for all the other product, and similar way we are going to calculate for fixed overhead cost. So obviously average direct labor hour required for each unit of production was 0.25, and fixed cost was somewhere around $15 or something. So let's calculate it right side so that we can check. This is the price, and we have same time 0.25. So we got this similar cost. We can check further if you want. Look, you can see. So this is how we are going to calculate our fixed standard cost. And then to cross check, what I did, I have updated the total price for each of the product, like direct material cost I have updated, I have updated direct labor cost, then clubbed together, then I have updated the variable cost and fixed cost. As you can see, this is the fixed cost, this is the variable cost, and then we have, this is the labor cost, and then you have your direct material usage budget, which is 123k. So similar cost I have updated here. So this, if you are clubbing together, it is coming 1651k. And similar way, if you multiply this standard price, because we have calculated this plus this, which is 46 plus 2 and plus this 3.8, which is coming around 51.9. So similar way, I did F2, you can check it. So when we club all this together, we are getting cost around 51k. So 51k, if you multiply by the number of unit produced, so you will get your cost product wise, you will get the cost of particular product, and then similar concept you will apply for these two. So if you club all these three, your cost would be exact same 651. So now if you can match this, whether we have calculated which is correct or not, you can simply add this and reduce this. You will get this, it is having no difference, so it is perfectly calculated. So if you are getting any confusion, you may rewatch it so that it will give you the good command on this. I have been sharing this Excel file with you, as well as you, when I'm teaching you, you should also practice this, so that you can pause this and practice this and check it whether what I'm taking is correct or not. Also try to think a lot of question, why I'm taking this, why I'm not taking something else, so you can get more exposure on this. So these are the simple things which you need to calculate. Finished good inventory, so obviously we need to use the similar standard cost and multiply by your ending inventory. You will get the finished good inventory price. For finished good also we have raw material, so for that also we will calculate. Then you will able to get your total inventory. Okay, now we have ending material. So ending material quantity, you will multiply by raw material quantity required for each product, because this is ending direct material quantity, this is not direct material, so this is quantity. Then we have multiplying by the is quantity required, so you will get total ending material. It must be available this much at the end of the period. There might be slightly differences it will come because raw material may be used more than what we have expected. Okay, this is we are calculating before the period ended, so that is why it will not have any variance. Okay, because we are not now doing the variance analysis. Now we are just learning how to create standard cost and calculate the cost of ending material, finished good, cost of goods, inventory cost, so all these things. When you have finished good ending balance as well as beginning inventory balance, ending inventory balance, then you will able to calculate your cost of goods also. Okay, so what would be the cost of goods formula? That would be exact same formula which we are using in creating production budget. What would be the cost of goods budget which we are going to flow into income statement? Because for balance sheet you need ending inventory balance, you need for income statement you need cost of goods budget. Okay, so that you can create your income statement model. So obviously for cost of goods you need beginning inventory quantity and as well as the average price, so that you can able to calculate the amount of beginning inventory. Then you will obviously you have expected budget usage that you will be adding. Then you will get your expected goods available for sale. Then you will reduce your desired ending inventory, how much inventory balance you want to hold in your balance sheet, correct? So that is the requirement. We are keeping it so that we cannot stock out, so that balance amount we will reduce. Then you will get your budgeted cost of goods, which is this. So similar way you will be same logic you will apply and you will calculate for budgeted cost of goods sold. So these are all budgeted cost we are calculating based on standard price. This all are not actual. So when we are preparing actual, that time we can compare how much it is coming. Then you will know where the difference is. The price has issue, our operations has issue, production quantity we use high material or not. So then how can you compare with the actual? Only when you have calculated this before the period is started, then only you will be able to compare or calculate this, correct? And then once we have a cost of goods for a particular year, so similar logic we will apply how we have applied in production budget. You can able to calculate for 5 years of cost of goods, like whatever our desired ending inventory, that will be the beginning inventory for a fresh year. And then similar way you will add your expected direct material usage, then you will get your total cost of goods availability, and then you will reduce your again desired ending inventory, then you will get the final budgeted cost of goods. So similar concept you will apply and calculate for your throughout the 5 year or 10 year, whatever the management require. And to check this whether we have used the same cost of goods in income statement or not, let's see 639 125. So obviously we have used the same balance in the income statement as well, correct? So this is our sales. Now we are able to flow our cost of goods, and then if you divide 1 by 4 you will get the quarter basis value, correct? Or you can calculate separate as you want. So as you can see, this one what we have calculated here, so same cost we have used in our income statement as well. So I think we are done with the Excel model preparation and how we have learned how to calculate standard price for direct material, direct labor, variable overhead and fixed overhead. Now it is time to give you the answer to asked question. So first question was, if your standard cost is consistently lower than your actual cost across multiple quarters, is it costing error, correct, or operational efficiency or strategic pricing flow? How would you diagnose, how will you evaluate the root cause, where the issue is, where actually the issue is flowing? So there is a straightforward, I would say it could be a combination of various issues we would diagnose is systematically. So first we'll do the variance analysis, like material price variance, correct? You know that direct material has some price. So first we will do the material price variance. So as you know that the material price for each product is around 8. So exactly in the actual cost of direct material, whether it is having the same or it is having differences, so that will give you the answer. Then you will have obviously labor efficiency variance, in which we will use the quantity point of view, that labor has been utilized optimum level but we have considered here, or it has not been used. Like direct labor hour we have calculated 818 for this particular product, but in the actual direct labor are same or it is lesser than that or it is higher than that, that you can able to calculate and understand whether we are having labor efficiency or not. So this way you will be able to calculate material price variance as well as labor efficiency variance. So these two things will check. Then we will check overhead variance. So like as we have manufacturing overhead prices, for obviously for fixed cost the per unit price was around $15.33 or INR, whatever whatever, and for variable cost we were having 8.28 rupees or dollar per product. Then you will check whether the actual fixed cost and divided by total direct labor hour, so whether it is coming correct or not. So that I will be teaching you in flexible budgeting, where I will give you the exact formula, a standard quantity divide by or multiply by a standard price, a kind of thing we will be learning in that. So that don't be confused here. The fixed cost standard direct labor hour to be used to calculate the variance in case of you are evaluating the overhead variances. So obviously that we are going to teach you in the flexible budgeting. So this is, I'm giving you idea so that when I will be teaching you flexible budgeting, that time you can able to reconnect it, actual cost to be applied and actual direct labor hour or standard direct labor hour. So you will be able to connect this. So where is this actual direct labor hour is coming and where is this standard direct labor price is coming. So when I will be referring standard direct price, so obviously all the standard related information will flow from this sheet, correct, and the actual will be calculated separately. Then we are doing the variance analysis. That time we will be learning in detail how you are going to do the analysis. Then we will be learning post period variance analysis and diagnose the issue. Then you might have costing error if standard costs were not updated based on the recent data. For example, when we are calculating the cost, we have not considered the inflation, supplier renegotiation or FX impact. It may simply be considered as an outdated assumption we have taken in calculation of standard price. So that would be the one issue. Like for example, if you are steel cost standard is $500 for 1 ton, and but in market it is now 600 per ton. So if you are comparing with your standard price with actual, obviously the variance will come, because in a standard price you have considered 500 per ton, but actually in market it is 600 per ton. So there is no issue from your buyer perspective or procurement perspective, because they are not able to buy this product on 6 in 500 ton, but you have considered in your standard price because market rate is 600 per ton. So now the issue is from costing error perspective compared to the actual result. Okay, so we are learning to find where the issue is, whether our standard is having issue or your operations has issue. Then we will be solving through operational inefficiency. Consistent high actual labor, machine labor despite of expected efficiency may point to process bottleneck. Use tool like lean analysis, sigma and time motion study to investigate this kind of operational efficiency. What we are saying here, we are using actual labor hour or actual machine hour, and we are considering the efficiency or we are giving the flexibility. Then we are calculating the machine labor hour. Despite of that, if you are having issue, it's simply meaning that we need to apply lean analysis, sigma and time motion study, and we need to educate our laborers to use and operate the machine effectively. Then we have a strategic pricing and product mix flow. If the costs are rising but price can't increase due to market margin shrink, so here the standard cost may be right, but pricing strategy flaws. Also check high selling product or low margin. So adverse sales mix variance we can review. In conclusion, I would say perform all three variance analysis to isolate the root cause and align the costing system with the operational realities and market dynamic. Then re-engineering the processes and renegotiate the contract term and consider the pricing. So you can correct your standard price calculation, and also you can further renegotiate your current contract and do the re-engineering processes. So that will give you the benefit. So that will give you opportunity to reduce the cost and make your standard price and standard costing more accurate and more realistic, because our ultimate goal is to create our budget more accurately. But if you are creating first time, there may not be chances that it will be accurate. So because mistakes will be the great teacher, so you will do mistake and learn it. If you are not doing mistake, you will not learning. If you are making budget which is 100% correct, it means you are not learning, so you will not know what impact is going to happen with the help of inflation, and the price what you have considered from market is the correct price you have considered. So that is very less probability to create budget which is very accurate kind of stuff. Okay, so next question is, imagine if you are a CFO of a rapid scaling sales or FMCG firm. Would you base your standard cost on ideal condition or practical capacity? What impact would you choose have a master budget team incentive and investor expectation. So obviously when we are creating such kind of calculation for standard cost, so obviously we cannot consider ideal condition, because ideal condition will not consider the labor will go outside and labor will take break, labor will go 4 times for restroom, and labor may be sick, labor may go on leave, and machine may not be working sometime. So these are the thing, if you are not considering, then it means you are making ideal condition, so which is not possible. So obviously you need to figure out the practical capacity. So basically ideal standard are flawless execution, no downtime, no error, and obviously it is not going to motivate to your team members. So and often it is unachievable, leads to demotivation and constant negative variances. And practical standard obviously reflect the normal inefficiency and machine maintenance, realistic productivity, aligning the better and actual performance, fewer denormalization surprises, correct? And impact on master budget, ideal standard obviously will be a lower cost, unrealistic budget, actual overspending, loss of credibility. And practical standard obviously help in realistic cash flow planning and procurement and hiring and capital allocation. So everything will be more accurate if you are using practical standard. That is also going to impact on your incentive of employee, and also you will not be able to calculate correct KPIs, because ultimately it is not going to achieve when you are creating ideal condition. So in conclusion, I would say for fast scaling business, practical standard provide a more sustainable and accurate and strategically aligned basis for master budgeting and cost control. Ideal standard may be better suited for benchmarking for long-term process excellence program, but it is not suitable for realistic point of view if you are strategically align your basis for master budget creation. So thanks for watching. See you into the next session and stay tuned. Please follow me on YouTube, LinkedIn, Instagram, and also visit my website. See you. Take care. Bye bye. Hello everyone. Welcome back to IBS. Today we are going to discuss about master budget part 2. And in master budget we have already learned about the sales budget, and also we have discussed about how to use AI and machine learning to get real-time budgeting forecasting data and get red flag in case any mishappening or any bad news is coming, how AI will react and how it will red flag you and give you the input, and they will also revise your budget. As well as when we are processing the flow of our inventory into cost of goods, for those things also if we use AI, then immediately it will update the average cost, or if you are using LIFO, FIFO, whatever method you are using or average cost based method you are using, that is going to impact correctly, so that you will have minimum differences in the month end. Anyway, so we have discussed enough about the AI uses. Now we'll go and learn traditional approach, how we normally create a particular budget. So sales budget we have done. Now we are going to discuss about production budget. Before that, I'm just going to give you a visualization how master budget flows are, so that it will be helpful to you in case if you are giving interview or something, if they will ask you when you are creating a budget, will you prepare direct material budget first or production budget first? So which one you are going to prepare first, whether capital budget is the part of operational budget or not? So these are the question being asked in the interview, and they will know if you are having experience, you can easily answer to this. But if you're not having experience, you may be started thinking, and they will understand whether you have experience or not. So first of all, we will have our strategic plan. Based on the strategic plan, it has been divided into two parts. First is capital project budget and another is operational budget. In capital project budget, you will prepare only when you are having any capital project which is greater than 1 year. So in those cases, you will be preparing this capital budget. If you talk about operational budget, from operational budget, first budget we will be preparing, which is sales budget. Sales budget is based on sales forecast figure. We have already discussed this. And sales budget will divided into multiple parts. As you can see, marketing and selling budget and income statement, and also there is a production budget. So first we will be preparing, after sales budget, we'll be preparing the production budget. As you know, income statement format, first we have revenue, correct? Then we have cost of goods sold. So these are the budget are the part of your cost of goods sold, correct? When we are preparing all this budget, it means we are already preparing our income statement budget. Once we prepare cost of goods, then we have gross profit, After gross profit, you will have other operational budget like electricity, utility related, and fixed rent, and your marketing and other budget. So all marketing and other budget are being part of here. So marketing budget specifically I have mentioned, but if you have any other budget, if you are preparing a salary budget for all your staff, so those all budget will be part of this budget. So now once we have prepared our production budget, you will get input from sales budget. So you need to remember, for marketing budget also you will get input from sales budget. For pro forma income statement also you will get input from many places, like forecasting revenue, that this budget will come here itself automatically. And then cost of goods related, all the budget if you are preparing there, then you will be preparing budgeted production cost sheet, and also you will prepare cost of goods budget when we are clubbing all our inventory and how much is going to flow into cost of goods. So that also budget will give you the straight away information for your income statement budget. Similarly, you will, after reducing this, you will get your gross profit, then you will add all your other budget, marketing budget and all budget, you will keep on adding the schedule, and then you will have your income statement budget. I think I have already explained in Excel how we are preparing the income statement budget. So based on income statement budget, we will further prepare our pro forma balance sheet and pro forma cash flow. This is the flow actually. From sales budget, we will be preparing all this budget. From this production cost sheet, you will get the information for your cash budget, and capital budget, you will exchange the information, because in capital project you have to burn the cash, and also after some time you will generate the cash. So when cash coming in, so also it will give input for cash budget. In cash budget, mainly we are trying to know how much cash is coming in, and the statement of cash flow is different budget. It is purely how we prepare the cash flow. Similar way cash budget will be prepared. So whatever the changes in investment, changes in fixed asset, all those things will come here. Changes in working capital will also be flowing to here. So based on that, this has been prepared. So change of investment, for that you need to prepare your fixed asset budget. Change in working capital related information, when you will be having your balance sheet been prepared, like how much you will have current asset, and at the period of that how much we want to keep our current asset. So all these things we will be learning one by one, so don't be worried about that. But this chart you need to master it. You should know that which budget is prepared when, and which budget has link with which budget. If you are preparing cash flow budget, you are having information from balance sheet, and balance sheet is the place where you get information from everywhere. Similarly, when you are preparing cash flow budget, you need income statement. So cash flow budget will be prepared at the end. So this is the end of the budget, and this is separate budget. This is capital budget. Even though if you are not preparing this budget, if you don't have capital budget, still you can prepare your master budget. So these are two things, and this is the beginning of your budget you prepare, and before prepare your sales budget. For sales budget, you will get information from strategy plan. Strategy plan will give you information how much sales forecast we are planning. As I have discussed, we have planned 3 product 1, 2 and 3, and their quantity we are going to sold 100, 200, 300, and then price. So this quantity which we are going to sell, this is based on our strategic plan. So that is called sales forecast. For that, how we are doing, what we are doing, we already know. Like we are going into the market and understanding the competitor and strategic planning, internal opportunities, SWOT analysis, BCG, everything we will do our research, and then we will be creating our strategic plan. Based on that, we will be preparing our sales budget, production budget. So now we are going to learn about the production budget. Also, I have uploaded all the Excel file and the PPT and PDF, everything in the first folder. So from first folder you download everything, and when I'm going to teach you in Excel sheets, that time you need to open that Excel sheet. You can pause it and check the name of the Excel sheet and open it and practice with me. So here you go. This is our Excel sheet whose name is Master Budgeting, Operation and Finance. This one also you will be having in your first folder. So open it from here, and then you can review this. And this one, you know that we have prepared our sales budget, correct? This is our sales budget. So based on sales budget, we are taking information. As you can see, we are taking input. So this is the input required. Without this input, you cannot prepare your production budget. This is our budgeted sales unit. Based on that, what we are adding, ending finished good material, how much you want to keep your ending finished good. So that is the good which you can easily sell. So we have this much target, plus we want to end up having 10% of inventory as in balance. So we need to produce one product, that is artistic sculpture, somewhere around 3520. Similarly, these are the total requirement of the year. correct? Now you are following me what I'm trying to say. Then we are reducing our beginning balances. You must be having some finished good available in your inventory, like how we are ending. So when you will be preparing for next year, that time you will be having this 322 as in your beginning finished goods that you will be reducing from your next year annual budget. So likewise we are having some of the inventory, so that I'm reducing. So after reducing that, we came to know how much finished good we need to produce or we need to buy as per your company requirement. Then if you can convert this into monthly and quarterly based on your requirement. So if you are dividing by 12, you will get the monthly information. If you are dividing further by 4, you will get weekly production, and then also by day. Why we are breaking it down? We are breaking it down because we want you to understand one thing, that for Friday when your laborers and all came to your factory, they know that how much quantity they need to produce today. For this product they need to produce 11 quantity, for another product they might need to produce 6 quantity, and another product 90 quantity. So the production manager will come with their sheet and they will give information input to everybody. We need to produce 11 product of this and this and this, and for that he will be planning for your direct material usage, direct material they will be having, or whatever the resources required he will be planning. So now we have learned the how we are going to prepare our production budget. Based on production budget we will be preparing our direct material usage budget. If you can see that this information, this is exactly the same. I have not linked it, you can link it. So this is the inventory we need to produce, so that production quantity we are directly taking it, correct? So these are the 3 direct material we need to produce. Before going that, let me one thing I want to clear you, that this is the input we have based on the same thing. You can see this, correct? We have exact same thing. You can pause it and check it. So based on that, this is our total production. When you club together all the products, so total quantity is somewhere around 7,500. Total material finished good inventory we need, that is also 750. Now we have to prepare, total requirement is somewhere around 8250. This is the value of clubbed quantity for all the material, so you have rough idea. So that is giving you one information. We have budgeted sales quantity for all the product is 7,500. Then we have to keep the inventory 10%, so we are having 750 quantity. Then we need total requirement we came to know. Then we have reduced our beginning inventory which is available, so this is total finished good we need to produce. Then we using same formula you can create budget for FY 15, 16 and 17. So what we did here, as you can see, we are targeting that our sales will grow by 10% every year. So it depends, company might be it is going to increase by 2%, maybe 1%, maybe minus 2%, maybe 10%, 20%, whatever the exact percentage has been decided by management and your team, that percentage will come, or quantity directly. If they are giving the quantity, no, we are going to sell 9,000 quantity, so you can accordingly you need to feed this data. But I'm giving you what as standard being followed. So now we have predicted similar way for every year. This is exactly coming from sales budget. When you are preparing sales budget based on this, so obviously in the income statement, as you can see, we have it. Let me show it to you. When we have prepared annual budget for 2024, then in 2025 we are increasing by 10%. In this product we are increasing 12%. This one we are going to increase by 8%. So now I'm checking how much percentage we have grown from 2024 to 2005. This is simply divide by last year budget, so around 9.6%. so hypothetically 10%. So you may use the exact same percentage over here when you are creating annual production budget. Instead of 1, you can also use 1.096, like this way. It is totally up to you how you are preparing your financial model. Then we have 10%. We have planned that we will be keeping the finished good every time around 10%, so that we have updated here. Then after we will have total requirement for 2025. Now you will consider what is the finished good you have. So as you can see, by this quantity we have budgeted sales, then we have ending finished inventory. So this is what we wanted to keep. So this inventory we have produced in 2024, so that was our ending inventory. Now it is being considered as your beginning finished good for 2025. So similar way this information will flow here, and this is based on your percentage or whatever company term and condition, how much they want to keep the inventory. And then this one also based on your input you will receive from either management, or you may use percentage, whatever the way you follow. So this is how you will get your finished good production budget for entire 5 years. So while getting just this information, based on this information we have created 5-year plan. Now you can also predict how much would be the sale if your average sale, if you can take it. Like this is your total quantity is 750. So you will have this divided by total production quantity. So this is our average sales value of every product. So you can get your potential sales for 5 years. This into this, somewhere around 12 million we are going to generate in FY27. Let's see how much is showing in 2027. You can see, we'll copy this, we'll see how much we have differences. Will not be having much differences. Look, there's just 16k differences because this is based on production. We are calculating based on average, so obviously marginal differences will come, but you got it how these everything are linked with each other. So but also there the percentage is different. This one is 10%, this one is 12%, and this one also 8%. So all different products have different percentage, as well as their selling price is different, so that is also impacting. But we are near about the 11 million. So the person who is the manager and someone who can predict that how much our revenue is going to generate, they know the average sales value or something. This is pure mathematics. If you are good in mathematics, you can easily do it, and you can also understand what I'm trying to say. Now we have direct material usage budget, how much material we are going to use. So every product may have a number of material or maybe one material. For simplicity, we have not much, we are keeping one material or something like that. Okay, now we have decided that direct material being used 2 unit or 2 kg for every single product. So if your total production we are going to produce as per this budget, finished good unit to be produced. So this is what we need to produce. We already have some of the quantity. So if we produce this, we will fulfill the requirement of 3520 because we already have 250. So this is the usage. So this one we need to produce for the production which you are going to produce. For that you need material, right? You don't need material for other things. So this is the total requirement of direct material, because every this artistic sculpture need 2 quantity, and this one need 1.5 quantity of material, and this one also need just 1 kg or 1 unit of material to produce one product. So quantity multiplied by quantity unit to be produced multiplied by material quantity required to produce one product. Then we got the total direct material quantity required. We got, then you will have your average price, that is 8, 12 and 15, and that also we will try to calculate based on our supplier input and based on our historical data. Maybe last year we are getting this product on $7 or 7 rupees, and now we are getting in 8. So we'll try to calculate from January to December how much price is normally increasing. Based on that we will take the average price here. So that is why I have specifically mentioned average, so that you will also notice whenever you see this model. So simply we have multiplied this, so we got the total cost of direct material uses, the material which we are going to use in the production. So the cost of that we have calculated now. So total our cost for all these 3 products is somewhere around 123k. Now we are going to discuss about direct material purchase budget. Hold for a second and understand direct material purchase budget and direct material usage budget are 2 different budget. So this is saying how much material we are going to use. Okay, use and purchase are 2 different things. Purchase depend on how much inventory or direct material we already have, then how much we need to buy. And this one they don't care, direct material usage budget, they don't care how much you have or not, they just care how much we need to produce and how much is the quantity required. So that will give you the, that at least we need this much amount of material, correct? And now we are again taking the same requirement, this 3270, you can see 3270, same input 3270. This is finished good to be produced, how much quantity we need to produce. So for that we need to purchase material, right? So that is why that amount we have considered, and then we will add further the ending direct material. So how much direct material we want to keep in our store, so in case any sudden requirement comes, so we will have material, right? We don't want to be in stock out condition where we do not have any material. So this is total requirement for the year, and this one we are having extra material for safety purpose. So we are always keeping some material. So this company has decided they will keep 15%. So that is why they are considering 15% of direct material to be used. And then you got your total unit required, but you also will be having some of the direct material in your factory, right? So that obviously we will reduce. So that we have reduced. Then we got the direct material unit required to be purchased. So this is your purchase plan. Before that what we were discussing was, that was the usage plan. You will multiply
based on the quantity required. So obviously similar way how here you need two quantity to produce one product. So also if you are going to produce 3311 quantities, so obviously two direct material required. So that's why we have multiplied and also multiplied by the price. So we got the actual cost of direct material purchase 52,960. This one is 52,320. This difference is because of different approach, because here based on this they have calculated only, but here we have adjusted the material purchase and we already having material that we have reduced, and then rest two things are same, like unit price per product, this is same, and this direct material quantity required to produce one product is also same. This is why it is coming little bit differences, because we have adjusted these two things. One side we have added, one side we have reduced. Then you have direct labor budget. In direct labor budget, before going further, first understand we do not have any opening balance and ending balances in direct labor budget. So this is the format for direct labor budget, and as you know, direct material, every labor will have their some hourly rate. For example, one labor has 30,000 salary, then you will divide by number of days he will come in office, and then you will divide by number of hour he will work. Based on that you will get your hourly rate, and then you will calculate in 1 hour how many product he produced. So for this artistic sculpture he produced 4 product in 1 hour. So if 120 is his 1 hour rate, then you multiply by 0.25, so obviously you will get per unit cost. So 30 rupees is the labor cost for every product. So how much quantity we need to produce? Obviously 3270. So if you multiply this, you can see number 9810. You can multiply this into this, you will get the same thing. Or you have other option also, you can use this is the rate, then you multiply by timing, then you will multiply by quantity. So let's understand this. There is 3 product as for this company, then they have their direct labor hour rate. How we can calculate that I have already explained. Then you have required timing, he will produce how many product in 1 hour. If he is producing 6 product in 1 hour, then what we will be doing, 1 divided by 6, so that will be the timing he will take. So if he is going to produce 1 product in 1 hour, then I will obviously applying 1. So likewise your budget will change. So now since he is creating 4 products, so 1 by 4, so then also if you multiply this 120 to 0.25, you will get your unit cost, and then you have total unit to be produced, that is also not a big deal. Then you have this, if you multiply by unit to be produced, and then the timing is required. So obviously this will give you how much timing required for this particular product. For this product you need 818 hour, and for this one you need 915 hour, and this one you need 1.5k hour. So this is how you will calculate your total hour requirement, and this way you can calculate average rate for per product, and this is the labor charges for per product. So once you club all this, you will get your total direct labor cost. And if you are getting confused, pause it and rewatch it so that you will get the concept clear in your mind. Manufacturing overhead budget, obviously this one you will have different schedule. For depreciation I have mentioned here as in 5,000, but if you are having fixed asset for 100k, and that life is somewhere around, I would say 36 months, divide by 36, so this is your monthly rate for your fixed cost. This is your fixed cost, correct? Fixed cost, and this is your depreciation. So I'm not going to teach you about the how to prepare depreciation schedule and all, but just I'm giving you the thing which is required for you. Depreciation is your fixed cost, so that is how you will put your fixed cost. And then also supervisor salary, you will be having another schedule where you will have a listed item of employee, their basic, their gross salary, their medical benefit, or whatever it is. You will consider everything, their increment and their promotion, expected bonus and everything. Then you will club everything, and then you will create salary of all the supervisor employee, whatever required here you will update here. So this is just a one line amount, but behind that there is a schedule that will be validating this information. So in here you will be keep on adding different sheets, or you may have same folder if you are keeping and linking this to this format, so that will also work. Then you have factory rent, also you will, based on your contract, you need to read and understand how much is your annual factory rent. Then you will have your indirect fixed cost, so you have to club together everything. Now I'm dividing this by direct labor hour. If your company has labor intensive, then you will divide this by direct labor hour to flow your manufacturing overhead cost. So if you can see, our direct labor cost is somewhere around 450k
and your material is just 125k. So your major cost is direct labor. So that is why I'm using direct labor. If that is not suitable for us, then we may use unit to be produced. That quantity we can use, or we can divide by, like we can apply here this one, then you will get slightly different rate, correct? And you can see this is your total direct labor hour. So when you club all this together, you will get 3263. So this is the total direct labor hour. So I'm dividing by 3263 and this is 3270. So if you use these three different unit, we club this unit all together 7650. If you divide this by 7650, then you will have different rate, and also for this one also you will have different rate. But okay, they have direct considered from there. So if you link this here, so you will get different rate, right? When we are going to use quantity produced, then your rate will change. So this is the point, but we are labor intensive, that is why I'm using the direct labor hour. So you will divide like this, your total fixed cost club together, and then divide by your number of direct labor are required, so you will get your unit rate. So that standard rate will flow with whenever your product is being prepared or something like that. Then we have cash budget. Cash budget we will be discussing into the separate session. So I hope you have enjoyed the session and I have given you enough food for thought. So practice this Excel sheet and create a dummy Excel sheet and take sales date, whatever we did the production budget and all. You try also prepare financial model from your end, so that will give you more confidence. Most of the people come to me and ask me, sir, how I do prepare the financial model and how will I get job in FP&A? So there is no shortcut. You have to prepare, take data from any of the company, or maybe create dummy data from your own brain and then create all these things. So that will give you a lot of insight. So which in 30 minutes and 1 hour lecture, even 5 hour lecture, nobody can teach you everything. So you have only one option, that you need to prepare this kind of financial model by yourself. Then only you will have grip and you will have control on the concept. Whenever I'm saying something, even though you are listening to me, you may ignore or you may forget, you will not understand why I'm saying what I'm saying. So that is why I'm telling you to prepare by yourself. Unless you will not practice by yourself, you will not learn this fully. So see you into the next session, and please follow me on YouTube. Thank you very much. Hello everyone, welcome back to IBS. Today we are going to discuss about mastering cash budget, and this is very important topic. So make sure to open your Excel and follow through what I'm teaching you, and also practice simultaneously. Before going through inside the lecture, let's begin with few questions. How can a profitable company go bankrupt? And if your company's revenue is growing 20% annually, do you still need a strict cash budget? So that is the two question you should think. When we will learn entire session, then obviously you will be able to answer this, but at the end of this session I will give you the answer. What is the definition of cash budget? Let's understand the definition of cash budget. A cash budget is an essential financial tool that estimates a company cash inflow, cash outflow, and over the specific period, usually weekly, monthly, and quarterly. It helps to determine whether the business has enough liquidity to operate and pay obligation and plan for future. It is not just a forecast, it is a strategic control mechanism. So to prevent from cash shortage, optimize excess cash, and this time borrowing or investment, enhance decision making and uncertainty. As per 2022 survey conducted by Hackett Group, 39% of world-class finance team normally prepare cash budget weekly basis to demonstrate how a critical cash viability is, and demonstrating how critical cash visibility has become in today's volatile environment. If you talk about core component of cash budget, obviously in the beginning you will have to understand the resources of your revenue, and out of your total resources how much is actually collectible. That will give you the information how much cash we are going to collect, that is our cash inflow. And then the core component of cash budget is obviously in beginning you will have cash balance from period, and then you will have to understand how much revenue we are going to generate that particular period, either weekly, monthly, or quarterly. In that period, if we have generated hundreds millions of dollars, in out of hundreds million dollar, how much cash is going to be collected. So normally companies sell hundreds million dollar of service or product, so they will collect 98%, 99% or 95%. It purely depends on company to company. So you need to research your historical data. Based on that, you will get the information like we are going to collect 98%. So 98% you will consider in your cash budget, but that too when you are going to collect. Maybe possibility that we have sell the product, but cash we are going to receive after 2 months or 3 months. So based on that historical data, you have to understand within bracket of that period how much cash actually we are going to generate. So based on that, you need to update. Also, you need to figure out how much AR balance you have and period revenue we have generated. Out of that, how much we are going to collect. Maybe last quarter related 50% or 12% cash we are going to generate, and prior to that 30 month, like between 6 to 3 month period which is greater than 90 days, so that maybe 3% or 2% we are going to collect the cash. So all these things we need to consider. Then your cash inflow part is clear, and then after you will also think about any investment you have already done, or you are going to sell any kind of asset or something. So from there also you might get resources, so that also you will update in your cash inflow side. And then you have obviously disbursements, all the expense we are going to pay. So that everything related to expense we will be updating. We are collecting information from all the department and reviewing our P&L and historical data and seeing how many vendor we have, how many of them we are paying monthly basis, how many of them we are paying quarterly and on annual basis, and when it is due, when we are going to pay. So based on that, you need to prepare schedule and update all your expense information and get connected with all your procurement and your all the other department, HR, payroll, everyone. So they will give you the information with regard to their expenses and with regard to their budgets, how much they are going to incur the expenses. Accordingly, you have to prepare disbursement schedule. Also, you need to figure out, as I discussed, some invoice may be annually which is being paid in March. So that amount you will consider in March, not in entire period. And some invoice may be quarterly basis, so you have paid in March, so it will come directly in June. So in April and May you will not have those kind of expenses. So these are the things you will be reducing. And then after, you also have to figure out how many are non-cash related item like depreciation, amortization, prepaid schedule. These are the things, if you have those expense, non-cash expense, you have to remove from your disbursement, and that will not be the part of your obviously cash budget. And then also you have to figure out how much tax you are going to collect or how much tax you are going to pay. So out of that, what exactly cash you are going to burn. So those whole thing will come into your cash disbursement part. And after that, you will get your cash balances. In that cash balance, further we will review the financing activity, and then you need to remove all, if you are going to invest or buy assets, so cash is going to burn, so that you will consider. And if you are buying back, so that thing you will consider in your financing activity. And below, if you might be having some based on SLA and debt agreement and debt covenant from your investor point of view, or maybe your venture capitalist and your series B, A, C, whatever series you are having. So those venture capital will also put some kind of restriction. You should have that much amount of cash. So that amount we need to carry as a desired ending cash balance. So for that point of view, if after considering cash inflow, cash outflow, then we have balances and also considered our financing activity. Then after, if it is not covering that balance which we need to carry forward as per the debt covenant and as per the venture capital rule or as per the company on policy. So if we are not having that much fund, so obviously we need to borrow some funds so that we can maintain that amount of cash. So this is how we are working. And also, while making the payment for those expenses, we can also finance some of the vendor payment. For example, if you have particular expense which is going to be for 3-month rental cost you are getting in March or maybe in Jan, so you can ask your bank to split this into 3 month or 4 month, and will pay that. They will pay you on your behalf and you will pay him later monthly basis. Like this also you can monitor and control your cash as much possible. So as a finance controller and VP of finance or maybe finance manager, so everyone who is dealing this cash budget or maintaining the cash budget, so they have to understand all these things. Basically, we are trying to balance and maintain our desired cash so that we are not defaulter in terms of debt covenant covenant, bond related agreements, and also equity holder or the owner of company, they might create some kind of restriction so that they can monitor that company is going through tough time or they are having enough cash. Because as I'm saying, cash is the bloodline of any company. Without cash, no company can run, even though that company is very good and cash rich company. If you're not monitoring the cash, you will not be able to survive. So, and another layer of question is why the cash budgeting matters. So in real world fact, 38% of startup fails due to cash flow issue, and this report has been published by CB Insight. So that is actually very important. You should know that 38% of startup are failing because of only the one reason, which is cash budget. If you are able to maintain your cash, so you have saved your company at least 38%. It means 40% of company is failing because of poor cash management. So because of the finance. So that is why finance and cash budget are the backbone of any company, and cash budget, I would say, bloodline of that company. There is also some other company like Carillion, Kotak, and Evergrande collapse due to cash budget kind of issue. So global failure due to poor cash budgeting, like Carillion UK, a giant company who has 5.2 billion euro revenue in 2018. So that is a huge amount. It is almost $7 billion. I'm not talking about million, it is billion. It means it is a huge company and collapsed due to poor cash flow forecast and over commitment. So despite of being profitable on paper, and its working capital issues and aggressive payment terms create cash vacuum. So that causes him and that hurt him very badly. So what happened in the result? This company is being bankrupted and 3,000 job lost and 450 project stalled. And if you talk about Kodak failed to manage declining cash flow during the digital disruption. As we know, Kodak is a camera company, and then there is a digital disruption has come. A lot of mobile and other industry has evolved and developed, and Kotak was not able to manage sales. So obviously their cash is going to down, so they are not able to maintain their operation from their whatever they are selling. So cash burn without any restructuring plan led to insolvency. Their focus in income statement, not only liquidity, proved fatal. Another example is Evergrande China, a real estate giant company in 2022, and over leverage and lacked the cash budgeting discipline, couldn't service 300 billion debt and leading to liquidity crisis. So these are the big example, like $300 billion, $5 billion company are going bankrupt and their project are getting failed. So this is some of the big learning we should learn from this. So you should also think why such a giant company are failing due to cash flow and due to not properly maintaining their cash budget. Either they are doing overestimate, they are not able to monitor their revenue, from where the revenue is going to come and where they are going to disburse. So these are the things they have to keep on monitoring. So it gives us an understanding whether you are a small company or you are a giant company, you have to manage your cash budget. So whether if you consider this in another way, whether you are very richest family or you are poor family are run by cash. If you are not earning cash, you are not able to run your family. So even you are upper middle class or you are high rich family, if you are not having cash, suddenly you will come on road. So cash is the key actually. Now you can open the Excel file which name is master budgeting. In that you will get your cash budget for the year. In that we will have the sheet whose name is cash budget. You can open that and practice with me on what I have updated here. So as I was explaining what are the key elements are in cash budget. So this is the overall structure of cash budget. First we will have opening balance, then we have all the collection related stuff that you will update here. Then after you will have your disbursements, all the expenses which you are going to pay. Then after adjusting that you will have the cash balance. Now you are having a kind of free cash balance in your hand which you can use in funding your capital project, and also if you are having less cash budget as we have expected, like this company has targeted to carry forward 100k every quarter. For example, company has targeted to repayment during the period of 150k, and they also have plan based on your capital budget, and they are planning to fund every quarter for 100k. Now they are seeing that cash balance after finance and funding, they are having negative balances. Their expectation to have 100k. So obviously how much they are in shortage of cash budget. So around 160k. So obviously they will knock the door of bank and they will take the loan. So they will update. Now we have 103k. So now we are having enough cash what we have expected. And then you will update the same ending balance as in your quarter two opening balance. Now we'll discuss about the collection point of view. As you know that different company will have different revenue resources. For example, if you are having FMCG company, so you have thousands of different product which you are selling. So obviously for that there is a billing team and there is also a collection team that will be giving you the update how much cash we are going to collect. So this cash budget is prepared based on when is the very important point for cash budget. So irrespective of your sales, it doesn't matter for cash budget unless you are collected that. So when we are going to collect the AR from that sales and how much. So these two things we need to focus. So we have considered for quarter one sales, if we did 100k, so 85% of that we are going to collect within the same quarter. This is what we have observed based on our historical data. So for your company, you also have to study that for last 3 year and 5 year. What is the pattern of your company? How much percentage of sales they are collecting immediately, or and what is the period of your sales? Maybe if you are selling any product and your customer are paying you after a month, after 2 months, so accordingly you have to update here when and how much we are going to collect. So that amount will come here irrespective of what you have sold. That doesn't matter. How much we are going to collect, that amount will come here. So likewise you have to prepare your schedule, update all your sales figure, then update your percentage, how much we are going to collect and which are the customer are paying on time. It all depend on the company you are working. For example, your company has 100 of customer, out of 100, 80% customer, you know that by name that these are the customer who pay immediately. So that amount you will consider as an collectible within the same period. And 20 customer are such a customer, they are paying after 15 days, and out of that there is 5 customer who will pay. Accordingly you have to prepare your cash collection schedule. From that schedule the information will flow here. So you will not prepare here, those information will be in the backend or in another sheet, and you will link that amount here because this is a kind of summary. So this is what we have considered our collection. Then I have updated prior period related collection for last quarter related, year 0 quarter 4 related sales, and from that sales how much we are going to collect in this period, that I have updated. Also one quarter is for 90 days. So beyond 90 days if your AR balance is showing 200k, so you must have finalizing your financial statement. You know that out of 200k which is longer than 90 days will be 50% would be bad debt, or maybe 50% we will collect. So how much is exact we are going to collect, that amount you will consider will be in quarter 1, and how much in quarter 1 and how much maybe you will receive in quarter 2 for which is greater than 90 days old AR balances. So you have to study that, you have to work with your billing team and collection team and review the contract. Then you will know that how much we are actually going to collect. So based on that we need to update here. And then you have to understand about disbursement point of view. There is 2-3 things I would like to clarify. You need to study all your vendor and categorize it based on their billing, monthly vendors and quarterly vendors and annual vendor. Then after you have to further refine that data based on payment terms. So which vendor you are paying after 60 days, which vendor we pay after 90 days, or which vendor we pay immediately and which vendor we pay after 30 days. That will be considered in the bucket of the period. So one vendor is from Jan, expense will go in Jan, but payment amount in your cash budget it will reflect in March, not in Jan. Similarly, if any expense which is related to Jan and what you have paid in advance, so that amount if you have already paid, so then it will not come in your budget. So all perspective you have to understand and categorize and filter it and then update in your cash budget. And then another point is with regard to tax, how much corporate tax you are going to pay. That also depend on when we are going to pay and how much we are going to pay, how much is the corporate tax rate. Accordingly you have to consider it and update here. Then you have other expenses, non-manufacturing related costs. So those cost related schedule you have to prepare, maybe electricity, water, utility, employee benefit, employee travel. So that may not be 100% accurate because travel and other such kind of costs which are variable or recurring in nature nature, and the cost which is fixed, that will obviously you can easily prepare when we are going to pay accordingly, irrespective of the benefit we have received in which period, that doesn't matter. So then you will update all those things. And one more thing is here we need to figure out, you need to keep filter with regard to cash and non-cash expenses. There is several expenses which are nature of non-cash, so like depreciation, amortization, and R&D related, capital amortization related stuff. So those things you need to properly consider and do not bring here, because if you are mentioning depreciation, for example, your collection is $10 and your disbursement is somewhere around $5. So how much net cash balance you will have? Obviously $5. And if you update here depreciation amount, so you know that depreciation is non-cash, so I will be updating here as in minus or plus. Update here minus and plus, that will reduce or add. If you are mentioning is just 2, so that will show you again wrong picture. This is not our free cash balance, right? If you mention in -2, that also not giving you the correct picture, because our cash balance would be after collection and payment of your disbursement, we will have balance of $5 only. So we are considering this non-cash related item just to not to bring in cash budget. This is the point actually. No need to update the amount in minus and positive. Okay, just we are considering this non-cash item so that we could not bring here, because we are not going to pay physical cash or through bank, whatever it is. So that is why it will not come. I hope you are getting my point. So now you have, I would say, free cash balance in your cash budget. Now you are free to use for capital project. If you are not able to maintain your desired cash balance, then you have to go for loan. And if you have any repayment or anything, that you have to update here. And then also I have discussed this ending cash balance will be the opening cash balance of another period. Then similar way you can club all the quarter, you will get your annual budget. Based on annual cash budget ending balance, you will update as an opening balance here. And then again same procedure with regard to your revenue collection, when and how much you are going to collect, that part. And also for uncollected AR revenue, when and how much we are going to collect in 2005 and how much we are going to collect in 2026, and so on. Then again similar way you have to calculate all your disbursement. But these are your detailed plan, correct? But this part you will be updating based on our assumption. So this is how we prepare the cash budget. Now we are going to answer to your question which I have asked in the beginning of the cash budget, that is, how can a profitable company go bankrupted? So there is one of the major reason is you have to understand that profit is not your cash. Okay, profit you may sell for hundreds of millions of dollars, and then you consider your expenses and you will show your net profit. But does this profit actually you have cash balance in your hand? If it is same, then we can say that your profit is cash, but it is not possible, because in profit you have added your depreciation and you have accrual, and based on accrual revenue, based on your accrued expenses, so many things are attached in your P&L. But cash budget exclude all those things, just will show you how much after cash inflow and how much cash outflow, how much balance you have. So that is why profit is not equal to your cash. So point here is revenue recognition, accrual can hide the cash flow gap. If obligation come due before the cash is received, even a profitable firm can run dry. And another question was, if your company's revenue is growing 20% annually, do you still need strict cash budget? So absolutely, growth often increase the working capital needs, like inventory will be increased, your AR will be expand. Without cash planning, and growth can become a silent killer. So this is the thing, we should always follow the tight cash budget, how Amazon, Tesla has managed this very well. And we should also learn from Kodak and other such company, Chinese company, who are having $300 billion of debt and lending to liquidity crisis. So we need to monitor this cash budget more accurate way as much possible. Then in final thought, I would say revenue is vanity, profit is sanity, but cash is the reality. Robust cash budget is not compliances task, it is a survival task, because cash is the oxygen for company. Without that you cannot survive. So in today's environment, companies that master the liquidity win, and not just on stability but also on the strategic flexibility. So I think I'm done for the day. We'll see you into to the next session. Please visit my website and follow me on LinkedIn, YouTube and Instagram. Thank you very much. Hello everyone, welcome back to IBS. Today we are going to discuss about capital budgeting, making a smart and long-term investment decision. So if your company has $50 million and you want to invest, either launching a new project or investing in particular company or any other different kind of investment in your business, like acquiring new company, like merger acquisition or buying asset or going for construction business, all this kind of investment need capital budgeting. So today we are going to discuss about that. Without wasting time, let's jump to the topic. So why do mega projects fail? So basically they fail because most business doesn't fail due to poor execution, but they fail due to bad investment. They don't know exactly how much they are going to get return. For example, if you are investing 100k every year for 5 years, so total investment is 500k, $500,000, and you are going to generate profit, for example, 120 every year. So throughout the 5 years, you have generated somewhere around 1600k. So do you think this is profitable or not? If your business are normally generating around 8% of return, for example, you are taking loan and your investor has expectation somewhere around 8%. So this is your weighted average cost of capital. We can say it WACC. So your WACC is somewhere around, or your expected risk-free return is somewhere around 8%. So will this example of investing $500,000 and getting return in 5 years consistently 120k, so 6 million you are going to generate. So whether this is profitable or not, that we will be going to learn. So these are the investment decision we do based on understanding how much cash is going out and how much cash is going in. So based on that, we will see that also we use time value of money and then understand the investment we are doing and the return we are getting based on today's date, whether this is profitable or they are crossing our marginal profit. Like 8% is our interest rate. Extension of same example, you have taken loan every year for 100k and you are investing, so you are paying loan 8% every year. So if your profit is more than 8%, then only you will generate marginal profit, because you need to pay that 8% to your bank who has given you funding. So that is why we are going to learn here that capital budget is very much important, because most of the business doesn't fail due to poor execution, they fail because of bad investment. Capital budget is huge and large strategic decisions are made with logic of number and vision, not based on business thought. So now we will be discussing about what capital budgeting is. So capital budgeting is the process of evaluation and reflecting long-term investment that are consistent with the firm goal of maximizing wealth. So this is ultimate goal. So scope includes like building new facility, poor development, equipment purchase or upgrade, merger and acquisition, and long-term IT and functional development like finance transformation related stuff. So these are the scope where we are going to invest our money. So basically capital investment are always long-term impact and high capital investment, irreversible of decision. If you have taken decision, you have invested huge amount. For example, in construction business have 100 millions of project and that project will go for 10 years. So if you have completely planned your capital budget and you have worked already for 2 years, so it means you have invested out of 100 million, maybe 25 million you have already invested. So now you cannot reverse. So that is why this capital investment is irreversible decision making. So when you have taken decision, you have to stick to that. That is why this is very much important to do the risk analysis. So the type of capital budgeting already discussed, like large capital, long-term, horizontal, irreversible, high risk in strategic decision. And why capital budgeting is so important? Because connect financial decision for long-term corporate strategy. It involves risk, forces planner to evaluate possible outcome before fund are committed. We need to be very much sure that what we are going to get the return. Because if we are not going to get return more than 8%, what we are taking fund as in that we are taking from other sources, and investor has invested money, so we want to generate profit more than 8% so that our investor will also be happy. So that is why risk management and understanding the business and the project which we are going to invest is very much important. And also do some scenario planning. What if your material cost has increased? What if the COVID has come? What if the vendor is not available? Maybe you are buying some material from another country, maybe China, Singapore, Malaysia, and maybe worker you are hiring from any developing country. And if these are not working for you, then how you are going to complete your project? So for that you have to do a lot of scenario planning for capital budgeting as well. So scenario planning we do for as a whole for entire business, like we have discussed in previous master budget session. We will do scenario planning for creating different layer of planning for income statement and balance sheet and cash flow in case of 5%, in case of 10% of revenue growth, in case of 0% revenue growth. So how you are going to deal with, similar way you have to plan your capital budget as well. Also capital planning is obviously we use a lot of resources we are going to invest, so capital is scarce, and proper budgeting ensure it goes the most value adding initiative, prevent institution based failure. For example, we don't go with our gut feeling, we need to be very sure that what we are going to invest we will generate the profit. So there are n number of company who fails because they have not successfully implemented their capital budgeting. Will give you that data as well based on my research. Okay, let's take few research evidence which will give you the insight how capital budgeting is important. For example, Graham and Harvey in 2001, 74% of CFO in US prefer NPV. NPV is a tool which we will be learning right away how to use that, and time value of money. These are the things are important as their primary capital budgeting tools. So all I'm saying, as per Graham Harvey report, 74% of CFO are using and preferring to use NPV and time value of money to understand about their return in terms of capital budgeting. And this is the very important tools which we are going to learn just right now in Excel sheet. Okay, then Indian specific research in 2023 has published information over 90% of medium large Indian firm use formal capital budgeting method. Firm using NPV and IRR had 24% higher chances of project success than using payback only. So there is another tool which is called payback that is not much effective. So that is why NPV and IRR being used, because these two tools actually calculate the impact of times value of money. World Bank Infrastructure Report 2015 published, and they said that the project with formal capital budgeting had 40% fewer cost overrun. So most of the business, when you are implementing capital budgeting, you are able to manage your over cost run. So this is something very much important. This is 40%, which is huge number. So there are other n number of reports which says NPV and IRR are very important for calculating capital budget. And I'm assuming you must be having good understanding in terms of times value of money. So let me explain you in a simple way. So for example, you have 100 million as of now, and if you having 100 million after 20 years, so which one is more value? Money in 100 million you can buy one land. Okay, and after 20 years will you be able to buy similar land in 100 million? Obviously not. Example of 2 crore land, if you can buy today, the same land can you buy after 20 years? Obviously not. You have to pay extra money. So that is why value of money is decreasing as the time is going up. So that is why when we are going to receive money in future, so we are bringing it back to today's date based on our hurdle rate or expected return rate, so that we can assume that as of today the worth of money is this. So this is what we are going to generate, and this is what we are going to invest. So this is the return as of now. As you can see few data with regard to research insight, 90% of Indian firm use capital budgeting. So most majority of company are using it. 73% uses NBV and IRR. So this is most effective method to calculate capital budgeting. And firm using discounted cash flow technique report better return. So discounted cash flow technique and NPV is almost similar concept. They are trying to calculate like 100,000 we are keep on investing in 5 years. So 500k we have invested, and return we have generated 120k every year like this. So in 5 year we have generated somewhere around 600k. So we are bringing it back as of today. This is year 1 to year 2, 3, 4, 5, like this. So we are bringing this worth of money as discussed, bringing it back to as of now, as of 0. So if we'll discount using hurdle rate, so that hurdle rate is something our discounted rate and our expected return. Based on that we will be bringing it back to today's that. Then if it is coming around 490k and 510k, based on that we will take decision. So if it is coming more than 500k, it means we are going to generate 1000k profit. If it is coming 490k, it means we will be getting more than what we have invested, but as of 0 period we have actually got the return is 490k. So entire mutual fund, insurance, which we pay for life insurance related stuff, so all those places the same method is being used and they calculate. And then people who invest small amount consistently throughout the period and they get good return in future, so they think they are getting more than what they have investment. But most majority of investment, if you do or buy any insurance where you are paying premium monthly basis and after 10 years you are getting return, so those are the return are, if you consider your hurdle rate is somewhere around more than bank interest rate. So if you consider this more than that, then obviously if you will calculate back using NPV formula, or then normally you will not be getting any return or very minimum return you are getting. So that is the strategy bank normally follow. So then the research says capital budgeting boosted the strategic alignment and success rate. So your success rate will be higher as compared to those who are not using capital budgeting and using gut feeling and investing. So majority of small businesses normally they think that they don't need CFO and founder, they don't need CFO or CA, CPA or CMA to calculate their investment. So they are making huge mistakes. Everybody, whether you are small startup or you are mid-size, you all need finance expert to plan your business more accurate way. And also they will be able to minimize your risk. They will able to calculate what you are going to generate in future and what is the worth of that money as of today. Also you can see there's few more data which says the payback method is used by industry somewhere around 27% and reported success rate is only 52%, very less. And if the company who is using NPV and IRR, they are getting chances of 73% firm are already using and their success rate is around 83%. So real option, if the company is using, very less firm are using 12% and their success chances is 88%. We will be learning this part only. Okay, so payback period is simply if you have invested 500k and you are generating 600k, so they are trying to calculate 1 year we have calculated 120k plus. Similar way if you are generating in 2 year, in year 3 you have generated another 120k, in 4th year also they have generated 120k. So now if you consider total 480 is now they have got the return, and after the 5th year they are going to generate 120k. So in 120 maybe 10k every month they are generating, so in 2 months they will generate further 20k, so that will be added. So how much payback period is 4 year plus 2 month, 4 year and 2 month. So this is how they will consider that what they have invested they will return back exactly same amount somewhere around 4 year 2 months. But that amount is obviously has the money you have invested, you have to pay further debt also, or you have to pay your investor as well, and then the money which you got consistently after 5 years, so that value is obviously lesser than what you have invested initially. So that is why this payback method is not very much effective. So that is why their success rate is also very less compared to NPV and IRR. And NPV and IRR will do a different approach that we will be learning in Excel sheet. There are few more research work I did. As you can say, Amazon logistic infrastructure, they also use NPV and IRR model. If you talk about Tesla Gigafactory in China, they are also using multi-scenario capital budgeting and future, like they are planning to know about the future battery demand and mining input cost in EV market, what would be their EV market. Based on that they have to do the investment, so they should be aware of all these things. So this is a very useful tool actually which we are learning. Zomato and Blinkit, with regard to acquisitions, Zomato must have done the capital budgeting before investing in Blinkit. Not only capital budgeting, we can say that they must have evaluated the Blinkit revenue and their potential for future return kind of stuff, and they have further calculated what would be the capital we are going to invest in Blinkit, and then when we are going to get the return, what would be our IRR, what would be our NPV, and when we are going to get the entire money. So these are the calculation is very much needed. And there is some issue which we have with regard to capital budgeting, with regard to risk bias and human error. As you can say, optimism biasness, like understanding the cost and overestimated the benefits, this will be the huge problem. And most of the finance team member, they are trying to underestimate, and not willingly but intentionally they want to reduce the cost as much possible and bring the profit much more than what actually in real life there is possible or not, because it will look good in bottom line profit and the project return will look good, and after 5 years maybe that finance modeler who has created them may not be in that company. At the time when they have prepared, they will be consider that they have presented the fair and true financial model, but company is going to bear the losses at the end of the project completion kind of stuff. So as an ethical practice, we should keep in mind that we should not underestimate the cost and overestimate the revenue just because we want to maintain the great profit, great ROI or great NPV. But our job is to give the correct strategic insight to let them take the decision, so they will take right decision, right? We should not dilute their thought process. Otherwise, as a founder, if you can think team member is creating good project, at the end that is not generating that profit, so how will you feel? So you have multiple option. One of the option we have selected based on the financial model, capital budgeting model has been prepared by that particular finance team or FP&A team. Based on that, investor and the founder of that company are taking decisions, so you should not bias on that. And sunk cost fallacy, continue to bad project due to past investments, we should not do that. We need to evaluate whether we should further do that project and we should close that based on your legal term and condition. And politics in capital allocation, obviously favoring the internal department over return on investment. Capital budgeting is much behavior finance as it is mathematics. Capital budgeting is a much behavioral finance as it's mathematics. As we know that emerging trend and capital budgeting and their AI and machine learning in capital budgeting is actually being used currently, like predicting the cash flow and with the help of machine learning, and that will be helpful for calculating your cash budget as well as the similar input you can use in your capital budgeting, because based on cash budget you can fund your capital projects. ECG adjusted budgeting, like return on investment plus impact measurement, so that we need to do. And automation tools such as Oracle, Anaplan, SAP, BPC and other Power BI tools are very much effective. They are giving real-time insight and they are also suggesting based on their understanding of data. So these are the tool, and data scientists and data analytics team are very much helpful. And when finance analyst and data science team working collaboratively, so that will bring good result and help management and take right and accurate decision and boost their company. So now let's jump to the Excel sheet and understand about the NPV calculation. For example, as you can see, this is simple ERP implementation project I have considered because we are finance team members, so that will be more suitable for us to understand that. So for example, we are buying a particular software and that licensing cost is somewhere around 100k, and then implementation and other cost which is 150k, and training and development related stuff. There is employee whom we need to train, so the company who is going to provide this service, they will charge us. We need to further buy some hardware or something, we replace some old hardware, so that is also one of the cost. And additional module, maybe based on our business we have selected 4 or 5 module, and maybe we need further more module like inventory module, POS module, auto bank reconciliation module. So based on current understanding we have selected, but maybe after 5 months or 6 months maybe we need more module that will be more automate our process. For that also we have added some extra fund. Then we have contingency reserve, maybe overall in project some of the extra cost requires, for that cushion we are trying to have. Then after considering all this, we have considered that our total cost of capital budget is somewhere around 430. So this is what we are going to invest. But are we investing entire amount today? Obviously not, right? So for example, if we are investing entire amount software licensing and implementing services companies, then our return would be different. But if we are going to invest that particular amount like 220, we will be giving in advance, and after year we are keep on giving 50,000 every year. So like that, if you are investing, so maybe we are investing a little bit higher. And now don't go on that way. So for example, if you are investing one amount at the same time, and if you are splitting that amount throughout the year, and then your return would be different. And this is our cash inflow. Cash inflow we have calculated based on maybe earlier you might need 10 employee, maybe 5 employee are working on bank reconciliation, because maybe the FMCG company having thousands and thousands of bank transaction every day, and if you are doing the reconciliation, it will need a lot of employee who can work together. There would be one manager who will consolidate all the information and check with revenue. So there is team required to do this. But what if we have implemented some POS automation and we work with bank, and then we can easily reconcile? That I have already done in my previous company in Saudi Arabia. We have FMCG company where they were having multiple store, and every store have various different transactions. So we have implemented different bank we have opened, and then in that bank we have discussed with bank and created such a mechanism for every branch transaction will come together, and when the batch will close, and then we can easily able to reconcile, because bank was also able to provide us some kind of data related document which we can download from bank, and then we can upload the same data in our Dynamics or SAP software, and then it will automatically calculate and reconcile, and whatever the variance is coming, that will give us the report, and that variance related stuff we are checking the reason behind this. So that has actually reduced a lot of time. There was actually 4 people who are doing this kind of reconciliation for different store. 1 people are maintaining reconciliation for 2-3 store. Likewise, we were having 10-12 stores, so every accountant are reconciling different. After this implementation, we don't need 4 accountant. We are needing 1 accountant who will do this reconciliation, and another accountant who will do the partial review of that reconciliation. But because they wanted to know whether that accountant did their task properly or not, so internal control has been set up, and that particular accountant who was reviewing that person was busy entire day for doing this. But now he's just investing couple of hours and reviewing all the summary file, and then they are closing, and he's also having free time to work on another project. So that 2% cost company was having to pay monthly salary, and also that cost we have considered as a cash inflow. So similar way, whatever project you are going to do for construction business, if you are investing hundreds of $1,000,000 in creating road, and after 5 years you are going to collect the toll tax, and based on potential toll tax you must forecast how much we are going to collect. Based on that, we can also consider what cash inflow is going to generate. So similar way, I have created this. These are our all cash outflow which we are going to pay, and this is all cost inflow. So as I was giving you example of 5 lakhs and 6 lakh return, so based on that we have calculated what is the return on investment. So on project, if you can see, this is saying that 28% we are going to get the return, but this project is saying we are going to get the return is 21%. So you will love to invest into this business based on the report. Okay, but further when we calculate payback period, you guys has to calculate. That is why I have not worked on it. So these are also you need to calculate by yourself, but my concern was to make you explain these 2 things. So what internal rate of return is saying about this project? We are doing scenario planning here. Project A, project B, same project, we are going to invest in a different way. Here we are giving entire 430 at once. Here we are giving 470, more than what we are actually giving, but we are giving it consistently 50,000 every year, and initially we just paid 220. So we have splitted our payment. Now we have in the project A first part, we have invested entire amount at once, and return is almost same. Our hurdle rate is 10%, because company normally have their weighting average cost of capital WACC is around 10%, or investor expectation is at least 10% return, otherwise they will invest in another project. So based on that we are calculating. So project A is saying we are going to generate around 28%, but project B is saying we are going to generate less. But if we consider IRR is saying for project A where the ROI is higher, but here IRR is lesser. As you can say, this project is saying our IRR is 18%, much more than what this project is saying. So what IRR does, IRR consider the time value of money, and then they are calculating it back as of now what percentage we are going to generate. So company hurdle rate is 10%, we are getting return is 12%, so it's still good project. But if you split your payment outflow, then it become a greater project for you. So this is how you should develop your thinking, how you can bring more profit, because we have not invested entire money at once. So just we need to pay this 220 for year 0, in year 1 we need to pay for total 270, and here if you are paying 10%, so 43,000 you are paying for every year. So if you can consider, make it simple, 43,000 into 5 years, so you are going to pay somewhere around 200k in interest. But if you consider here, you will be paying lesser amount. Year 1 you are paying around 22k, in year 2 you will be paying this plus, so 27k around. Similar way every year it will be increased, like 32k, just taking example, and 37k around, right? Because if you consider 10% till there, we have paid 37 it is coming. Similar way it will be 42, then 470, correct? So total how much we are going to pay? We are going to pay in total around 200k. If you bring this back based on the interest rate, so you will get much more lesser value. What I'm trying to say, 47k you paid year 5, okay, and what if you paid the same amount in year 0? So obviously that value of money is decreasing as the year is passing. So that is why, though it is showing you 200k, but 47k in year 5 what you have paid is not the same what you have paid in year 0, because in year 0 from day 1 you are paying 43k, but at the end we are paying higher. So that is why if you bring it back as of today, it will be having much more lesser value. So similar concept has been applied here. Then they are saying that our IRR is much more higher, but profit is lesser. You can see this profit for project 1 is 170k. So if you are using payback period, you will consider this project is good. But if you are using NPV and IRR, you will say no, this project has more better return of investment, and their NPV is also 42k, around 41k, and this project NPV is only 22k, because NPV is reducing their value based on time value of money. So now let's calculate the IRR equal IRR. This is very simple formula. Then you select this, then he is asking the value. So these are the value we have. Then they are saying guess how much potential as per you, how much would be the potential of your IRR. So we are considering 10%, but he has calculated this entire project, and then he said, look, by the way, we have not given him this year 1 this, year 2 this, but this formula itself has been designed in such a way, this one he will consider year 0 and this one he will consider year 1. So based on that he has bring this value as of today, and then he is saying you are going to generate only 12%. Similar formula I have applied, as you can see, correct? And then he is saying our IRR is much more higher than previous project. Similar way NPV, if you do NPV, he's saying rate, what rate we have, our expectation is we should generate at least 10% of any investment. Beyond that, whatever is coming, we will generate profit, would be more better project for us. So but minimum expectation is risk free investment expectation is 10%. Then he is saying select the value, so these are the value, then press enter. He is saying 22k. Similar formula if you apply here, NPV, our IRR is again hurdle rate is 10%, and then you are selecting again the return, then press enter. He is saying 41k. So this project is more beneficial, whereas when you are saying that your net profit is only 130k, here we are seeing this net profit is more than that. I hope I tried my level best to make you understand about the time value of money. I know it may be hard, you can also do some research with regard to time value of money, you will know that what I'm trying to say. So this is how when you are creating capital budget, you are doing the risk management. Now if we want to summarize this entire capital budget session, so obviously in summary I would say capital budgeting is essential for investment, and NPV and IRR is gold standard method which is to be used by every company. And also if you are doing a lot of scenario planning for similar project, and when you are changing material price and your investment project payment plan, if you are changing versus your cash inflow plan, what I have given you that Excel sheet, you should play around, change the amount and check the calculation and see that what are the difference are coming. Okay, and the final reflection I would say, can your business afford to make $1 million decision without capital budgeting framework? So I know you guys are able to answer that. And Peter Drucker says what gets measured get managed. If you can measure, you can manage. If you cannot measure, you cannot manage this. This is as simple as that. So thanks for watching. See you into the next session. Stay tuned. Thank you very much.
Hello everyone, welcome back to IBS. Today we are going to discuss about a new section or new module in which we are going to discuss about forecasting. And imagine if you are driving a car only a rear view mirror, that is budgeting without forecasting. If you talk about definition of forecasting, so forecasting is a process of predicting future event or trend based on analysis of past and present data. It guides decision making, planning and risk management. Just one question for you: if you knew with 80% accuracy what your sales will be in the next 6 months, how would it change your business decision today? So think over it. Let's jump to the another point. So the question is, where do we do forecasting? So planning and goal setting, align the resource with expected demand, resource allocation, adjust manpower, inventory and fund based on the projection, and risk management, prepare for uncertainty in market. Decision making drives strategic move like pricing, expansion and product launch. So there is a research fact: 2023 Deloitte CFO survey found that 73% of CFO use rolling forecast as a supplement to budget because static budget cannot keep pace with market volatility. So that is the reason we are using forecasts, because static budget is not that much useful or impactful because it is static. It doesn't change based on the scenario, based on the situation. So that is where we do the forecasting. So keep on changing the things. Now we'd like to discuss about the purpose of budgeting and forecasting. So budgeting is annual financial plan like revenue, expense and targets, and purpose is to allocate resources, which department and which country will have how much fund, and also set the benchmark so that you can check and compare whether you have achieved that benchmark or not. And then fixed and more detailed budget we use. All of these are called budgeting. If I talk about forecasting, so forecasting predict the future outcome using data plus assumption. Okay, and purpose of to anticipate the changes and guide the decision, and it is flexible and less detailed. So cover the short term, monthly, quarterly to long term 5-year plus we do the forecasting. So basically forecasting is something which is being used to calculate the future revenue. So once you have calculated your revenue and forecasted using various different methods, we will be learning those technique in detail later on. So based on that technique, we have agreed, everyone are agreed on that particular revenue, 1 million, 10 million, whatever amount. If you are agreed, accordingly we are going to set the target and allocate the budget to different department. So now I have one more question to you. If a budget are fixed and forecast are flexible, should company rely more on forecast in today's uncertain economy? So you can answer to this. Now we are going to discuss about technique of forecasting. There are various different techniques we use in forecasting. First one is time series analysis. So use the historical sales figure or sales data and identify the trend and seasonality factor based on predict for your upcoming future sales. Okay, and for example, moving average, exponential smoothing, these are the method we use. If the smartphone sales grew by 10% every quarter for 5 years, so this is something we are planning. So forecasting will be the factor based on seasonality, spike, etc. Then another method is casual forecasting based on cause and effect relationship. Example, sales increase when ad spend being rise. If you are reducing your ad spend, then your revenue will also be decreased. Okay, then the third very popular method, which is regression analysis. This is something measure the relationship between your sales and other variable like your marketing cost, your cost of goods cost, etc. Okay, and for example, every 1000 spent on ads will increase 7500 of revenue. So this is something we can create link and analyze that based on regression analysis. Then the fourth method is market research and expert opinion. So based on the survey, focus group or qualitative insight, or
maybe somebody is expert in financial forecasting or creating financial model for that particular industry or business. So you can take suggestion from him and take insight from him and then finalize your financial forecast. Then the fifth method is leading indicator. For example, housing start can predict the furniture demand. If your housing kind of construction business is booming, if you are in furniture market, so obviously furniture demand will also going to increase. Qualitative forecasting, in which we use judgment or Delphi method like panel of expert. All these things we are doing. According to Gartner and company that use a mix of quantitative and qualitative forecasting, improve their accuracy by 20 to 30% as compared to those who are not using quantitative and qualitative both approach. Okay, so you need to do good research on marketing, you need to do good research on your historical data, and then you have good idea about the market and your internal planning, how much you are going to spend in ad campaign and marketing, and what kind of strategy you are using and how you are trying to defeat your competitor. So these all factor you need to consider while creating your forecast. Okay, now going to evaluate the accuracy and finalize your forecast, because company doesn't go with one particular method, either time series or weighted average and regression analysis or casual forecasting. So company use multiple method and then take the average of everything. Then it is called the best approach, where we are considering all the different approach. Based on that, for time series analysis we are getting revenue of 10 million, and through weighted average or some other method we are getting 12 million, or some other process through the expert opinion he is saying somewhere around 11 million to 12 million would be your revenue. Or through regression analysis normally gives us not the exact figure, they say there is 90% chances of your revenue would be somewhere around 11 million. So then we'll use the probability based on 90% multiply and then calculate our revenue. So based on different approach, different revenue figure will come. Then you need to club all together and then finalize one particular amount, and then based on that we are going to create all the budget we have already discussed in the budgeting lecture, right? So now, just long story short, step to improve reliability is compare your forecast versus actual, track the deviations. Example, your forecast is 100k unit but actually 95%, error rate is 5%. Weighted average or consensus align the weight based on accuracy of method. Expert view sales manager or finance team or adjust the forecast with their own judgment. Correct, because some of the employee in the organization, he is keep on doing the forecasting, so he have better gut feeling and having better judgment, so that is why he has to finalize certain amount of revenue. Correct, then you need to generate your final forecast and consolidate forecast used for production, inventory and for hiring as well. Okay, now I would like to ask you one question: would you trust the statistical forecast that shows 50% growth, or your sales manager gut feeling that growth all will be flat? So which one you will choose? Now let's take one practical example. There is an electronic company. Last 3 years smartphone sales is around 1 million, 1.2 million, and then the last year is 1.5 million, and then time series analysis is predicting 1.5 million upcoming year based on the sales trend, even considering the seasonality factor. Then the another method using regression analysis based on the ad spend. So we are going to do more aggressive marketing, so we are spending more. Then regression analysis is predicting our sales would be somewhere around 2 million, okay, instead of 1 million. So that means it is regression analysis is saying 200k would be more sales. Then market research and survey says demand is slowing and due to inflation, our forecast revised. Due to that, they are saying 1.5 million would be the actual sales. Or maybe, as you know, there is a lot of uncertainty in market, a lot of tariff war is going on. So if your business something is going to directly being impacted based on tariff, for example, you are supplying product in USA or China or maybe any other place, and if that country and your country is having tariff related war, so then obviously your business will directly going to be impacted. So that is the reason your regression analysis will not be able to work on it, because he doesn't use his own brain. If you talk about your time series analysis, they will also do the forecasting based on historical data and seasonality factor. He will consider multiple things, and then he will think last 3 years if it is increasing by 10 or 12%, so he will increase similar amount. So this is how your mathematical calculation normally work. But we are human, we need to watch it more accurately. We know current market condition, inflation and deflation, or whatever the situation is in your company or your product or service, whatever you are providing. So based on that, you will take the right decision. So based on considering everything, then we look all the perspective and all the way of qualitative and quantitative calculation. Then we finalize around the revenue would be somewhere around 165 million. Even though if we are going to spend more in advertisement, still we can able to achieve 1.65 million unit sale. Okay, so this blended forecast is then used for production planning, inventory and hiring staff, sales, etc. Why I'm saying again, because once we finalize our sales figure, based on that we need to further recalculate and plan your inventory, how much production we need to do. For that you have already might be having some of the raw material and new raw material you need to buy. So that quantity you will calculate based on the sales forecast, right? So I have already given this information in the budgeting related lectures, right? Let's discuss something about budgeting versus forecasting. What are the key differences? Budgeting is, the purpose is to resource allocation and financial target, and forecasting actually predict the future trend and trend for planning. If you talk about flexibility point of view, I already discussed all these things. Budgeting is normally fixed and less flexible, whereas your forecasting is dynamic. It updates frequently, every quarter, every month, even monthly. We can review the market situation and adjust ourselves, because suddenly Trump has applied the tariff. So if you are supplying that particular product to USA, so then immediately it is going to impact. So when you are doing budgeting, that time you are not aware of that the condition will change or something. So suddenly if the situation has changed, that is why you need to do the changes of your budgeting. So that changes of budgeting is called forecasting. So we are now changing based on the situation has changed. So based on the dynamics, we are updating frequently. And budget are more detailed and forecasting is broad but may be less detailed, because forecasting just focus on the sales amount, what could be the sales figure. Based on that we will calculate all the budgeting related stuff. Time frame perspective, budgeting are usually annually, but forecasting are mostly weekly, monthly or quarterly. And also we do forecast for entire year. Based on that we do the budgeting. So that amount is also being considered as in forecasting, because last year in November or October we are forecasting for sales for entire upcoming year. So that time we have calculated the sales figure for entire 12 months. So that amount is forecasting. Based on that we are creating all our financial plan or target and setting benchmark. So that is budgeting. But sales figure is forecasting. So that is why sales forecast is also being considered as an annually. But we are keep on changing after quarter or month. That is also called forecast. Based on that we are also revising our budgeting. So that is called forecasting. I hope you are getting my point. What is the difference between forecasting and budgeting? Okay. So based on the PwC report, 60% of company now revise forecast quarterly and compared to 30% a decade ago. So all I'm trying to say, 10 years before 30% of company are keep on revising their forecast, but now 60% of company around the world are keep on using forecasting. Okay. So in conclusion point of view, if I will say, forecasting is basically predictive tools and budgeting are planning tools, and together they ensure the company are prepared for both expected and unexpected event. I think I have given enough food for thought today. Let me give you one more question to close my lecture. If your company had to choose between detailed budget or an accurate forecast, which one would you keep? So I'm done for the day. We'll see you into the next session. Stay tuned. Thank you very much. Hello everyone. Welcome back to IBS. Today we are going to discuss about time series analysis. Before going deep into that, let's recap the last session. So in last session we have discussed about forecasting. Forecasting is something where we use past data and past information to predict future event and future budget, so that when we are running into that particular moment our business is running, that time we can able to evaluate whether we are going into the strategic direction or not. So for that we use forecasting. Forecasting help to set benchmark. Forecasting help to set what number of production we need to do and how much raw material we required, how much stock we need to maintain. So like this everything we are calculating before, and then we are having all this data so that we can take right decision, we will not get confused or something. So that is the reason we use forecasting. Okay, how we are doing forecasting? We using past historical data and analyzing their trend in detail using various different methods like time series, regression, expected value, expert opinion, and many more. And the purpose of forecasting is obviously the risk management, allocating resource, and goal setting, as discussed all these things. And forecasting is quite flexible compared to budgeting. We can keep on update based on our requirement. Company may update it quarterly or maybe weekly or monthly, whatever the requirement. Based on the nature and management decision, you need to do the forecasting or update your, basically update your budget every gap of that time period, whatever being finalized by the management. Okay, then we also discussed about the budgeting versus forecasting. Budgeting help to forecast the revenue and expenses, and purpose of budgeting was to allocate the resources and do the financial planning and performance monitoring. So these are the purpose of budgeting. And forecasting is something where we are using the historical data and predicting future, and that is flexible. We are keep on updating so that we can update the budget. Budget is something rigid and fixed which doesn't change for entire year. So that is the reason we are involving forecasting so that make this budget quite flexible and useful. And as you can see the screenshot differences, this is all we discussed in last session. Let's jump to the today's session. We are going to discuss about time series analysis, then we will be discussing about the casual forecasting, regression analysis, and market research, etc. Okay, and you know that last session before this module we have one particular module in which we have discussed strategic planning journey. In this particular topic we will be discussing about the research and strategic planning we did for our competitor, for our product, or for our processes, and how we are going to use different methodology to reduce our inventory. So based on business requirements, so whatever we have learned throughout that module, that you are going to apply in this particular session when we are going to forecast. Practically I am saying, in company if you are doing forecasting and you are head of the forecasting, then you need to have all this information. But if you are someone who is doing based on your management or somebody else are guiding you and directing you, so what they are saying accordingly you can create financial model. That we will be learning in upcoming module, in which we will be learning how to create financial model. But I am giving you what is actually required for strategy, decision making, product related innovation, product planning, and everything. I'm giving you based on teaching point of view. But in practical life, if you already working in FP&A team, you might not notice that management are not doing all this research, but it is not happening. Actually management does all this research, but if you have joined later or something, so you may not aware that management has done all this research. Every company does this research. So if you are not seeing this kind of activities being performed in your company, you may not think that this is not practical or something. What I'm teaching is not practical, that is only a theoretical thing. No, this is practical. This is happening in every company. Okay, let's start with time series analysis. Predicting the future of business is not about magic, it is about reading the story and hidden in past number. So what I'm trying to say is, we want to get insight from our historical data based on the trend, based on the competitor action. So whatever we did previously, based on that we are trying to create and plan future, which direction we want to go, which subsidiary we need to close, and where we need to invest, where we don't need to invest. So previously if we made some kind of mistake, that we are going to remove, and we are trying to explore new opportunity and trying to invest in that particular area where we will get more benefit. Like how we have learned in activity based budgeting, and some like in activity and zero based budgeting, we have noticed that particular ad campaign is not effective as much other campaign are effective. So that is the reason we are doing all this activity and learning all these things, so that we can avoid ineffective ineffective or less effective methodology or process or investment or ad campaign, whatever is ineffective we need to reduce, and we focus more on what activity and process and things are giving more benefit and more efficient for company. So this is the whole and sole purpose of doing all this activity. Okay, I want to ask you a question. If a company sales have been growing by 10% every years for the past 5 years, can we simply assume that same growth will continue, or deeper pattern that we need to uncover first? What is your thought on this? So obviously we need to do more research, find pattern, etc., so that we can take more deeper insight and then apply all those things. So in forecasting, time series analysis is one of the most powerful technique. Basically, a time series meaning tracking a single variable such as sales, revenue and production, volume or expenses across multiple time period. Okay, so goal is to understand the past pattern, what are your past pattern, and use them to predict your future pattern. So based on past data, how we are seeing ourselves in future. So that is what the purpose of time series analysis. But time series analysis also have some demerit or cons and some pros or benefit, because time series analysis does based on the past. In past may be great and future is not going to be great. Future may be affected by corona, future may be affected by some war, future may be affected by tariff, future may be affected by your competitor, future may be affected by your marketing campaign, future may be affected by your internal control, your process control, your system control, your audit. There is n number, and I would say infinity number of possibility which is going to affect your future. But time series analysis gives you overall idea. For example, last 5 years, if your company is consistently growing 10%, so he will take average and he will say your average growth is expected to be 10%. He may address and adjust based on your seasonality factor. For maybe quarter 2 has less sale and quarter 3 and 4 has more sales, so he will do the prediction accordingly. For 4 quarter he will predict similar way that we will be teaching you in Excel. But the purpose I'm saying is this is based on mathematical calculation. Mathematical calculation will not be able to address your uncertainty. Okay, so that is why human intervention and human mind is compulsorily required. So this is something which we are learning, which is not going to be replaced by AI, and not easily it is possible, because there is a number of thing. Future is uncertain. So if there is uncertain thing where we are working, so our job are safe and secure. So that is the good news for all of you. Okay, so the whole goal of this time series analysis is to understand the past pattern and use the basis for predicting future. So that is something mathematical calculation. So now the question is, what is time series data? So the definition is historical data of a single variable collected at consistent time interval, like daily, weekly, monthly or annually, whatever based on your management. For example, sales revenue, customer subscription, website traffic and production output, and monthly operating expenses. So time series forecasting approach rely on purely historical value of variable, identify patterns, cycle and seasonality and long-term trend. Use this pattern to predict your future outcome. Okay, so in one side all the past data is going, and outside they are giving you the future outcome. So there are a number of pattern which is impacting the time series, like trend pattern. So time series analysis identify the trend pattern, like long term upward downward movement. For example, here you can see, if you consider this quarter 1, quarter 2, quarter 3, quarter 4, again quarter 1, 2, 3, 4. So as you can see, quarter 1 sales is little bit lesser compared to quarter 2. Quarter 3 is down. Let's see quarter 3 here. Quarter 3 is down. Quarter 2 is up. Here you can see quarter 2 is up. Quarter 1 is down. Quarter 1 and quarter 2. So quarter 1 is down little bit, and quarter 2 is normally up, and quarter 3 is down and lesser than your quarter 1. So if you can see, this is lesser, and here also you can see it is almost little bit up. So overall I'm trying to say that this pattern is clearly identifying the pattern when your sales is going up, when sales is going down. So this is something he is identifying the trend, and that trend is called seasonality factor. So seasonality factor we have discussed. And if you talk about trend pattern, so this is the trend pattern. You can see this blue line, so which is something it is saying it is started from here, and after a couple of years in long run it is going upward. And seasonality factor is something like this one, this kind of thing they are noticing. Okay, and cyclical pattern is something like this way: year 1, year 2, year 3, year 4. For example, year 1 it is going up, and then year 3 it is going down, year 4 it is also going down, from year 5 it is going up, like this way. If you see such kind of cyclical pattern for longer than 1 year or something greater than 1 year, then that is being considered as a cyclical pattern. But if it is quarterly, monthly, okay, something monthly and quarterly, then you can consider those things as a seasonal pattern. Okay, and this one we will consider as a cyclical pattern. And there may be some other random irregular pattern you may notice and you may not notice, but if you teach your AI to notice all of this, so he will definitely going to notice all this thing and he will give you insight. So that is why we use and we involve AI and feed them data for thousands of company, and they will learn through this all the data and they will give you more insight. So maybe we will not notice for a small thing, so that AI will help you to notice all of this so that you can take better and correct decision. Now I want to discuss why time series matter. So it helps business to plan product, avoid shortage and overproduction. So if you are planning in accurate way, so you will not be having issue of shortage of inventory, and you will also not be having more production. So that is also cost burning. If you are having shortage, you are losing your customer. So in both way it is dangerous for us. It support in marketing strategy, allocating ad spend during the peak demand. So when we have peak demand, that time we will be pushing all our effort to run more ad, invest more in ad marketing, so that we can get more client or customer. So when you will be able to do this? Only when you will learn how to use the time series analysis and identify all the pattern, cyclical pattern or seasonality pattern. So in that time you can use, if your cyclical pattern, if you have noticed that this couple of year maybe sale will go down, after 8 year or 10 year there is a recession or something. So if you have gut feeling that now in 2027 and 229 that again the same kind of situation will come and entire world is going to suffer some kind of recession, or maybe some bubble is going to burst or something, so in those situations you can use your brain and cut the cost and save the money for company. As a CFO or finance director level if you are working, so you will understand what I'm trying to say. So that is why we are trying to train you so that you can think like CFO, you can think like finance director and save the company money, so that you can update all this information in your resume, how much amount of impact or value you have added to that particular company. So that is what making you stand out in front of other people. So guide financial planning, like estimate the revenue and expense. So when you have all this information, you can easily able to estimate the revenue and expense. So and then provide the early warning signal, so spot the downward trend, and then before the losses increases you can reduce the manufacturing. If you are purchasing and then you are selling, then you will reduce your purchasing. So like this, if you are able to spot the downward trend, accordingly you will take your action. If you are able to spot the upward trend, accordingly you can also plan yourself. So that is what the purpose of finance team. So earlier, like 10 years before, finance team was only involved in accounting and getting audit done, so that's it. But now finance is been considered as a business partner, because finance is the team who have all the data. So if finance is providing data to other team and they are doing the analysis, so not that much effective as much finance team if he will do those kind of research and analysis like how FP&A team are doing. So FP&A is being considered remarkable nowadays in the entire industry, and they are getting high demand and also they are getting high package. And limitation of time series I think already discussed in detail, so I'm not going into that in further. So in real life example, I would say retail sales, a clothing
clothing brand track the monthly sales and short-term spike happen during the Christmas or Diwali, but overall trend shows the steady growth. So these are the things we can use using the time series. SaaS kind of subscription based company increase consistently for 3 years. So time series forecasting help them to predict upcoming 12 months, which support the capacity planning, and accordingly they can adjust whole plan with regard to their expenses, with regard to their funding, and with regard to their procurement, with regard to their asset investment or assets or equipment purchase kind of stuff. Or you can also plan yourself for R&D investment so that we can make more better product, more user friendly product. So these are the thing is dependent on your forecast. So finance team is very important for all the company nowadays. Okay, we can also take example of airline industry, like ticket demand peaks in summer and festive season and drop during the off season. So accordingly you can use that dynamic pricing related stuff so that you can get more revenue and use the benefit of demand and supply, and then bring more profit to your company. So customer perspective, it is okay, it is not good, but company point of view, when you are working in the particular company, your job is to bring profit, right? So basically here time series analysis is helping to optimize the pricing and fleet planning. So time series analysis is like looking at the rear view mirror to understand the road ahead, but always remember sharp turn may not be visible. So what I'm trying to say, future is uncertain. Even though we are trying to rear view mirror, but still there is chances of sharp turn that may going to affect you, okay, because that is not visible. So the purpose of this statement is to tell you that time series analysis is helpful, but this is not the end of the world. So now if I ask you, if your company sales are growing 8% annually, but new competitor enter with aggressive pricing, and should you only rely on time series forecasting, or should you combine it with other forecasting method, and why? You need to answer all these things. Okay, now we are going to discuss about simple sales fluctuation related stuff. This one already I have discussed. This is something seasonality factor. Sometime it is going up, sometime it is going down, and overall it is upward trend. Okay, and downward trend is something when overall sales is going down. So there may be reason, the industry in which you are, that industry is declining, that may be the reason, or maybe your process policy and your internal control, your cash flow issue, maybe your revenue is not growing, maybe your product is not good. So there are a number of possibility where you will see a downward trend in your company. So you need to figure out why this is having a downward trend. Okay, non-linear trend means there is no trend at all, it will be straight away. So that will be considered as a non-linear. And no trend at all maybe because sometime your sales is very high, sometime your sales is low, or maybe you have no sales. Because I have joined a company who is supplying medical product, okay, like mask or something. So at the time of corona, they have started a venture that sales has directly picked from zero to hero. Like they were selling somewhere around hundreds of $1 million sale for particular year, and next year their sales was somewhere around 5 to 10 million only. So this kind of trend if you see, so that company has been created for that, to take benefit of that particular event which is happening. So that couple of years they have earned $200 million as a revenue, and they have overall they get the good profit. But after that the COVID has gone, then their product are no more in demand and that much demand. So now they are come to the right direction. So for this kind of company you will not be able to find any kind of pattern. So trend are analyzed using the simple regression analysis for forecasting purpose. And this is the simple linear regression where you can see y is equal to 22 dot x minus 965. This is 965 is your fixed amount. Okay, you can say fixed asset. We can also consider this is something which is variable, and this is something is time. So as your time is growing, you will multiply your variable with time, and your fixed amount will be added. Then you will able to predict your sales. Y is your sales. Okay, and r square is something which is giving you information about that. This is your r square line. So this r square line is nearby 1. So it is saying that your upcoming future, for example, you have data, past data till this period, okay, from 2020 to this period. Consider this year 1, year 2, year 3. So for year 4, what the time series analysis is going to predict for you, they are predicting this much amount of sales, and this r square is saying this. So there is no much much difference, there is very less difference. So this is the point he is saying, your sales could be around 90% accurate. Okay, if r square is in minus, it means it has inverse or negative relationship. If r is 0, it means there is no relationship. So that will be, we are going to discuss more in time series analysis when we are using Excel sheet. Okay, so thanks for watching. See you into the next session. In next session we will be going to learn this same similar linear regression related stuff or time series analysis and forecasting using Excel sheet. Okay, so that Excel sheet will be available into the first lecture of your this module. Okay, hello everyone, welcome back to IBS. Today we are going to discuss about forecasting. In forecasting, now we are going to learn through Excel sheet how to do the forecasting using trend and using historical data. So without wasting time, let's jump to the topic. In last session we have discussed about the time series analysis, then we have discussed about the pattern in time series analysis like trend pattern, seasonality, in cyclical pattern, and random variable related pattern, then why it is matter, all these things we have discussed, so I'm not going into that. Then we have discussed about linear trend, upward, downward, and non-linear trend related stuff, and how the seasonality and other things are creating such kind of diagram. So now we will use almost similar kind of data, and in Excel sheet we will be going to learn this. So as you can see, this is the Excel sheet whose name is forecasting IBS. So in this Excel sheet you will get this same Excel sheet in your first lecture of video, or in the folder of that forecasting module you will get this Excel sheet. So I have not created isolated Excel sheet, I have just updated every single tab which we are going to discuss in this session in forecasting, whether simple linear regression or multiple linear regression or forecasting and regression analysis, everything will be there in the same Excel sheet. So you can use this, and if you already downloaded it, you can open this and practice with me how we are going to do this. So now I want to create sales forecast, but before that I just wanted to create this simple linear regression, how we can create this. So first you need to select this data. Now we are not doing forecasting, we have data till March. In this line we will be having data till April and May. Okay, so then we will be going to do the forecasting. Okay, so now we have whatever data we have, based on that we are trying to learn now how we can create this kind of chart using the historical data. Then once we will learn this chart creation and all, then we will learn how we are going to predict using similar data. So first you need to select, okay, and then click on insert. You will see the recommended chart. Either you can select this and select this one, or you can go here then select this one. So either way you can do it. So now since this one is created here, I just want to create this over here. 1 second, I will go up. When you will go up, then it will give you data where you want. I have selected this, press OK, you will get this. Okay, now I want to do the formatting. This is sales data. I want to make this background, I want to change it to dark blue and then make it white. Okay, so now sales data is done. Now I want to do few changes, like I want to remove the grid line. Grid line is, you can see this line, this one I wanted to just remove, or you want to keep it, you can keep it. Just I'm showing you what are the things we can do the changes. Then we have timeline. Okay, so this timeline is something which is giving you the data of what you call R square. Okay, I want to make it bold, change the color to black so that it will be visible. Select this one. Okay, and dash type, select this one so that it will be a strong bold lines, you can easily view this. Now I want to keep it as a monthly. You can also play around this and make it as much as you want to do. Just here you right click and go to the format axis, you will get this option. Then go here, then select the days, and we want to change this to month. So we'll, in days we will write 30. Okay, you will see this has, this format has been changed to month. So now you go and click here and go to trend line, and in trend line you can see this arrow, click here and then click on more option. So this format will open. Go here. Now we want to see the equation, the formula. As you can see, it has come now. Then R square I want to see. So these two things has come now. We can make the changes and make it bigger so that it will be visible. Correct. Now you can place it where you want to place. So now overall editing has been done as I wanted to do, and you can also do changes and play around as you want to do. Also you can update here like axis. One side we have sales, and y axis what we have date.
So both the thing you can update it. Okay, so now I don't want to do all this thing, I just want to keep it simple. Okay, these are the sales and these are the date. So formatting point of view, we have created just a simple linear regression, so that in future if you want to further forecast for few months, then we will be doing into the next slide. Now as you can see, R square I have already discussed. R square is like we can say coefficient of correlation. So what does it says? It says that coefficient of correlation measure the relationship between two variables. What he is trying to say that between your sales and your date, between date and sales, what is the relationship? So relationship, it is saying it is 0.9. So it means 0.9 has a strong representation of relationship. How much low it will go nearby 0, that will be considered as a lowest relationship. As long as you are going nearby 1, so it is being considered a strong relationship. And already discussed, if it is 0, then there is no relationship. If it is in minus, so it means it has inverse or negative relationship. Okay, these are the things I have already written, you can read it out. Now we will go and learn this into forecast future. So now you can see same data I have taken till March, then we want to forecast for April to May, 2 months. And just we are doing it for learning purpose. So for that I will delete my old data and will, I'm just trying to make it bold. So look, so now we want to do the forecast using different method like this format. In this tab we are using one formula forecast, in another tab we are using forecast.est. Another method is these two have different value, then we are using another formula which is called trend. So based on that there is another forecast is coming, so which is almost similar. Okay, then we have used the formula. Which formula? This formula if we are using, so what would be the result that we are trying to calculate? So these three different approach if we are using, we are getting the similar result. So but we are learning here, so we'll learn all the method, then we can finalize which one is more accurate to you based on your historical data. You can also check, like for example you have 5 year of data, so you take 4 year of data and predict your 5th year result using this method, all these three methods, and then see which one is more accurately predicting your 5th year revenue or sales forecast. So based on that you will be able to understand which one you should use for your future prediction. So this is how we can use the data and use our logic so that we can finalize which format and which formula is more accurate for us, because these three are giving almost similar data. So using any of the three is appropriate, and then this forecast.est is giving another result. So based on that you can see which one is more accurate for you, or you can take average of both of the two. So whichever is more appropriate for you, you can use. Now let's learn how we can create the forecast formula equal forecast. Then he is asking you to select the x. So what is the x? Independent variable. Okay, so independent variable is what? When this is y is your slope and this 970 904 is your intercept. Okay, and then you have x. X is what? Your future date, or we can say independent variable. Okay, so both the thing you can consider. So this is our future date or independent variable. Then we don't want to freeze this, because we want as and when we go down, so it will automatically change. So we will not freeze this, we'll keep this as it is. Then what is saying non-wise. So what is y? Y is sales or dependent variable. So we already known, so which that we are going to select. So these are the sales figure, we know we will be selecting this, and then we will freeze this, because press F4. Why we are freezing this? Because we don't want this to change as and when we are going down. Then we have non-wise, so select this. Non-wise is our date, as you can see. Then we need to select non-excess. So non-excess is what? Independent variable, which is date, but this date is your historical date. Based on your sales, what was the date when what sales amount has come. So for example 28th of March your sales was this, 29th March your sales were something else. So accordingly you want your data. Now we have selected non-x. Now you can keep bracket, press enter. So it will predict your sales figure. Now you can go down by clicking control arrow, then go up by control shift and arrow up, then press control D. You will get your sales data. It is not changing, so there is some formula error. Whenever we do formula error, that is better for us, so that we can learn more. So as you can see, I have not made this freeze, that is the reason it is not calculating correctly. So when you are correcting your formula, that time if you go go here and click F4, it will not take the correct figure. That is why better you should select the entire formula you want to freeze. Select that in your formula, then press F4. Then it will be perfectly freeze your data. Now Control D, you can see it is predicting our sales value. So now it is correct. Now we use another method which is called forecast.est. Forecast.est. Now he is saying target date. Target date is your future date. On which date you want to forecast. Again, I have not freeze this. Then he is saying value. Value based on your seasonality and whatever the thing is there in your sales data, he will consider it. Just selecting this. Press F4 and comma, then asking for your timeline, old timeline. These are our old timeline we have. Then again press F4, then press enter. As you can see, it has predicted our sales data. Now press Ctrl D, you will get your sales figure. You can see how much differences are there in their prediction. There is not much differences, so they are predicting almost similar. Now we use another method to predict our sales value. I'm changing the color so that we can able to understand. This is another formula equal trend non-wise. What is the y? You can see y is our sales, historical sales data. Then press F4 in comma, then non-excess. Non-excess is our old date related to sales. Press F4, then comma, then he's saying select your new excess, means new date in which you want to calculate your forecast. Then shift bracket. Okay, here it has predicted the exact same amount. As you can see, I've already informed you using 3 different methods. They are predicting the exact same sales. Now Control Shift arrow up, you will able to update the formula till where you want. Now you can see these are having the same amount, correct? Now we'll go up, we'll predict the sales using another method which is called same this formula. This is the formula. This is the formula which is we are using to calculate our simple linear regression based on historical data. He has calculated this is your formula will work to calculate your future sales. Okay, even this same formula you can use to calculate your older sales data. If you have like you have 1.5 month data, you want to calculate sales figure for this amount, if you use the same this formula, it will be almost same amount it will calculate. Now we'll use this and just making it little bit bigger so that you can easily calculate. It is equal, then 22, this is the 22 I have already written. Just press F4 so that because we want this to be fixed, we don't want to change this. Then multiply by your x. What is the x? Independent variable. This is our independent variable or future date. Then what this formula is saying, minus this amount. So if it is already mentioned minus, so I will not minus, I will put plus. Now again make it F4 because we want to freeze these two data. We want our forecasted date should be change every whenever we go to new tab, it will change. Now see whether this formula is calculating correct or not. You can see, so these all 3 places he is calculating exact same amount. Okay, but only the difference is coming from sales.est formula. So now since we have learned all these different formula, how we can use it to calculate your future sales. When we have forecasted, what we will do, we will try to create similar type of chart using this data. So now we have data this much. I'm just using these two because these two are almost same, so we don't need to select all of this data. Even I will use only these 3 data because and right now I'm not doing the forecast using different model. I just want to forecast using one simple model. Go to insert this one, press OK. You will get the same chart. We just want to make it little bit longer. You can change the date and all as you want, and you can do it by using this. You can use access table so that you can give the sales, where is the sales, where is date, like this kind of thing you can update. As you can see, this has created your diagram. You can also update your title and all thing. Okay, so like this, if you can do it. You can mention simple linear regression, etc. You can update this formula. Just now we have practices, so you can go ahead and do it again. I don't want to go ahead and explain it again. It will be a waste of time for you as well. So you can see this is something, it is predicting your upcoming future sales using your historical data. So now the same thing we will be learning using another method that would be more easiest for you. We'll take fresh sheet. We'll use the name as in forecasting version 1. So now we'll take our data. 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 We'll take our this will take this data only, will not take the forecasting value, will take only this data. You can paste a special here or you can paste simply. So we don't want to change the format. If you paste it without as an paste a special, then it will change. Then again you have to update this as a date, this as a number. So it is already correct. So I don't want to do the changes. Now select this historical data. Now go to data. In data, you can go to forecast sheet and click here. You can see this chart has been appeared. Now you can click on the create. It will create. You can see this. So just a second it take and it create your sales forecast. Now you can see that they have not created just one forecast, he has created two more lines of forecasting. So what are the things they are doing? If you can see, this amount will take this data from our historical calculation, we'll see how much differences are there. We'll take just two because the rest all are same. We'll paste it here. So you can see this using this Excel forecast, it is calculating almost same. You can see this is matching 100%, correct? Yeah, exactly same. Maybe they are using the same formula, forecast.est. And this one is another method we have learned through using different approach, like trend approach. This one is forecast approach. This one based on your formula approach, and this one is based on your trend approach. So these three methods have the same forecasting value. Okay. So normally when you have updated your data, it will calculate in another sheet. So we can give the name forecast version 1A. So because this is the part of your version 1 only, 1A. So you can see they are using almost similar method they are calculating. So the main point is they have not created just one sales forecast, they have also created lower confidence bond and upper confidence bond. So what does it mean? It's simply meaning that in case your sales is not good, then what would be your result? If in case situation is great and better than expectation, how much anticipated sales would be. Okay. So as you can see this formula, we can also calculate manually if you want to do it. Equal forecast dot est count. If there is a formula, then there is a target date and all, so you can use this. This is our target date, then it's asking for your value. So this is our sales value historical. We will press F4 comma, then is asking for your old timeline. Select that, press F4 comma, this one is the formula. And then they have, what they did is they have selected this, then press minus. Let's see what result is coming. You can see 2309, exactly the same. Okay, so this is how you can also calculate and check manually. Okay, so in this case they have just updated, instead of pasting minus they have mentioned as a plus. So we'll use the same formula, we'll change from plus to minus. Here we can update as a plus. Let's see, it is calculating the exact same amount, correct? So this is how you can also check what they are doing to calculate the differences, like in case of bad situation how much would be the sales, in case of good situation how much would be the sales. Okay, so if you can remove this plus and minus both the case, let's see what amount they are considering. So what they are doing is they are taking some, this formula is something is trying to calculate in case of lower situation how much sales will go down. So they are considering in both the case 165 up, 165 down. So what is the percentage? We can also check this divide by sales figure. So they are considering around 6.7%. Based on your historical data, he is able to understand your sales may go up and down by around 6 to 7%. So that is why he is adjusting 6% upper side and 6% lower side. So this figure is calculating your overall sales. Now we can make it little bit clean. We can update the trend line. We can also display equation and all if you want. Make it little bit bigger so that it will be visible to all of us. Correct. As you can see, I have updated the trend line color as in black so that it will be more visible to us. I'm trying to make it little bit bolder so that we can easily view this. So now we're done with almost formatting. We don't want to do so many changes, just want to represent this what they are trying to say. This is black line is your R square, which is saying your potential sales would be somewhere around this much value. You can keep the grid line if you want, that will give you more better idea. So this is the grid line. This is saying somewhere around 3700 would be your sales, as you can see below. That is also saying 3700, around 3700 your sales would be. And in case of lower situation, as you can say, this is your grid line. This will give you the idea sale would be somewhere around above 3000. Okay, in case of bad situation. In case of great situation, it may go beyond the 4000 of your sales, which amount you can also see here. In case of unfavorable situation, our sales would be somewhere around 3200. In case of favorable situation, our sales will be somewhere around 4000. So this is how this entire forecasting you can do immediately, instantly. Okay, so this is what we want to learn today. I think I am done for the day. We'll see you into the next session. Stay tuned. Thank you very much.
Hello everyone, welcome back to IBS. Today we are going to discuss about a very important topic, which is regression analysis. Regression is the microscope of business data. It shows which factors move outcome by how much. Finance team use it to forecast revenue and understand the cost driver and test it, like what if scenario planning. But not every organization uses the regression analysis, and that gap matters for budgeting accuracy and decision making. Let's understand the definition of regression analysis. So basically, regression analysis is the model that represents the relationship between dependent, I mean to say targeted variable, and another side would be independent variable, such as your marketing expense and your time and your other organization activity. So they are trying to create a relationship between these two. If you are aggressively doing marketing, ad spend related stuff, or if you are updating your system, or as on when your time is passing, so how much revenue you are going to generate. So that relationship is being calculated by regression analysis. So basically, regression analysis is a kind of statistical techniques that create relationship between dependent and independent variables. So dependent variable always be our sales, because we are in the module of forecasting, so we are learning how to predict sales. So we have learned so many different methods through time series analysis. Now the another chapter, which is called regression analysis. Based on that also we are trying to predict our sales forecast. So now dependent variable, whenever I will say, that is your sales value. Okay, and independent variable would be another side, like marketing, time, organization activity, and other things. Whatever you can take another side, that would be independent variable, because your marketing is not dependent on sale. Your sales is purely dependent on your marketing, ad campaign, your strategy. Correct? So that is the point I am trying to make here. So if you talk about definition of linear regression and simple linear regression, so let's understand that. So regression analysis model relationship between dependent variable and independent variable. That point is clear. So simple linear regression is having one predictor and one outcome. For example, predicting revenue based on ad spend. So one side is your marketing, another side is your sales. So when there is relationship between one and one, so then it will be considered as a simple linear regression. And when there is a multiple linear regression, several predictor and one outcome. So like you are using marketing, ad spend, price, seasonality factor to calculate your revenue. So one side is revenue, which is dependent variable, another side is multiple independent variable. So that will be considered as a multiple linear regression. So as you can see the formula for simple linear regression, there is y is equal to a plus bx. So when there is a multiple regression analysis formula, then there is y is equal to a plus b1 plus x1 plus then again b2 and multiply by x2. Again it will go n number of your different independent variables. So they will consider everything. So that is the reason they have mentioned bn and xn in the last. Okay, this is the formula for your multiple linear regression. Now again I want to go back to regression analysis, and so that we can understand the meaning of regression line. As you can see, this is the red line. So in that red line, the regression line is the best fitting straight line that describe the average relationship between all these scattered plots. Okay, average relationship between, we can say, the dependent and independent variable. Like if you can see, this is the sales figure and this is your regression line. So
this line is best fit from all the lines. So if your line would be some other place other than this line, so do you think that this will be the nearest line for other line if your line would be from here to here? So for these two scattered plot, this line would be nearest, and rest all it will not be nearest possible line. So that is the reason this line is somewhere which is average of all the scattered plot. So this dotted point is something which is called scattered plot. So for all these scattered plot, this is the most best fitting line for all the scattered plots. So this is the average. That is why we are saying average relationship between all the dependent and independent variables. So that is what it is called, linear line. So linear line is best fitting line for all the dot. Okay, if you keep this line anywhere other than this line, this place, so it will not be average for all the scattered plots. This is the point I want to make here. Let us discuss little bit about the adoption of regression or predictive method in companies. Like survey shows adoption varies widely. Only about 40% of companies deploy predictive analytics in production across business function. Many experiment but don't fully operationalize it because of there is other reason for that we will discuss later. So why they are 60% of company are not able to deploy regression analysis to predict their forecasting. Okay, broader definition shows up to 70% of adoption when the count pilot or partial use. McKinsey data shows that finance and budgeting function lags behind the marketing and IT in predictive analytics adoption. So takeaway is while regression analysis is a powerful tool, many finance teams still rely on manual budget instead of data-driven regression forecasting. So there is another reason behind that finance team don't rely on regression forecasting, because as I said, regression analysis will do and create your model based on your past historical data, but they will not consider the future anticipated changes or external force or external things what we are planning to change. If we are not feeding those data to this regression analysis, so they will not be able to calculate. But yeah, it will be calculating based on your past historical data, so he will give you an idea what would be our potential sales. So now let's discuss why many companies don't use regression analysis in budgeting. So mostly common barriers includes like data quality and availability, historical record may be incomplete, and talent gap, shortage of skills and analytical professionals. This is one of the major reason. And tooling and integration issue, like budget is often run manually in a spreadsheet, so we are not able to plug in this kind of data into our budgeting tools. And managerial resistance, executive prefer judgment forecast. Okay, so they are not willing to go with the regression analysis. Unstable environment, because regression works poorly when market condition changes drastically, and if there is a lot of changes in new product and economic stock, as I already informed you. So if there is sudden changes is coming, so he is not able to consider those things. Okay, now let's discuss why regression matter for forecasting and budgeting. So despite of barrier, regression offer big advantage, like it qualify drivers showing the exactly how much ad spend and price or value affect the revenue. So they will give you exact relation. Maybe you're not getting what I'm trying to say right now, but when I will be explaining you the same thing in Excel sheet and while running a regression analysis model, then you will be able to understand this. Okay, it improves the forecast accuracy when predictors are chosen well. Okay, it supports the scenario analysis. If ad spend raises by 10%, how much will revenue grow? So these are the answer he will give you. Okay, so that makes a regression critical complement to management judgment. Let us move to the Excel sheet and we will be learning this model. And you can see this is the same exact forecasting IBS Excel sheet. You must have been downloaded already and you need to do the practice with me. For running regression analysis, we need to enable some of the option which is if it is not available. So what I'm doing is just I have taken historical sales data. Okay, these are the sales data, and if you can see every third quarter I'm trying to down the sales. So as you can see, the sales is in quarter 3 is always 85% of previous month sales. So it says that there is a seasonality factor in every third quarter. Okay, so this is the fourth, and then this is the 7th quarter also have some seasonality impact. Then again there is a seasonality impact. So I have intentionally given this amount so that we can able to identify whether regression analysis model is considering this kind of changes or not. So for that I have purposely reduced the value of sales so that we can easily understand. And this is your time. Okay, this is one side is time, another side is your sales. So sales is your dependent variable and excess is your all independent variable. Okay, and these are the quarter we have splitted it. So to run this regression analysis, if you go into data, you will not be having this option. So for that you need to enable this option. Let me show. I go to file, then click on option so that you will get this pop-up message. Go to add in and then select analysis tool pack dash VBA. So if you will plug this, then you need to select this, then press OK. You can see this new option has been enabled now. So click here, then you have multiple options. You can play around this like correlation, covariance, descriptive statistic. Okay, all these information is there. Histogram is there. That is also one of the useful tools to predict your sales outcome and outlier related stuff. So that is not our concern here. Now we want to learn about the regression. So click on regression, press OK. Now you will have to select input Y range. Y range is our, what is that? Tell me. This is our dependent variable. Then go and select your X range, your period. Now we want to check confidence level. It is 95%. You can also change it manually if you want to check the confidence level. If in case you want to see 90% confidence level, what would be our sales? Okay. Then we have outcome range. You can select this. So I don't want to create this model in some another page. I want to create this model at this sheet. So we need to select input range like this. We don't need to select this manual written amount. Just select the number. Okay. For this one also you need to select only period. Don't select period itself. Now I think everything is as it is. Just click OK. He is asking you want to overwrite. So I will say yes. So he has overwritten everything. Now we want to do little bit formatting so that we can see these things. Now I will update this again. So as you can see, multiple R, it is saying 0.76. It means your period and your sales has not very good relationship. It is not somewhere around 95% or something. It is 0.76, so there is still 24%. So that is why I'm saying this is not having a very good or very attractive relationship, but it has positive relationship. Okay, then R square is saying even lesser relationship. So it is saying your data has no very good relationship, but it has appropriate relationship actually. And adjusted R square, they do further more adjustment and make it more conservative approach, and that is why you will always see adjusted R square will be having lesser compared to R square. So R square is saying 58% relationship and adjusted R square is saying even lesser, 56% relationship. The standard error is around 1426. That is also, I mean to say, big amount of differences. If you can check this way, any amount will take two different amount. Otherwise, it will not be accurate from this divided by this. Okay. So now it is saying 10%. Standard error chances is 10% in lower range. To select this, divide by this. So standard error, I have taken highest and smallest, both the amount. Based on that, your standard error percentage is somewhere around 11 to 7%. Okay. So this is what it is saying. Whenever you are using this model and like using this formula to create your sales forecast, so your forecast would be having an error of around 1426. So this is what the meaning of a standard error. The standard error basically defines that how much would be your sales up and low. Okay, for example, here if you have predicting 20,000, so your sales would go in the bad situation or worst situation would be somewhere around this. If you have predicted 20,066, and then in case of good situation, your sales will go upside by this much. Let me make it upside by. So your sales will go up by around $21,492. So this is the range they are saying based on standard error. Okay. So this standard error is for entire model, and there is other standard error you will see. This standard error are not for entire model. This is for intercept, and this one is for your X variable. So that I will be learning this thing also in more detail. And observation is something he is saying how many observation we did. So we have taken how many data? We have taken only 16 data. So that is the reason he is saying total observation data is 16. Now we will discuss a little bit about this T stat. Your T stat should be nearby 2 and your P value should be less than 0.5 or 0.1. So earlier we used to have this amount. Okay, now you can see. So your P value should be less than 0.05. Okay, and here we have good relationship. The p value is showing correct, so your t state must be plus minus 2. If it is beyond that, then we will consider that it has significant impact on your regression model. If it is nearby 2 or plus minus, so then we will consider this is just a noise, so your regression model has no much impact of your t stat. Okay, so as much it would be closer to plus minus 2, that will be considered more better regression mode. I hope you are getting my point. So again, let me tell you once again, if your t stat value is 2 plus or minus, so if it is in between this range, then your t stat is not going to impact much on your regression model. So it is being considered as a this is a small noise. Okay, if it is having more value like 3, 5, 7 or minus 5, minus 10, so that means it has really going to impact your regression model. So if it is between plus minus 2, that indicates that regression model has less impact of your t state, and if it is beyond that, it is having more impact on your regression model. So a similar concept for p value. So if you want to calculate t state, then you have to just understand one thing, like you have to give the coefficient estimate and then divide it by a standard error, so then you will get your t state. Okay, similar way, if you want to understand about the p value, so what does p value is? It is a probability that a coefficient appear just by chance. If p is less than 0.05, the result is statistically significant, not random. Okay, so whenever your p value is less than 0.05%, that will be considered as a good regression analysis model. So these are the few indications you need to keep in mind. Okay, so if you see these two, if you see this one standard would be as much lesser, that would be more better regression analysis, and multiple r square, these all are, if it is nearby 1, that would be more better relationship. Okay, so that I think I have already explained in previous lectures also. So if it is nearby 0, it means it has almost no relationship. If it is in negative, it means it has inverse relationship. So that is why the more it will go nearby 1, so that will be considered more better regression analysis. It means to say between dependent and independent variable there is a strong bond or a strong relationship. Okay, so let's take one more example. Here if you can see, I have purposely made this 8500, you can see in negative, these are the negative number. So I'm just trying to understand if we have sales around 12,500 in maybe year 1, in year 2 our sales is minus 85. So does the period has any relationship with this sale? So this is what this model, I'm just trying to feed this information. So let's see whether what regression analysis is saying. So as you can see, this is multiple r is almost 0. Okay, similar way your r square is also almost 0, standard error is also almost 0. So these all are trying to convey this message that this sales data doesn't have any relationship with your period. If it has a relationship, that is very minor relationship. Okay, so this is what they are saying. If you can see that their t is also very low. Okay, and their p value is also above 0.05%. okay, and this in period point of view, it is even beyond the 0.05%. okay, too high, and this one also 0. So this is what all it is saying. This has almost very bad relationship, and if you can see, standard error is 30,000, whereas this time when we are still we are not having perfect model, we are having seasonality impact, still they are saying there is a standard error is around 1400 only. So but now he is saying standard errors are 30,000, so there is 2,500. so what he is saying, 12,500 plus this, so your sale would be between these to this. So your confidence of your sales would be for the future will range between minus 70,000k to 42 or 43k positive. So this is the range it is giving. So it means it has no useful for us if the regression model is giving such kind of wide range of sales forecast amount. Okay, now again I have updated the same formula so that we can able to calculate using this formula also, because this is the formula is being used while creating this kind of model. Now what I did is, as you can see, I have perfectly just doubled the sales as the period is adding. So like year 1 our sales was 12,500 and year 2 I just double it 25,000 and year 3 it is triple and year 4 it is 4 times of your last sales. So let's see what regression model is saying. So if you want, you can recreate this. Simply you need to go to data. You will have to go to data analytics. Then you need to select regression analysis, press OK. Then you select your Y range. You don't need to select this period or sales. You just need to select 12,500 to 50,000. This column D 57 to column D 60 till there, and for X ranges you need to select column E 57 to column E 60. So this is D3 to D18. So this one what I have selected when I was creating this model. So whatever I have selected, that is what it is saying. Okay. So we need to select these two period, then you need to select confidence level and then press OK. Then you will get this. So let me create this for you. Regression analysis, Y range is this, then X range I will select this, then I will press confidence is already selected. Now I will select output where I want my output, summary output I will select, then press OK. He will ask you want to replace, I will say yes. You can see this. When we have perfect relationship between sales and period, so he is also saying that your regression model is 100% accurate. Multiple R is 1, your R square is 1, your adjusted R square is normally lesser than R square, still it is saying 1. Let's see if we can see if there is any issue. No, the both are saying 100% relationship between these two, sales and period, between dependent and independent variable. The standard error you can see it is 0. It is 0. It means there is no, whatever we are predicting for year 5, the same amount of revenue will generate. This is what the confidence it is representing. Now you can see standard error is 0 and T state is 65. P value is not able to calculate because of this is something which is perfect relationship or something. Okay. So now let's calculate using this formula. Y is equal to 22 into X minus your intercept. This is intercept and this is your period and this is our slope. Slope multiplied by period. What is the period? Period is not given here. I will update here. Okay. Then we need to reduce intercept. This is the intercept. So we want to fix this thing, and we want to fix this thing. Okay, paste it here. We mention here 5. He is able to calculate your sales forecast for period 5. So 5th year. If you want to go update here 6, he is able to predict your forecast for 6th year. Similar way, he will be able to predict your sales forecast for 7th year. So this is how you can use this formula and calculate. Apart from this, I just wanted to check one more thing so that you can also understand a little bit more hidden this. So what I did here, this is your task, you need to do it. So I have calculated this, okay, using standard error and intercept and this slope, etc. So what I'm trying to say, you have this model. It means it has formula based on this historical data. Now we want to calculate this forecasted value. Okay, for that I have already manually updated this. So you can also update this. You can start doing it with me. Okay, so what I'm doing is using the same formula. Now we need to look for slope. Where is the slope? So this is the slope into period. Period is this 17 plus use this intercept. Let's see. He has calculated the forecasted value. Okay. Since we are considering the seasonality factor, that is the reason we need to add the seasonality factor plus look. Since there is all these are the 0 quarter 1 to quarter 3, so it is no point of considering this because from 0 if you multiply anything it will be 0. So that is the reason I am making it little bit shorter. So I am just considering the quarter 4 and quarter 4 I will multiply by slope. So this is the sales forecast. Similar way I have calculated, but here what I have done is I have considered all the quarter and all their slope. So since their slope has no value, so that is the reason it is not going to impact. This is quarter 1, this is quarter 2 and this one is quarter 3. Your job is to calculate the sales figure and see they are considering the seasonality factor or not. So what I have mentioned, as I have calculated, it seems it is for simple formula it will not consider, but you need to add here this quarter 3, then multiply by, okay, so when you are calculating this, you need to also consider the quarterly factor. Okay, like this one, this first one is related to quarter 1, so here you can add further quarter 1 period, or you can select as per formula, you need to multiply quarter 1 slope to period. Okay, so quarter 1 will not have any impact. For quarter 2, again you need to see, I have not considered quarter 2 impact, so I will do plus quarter 2 this one into quarter 2 slope, like this way. Look, if you are keep on multiplying these with this slope, will not have any impact because these are all 0. So that is why I'm not making this formula much larger. That is why I'm just considering quarter 2. For quarter 2, I'm just considering quarter 2 and quarter 2 slope, so that it will be easier. Similar way for quarter 3, you need to select quarter 3 and multiply this by quarter 3. So then you can see how much percentage of changes it is coming. So this is what we wanted to learn through Excel sheet. So regression is not just a statistical exercise. It is a kind of discipline way to link business drivers with financial outcome. The regression analysis tells us the average relationship, enabling more objective scenario-based budgeting for organizations willing to invest in data and talent, and regression can transform the forecasting accuracy and confidence. So I have also given some of the quick reference links. You guys can copy paste this link and read more article and all, so you will get more understanding on this topic. Okay, so I think I am done for today. We'll see you into the next session. Stay tuned. Thank you very much.
Hello everyone, welcome back to IBS. Today we are going to discuss about multiple linear regression analysis. This is also one of the important topics, so let's jump to the topic and understand it. So we will be learning this through Excel sheet. Okay, so that is why I'm directly jumping to the Excel sheet. This Excel sheet is the same Excel sheet which we are following throughout the forecasting module. Okay, so as you can see, I have updated the data for the period from 2012 to till 2031. So till 2027, you can consider that we have this all historical data we have. Okay, and these are our period 1 to period 16, and these are our quantity of product we have sold, and these are the marketing spend. Okay, we can consider this is in million, or this may you can consider in CR. So our revenue generated is also in CR. You can consider in that way, or whatever way you want to consider. Okay, but this is the number we have. So now we will run the regression analysis. Since we have run this regression analysis multiple times, so I will show you one more time. Go to data and then click on data analysis, then you will select the regression analysis, press OK, then select your Y range. Y range is our sales data already being selected correctly. Then select the X range. X range is our period, quantity and marketing. We are using multiple independent variables, not a single, so that we can see that if we are using multiple independent variable, how much they are going to impact on our regression model. So once we have run this, is asking for overlap, so it's okay, we'll do this. Then we will do some formatting, comma, this multiple R is numeric form, and this R square and adjusted R is being considered under percentage term. And then we have a standard error is 298. In terms of sales, if we can see 298 divided by this, so the variance is quite low, as you can see. So if you predict using this model, or if you have similar level of data, then your sales would vary between 1.6% up and down, like this. So this is what a standard error is saying. Then we have all these things. We'll do some formatting. Just press comma, you will see this. So we have used three different independent variable. One is period, another is quantity and marketing. As you can see, this one is something perfect. Then our sales has increased, and similar way our quantity of production, quantity sold has also increased, and marketing cost has increased slightly. Then again our sales has increased, product sold has also increased similar way, but marketing cost has dropped down. So marketing cost, it looked like not very healthy relationship with sales, but it has a healthy relationship. If we are not spending equal percentage as much sales is growing, that doesn't mean marketing doesn't has a relationship, because what I'm trying to learn here, when you have invested heavily in your marketing, so sometimes it happens that your marketing cost, you have spent a lot of money in that particular period. That doesn't mean your revenue will generate always in the same period. Okay, it is not compulsory. So maybe next month you will get more sales, and maybe that marketing campaign will have impact of throughout the multiple years. So these are so many things, but you have to consider all these things in your mind. So that is the reason, if marketing cost is going down, that doesn't mean marketing has no relationship. But regression analysis don't understand all these things. So like how we do marketing cost in USA, also you can capitalize it if that is going to impact to your business for multiple years in those cases. Also, if we take example of Udemy and such kind of many companies, they do marketing in some month and some another month they don't do any marketing, still they generate revenue. So how they are generating? They are generating based on their organic growth, and they have built their goodwill. Based on that, people are coming and buying their product, right? So that is the reason. So it doesn't mean marketing ad spend has no 100% relationship. Okay, so similar with seeing that marketing has also increased simultaneously as the sales has increased. Maybe they are not increasing exact the same percentage, or maybe quantity has not increased exact the same percentage, but it has relationship. Okay, then what we have, R square is 99.2. That is also one of the great module. We can assume that. Also adjusted R square is little bit lower than R square. So it look like this model is representing healthy relationship. Okay, this one you guys need to calculate. I have already explained to you the last video how we can calculate. Okay, so you will take first the intercept, and then you will multiply by the period with your variable 1. So variable 1 related slope is for period, variable 2 is this, variable 2 related slope is this. So like this you will need to multiply, and then you can calculate. Okay, what I will do here, I will try to see that, like we have created this model, we have considered till 2026 and 27. For example, we were having data till 2025 and we want to predict for 2026. Will this model will give us a forecasted revenue around this, or something else it will give? That is the reason I want to check. So what I will do, equal, first I will be taking slope plus slope of independent variable 1 multiply by independent variable first, then plus, then again take independent variable 2 multiply by marketing, plus also again select independent variable related slope third, multiply this by third independent variable, which is marketing, and plus you can add your standard. So look, it is saying you would have predicted sales somewhere around 19,437, so and your sales is somewhere around 19,000. So we are not having much difference. As you can see, 437.9 divided by this actual sale, so our variance would have come somewhere around 2%, right? So as you can see, we have calculated here initially this divided by, we can take average of all the period, this plus this divided by 2, then again make the bracket. So it is also around 2%. So this model itself is saying our predicted sales forecast would be different around 2%. Okay, so this model is quite good actually. He can able to predict your sales forecast much accurately. Okay, so similar way we have taken this data and we have also predicted our sales using this number. So I'm not sure how we have calculated is correct or not. Yeah, I think it is correctly being calculated. We have considered standard error as well as all of this. C19, D19, yeah, perfect. It look perfect. So we have calculated this. So this amount I will update here. So now we want to create forecasted trend line. Let's see how it will look like. Recommended. Normally you can select recommended. It will give more better chart. So as you can see, it is saying your sales is going upward first thing, and second he is giving you little bit of space, just that because we have two different lines, that is the reason. Other than that, around it has started at the same amount. You can see 18,463, it is also 18,428. So there is small difference, right? So from there itself has been started. And also you can see that they are considering this upward slope and then downward little bit. So exact how your pattern are here, if you can see a little bit going up and then slightly jump and then going linear, not much higher sales. Similar way it is also going very linear, not much sales, then sudden little bit jump and then again it is linear. So it look like they are considering. So this regression model has considered based on this data how your slope are. In similar way, he is giving you the forecasted value. So normally also we have checked here. So what is the difference between 2026 actual sales versus if we have predicted the sales forecast, that would be around 2% difference. So this is overall the discussion with regard to multiple regression analysis. We have some more data, like we have given the date, sales, year, and marketing ad spend, and then R&D cost. So if your R&D cost is this, why I am giving this data? Just to inform you that regression analysis has some drawback. Okay, why I'm saying this? Because if this is your customer satisfaction, if your customer is not satisfied, your sales will go drastically down. For example, if here it is saying your customer satisfaction is 9.2, then your sales is coming 3896. We have calculated using this model. If I make it 4, so it means your customer is not satisfied at all. So you can see there is how much changes has come. There is I17. So we have considered I17 or not, that I'm checking. It seems we haven't considered. Consider O, F, D, H 17. We need to select H17. Function F4. I don't think so. We need to do function F4 into the variable 3. This is the third variable. First, second, third. So third variable we will select. Then we'll press F4 because we want to make this as it is. Then I'm going to select the customer. Customer satisfaction is your I17. Then I will multiply this by your coefficient of independent variable of marketing, which is also being called as a slope, and I will freeze this. Then also I need to consider standard error plus this is our standard error. So as you can see, if we are making it 10, so your sales is somewhere around 3646, correct? And if we are making it to 4, the customer is just 40% of your customer are satisfied, then how much they are considering your sales would be. So how much impact it has, this minus this, and we'll take the percentage. So we'll better understand how much it is going to impact. 14%, they are saying there your sales will drop down if your customer satisfaction will go from 10 rating to 4, or if you can consider in 5-star rating. So 10 is your 5-star, then 4 is obviously your 2-star. So do you think if you are getting 2-star rating for any product, so will your sales will drop down from 100 to only 14%? It means your sales is 86%. So will your sales will drop down to 100 to 86 only? I don't think so. I think if my star rating from 5 or 4.9 to if drop down to 2, I would say my sales will remain 14%. 86% sales will go on. Okay, the important independent variable, right? It is one of the most important independent variable for entire business, because customer is the king. For customer we have understand many things, right? But this regression model doesn't understand the weightage of this number. So we have given him the percentage of 1 to 10. Okay, so we understand the importance of if your product is ranking on 10 or 5-star, and if your product is ranking as a 2-star and 3-star. So I know the importance of this, but I don't think regression analysis understand this. He just calculate the mathematically, and if we do the changes of this, like nearby sales, okay, we want to keep this way, then you will see the impact. What I'm trying to do is this sales into this one I will consider as a percentage 0.8. So this is the percentage I will be considering as a customer satisfaction. Customer satisfaction. I will keep this into 0.7. Okay, you can also do this 23 into 0.76%. Then this into 0.91%. What I'm doing is I'm just increasing the amount. I'm not limiting this between the range 1 to 10. Okay, now I'm improving it based on the range. Basically I'm increasing the range so that it will understand your model more better. Basically you need to spoon feed this kind of model, regression analysis related model. They don't fully understand everything. Like what I was saying, like common sense is not so common for automation, or I would say for regression model, histogram model, or data analytics related thing. They don't understand everything, correct? 3000 that time, 88% customer are satisfied. So now we'll see that how great it will influence your sales. When I will be changing this, then you will see the difference. Okay, 3420 into 92% customer are satisfied, 4434 into 92% of customer are satisfied. Similar way, 3646 into 100% customer are satisfied. Okay, now since we have given this, I will have to copy and paste somewhere else, otherwise I will not be able to calculate the model perfect. Okay, just now I have removed this, so I will be deleting this, correct? I will copy paste this here. Now let's see this. Go to data, then go to data analytics. It's okay. Y range, sales range, then pick the independent variable. These are our independent variable. I need to correct Y again because it has considered sales. Sales we don't need to consider. Now output is this, and press OK. Now you can see how better model it is. These are all saying that your model are very better. Now I will be changing the marketing cost. We'll see. So there is missing element we have not considered, that I will be considering this customer satisfaction. Into customer satisfaction is this 83, it means P21. So this one we will remove. Now our formula is correct. Something went wrong. Let's consider intercept plus freeze this into period 10 plus variable 2, freeze this into select the marketing plus variable third, freeze this into this is your R&D plus variable 4 into your variable 4. And we need to freeze this P21. Then also I need to add standard error. Let's see, something is wrong or something. I'm not able to understand what went wrong. This was somewhere around 3609 or something like that, so I'm correcting that. Now I will rerun this model because there is some issue in that model, and I have considered this one I should not consider because these are formula based. Okay, let me rerun the model. Select the sales amount till here for 10 period, then select this all year, marketing, R&D, and this customer satisfaction, then press OK. So now this model is sound like more better. Earlier it was coming 1 and 1 and almost 100% accurate, which was not correct model. So now I think we have got the perfect model. Sometimes regression model doesn't calculate things more accurately as when we select wrong criteria or something. Okay, because these were based on formula, these are numerical numbers, so maybe regression analysis don't understand some kind of stuff. Okay, so we have calculated this, yeah, perfectly calculated. Okay, now I want to change the customer satisfaction level. Like I have considered almost similar way. If I'm reducing it to making it almost half of this, then see how much impact it has. It has great impact, right? Now we'll see this. This is the amount. So we will check this one, 4747, and then we'll change it to 1600, just half of that. Then how much it is coming? So what is the difference? This minus this, then we can consider in percentage term. So now they are considering 20%. If your customer satisfaction has dropped down by 50%, still they are considering 19%. So as you can see, even though we have changed the range, like earlier we were having range between 1 to 10, still it was not able to perfectly calculate the impact of customer satisfaction, as we can assume that if customers are not satisfied, our sales will drastically impact. If your rating go from 5 to 4, your sales will drop down by more than 80%. Okay, but it still we have increased the range from 1 to 10 to almost similar way as per sales, but still it is not perfectly calculating. As you can see, it is considering only 90%. If your marketing cost will drop down by half. Now make it again 3602, then there is no impact. Again, if you make it 0, then let's see, still they are saying if your 100% customer are not satisfied, still your sales will be 66% and your sales will drop down by only 34%. So that is the reason keep on saying that regression model doesn't have common sense, but we need to feed this kind of information instead of limiting it or something, so that they will make it your regression model more accurate. So as you can see, they are already saying your regression model will be able to calculate 92% accurately. The rest all we have already discussed. So now what I did here, I have removed this hugely impacted thing like customer satisfaction, and I just kept this kind of cost, marketing, R&D, and
year. Then you can see the regression model how it is saying. It is R square is 89, adjusted R square is 84. So still it's saying your revenue related sales forecast would be 84% accurate. So it means 60% chances of sales would be very, but in actual FP&A team, if you would be working, so management are not expecting 60% differences. They are expecting you should have your minimum to minimum expectation is plus minus 5% of difference. So either your predicted sales will go up from what you have predicted by 5%, that would be in the range, and if it is going low, that is also around 5%. If it is going beyond that, then they will say you have not perfectly planned, because even though if your sales you have targeted for $1,000, and if it is going $1,200,000, something like that, so 20% it has increased, which is good, but we have fail in planning the forecast. So what will have the impact? You will not be able to manage the inventory, you will not be able to balance the working flow, you will not be able to balance the working capital related stuff, and if you are having some kind of a stock issue or something, so then you will be having brand recognition related issue, so brand image will be in danger. Okay, so that is the reason management are expecting generally 5% up and down, and most of the people in finance, they are already working as a FP&A director or CFO. They are not satisfied even with 5% up and down, so they think that should be around 2% or 1% difference in variable, but which is not possible. So I am assuring you, whenever you are working or wherever you are working, if your model are 5% up and down, then you can easily debate and you can represent him some kind of research data. So most of the company having these kind of variances, and it is okay, because future is unpredictable. Future we cannot predict 100%. So that is the reason, even though 5% if it is coming up and down, that is also perfect. Then as you can see, what I tried here, I tried to calculate the sales growth percentage. Accordingly, I will increase the R&D and marketing ad campaign both in almost same percentage, so that we'll see how is your regression model able to analyze, and they will able to give you result or not. So if we did this already in previous lecture as well. As you can see that adjusted R square is also 99%, and the standard error is very less, it is almost $5. So if you are predicting your sales somewhere around, let's take the average of this plus this, total is this, divide by 2, this is your sales figure, and if your error is somewhere around 4.86 by this, so how much is in percentage terms? We can see even not 1%, even 0.017%, which is very less percentage. Okay, it is the 10% of 1% would be the variance in sales forecast. So this is what the standard error is saying. So it is that much accurate. Okay, their T stat is also 1.2, which is good actually, because the T stat, as we have discussed, it should be range between plus minus 2, correct, and P value should also be range less than 0.5 or less than 0.1 also being considered as a good. So P value is all are looking good actually. That is also all are good. Just one item is not good, which is 4.26, which is beyond 2. That will not be considered as in good. So this one we can change the color as in red or some other color. Okay, I have also checked this formula and recalculated based on this model. Based on this model, if we have predicted in year 1, so how much this model has calculated or predicted your sales, so they are calculating this amount. So the variance you can see is very less, just $8, $3, and minus $36. So this is very less amount, even not 1% in any case. So if your regression model is showing this kind of adjusted R square percentage, so then it is the indication that this model is very accurate. So we can rely on this. And what is the drop down, or what are the issues regression analysis has, which I have already discussed. Okay, so thanks for watching. I will see you into the next lecture. Stay tuned. Thank you very much. And please do follow me on YouTube, LinkedIn, and Instagram. Hello everyone, welcome back to IBS. Today we are going to discuss about casual forecasting. This is something very important topic again, because regression analysis and time series analysis, seasonal factor related analysis, these all are very important to help you to predict more accurate forecast. But casual forecasting method is something like giving you the reason between two dependent and independent variable. Like ever wonder why ice cream sales rise when temperature increases and why car sales drop when fuel price increases or tax price has increased? So these are the things where we are trying to understand the reason behind these two different variables, in which one is dependent and another is independent. So that casual forecasting is in action to solve this problem. So casual forecasting method are used when the value we want to predict, called dependent variable, is directly influenced by one or more independent variables such as marketing, times, customer satisfaction, sensex, and market condition, like market is very high in demand of such kind of product, or maybe industry are in demand. So these are the different independent variable that is what influencing your sales. Okay, unlike simple trend forecasting which only look the past pattern, and casual forecasting dig deeper and identify the cause and effect relationship behind the numbers. For example, if we are forecasting electricity demand, and temperature might be an independent variable. If we are predicting sales advertising spend on GDP growth, so might be the key drivers. So these method help manager to make data driven, not just trend based guesses. So as a casual forecasting, you can see forecasting is equal to business GPS, and if we are making any wrong forecast or something, then excess stock you will have, excess inventory, I mean to say you will predict more revenue, for that you will do more advertising or something. And if their demand is not that much, so your marketing cost, your excess inventory cost, all will be wasteful, and it will create negative impact on your P&L and balance sheets. Okay, so basically good forecast save all those things. So that is why we are learning to understand the independent variable to predict the dependent variable. So foundation of casual forecasting lies in understanding why something happened, and the economy and businesses, many outcomes are not random, they are result of specific influences factors. For example, demand of umbrella and rain jacket increases when the raining seasons comes, right? And the loan default rate may rise when unemployment rises. So these are the link each other. So that is the reason we are trying to understand what are the factor which is influencing our sales. In casual forecasting, we have linear relationship. So in linear relationship, you can see most casual forecast model assume linear relationship, meaning when independent variables changes, the dependent variable changes proportionally. So mathematically we can say y is equal to a plus bx, where y is our dependent variable such as sales, correct? So anyway, we have already discussed this thing and very detailed already, and your x is independent variable. So this is simple linear regression, and then we have discussed about multiple linear regression as well. So in multiple regression, we will have multiple independent variables such as your sensex data, such as your market demand, and your timing, and your ad spend, and multiple other things are the reason. These all are the driver who is forcing to generate revenue. So there is no one thing only impacting your sales, right? And then obviously B is your slope, correct, and A is your intercept. So based on the same exact formula, we are also going to do the casual forecasting. And one more important thing is choosing right independent variable is critical, because in just after some time I will be running an Excel sheet in which we will take multiple independent variable and try to understand which variable has more relationship with sales. So while running the regression model or casual forecasting model, we will use those independent variable which has huge and better relationship with sales, and likewise we will also able to refine and remove those independent variable which has less relationship or which is causing us to predict more inaccurate results. So that is the reason we are learning here the cause and effect relationship, so that we can identify what are the independent variable has great relationship, okay, and understand the logic behind. So now let's jump to the Excel sheet and understand this. So as you can see, I have taken just 5 different nature of data, and this is dependent variable and these are all independent variable. So now to understand cause and effect relationship, we have another formula. You need to go to data and then click data analysis, and then you will have core relationship. Click OK, and then click input range. In input range, we don't need any manual text information. We will take only hard-coded number. So from 1 to 5. Then we need to select the output range. So this would be our output range. Then we can press OK. So as you can see, this has given us a great data. Let me do some little bit formatting. So now you can see column 1 is our sales. You can paste like this, Alt ES V and then transpose. So it will be pasted like this way. So 1 is relationship and then column, we can again paste it here, correct? So this is our sales data, this is also sales data. So between sales and sales there must be 100% relationship, so no doubt about it. So we can understand this, right? Then for also year, relationship with year is also 1. Similar way, marketing, relationship with marketing is 1. So these data are not important for us. We need to understand this years, how periods are relatable to your sales or not. So it says that as and when your new period will come, 91% he has relationship. Okay, similar way, marketing has not a good relationship. Based on the marketing information, it says, which we are able to predict 42% accurately our sales if we use marketing data. Similar way, if we check marketing relationship with year is also not good. Marketing has good relationship with marketing itself. This one is marketing relationship with R&D is 42. As you can see, this is R&D line and this is also R&D. So this is marketing relationship with R&D, and then marketing relationship with CS. CS stand for customer satisfaction. We can paste it here. Okay, so this one you can see marketing, we have tried to understand all the relationship of marketing with other independent variables. So similar way, you can see R&D relationship with sales is 85%, which is not very good but not even bad. If you are having 85% of your sales are relatable to R&D, that is something good, I would say. This would also, customer satisfaction is 93%, so that is also saying somewhere it is having good relationship compared to marketing. But overall, I would say this entire model is not very good, I would say. So let's run regression model as well as for this particular data and then see. So basically I'm doing this to understand which are the item doesn't have good relationship, so that we can drop those independent variable and we will keep those which has good relationship. These two are, I'm thinking, has no good relationship with sales, so we will drop this. Okay, but we'll drop this later. We will run a regression model using all data and then we will remove this and we'll use these 3 data and then we will see what would be the regression model result will come. Data analysis, go to regression, y range, then x range. As you can see, it has 91% adjusted R square. So this model has capacity or capability to predict sales figure at least 90% accurately. Okay, let's remove this. Okay, let's rerun, reducing these 2 factors. Go to data analysis, regression model. Y is already correct, only these 2 I need to take. Output, I will select this and press OK. Let's see this. Adjusted R square is 92% and now it is 91%, so it has improved little bit. Okay, and if we talk about standard error has also improved little bit. So overall it is giving a good idea that if we are removing marketing and years, then it is going to predict our sales even more accurate. But as per a study, it says if you are keeping more, I would say, more independent variable to predict your dependent variable, that will be more better result. Okay, now we want to learn little bit more with regard to casual forecasting. One side we have advertising related costs and another side we have sales data, and then we have created our regression model. So based on this information, you can see our multiple R is 99%, so it is saying that it has good relationship with your advertising ad spend related stuff. So this is the reason we are working on it, so that we can able to understand a cause and effect relationship. Once you understand the cause and effect relationship, then you need to create a regression model so that you will get this formula and you are able to predict your sales. Okay, by using this kind of forecasting model like this way. we have sales data, and then we want to predict for April 2020 sales. So if you have better regression model formula, you will be able to calculate your forecast much more accurate way, okay, rather than just creating like this way, how we have created earlier like this way. If we are calculating this is just simply they are taking sales data and they are getting little bit upside 5% and downside 5%, and they are predicting the model. So he is also using the formula. So this formula we are trying to make it more better. For that we are using casual forecasting, so that we can reduce unwanted data and update more accurate or more clean data to predict our sales, okay. So if you can understand this, as you can see, based on this data, it is saying your scattered plot are nearby the trend line. So it means when you are investing money in your advertising or ad spend related stuff, your sales is increasing simultaneously. So it has good relationship, because you can see most of the scatter plot are very near to the trend lines, but this too has some kind of issue, because as you can see, if you are investing money in sales around 11,000k, your revenue is being generated between 7.5 million to 6.5 million, and even though if you are doing ad spend around 10,000, still you are able to generate revenue similar range, right? So what is the point of increasing 1,000 excess money in ad spend? This is the question we are going to address using and watching this kind of stuff. But overall, if you will see, if you are keep on increasing your ad spend, your sales is booming, okay. Then we have another casual forecasting model where we have low relationship. For that you can see that multiple R is also very low, R square is even 48%, and adjusted R is very less, 41%, and you can see standard error will be nearby 9,96,000 up and down. So that is huge range, right? Because if you will consider this as in 1 million, so what you are predicting your sales, that sales maybe go up and down by $2 million, and here based on this model, if you will predict, your sales will go by 2.5 million up and down. So overall $500,000 your sales not be accurate as you will predict. That is the reason we will say this regression model is not better. If you can see this scattered plot related stuff, you can see when we are putting money in ad around 9,000, we are able to generate sales around 6 million and upper, and when we have increased our advertising even 1,000 extra, still your sales is little bit high. But when you are doing ad spend around 14,000k, still your sales is here. This line is the indication in this period your sales is here, okay. Though your trend line is here, but your actual sales was here. So you are able to generate sales somewhere around 6.8 million or something, okay. And here also, if you are investing in ad, you are able to generate around 6.6 million dollar, and if you are spending around 14,000k, still you are able to generate within the same bracket. So that is the reason. Here you can see suddenly if you have just increased $1,000, your sales has jumped to just 30% high, from between 6 to 7 million, now it is between 9 million to 10 million, okay. So this is the difference of opinion. It is something where you are not able to understand based on the scattered plot and trend line that the data is giving you more better results. So in case of this model, you can see most of your scattered plot are nearby the line. So this is something which will give you a visual understanding that this model is more accurate. Similar way, we have created one more model in which we are trying to understand. As you can see, your multiple R is 0.57, which is still not good. So as much it would be nearby one, that would be better. R square is 32, adjusted R is 24, standard error is too high. So if you see this scattered plot, nothing is nearby the trend line, okay. As you can see this, if you are investing money 9,000, you are able to generate between 7 to 9 million dollar. Even though if you spend around 35,000 in marketing, you are able to generate just little bit higher. And if you are investing money less than 34,000, then you are able to generate around 19 million dollars. So this is something which is giving clear indication that there is no relationship between sales and ad expenses. So this is just an example, but normally ad has direct relationship with your sales figure. So now we want to know little bit more about where it helps. So obviously your casual forecasting will help you to predict your inventory cost, predict your sales and revenue forecast, and also you can use this model to predict your workforce, capacity planning related stuff, cash flow, and working capital related stuff. So these are the things where you can use this casual forecasting. So thanks for watching. See you into the next session. Stay tuned and please follow me on YouTube, LinkedIn, and Instagram. Thank you very much. Hello everyone, welcome back to IBS. Today we are going to discuss about learning curve, or we can say
experience curve. So we are going to explore the foundational tool for cost management and process improvement, learning curve, and which is also known as an experience curve. Okay, this concept is specifically critical in industries where the labor cost is high and various processes are being monitored through labor or employees, and it has been used by top consultant like BCG to help firm to generate breakthrough cost saving and competitive advantages. Throughout today's session, we will bind theory with real world example and quantitative insight. So what is the meaning of learning curve? So as a definition, the learning curve describes how the time or cost required to perform a task decline with repeated performance. For example, as cumulative production increases, operator or process become more efficient. So experience curve in a broader extension, BCG introduced the concept of the experience curve in 1960 to link the learning not only to labor but also all costs such as manufacturing, administrative, sales, marketing and other costs. Whereas the traditional learning curve often focus on direct labor hour, the experience curve broader the view to total cost decline with sales, with scales. So if you talk about little bit historical root of this learning curves is, so this is originated basically through the aircraft industry, which is I would say Boeing, and in 1930 noted that each time accumulate the airplane production doubled, so labor cost per unit fell by predictable percentage. So typically the learning rate range between 75 to 90. So it means to say your cost is 100, then next when you are doubling the processes and you are making new unit for the same product, so there may be your labor cost will reduce by 90. So 10% or 15% or 25% your overall cost will decrease. So interpretation of learning rate is basically a learning curve rate of 80%, also sometimes called an 80% curve, meaning when accumulative output doubled and new units time or cost is 80% of what we was having before. So 20% improvement in cost, so basically we saved 20%. So let's take one example. For example, we are making an aircraft, and for first product we have invested, and the cost, actual cost which has been incurred for this product is around 100 million for product 1. So and it takes 6 months. From next time when we are producing the same product again, so we have learned so many things while creating this product from here to here, from here to here. Okay, so while going through those processes, we are doing study, we are researching, we are improving, we are going with a lot of discussion, and when we have finalized one particular product, so it means we have learned so many things, we have decided so many things, we have finalized so many processes. So this is what we are going to do and how we are going to do and when we are going to do what. So initial first time which will take huge time. So for example, it takes 6 months. So when you are doing the same processes, so all your processes are final now. You will save all the discussion, all the confusion whether we do with that way or this way. So these are the thing has been stopped now. So it will obviously reduce. Again, your time taken is somewhere around 4 months. So we are assuming that your cost has also reduced similar percentage. Let's make it $70 million. So basically we reduce time also 2 months, and also we reduce the cost, because in 2 months we will also have to pay extra cost for our labor, engineer, everyone, right, whoever has working on this particular product. So 30 million is directly saved. So this is the concept basically. So this concept has been used by many company and they have saved millions and billions of dollars. So let's make it another example in more easier way. For product 1 we took 10 hour and cost $100, and next time when we are producing same product 2, so that time it took around 6 hours and the cost is 60. So total hours is somewhere around 16. So the concept cumulative learning is, you might think two point will come. First is we have reduced from 10 to 6, it means 60% we have reduced. But accumulative costing says something else. I mean to say accumulative learning curve says 10 plus 6 divided by 2. Product 1, product 2. So 2 products. So that is why I am dividing by 2. So 16 divided by 2 is 8. Okay. So now the average time is 8.
divided by 10 is 80%. So this is called 80% is your learning curve. Now if you will say that product 1 is 10 hour, product 2 is taking 6 hour, okay, and average learning curve is 80%. So you can't say that product 1 has taken 10% into 80% is 8 hour. That 8 hour plus 10 hour, then that will be something else, right? So that will not be correct. 10 plus 8 divided by 2 is, you will get 9, which is 90%, right? So which is not correct. So all I'm trying to say here, 10 into 0.6 is 6. So actually that second product has reduced by 40%, but accumulative learning curves is saying reduced by 20%, 100% to 80%, which is 20%, right? So 20% is reduction in timing, not 40%. But if you go with product wise, it is 40%. Okay, this is the point I wanted to make you clear, because when we will solve the question related to learning curves, so that may create confusion. So that is why I'm explaining it. Another point which is very important, and it is a favorite for my point of view, so the impact of learning curve in practices. So now let's talk about the rate of improvement over the time. Early on the curves is steep, meaning that you make significant progress in reducing the time initially, but over the time the rate of improvement start to level off. The time of saving become less dramatic. Okay, so this phenomenon is known as a diminishing return to learning. For example, initially the process might improve by 50%. Let's take this example, what I'm trying to say. Product 1 you took 10 hours, for product 2 you reduce by 50%. So it means you will take 5 hours, correct? So having the time it takes, so after few more cycle the improvement drop to 20%, and then it would drop further by 10%, and eventually the improvements become marginal, and perhaps the reducing only by 1 to 2% each time. So what I'm trying to say here, initially you might reduce by 50%, but do you think the same 50% every time when you double the production will reduce? Obviously not, right? Initial learning will drop dramatically, but later on it will be marginal, perhaps reducing only 1 or 2%, or may not be reducing. Okay, so this is the point I wanted to make. So initially you will drop down is very drastically, later on you will not be able to reduce your cost drastically, because learning and everything has been happened between this transition period, but later on it is not possible. So similar thing I'm trying to say. So from this period maybe 50%, from there to there you have started 20, then it is 10%, and then here you will 1 to 2% your total production timing is decreasing. So instead of 10 hour, here you are taking 5 hour, here you might be taking 3 hour, and then further 2 hour, and then you may not be able to reduce by 2 into 60, it means 120 minutes. So you may be reduced by 110 minutes or maybe 115 minutes, but not more than that. So this is the place where your learning will stop, because we have done everything. So but still there is a Kaizen concept, there is so many different Japanese concept where they always say there is always the scope of improvement. So that is also possible, but you have to do something externally, like you will bring some kind of automation and automatic machine or something, so that may be the reason, then your production may reduce further. But through manually what we have reduced, that initially it will be drastically, but later on it will be marginal reduction. Let's understand little bit about why this is important for firm or consulting. So obviously it is going to reduce the cost and marginal improvement, and this will scale the advantage and barrier to enter new company, because you have already creating product which is very cost advantage, and hard to new entrants to come into the business, because you have already reduced the cost. So another company cannot enter into that business, because you have refined your processes, you have reviewed the learning curve, you have created your budget, and then you are based on that you are improving your processes, everything you have already done in 5-10 years. So your company has reached to that level where your cost is 100% optimized, your efficiency is at 100 level, unless you are going to implement something new. So that I'm not talking about, but as an industry you are grown industry, so then it will reduce the chances of new entrants. And forecasting and planning, obviously it will help you to forecast your learning cost, as I told you initially, when we are going with this huge processes, so that time your cost will decrease learning later. So if you know this learning curve, so then only you will give this idea to your management and tell them that learning curve, we have learned this concept. So you can give this suggestion to those management saying that we are labor intensive or process intensive businesses, so our cost will reduce by 80% or something like that if you will say, and next year the same thing will happen. And if somebody will ignore this, I mean the suggestion given by you, so then obviously people will recognize who has given this suggestion, so they will come to you, and then obviously your value will increase. And if they will follow your suggestion, then also they will be able to make more accurate and more better forecast, correct? So this is why I'm trying to give you as much knowledge and as much skills possible for you to make you more better leader. So that learning curve will also help you to strategically market your position. Like using this strategy, you can able to predict the future cost, and then you can able to demand the value for that particular product into the market. That will help you to correctly analyze the product price, that will help you to correctly quote the quotation price for bringing sale. So obviously you want to reduce the target price to bring the contract. For example, there is a construction contract or something, so if you are going to sign that contract, so the person who is quoting the less amount will get the contract, right? So if you are having this knowledge, so you can able to calculate the future cost, and then you can apply this, and you can calculate better cost of your construction, and you can better cost the pricing, correct? So these are the overall benefit of learning curves. Let's understand the formula and equation how it actually works. As you can say, learning rate is 80%. A one car takes 6 hours initially. So basically if you are making a car, one car, it will take 80% from the initial 6 hours. So the time required to first car is 2 into LC power n. LC stands for learning curve rate. Learning curve rate is 80%, which is mentioned here, correct? And then A is total time for first production. So total time first production is 6. So 6 you will keep it here. And then number of doubling. So number of doubling is 1 to 2 is one time doubling, right? So that is why 1 I will be updating to the power 1. So you will get 9.6. Now you can see 6 is the cost of product 1, and product 2 cost is how much? 9.6 minus 6 is 3.6. So you might notice 3.6 divided by 6 is 60%, but actual learning curve rate is 80%. So this is what I was discussing over there. Okay, from 80%, if you multiply 6 to 0.8, you will get 4.8. 4.8 plus 6 would be how much? 10.8. So which is not correct, because this is the correct answer. Okay, 9.6. So that is the difference between accumulative. So accumulative is something which they are considering both the product, and then they are making the average. Now let's understand another point. From second doubling is 2 to 4. 2 to 3 is not the second doubling. 2 to the 4, right? And then 4 to the 8. So this is the third doubling. This is second doubling. This is the third doubling. So second doubling is 2, and third doubling is this. So same formula if you will apply, you will get this answer. Okay. So this is what the way how learning curves normally work. But what I have told you, initially it may be 80%, but later on it will not be 80%. So from product 1 to product 8, maybe till product 10 or 20, it will go by average 80% to it will be somewhere around 90%. It will reduce like this way, right? Here might be 80%, then it would be 90%. It means to say 20% reducing, then 10% reducing. Then after there may not be 10%, they will say they will go further down like this way. There may be 1%. So 99% from here to here, 99% will be remaining the cost. It means I'm trying to say then at the end, after multiple times we have produced this product, so they might be taking 2 hours. So then after 2 hours to 99% would be somewhere around 120 is the minute into 99%. You can calculate it. Maybe I'm just checking hypothetically, it will go 118 or maybe 115. So it will reduce like this way, not like this way 80% again from 120, then 80% would be, just take an example, 24 I'm reducing, so 96. So 96, 95 or 100 maybe. So this will not reduce that much. Initially it will reduce that much by this 80%. Then the same formula will be like this: 6 into 2 into 99% to the power whatever the number that you can apply, like this way. So this is what I am trying to tell you. Initially there may be high in the reduction of timing, but later on it may not be, it will be marginal. I hope you are getting what I'm trying to say. But formula is not like this. Formula is straight away simple.
your cost will be reduced by 80%, it means to say 20% of your time will reduce, 80% cost will be your upcoming cost. So this is how the formula has been designed. So there is one example, you can read it out and try to understand this. If you have any question, you can comment me, you can ask me into the platform wherever you are watching this video. Then there is one more example with regard to maximum learning possible. So maximum learning possible is something which is also again a difficult concept, but let's understand it. So initially, if you can see, your first time your learning was 100%. So when you are creating first product, then it is 100%. Then your second learning would be 80% drop down, so you will get the cost of 16. Okay, then the third types of learning, how much your, I would say, time will reduce. So the maximum, so maximum is 50. So what I'm trying to say here, if you solve this, you will get 10. So what they are trying to say, product 1, when you made the first product, it takes 10 hours. When you create second hour, the average timing considering product 1 and product 2 is equal to how much they are saying, 10 hours. So is it possible to create product 1 and create 2 product? Okay, total 1 plus 2 is not that, total 2 product cost is $10. Is it possible? Obviously not, right? For example, if you are creating a biscuit, you take 1 hour, or maybe you are making chapati, you take 5 minutes, and then you are making another chapati, second chapati, so you will take some amount of timing, right? Maybe 1 minute, so then the total would be 6 minutes. So initially this is 100%, then the 6 minutes is how much? 1 divided by 5 is 20%. So you reduce the 80% of timing, okay, but still there is 20% time you have invested to create second product. But here they are saying, if you create chapati or one bread, you took 5 minutes, and another bread you took 0 minutes. Is it possible? Then you are adding, but you are adding 5 plus 0, 5 plus 0 is equal to 5. So this is the total time for 2 products, and total time for one product was also 5. So that is not possible. So that is why your learning would be always greater than 50%. Okay, I hope you are getting what I'm trying to say. We'll take another example. If your learning is dropped down by 60%, so 40% is your accumulative learning. So initial product you have created, you investing 10 minutes, and then or 10 hour, whatever. And second product, if you solve this using the same formula, it will be saying 8 hours. It means to say product 1 you have invested 10 hours, and then you have created product 1 and product 2, and total timing is 8 hours. So it is not possible, correct? So how can you reduce your previous cost, previous timing? Okay, so same example, making a one bread you took 10 minutes, and making two breads you took 8 minutes. Is it possible? Not possible, right? So you have already invested this time, right? How can you reduce this? So that is the reason I'm saying more than 50% is the maximum, 50% is also not possible. Let's talk about little bit about the benefit of learning curve. So obviously development of production plan and labor requirement, so it will be going to help you in the development of your labor plan, management control, understanding, and that initial costs are higher, and product life cycle enable the better evaluation of managers performance. So basically management will be able to control your product timing more accurate and better way, and development of a standard cost. When we are creating a standard cost, that time we will use this tool, try to calculate the standard price for that particular product more accurate way when we are calculating direct labor cost, correct? And life cycle costing, so obviously learning curve analysis ensure the accurate cost estimate and over the life of contract, improving the bidding accuracy, as I have already discussed all of this. When you are going to bid particular project, so you will be able to calculate the cost more better way. Cost volume profit analysis, obviously it will help you to analyze the profitability, okay? And then capital budgeting, obviously it will help you to plan your capital budget, project budget more accurate way. So that will also help you obviously in make and buy decision making as well. So you can read it out, your key takeaway, and I think I'm done for the day. We'll see you to the next lecture. Stay tuned. Thank you very much.
Hello everyone, welcome back to IBS. Today we are going to discuss about expected value. So if you have multiple forecast with the help of regression model, with the help of time series analysis, through time series analysis you will have multiple forecasted value like high, base and low. Then you have cows based forecasting. So using multiple different forecasting method, also you will get forecasting amount from marketing, and you will get also forecasting value from expert opinion. So like this you have a number of forecasted amount
and the potential sales is going to be for throughout the upcoming year. So how will you create your budget when you have endless and different multiple different many forecasted amount? So for that, to solve this issue, we are introducing the expected value. That would be our last lecture, where we are going to conclude all our forecasting learning journey. Okay, so we will also tell you how actually various top companies are using similar model to create their budget. So this is something which we are learning is actually practical and which is being used in entire world, also say world top companies. So what do you mean by expected value? So let me redesign the concept. Forecasting gives direction, but budgeting demand the decision, and expected value is the bridge between multiple forecast and single actionable plan, which is what we are looking here. Let's see how leading organization apply this concept and make a data driven yet flexible budgeting. So expected value is the weighted average of all possible outcome, where each outcome is multiplied by its probability. And the business forecasting is usually have three scenario, like pessimistic and most likely and optimistic. So the expected value gives management one anchor to point for planning, resource allocation and target setting. However, EV is not guaranteed that your decision benchmark and surrounded by the scenario buffer. For example, maybe plus minus 5% up or down. Let's understand this, since we have considered only three different thought of forecasting. First one we are getting from time series or maybe through casual forecasting. So we have planned our sales would be around 301k, and based on regression model we are thinking that our sales would be 326k. So this one we can consider as a time series basis, and this one based on casual forecast. Okay, and then we have marketing. So marketing team is coming and saying our forecasting would be around 250k. As per expected value, we will need to think how much would be the weightage of each part of each types of forecasted model. So forecasted model based on time series we are considering, they will have 20% of weightage. I mean to say the chances to be potential sales, probability of our sales would be somewhere around 20%. Like we are thinking that this 20% says that we all as a management, BU, finance team, marketing team, everything thinks based on whatever the method they use, they are come to that point that we are thinking there is a 20% chances that our sales would be somewhere around 301k. And then another side, 20% people again think there is chances our sales would be 326k. So this is the weightage we are giving, or this is the percentage we are thinking that our sales would be this much, and 60% we are thinking, or maybe by voting or whatever the way, we think that 60% chances our sales would be around 250k. So as you can see, marketing cost is very low. So we will ask the right question to marketing team, because our forecasted model and regression model, we must have used the logic behind, like casual forecast. We know the based on our marketing strategy, based on our customer satisfaction and whatever data we have used, based on that our sales forecast will not go that much wrong, that this is 326k and this is just 75k. It is almost 30% down compared to what we are predicting through the predicting models. So obviously we will ask a multiple question to marketing team then to justify this budgeting amount. Okay, because regression model and all says our sales would be somewhere around 300 to 326k. So that is the reason we are asking question. So as we have discussed earlier lecture, like marketing team always want to reduce the revenue and increase the expenses so that they will get the benefit of cushion, and that cushion is the margin for them to utilize this for their promotion, for their increment, for showing management that we have planned 250 but we have achieved 300k. So we have bring 20% more revenue than what we have expected if budget is being setted by this value. So they can say this, right? And they get good bonus and all. So that is the reason a management want to reduce this kind of cushion and margin. So they want to get genuine outcome, potentially genuine sales would be whatever management is targeting. So that is why we want to remove this. So that is the reason FP&A and finance team will ask multiple questions to justify this. So if they are not able to back this by data, and these are the based on data, so obviously the weightage will increase. So they might increase by 22 or 30%, and this one also we will increase by 30%, and they might say, okay, I'm considering that our sales would be somewhere around 300k. Then what will happen? 300k into 40%. So then what would be the result? 30% into 300k will remove 1k or something, so 90k, and then 320 into 30, that might be 96k, and then 300 into 40k, this one we are considering 300k would be the sales instead of 250, then 120. If you add together 6, 9, 9, 18 plus 2, 0, and 2 we are having in hand, and plus 1, 3. So 306k is coming as a expected value result after the discussion with the management and all the marketing team, and what we have predicted based on previous discussion, that has been removed. So now instead of 275k we are considering this, and everybody are agreed, so it will get approved as well, right? So this is how it normally work, not only in a small company, also in giant and big companies. So I'm going to give you little bit more information with regard to expected value, how actually it is being utilized in top 100 greatest or giant company around the world. Let's understand little bit about the research and real world evidence, what this evidence says, and the use of expected value basically. So the first point is expected commercial value in capital budgeting, used by major corporation in R&D and project evaluation. Like expected commercial value, weight each potential outcome by its probability. So this approach helps rank the risky investment and is widely taught in business schools. The premium and is widely taught in premium business schools and apply in consulting firms such as McKinsey and Deloitte. The second point is dynamic scenario planning by leading consultancies like Bain and Company promote the dynamic strategic planning, where the organization plan across the multiple future rather than one static budget, so that they can be able to flexible while using the multiple future projection. So that we have already discussed this in our previous lecture, how we should have multiple budgets. Okay, and Bain's research shows that flexible budgeting and scenario thinking improve the decision and resilience during volatility. And the third point is planning agility and resilience. A Gartner study conducted in 2004, and they says those companies who are using scenario based budgeting were 3.4x more likely to adapt successfully to the market disruption. For example, we are in automobile industry and suddenly EV has come, so that is some kind of disruption. And in similar way, wherever you are working in any company, so there might be some kind of technology changes, AI and machine learning related changes are coming, and they are creating disruption for us as well. As if you are working in accounts payable team and you are processing invoices or something, and then suddenly the RPA has come and RPA has been introduced, so hundreds of invoices being processed through RPA bot system. So there might be 10 people are working in AP team, so there might be chances of replacement, or maybe you need to shift and you need to upgrade your skills and switch to the another department. So this is something is called AI related disruption. So those companies who are using scenario planning based modeling, they are having 3.4x more chances to be beat this kind of disruption. Okay, still only 20% of firm are currently use probabilistic or scenario planning model. So this is the harsh reality. Workday and Oracle highlight that the CFO of top company increasingly integrate what if simulation into their financial planning platform. Let's take real company examples such as Unilever and sales. So Unilever applies expected value logic in its sales and operational planning processes and balancing demand variability with probabilistic forecast. Sales, also known for pioneering scenario planning, uses probability weighted outcome for energy demand forecast and long-term investment. So while top global firm may not explicitly publish expected value related data, but they apply the same probabilistic mindset through the scenario modeling and sensitivity analysis and dynamic budgeting. And now we want to discuss how to apply this model practically. So we have learned through this expected value and we got the result, right? What result we got? 306k would be the final budgeted amount. So now what you need to do based on your scenario planning or your historical data, your sales may inflate or maybe go up and down by 5% plus and minus, so we'll reduce 5%, so our sales would be 200 let's take 90,000, and in case of great situation our sales go somewhere around 320. So based on this sales amount we will also calculate our cost of goods sold, and here also same thing, we'll also calculate our GP, and then also we will calculate our net profit similar way, and operating expenses, etc., EBITDA and everything we will be calculating. So we will be having almost three different model. Okay, one is base model which is 306k, another is pessimistic model where we will be having sales forecast as a 290k, and another situation where our sales we are very optimistic, so our sales would be 320k. So this is how you will be having different scenario planning model, and based on that we have been learning how we are going to reduce all the recurring cost, and like it, which is not going to impact our core businesses, or we will not be doing those expenses. So that will give you the marginal net profit, and net profit would be the same percentage whether you are selling 290k or whether you are selling to 320k. So you will be able to generate sustainable similar amount of profit. So those fixed cost and the agreed cost you can not avoid, but other than those variable costs which we can able to avoid, we will try to avoid this, like furniture making, like painting, like rebuilding the office, and also some kind of investment, and also you will save the cost based on your scenario planning. As the situation is being changed accordingly, you have used another financial model or forecasted model to, and that forecasted model will already have all the cost which is not going to boost your sales. So those costs we will already have thought and already systematically discussed, so that those costs has already been reduced from those budgets. So obviously that budget will be applied now. So likewise you are not going to have a discussion instantly, rather we are having discussion prior to the situation coming. So this is what the scenario planning normally helps to take quick decision and have discussion prior to the situation or risk, basic when risk actually emerge or risk actually come to the door. So that is the reason we are doing the scenario planning, and then you will be able to solve the risk, you will able to minimize the risk, and as well as you can able to reduce the disruption. And then you can also have three different model, and based on the risk, based on the situation, you can apply different model and different model. So you have multiple option in hand, rather than you need to figure out the situation at the time of risk and then do the as and when the situation change, then you applied different model, and accordingly you have to also replan your future potential risk and based on the situation, and do the reforecasting periodically, and then communicate this to your investor or stockholder or management, so that will give transparency, faith and trust in you. So final key takeaway would be from my side would be expected value equal to decide the grade forecasting, and it's transformed the uncertainty into structured decision making, and top companies combine the EV with the scenario flexibility and continue reforecasting kind of stuff. And remember, don't chase, rather evolve with the new information. So basically EV turn forecasting into action. It is not about being perfect, it is about prepare for every outcome. So I'm done for the day. We'll see you into the next lecture. Stay tuned. Thank you very much.
Hello student, welcome back to IBS. Today we are going to discuss about financial statement, how to review, how to do the comprehensive analysis. We will try to deep down into the asset and liability and equity section and income statement and cash flow. We'll try to understand what are the major item and what their definition is and why it is useful, and this kind of stuff we will be discussing into this topic. So let's jump to the topic and understand it one by one. Okay, so first of all you can see I have given a beautiful picture of this. Why I have given this? I just wanted to highlight to you, always your asset are equal to your liability and equity. The question come is why? So answer is company. There is a company. Okay, if this is your company and this is you. Okay, so you have given this company hundreds of million, okay, as a debt. So he took this money, okay, in his since this company is imaginary person, okay, he don't have his own amount or something, okay. So whatever you are investing into your company, so your company will consider it as a debt. So for him it is a debt, so that is why he will keep into equity 100 million. 100 million, if it is coming one part of your balance sheet, so another part should also have the same amount, right? Then only it will be balanced and there will be no difference. Okay, it will come to the asset side, and that too depend on criteria where you want to keep it. If you are keeping this cash for cash and cash equivalent, then that will be under your current asset. If you are invested this cash to building, land, equipment, furniture, so this will be your long-term investment, so that will be your fixed asset. Okay, so this is how you have invested 10 million in building, 10 million in land, 10 million in fixture furniture, 10 million you have invested in some other car or whatever it is, equipment or something. So you have invested 40 million, so that is why your fixed asset would be 50 million and your current asset would be whatever the remaining is 50. And then another side, your liability would be 0 as of now and your equity will be hundreds of million. So now your balance is matching. Okay, 100 million and 100 million. So now if you take any amount of loan, suppose you took loan for 10 million, okay, from bank or something. So again you have to increase your liability to 10. So your net this side would be 110. Okay. So simultaneously when you have taken a loan, so you receive cash, right? So your cash should increase from now. Earlier you were having 50 million. So obviously you will add 10 million and your cash will be 60 million. Okay, so likewise 60 million plus 50 million would be 110. So your all the side will always remain balanced and their difference should also remain 0. So that is why this is considered as a balance sheet, because all the point it is equal. Okay, so we'll jump to another slide and understand this. So now we have our current asset. So under current asset, what is the definition of current asset? You know, asset you have for less than 12 months or 1 year will be considered as a current asset. For example, cash and cash equivalent. If you have anything you in cash which or you have purchased some kind of deposits or something, okay, so that you can sold immediately and you can get cash again. So whenever you have cash in hands, okay, in company drawer or something, so that will be considered as an current asset. Okay, I hope it is clear to you. If I talk about long-term asset, so what is the case here would be, if you have any asset which is more than or investment which is more than 1 year or more than 12 months will be your long-term asset or will consider non-current asset. Okay, for example, property. Do you buy property for less than 12 months? If yes, then that property you have to account into your current asset section. You have to reflect in balance sheet current asset side. You will reflect your property if it is less than 12 months, and your non-current asset you will keep only those which are greater than 12 months or 1 year. Okay, and liability section would be the same case. If you talk about liability point of view, so liability section would be just opposite of this, but the concept remain again same. Okay, current liability, if you are having any kind of liability for less than 12 months or 1 year, that will be your current liability. For example, you have received or avail any service, okay, or you have consumed particular product, so that or you have to consume that service or product, you have to pay him, right? So that payment amount become your liability. Okay, if you are not going to pay within 12 months, if you are going to pay him after 12 months or after 1 year, so that will be your long-term liability. Okay, so this is the simplest definition I can give. Okay, and just if you talk about reverse concept, the similar thing, in case you have given service to your client, okay, and he has consumed your services and you have billed to him, so that amount you can consider your current asset in account receivable section. Similarly, your cash will be your current asset. Okay, so now we'll understand about other few major point of current asset. Okay, so cash and cash equivalent. Since we understood about current asset which is less than 12 months, convert into your cash will be your current asset. But within current asset, if we talk about cash and cash equivalent, that will be even little bit more conservative. You can convert your particular investment within 3 months or less. okay, then it will be considered under your cash and cash equivalent. So that is what exactly the meaning. They are considering this as a cash in hand, even though you have invested in demand draft, okay, and other highly liquid investment. So these are the investment which can easily convert within a minute or within a second or within 3 months of period. So those kind of investment you can consider as an cash and cash equivalent for company. And even your physical currency like your notes, that is also considered as a cash equivalent. Okay, if I talk about other perspective like what is account receivable, as I have told you, when we have given service, okay, or we have given product to particular client or someone, so when he has received or he has consumed, so we can consider the service amount or product amount as an account receivable section. If he has agreed to pay within 12 months of period, okay, so that will be in current asset. If he has said he will pay after 12 months, so that will be your non-current asset, that will go to your non-current asset side. Okay, so let us read it out. Account owned and company by its own customer. Okay, if you read this definition, they are saying the same thing. Okay, it's a customer and for goods and service deliver. Okay, we have delivered the service on credit. Okay, on the credit basis, if we have delivered the service, they will pay us later. Okay, so it represents money the company expect to receive in near future. Near future we are going to receive a fund. Okay, and this is the amount on the company by its customer. Okay, so for customer is actually owning our money, so he has my money in his hand, so that is why he has to give us and as soon as possible. So that is the simplest definition this is the simplest definition for account receivable. If we talk about inventory, so before going to inventory, let me make it clear between inventory and account receivable. For example, you took loan, you have money in your asset. Okay, let's understand it. This is the company, this is the owner has given fund, that will be in their equity section. Okay, and another section of company they will be having in either cash or they will be having in their non-current asset side wherever they have invested. So this one will be remaining equal. Okay, so now they have cash. If suppose you have invested 5,000 cash into your inventory, what does actually meaning is you have cash somewhere around 10,000. Okay, out of 10,000 you have purchased particular asset. Okay, so your inventory will increase by 5,000 and you have paid cash. Okay, so your cash will become 10 to 5. Okay, 5k, and this 5k will come here as an inventory. So again your balance will be same because your cash has been splitted between your cash and inventory. 5k 5k 10k is still 10k. Okay, so now once you have this inventory of 10,000k, if you sold this inventory in 20k to particular customer, so then he on credit. Okay, so he will say he will pay you after 30 days. So then that will be in your account receivable section. So this is the account receivable section. So that when inventory is sold on credit, okay, that will become account receivable. Or if your inventory is sold on cash, so then it will be directly convert to your cash. So again, if you sold this inventory of 5k and 20k, so then what will happen? This inventory will go to 0. Okay, since you have sold all the inventory, and this will become 5 plus 20, it will become 25. Total asset side has been increased by how much? He was earlier 10, now it is 25. 15,000 has been increased. If you talk about profits, what is your profit? When your cost is 5 and you sold in 20, so your profit is obviously 15,000. If I talk about income statement, so revenue would be how much? 20. How much you will charge your cost of goods? Cost of goods, obviously you will charge this inventory part. Okay, this inventory part 5,000 you will charge in your cost of goods. So what would be your net profit? Obviously 15,000. So that 15,000 will go where? This 15,000 will go to your equity section. So again, your one side of your balance sheet, it has increased by 15,000. So another side of your balance sheet, as you can see that your balance sheet is like that, right? Your current asset, your fixed asset or non-current asset, and then this side is your liability, current liability, long-term liability, and your equity section. So equity section you are increasing by 50,000, and as I have discussed 50,000 you are increasing your cash side also because you have sold into cash. So immediately your cash has increased. Okay, so now your cash is how much? Earlier you were having 5, you have again received 50,000 cash, so now your cash is 25,000. Okay, and earlier you were having 10,000, so now 10,000 has converted to 25,000, so 15,000 of cash you have extra. Okay, so that is why your return earning side also, your equity section also increased by 15,000 from net income. Okay, so that is why this side also 15,000 increase, this side also, I mean, so this side, your current asset side, you have increased 15,000. So this side also you have net profit has, due to net profit, your return earnings has also increased by 15,000. So your balance sheet will remain always zero, no difference. It will remain always balanced. So this is how system is defined. I hope it is clear to you. If it is not clear to you, rewatch this video and try to understand it. Okay, now let us understand what is meaning of account receivable and inventory. So we'll take one example so that we will be able to understand our cash and cash equivalent, account receivable and inventory and their relationship. Okay, so I have created this balance sheet. For example, we have cash fund around 1000k. Okay, and about the inventory, we are planning to buy particular inventory of 1000k. Okay, so when you buy this inventory, you have to pay either on cash or you have to buy on what you call is on credit. So we'll consider on credit you have purchased. Okay, so what will happen, your inventory will increase, so this will become 3000. Okay, since you have purchased 1000 inventory, you have cash 1000 and you have fixed asset of 1000k, so total you have 3000k. So another side, since you have purchased for short period of time, so your current liability will increase by 1000k. So now you have purchased this, and now this side also 2000k you have equity, because cash and fixed asset, cash plus your fixed asset, total asset side you were having 2000k, so equity side was 2000k. The owner has given this fund to run the business. Okay, now you have current liability of 1000k since you have purchased on credit. If you sold this asset on credit to your customer, so what will happen? You sold this into 2000k. You have purchased in 1000k and you took marginal benefit of 50% and you sold him into 2000k. So what will happen? This inventory becomes zero. Okay, this cash will remain as it is, and this one is 300. Earlier you were having fixed asset of 1000k. So now your total would be 2 plus 1 and plus 1, 4000k. It has changed to 4000k now. So what will happen? If you go to income statement and you have billed for 2000k, okay, so now you have to book your revenue. Once, what would be the entry for our revenue booking? Simply you will debit your AR for 2000k and you will credit your revenue side for 2000k. Okay, and also you will pass one more entry with regard to inventory. You will debit your cost of goods for 1000k and you will credit your inventory by 1000k. Okay, so that is why your inventory becomes zero. Okay, and then this inventory will come from here to here in P&L. Okay, 1000k, and this AR you have billed it okay for 2000k, so that amount will come and reflect here 2000k. So now you have 2000k is your revenue, 1000k is your cost, so now net profit is 1000k. So this is your income statement part. So this income statement are linked from here to equity section. So what will happen? Your return earning or your net profit or current year earning, there is one particular section in your equity which is CY, current year earning, like this. So in that your 1000k will increase. So your equity will become how much? 3000k. Okay, and this 1000. So again your balance sheet is 4000k. It is matching with your current asset side. So now you can see that current asset, your balance sheet, right side balance sheet always match with your left side balance sheet. So how it is linked with your income statement, that I have also explained it to you. Okay, so I hope this is clear to you. Okay, we'll move to the slide and understand it further. And what is the meaning of prepaid expense? Prepaid expense is something we paid, okay, in advance. So if we paid, we have not consumed the service or goods. Okay, either we have not received the goods or we have not consumed the service and we paid in advance. So what will happen? Since we have given this money to another company or vendor, whoever it is, so they own our money, right? So we will not keep it as an what you call we consume or something. So we will remove. Suppose we have paid 1000k. So we'll keep this 1000k from current cash to prepaid. we will move this one fund up from 1000k to this way. So how we will do this? We will pass entry. Simply we will debit our prepaid, okay, prepaid expense account, and will credit our cash. So cash will be reduced by 1000k, okay, and prepaid will increase by 1000k. So both will remain in balance sheet current asset side. So if you are removing 1000k and you are adding 1000k, so impact will be 0, okay. Since we have not consumed service, so that is why we cannot remove fund from our balance sheet, okay. When you consume or when you receive particular goods or service, okay, for this is prepaid is normally in kind of insurance or something, okay, like this, or you paid rent advance or something, okay, insurance kind of stuff. When you particularly when you have avail insurance for 12 months, but once your January close, so 1 month of insurance you have cover, okay, so that whatever amount you have booked, suppose you have 120 rupees of one insurance, so if you divide by 12, so you will be having 10 rupees per month cost. So then what will you do? You will book your expense for insurance expense account. You will debit by 10 and you will credit your what you call is your prepaid, okay, accumulated. You will credit your prepaid expense account. So likewise your prepaid expense account will be keep on reducing by every month, and at the end of the year it will become 0. So this is how this process works. So I hope it is clear to you about prepaid also. If I talk about non-current asset, there are few things: property, plant and equipment. If you have purchased any property, okay, like intangible asset, okay, to maintain your operation, okay, business operation, we need to have an office, we need to have a vehicle, we need to have fixture, furniture, land, building, machinery. So for all these things, these are more than that product will remain, or that asset will remain more than 1 year. So that is why that kind of stuff will be considered under property, plant and equipment, and you have to charge depreciation every monthly or quarterly or yearly as per the government law or as per your requirement of company, okay. If we talk about intangible asset are those assets which are non-physical, like goodwill, and long-term economic also have long-term economic benefit, okay. So that those kind of asset will be your intangible assets, such as patent, trademark, copyright and goodwill, okay. So there are few more other assets like deferred tax. We have some kind of we paid tax some extra, so that we will can adjust from our other tax liability later on. So those kind of stuff will be your deferred tax asset, okay. If it is more than 1 year period, it will remain long-term receivable, okay. If you have sold some product, they will pay you after 12 months. So those kind of stuff will be your long-term asset, okay. Or investment in subsidiary, okay. If you are investing in particular subsidiary to get good return on investment, so those kind of stuff will be your long-term asset, okay. Now we'll jump to another topic. If we talk about liability, accounts payable, whenever we have consumed service or goods, so we will have to book the liability, that is called accounts payable, okay. Supplier or vendor, goods or service on credit, okay. On credit, if we have purchased and we own the asset, suppose we have purchased bag, we have purchased laptop on credit, so we have this now, okay, we own this now. So that is why your asset has increased. If you have owned this either current asset or fixed asset, so you have to also have to increase another side. So liability side will also increase by same amount, okay. So that is why that is called liability. Short-term borrowing, if you have taken any bank loan or something, you will be able to pay within a year, so those kind of bank loan will be considered as a short-term borrowing, okay. Like bank overdraft, like short-term notes payable, etc., okay. Accrued expense are the expense which has incurred but not yet paid to the company. For example, you have your employee, from employee you receive service, okay. So now since he worked in Jan, and you will pay him in Feb. So when you are closing your Jan month, so that time you have to book those expenses into your income statement, okay. So that your income statement profit will not have misleading information. So because you have already consumed, so you have to book. Since you have not billed him, okay, or he has not billed to you, or some other stuff like you have consumed service or benefit from particular vendor also, if it is not implied, and he has not given you the invoices, so what will happen at the end? You have to have a vendor list. In that you have to check how many bills has not come. For those bills, if you have received already services, so for that you have to increase your expense, you have to book those expenses and credit your liability or accrued expense section. So likewise, what will happen, your expense will increase, your net profit will come the genuine figure. Since we have consumed the service, we have to book, okay, in that particular period. So that is the main purpose of accrued expense. Now if you talk about deferred revenue, that is simple thing. So in case you receive a particular payment, okay, from your client, he has given you order to complete that particular task and you have not yet completed. So what will happen, you are owning money of somebody else, okay. So that will obviously, when you own somebody else money, your cash will increase. So you have to increase another side of your balance sheet liability section, okay. So that is nothing but your deferred revenue. So if it is short time, you can keep it in contra current asset side as an contra asset side, or you can keep it into your liability section. As company wants, they can do it. They are free to do it as per the requirement or legal and government compliances, either US GAAP or IFRS, whatever the rule you are following, accordingly you have to pass the entry, okay. But the thing is, you have to if you are owning somebody else money, you have to increase your liability side also, okay, if you are increasing your current asset. So that if you read this, deferred revenue, payment received in advance, okay, you have received in advance from customer for delivering goods or service, but that have not yet been completed, or you have not delivered the service. So that represent what? Obligation. It is your obligation you have to fulfill. So that is why you have to increase your liability also, okay. If you talk about current portion of long-term debt, so current portion of long-term debt simply is, if you have taken loan for 1000k for 5 years, 1000k, 20,000k you have to pay this year, okay, current year. So that amount will be your current liability, that will not be the part of your long-term liability. You have to pass one entry and you have to move from long-term to current liability, okay. So this is the meaning. Deferred tax liability, that is simply if you have not paid the tax, okay, so that will be your liability you have to pay, okay. In deferred tax asset, in the case when you have paid extra amount, what you, as per your financial statement or income statement, whatever your tax liability was, if you had paid extra, that will be your deferred tax asset. If you have paid less, okay, there is a two statement we prepare, like one income statement we prepare as per our company financial perspective, and another income statement are prepared based on tax audit, okay, for income tax office. Based on income tax office, if your tax is 1000k and if you have paid 80k based on this income statement, so then you have to pay 20k. That time it will become your deferred tax liability. If your tax, as per taxable law, your tax is 100k and you have paid 120k, so it means you have paid 20k extra, which you can adjust from next year tax or next quarter tax. So that time 20,000 will be becoming your deferred tax asset, okay. This is deferred, 20k will become your deferred tax asset. And when you have paid less than the required taxable amount, that time it will become 20k is your tax liability. I hope it is clear to you. There are a few more other liability, like pension liability, you have to pay your employee as a pension, and lease liability, if you have any long-term lease or something, or other contingent liability which you don't know exactly, but since your case or something is happening in the court or something, so you may occur some penalty or something, for that you have to take contingent liability. Now we will discuss about equity. Equity is nothing, just your owner's fund, okay. Owner has given you as a loan, to pay him back you have to keep it in equity section. So there are few things. Share capital, okay. Share capital basically amount which has been contributed by owner, okay. So for example, you have multiple owner, one owner has given 1000k, another owner has given 1000k, so you have to contribute 50%. So that is called, in exchange of money you are giving him ownership, okay. So that is called share capital. If you talk about retained earning, as I told you, whatever the net profit we generate, that we will keep into retained earning, okay. If your business is consistently growing, then you will reinvest that retained earning into your business, or you can pay dividend to your owner, okay. This owner, you pay him, your retained earning will be gone, okay. So either way company can follow, but normally business keep the fund if they are if you can see any balance sheet of any income statement of particular company, if it is growing, so in those cases they have a lot of opportunity to grow. In those cases they don't pay dividend, they try to invest the return earning into the business, and so that they can avail the same growing pattern profit, okay. Dividend payable amount which is owned by company to shareholder as a dividend, declared but not yet paid. When you have declared your dividend, we have not paid, so that will be your dividend payable. Okay, when you will pay it will be gone. Reserve is something like return earning aside of company specific purpose, such as reserve. You can reserve for any purpose. Okay, for contingency planning also you can reserve for future investments I was discussing just now. If your company and business is growing good, you should reserve some funds so that you can invest. Okay, also you can reserve for employee benefit. You have to pay like for example pension kind of stuff, so for that also you reserve all this fund. So I think I have spoken enough about balance sheet. In next session we will discuss other things also. Okay, so we have discussed enough. We will discuss tomorrow other part of income statement kind of stuff, and we will try to do the performance analysis, ratio analysis. Okay, so thanks for watching. See you into the next session. So hello student, welcome back to IBS. Today we are going to discuss about cash flow, and we will also learn the ratio analysis. Based on our balance sheet data, we will try to review our ratio analysis. Okay, so let us jump to the topic and understand it. So we are going to learn about liquidity ratio and profitability ratio. This is the main ratio. We should all know about this. Okay, so first we will go with return on equity. Okay, so how much equity we have? Let us see this. Okay, this is the total equity we have. We want to see how much we generated the return from our equity. So simply we have to take net income and we'll divide by equity value. So net income, you will get it into your income statement. This is my net income. I will divide this by our equity. Total shareholder equity is this. Okay, so now since we are generating somewhere around 11%. Okay, so you can simply drag it. So you will get all the return. Okay, so 2029 we have received 11%. So this is something the owner investment. So if you have invested somewhere around 95,000 CR and you have generated 10% of your return from this investment. Okay, and 2021 you have generated 10%, and then 12%, 9%, and 5%. Okay, so you can also check why in this year it is reduced or something. Okay, we can ask concerned question, we can review. And if you are doing in quarterly or something, so when you find this kind of thing, you can immediately take action and work with your team and whatever team is defaulter or whatever case you found, you need to review income statement. Okay, and find why the profit is less and what exactly is happening, why our sales is down or something. So you need to ask so many questions. Based on this question, you can satisfy the owner why this profit is lost. If you found any issue, you have to immediately take action and resolve all those issues. So now if you talk about return on asset, so now we want to see how much is our total asset. Okay, and then we will reduce. This is our liability section, this is our total asset. Okay, so our total asset is somewhere around 8,000 we have. 8.6 thousand we have in our fixed asset, and 7,600 is somewhere around our current asset. So now we will divide and see how much is our return. Again, you can take net income that period. You can divide this by your total fixed asset value. So our total fixed asset is this. You can simply drag it like this, give the formula. We can clean the data. So now we can see our return from asset point of view is around 6%. Now again it has dropped down. Again you have to make it a red flag and check it. Okay, you can ask a concerned person regarding the question and all. Okay. Now we will check debt equity. Debt equity is something is indicator. So if your debt equity, if it is coming around 1 or if it is coming somewhere around 2, so from 0 to 2 it is okay. If it is going beyond that, then it means your company is in danger of debt. Okay, so while seeing this we can understand. So how much is our total debt, where you will get in income statement total debt. This is asset, total debt will be, so we'll take both this plus 2. Now we have to keep bracket. Okay, so now we got our total debt. Now we need to divide by equity. So where is your equity? Equity is here. This is our total equity. So this is showing a good range. So equity point of view, our we are not in the red flag, we are in the right flag. Based on your criteria, you can select, you can give condition, okay, and give rule. If in case if it is more than one, you can make it red flag or something, okay, so it will look good. That part we are not covering now because we are not working on Excel. We are not learning Excel, we are learning concept, okay. Asset turnover ratio we will calculate. Simply formula is you have to select revenue and divide by average total asset, okay. Average total asset is last year asset and current year asset divide by 2, you will get average. So now we will simply divide by total asset, will not go in that way, but you should know that average total asset will be divided, okay. Total sales will be divided by average total asset, okay. Now we'll go to income statement, we'll select revenue, okay. 2019 total revenue is this, and then we will divide by total asset. Total asset we will get in our balance sheet, right? Around 16,000. Yeah, this is our total. So you need to take these two and take average, okay, like this. Since we don't have 2018 information, so I'm taking this one like this, okay. So our asset turnover ratio is also good. Now the question comes, what asset turnover ratio is? So the asset turnover ratio is usually expressed as a percentage, okay. It shows the amount of sales generated for each dollar of assets the company owns, okay. The higher asset turnover ratio generally indicate that better asset utilization, as it means company is generating more revenue per dollar of asset. Conversely, a lower ratio suggests that company is less efficient and utilizing the asset to generate the sales. So if you have as in 1, if it is coming 1, so what does it mean? You are generating $1 of revenue from utilizing $1 of asset. So what is your net profit? If your net profit ratio is 10, so ultimately you are using 1 rupees and generating 1%, 10% of return. If you can see that it is around 93%, and this is generating 11% of net revenue. So we can see net income. What is our net income percentage? Okay, 7.2. okay. So if you are using your asset, you are generating around 93%. For every single rupees or dollar of asset, you are generating revenue of 93 cents, okay. Or and then if you go to this into, you multiply 0.07%, so you will get only 6 cents you will be generating as a net profit, which is owner will take it to home or invest into the business again. So every single rupees of asset you are generating only 6 cents. So this is the generation of your net income, and this one is your net revenue you are generating based on every single dollar. So this is the meaning. Now we can, so you will get every year how much you are generating revenue based on your assets. So every single dollar of asset investment will be generating revenue around 89 cents, okay, 89 paise, like this. So if it is going down, that will be problematic. So you can have to review where the issue is, or we are not effectively utilizing our asset. That kind of question will come. So now we will be learning about liquidity ratio. So first of all, we will try to learn about the inventory turnover ratio. So inventory turnover ratio, what does it mean and what it actually indicates? So it indicates how many times company's inventory has been sold and replaced during the period. A higher inventory turnover ratio generally suggests that the company is selling its inventory quickly and effectively, okay, which can be positive sign of effective inventory management. Conversely, a lower ratio may indicate slow moving inventory or overstocking, and which could tie up capital and lead to a potential obsolescence or damage or storage cost. Okay, so this is the purpose of inventory turnover ratio, is to identify how many times we are cycling our inventory. If it is coming 5, it means we are investing in inventory 100 rupees and we are selling this within a year 5 times. So 100 become 500, and then if you are generating profit somewhere around 10%, so if you are investing 10 rupees, 100 rupees, and you are generating 10 rupees. Okay, so let's take this example. 100 is your inventory and 10 rupees you are generating every time when you sold. So if you sold this into 5 times within a year, so how much net profit you also generate? Okay, you also generate, you can just directly calculate 5%, 10%, or you can multiply net profit into 5. So when you are investing $100 for in a year and you are generating $50, so that time your that will be considered your net inventory turnover ratio will come as in 5. So if you are doing this, if you are able to sold your inventory within a year, okay, within a month, so that time what will be your inventory turnover ratio? You will be able to sold your inventory completely by 12 times within a year. So you are investing 100 rupees or you are generating net profit by 120. So this is the concept of fast moving and slow moving inventory. So now we will try to calculate the inventory. Okay, so first what we will do, first we will go to our income statement, okay, to find our cost of goods. Okay, we will get cost of goods. Okay, this is our cost of goods. Now we will divide by average inventory. Since we don't have average inventory right now for this year, we'll directly divide the total inventory value. Okay, this is our inventory. Okay, so now we have 4. It says it is very good actually. Okay, so now we are consistently growing down, so that is a red flag. You can create a red flag and ask question. You can reflect to management, keep on growing down. Okay, now we will discuss about current ratio. Okay, so what is the use of current ratio? Current ratio is a financial metric used to assess the company's short-term liability, specifically its ability to meet its short-term obligation. Whatever you have in current liability can be able to meet those obligations or not with its short term of assets. So what we have in short term, that is our current asset. Okay, so that is why the formula is current asset divided by current liability. The more would be your current asset, you are would be the more safer position. But if you are keeping too much in current asset, that is again indication of not effectively utilizing your current asset. Okay, so this thing also we need to make sure. So now we can try to calculate it. Simply we'll go and find our current asset. Okay, this is our total current asset. Okay, we'll divide by total current liability. So we are it looks like we are on the safe and good position, but still we can see we are consistently dropping down. Okay, so this is again concern. We can raise the concern to management, but it is not much serious. If it is nearby 1, that is well enough. Okay, now we will learn about the quick ratio. Before that, let me define you few more points with regard to current ratio. Current ratio basically provide insight into a company's ability to cover its short-term obligation with the short-term asset. So short-term obligation we can fulfill through short-term asset only. This ratio, if it is higher than 1, it indicates company has more current asset than its current liability. Okay, suggesting a stronger liquidity position. However, I'm trying to say if it is higher side, more than 1, it is suggesting a stronger liquidity position. So company is not suffering from liquidity issue. Okay, what amount of current ratio is considered a very good? Unhealthy, which is 2. If it is nearby 2, it is good. So this one is good. These are not that much good, but still it is not bad. Unless you go by 1, then if it is your asset and liability is equal or it is lower than that, then only you have issue. Okay, now we will discuss about quick ratio. Quick ratio is almost same as your current ratio, just that they remove the inventory. So we will discuss why they will remove the inventory. Okay, so let us calculate that current asset. We will remove inventory part. Okay, current asset. We will minus our inventory part. We will give bracket. And now we can divide by current liability. This is our current liability. Okay, so this is conservative. That is why they are removing inventory to check more accurate liquidity ratio. So why they remove inventory? Simple logic is inventory will take time. Okay, like in here you can say we have inventory turnover ratio. So if it is 4 time or 3 time, so what does it mean? In 365 divide by this, so you are taking average 111 days to convert your inventory into sales. And if your AR ratio, there is also AR average ratio we have consider. Okay, there is, yeah, days day AR ratio. Our AR ratio is also 53 to 50, somewhere around. So take this also consideration 50. So you are taking total inventory plus AR somewhere around 160 days. So first you invest or burn your cash to buy this inventory, and then you will have to keep this inventory for almost 3.5 months, and then you sold this to your client or customer, and then they will pay you after 50 days. So total you will have to hold your cash for 160 days. Okay, so this question come, so you have to carry on a lot of you have to invest a lot of amount in working capital to maintain a 160-day cash and inventory in hand. Okay, another point is, can you pay to your liquidity, like a current liability, can you pay through this inventory? We cannot, right? Through AR can we pay account receivable, can we pay our liquidity? No. But in bank you can give this AR and take a fund or something, that is separate thing. But in general these are the current asset which are not highly convertible. Okay, like, as we have other thing like as I was discussing about cash and cash equivalent. So what are the item is available into cash and cash equivalent? They can easily or immediately within 3 months they can convert. So but other than this, these are the items which are not highly liquid. So that is why in conservative approach they wanted to know how much exactly cash and cash equivalent kind of stuff we have in hand, so that we can immediately pay and manage our liquidity. So it is going down. This is again not very bad, but this one is the little bit of bad condition, so that we can raise concern. Okay, so I think I have explained to you about the quick ratio and current ratio. We have one more ratio in which what we do, we normally remove our what you call is account receivable. Okay, so that is called cash ratio. Okay, that is also, let us calculate. In cash ratio, what we will do, we will remove our all the items, only they will consider so and short-term loan, I don't know what exactly we have given this loan, will when we can get return or something, they are getting return. Okay, and other current assets, so we don't know exactly. So what I will do, I will not consider this, so that will be very negative impact. So I will consider entire current asset, and then I will minus only trade receivable, because this is not this is something which cannot immediately convert, and inventory cannot be converted. So if these two we will minus, and then we divide by our current liability, so that will give little bit sensible amount of current ratio. Okay, cash ratio. So now it is coming even more conservative. It is showing it has around 74%, even we have 53%. Whatever liquidity current liability we have, we can only pay 50% of our total liquidity. But again you have a few things in current liability also, which are may not be immediately to be paid, like maybe in other liability we have booked some kind of liability which may not be required to be paid immediately or something. Okay, so that is why but the logic here is cash ratio will give you more conservative approach, will give you more exact how much cash in hand you have, which you can use to meet your short-term obligation, daily working capital kind of stuff. Okay, so these are the red flag. Okay, so you can keep this red flag and you can put your comment, you deep down into these things and understand, and then you can report to management with your comment. So I think I have explain you important formula with regard to balance sheet. But again, if you go to company and see how they actually do, okay, so this is the Vodafone. If you go item, okay, so company may use a lot of KPIs. It totally depend on company to company, but I would recommend not to use too much KPI that will make confuse or something. But yeah, we should aware of this. Earning per share is simply whatever your total net income is, and then divide by total equity. Okay, total number of equity. So you will get your earning per share. Okay, diluted will be considered based on preferred share and or convertible share that actually are those share which can convert in future. You have given option, they can convert into basic share. In that they will also have right in ownership or something. So that is why. So okay, let's not discuss more about this thing. Then we have cash earning per share ratio, and then book value, dividend per share, how much dividend they have paid. Last time they have paid 10 rupees per dividend. Okay, revenue to operation ratio, PB, DIT, they are trying to say earning before depreciation, interest and tax. So that the income, if they divide by shares, so what is their total earning. So this is their total earning, but this is their net earning. So the difference is because of depreciation and interest or something. So PBIT is again they are reducing depreciation, so that is why they have little bit lesser. If they further pay interest, so then they have only PBT, so it will reduce further. Okay, so your and then you when you are calculating based on net income, then you will get most accurate your earning per share. You will have the same basic EPS and your net profit EPS. It will be almost same. There is some differences coming, don't know exactly why, but it should come same. Okay, then profitability ratio we have already discussed in income statement. Okay, gross profit margin kind of stuff. Net profit margin is 7.52. okay, so this is simply the total net profit will be divided by revenue. So revenue is the base, and rest all the line item will be divided, even cost of goods, operating expense, everything will be divided by net revenue. So whatever the percentage is coming, that kind of percentage will be coming here, that is being called as a profitability ratio. And return on this one we have already calculated, return on equity, return on asset, return on debt equity ratio. Okay, these are the things. Current ratio, quick ratio, inventory turnover ratio we have learned already. So dividend payout ratio, how much amount we have paid to every shareholder. So these are the thing is not much important for a company. Okay, but as an investor point of view, you need to know how much they are actually paying. Okay, so since we have discussed enough thing, we'll jump to our cash flow and try to understand what cash flow is and their definition, etc. Okay, so now we are going to discuss about cash flow statement, what exactly the cash flow is and their requirement and their uses. So first of all, I would like to discuss about cash flow statement. So cash flow statement refers to the movement of basically cash inflow and cash outflow of a business over the specific period of time, maybe quarter, maybe month, or maybe year. So we can prepare accordingly. It is a crucial measurement of a company financial health, indicating its ability to generate cash internally and meet its short-term and long-term financial obligations. So company have a lot of short-term and long-term obligations that we have to meet. Okay, if we talk about positive cash flow is indication of generating more cash. Okay, then their cash inflow is, suppose cash inflow is 500 and cash outflow is 600. So you are generating negative cash flow, so that is indication of unhealthy cash flow statement. If you are generating positive, that will be considered as a healthy cash flow. Okay, so if you are generating negative, it indicates a company need external financing. You will be needing external financing if you are generating in negative. So that is why that cash flow help to analyze all the potential investors and owner, shareholder. This kind of people will see and analyze what is the status of that company. Okay, if I talk about uses and requirement of cash flow, so First, I will discuss about operating cash flow. So first you have net income, then we have operating cash flow. We do the adjustment, etc. Okay. So cash flow from operating activity is essential for funding day to day. Okay. Day to day funding you will do by this. Okay. And then maintaining your operating activity, including your paying to supplier, okay, supplier, employee, and other operating expenses. Okay. Positive, if it is positive operating cash flow, okay, what does it indicate? It indicates that company core business is generating enough, okay, enough positive cash flow to sustain the operation. If operating cash flow is negative, it means the normal business is not good. What we are trying to say, in general, in operating cash flow is negative, that business is in danger. So they are not able to meet the working capital requirement. You need to have extra loan or something to meet your working capital. That means selling and the cost of goods, and then you are generating your gross profit or something to meet your daily obligation or operational expenses. If you're not able to meet these only, so it means this business is useless. This is the point actually. I think you got it. So as you can see this, these are operating activity. In operating activity, what are the item is? After net income, there is only depreciation, okay, depreciation and other deferred financing and other. These are the part of non-cash related. So this is not talking about, or this is not talking about operating activity. Other than that, all your other things are your current asset, and below you will get current liability. If we go down, so other than that, what we have working capital, right? For to meet our normal operation, all our current asset, all our current liability. So whatever current asset will increase, okay, so that will come here. So how much amount of your current asset has increased, that will be reduced, okay. And when your current asset is decreasing, that will be added back. So what does it mean? Current asset is decreasing, simply meaning is that you have not invested your cash to purchase your current asset, okay. So and you are selling your inventory, by using your inventory you have sold, so your current asset is going down, but you have not used your cash. You are getting my point, what I'm trying to say? You have a inventory of 100 rupees, and you have cash, okay, of 100 rupees. So cash flow will have a focus on this. He will closely looking. You are selling and generating revenue, and you sold 20 rupees of inventory. Now you have inventory 80 rupees. So between two period, your inventory has gone down and your revenue has increased, maybe 50, and then you have generated net income, something, whatever it is. So the point here is your cash has not changed, okay. So your inventory has dropped down by 20%. So how much is the difference? 20 is the difference. So that is why it will be added back here, okay. So that your net income, in net income you will add this 20, so you will get actual cash flow, because this time you have not used the cash, okay, in buying current asset. So you have not used, that is why you will have to add back here. So in case you have used, then you have to reduce. We can take this in balance sheet and see 2024 and 25 to balance sheet. Yeah, we can see this from 2023 to 2024, okay, we have reduced. So it means we have not invested cash and we have reduced by somewhere around 580. What happened to 2050 to 2024? We have increased. So how we have increased 35 to 47? We have invested cash and we have purchased the inventory. I think you are getting my point. So when you are burning your cash, then it will reduce your net income. When you are not burning, your current asset is reducing, then you have to add back here. I hope it is clear to you. And similarly, just opposite case would be with regard to current liability. When your accounts payable or current liability will increase from one period 1 to period 2, okay. If it is increasing, then you have to add back to your net income. Why is this? You have to understand the logic behind it. You are generating net income, revenue, cost of goods, okay, and then you got your net income. So Accounts payable will be in your balance sheet, okay, in current liability section. Okay, there is your current asset, there it is current liability, in that you have accounts payable. So whenever you are purchasing, okay, you have purchased, you have increased your inventory and you have increased your accounts payable. Did you paid any cash if it is on credit? Basically accounts payable only if it will come when you are purchasing on credit, otherwise it will not come here. It will directly, your inventory and cash transaction will be like this. But if you are purchasing on credit, then it will be routed through accounts payable. So account payable has increased but without touching your cash, but your current asset has also increased. So that is why you have to add back to your net income. So basically this is just a similar concept but what you have used in current asset, just reverse psychology here. Okay, here in current asset when you are increasing you have to reduce, when in current liability when you are increasing you have to add back. In case of current asset you are decreasing, okay, you have to add back, like here we did add back. And in current liability when you are decreasing you have to decrease here. Okay, simple concept, just reverse psychology you will follow. Okay, so normally to make it more simple, current liability are normally keep on increasing, so you have to add in positive. So if it is decreasing then only you have to reduce, but normally it is increasing, so keep in mind you have to add current liability and you have to reduce. Normally it current asset normally increases, so normally here it will come into reduction part, but some cases it is positive side. So this is the proper explanation of working capital. Okay, so now if you talk about another point which is nothing, just investing activity. Whenever you are investing in property, plant and equipment for long term, so that will come into your investing activity. So what is there it will go positive and what are the thing will go into your negative. You keep in your mind as in cash, when your cash is going out, okay, it will be in minus. Okay, so whenever you are investing, you have buy any building, so what happened, your cash is going, right? So you have to put that value. So how it will be between two period 1 to period 2, whatever, quarter, monthly, yearly, weekly, per day, whatever it is. So between two period if you have purchased, your investment account has increased, so like a PP asset account has increased, so you will have to reduce here. And if you have sold, so that amount will come here, okay, as in positive. Okay, if you return, if you receive particular return or something, that will also come here. So this is the simple, you think based on cash. If cash is going out you have to reduce, if cash is generating you have to add back. Okay, now if we talk about financing activity, so in financing activity also when cash is coming, okay, when cash is increasing, okay, so you will also increase here, okay, because cash is coming, and cash is going out you have to minus here. So you can see change in revolving credit, bank debt and subordinate bad debt. So what we are doing, we are paying what we are paying. Then what happen is our bad debt account is going down. So the difference of debt account between two period, that amount we are reducing here. Okay, so why we are reducing, because we are paying cash, that is why it is coming here. So I think I have explained it to you in very precisely and very comprehensively. So this is almost, we are done with our cash flow statement. Okay, and net change we can also discuss. So whatever we have net income, then we have operating cash. Okay, net income, whatever X amount, operating X amount added or reduced, whatever you got, then you have adjusted your investing activity, financing activity, and then you get your net change in cash flow. Okay, so this is the amount it is coming. So the changes in your net cash flow will be here 473. This is the total changes, whatever we have net income, operating adjustment, then we have adjusted our investment, financing activity. So net changes has come, and then whatever we have carrying the cash. So the beginning we are having 100. Okay, so that 100 will be added here. Similarly, the net changes is again coming 857. This, if this is positive, this is indication of a company has healthy cash flow. Also normally you will get your financing activity, okay, as in positive, but here is the case, it is negative because we have taken huge debt, so that is why we are paying back, that is why it is coming negative. But normally financing activity, some company owners gives fund, or if you have any long-term borrowing, you have taken loan or something, so those things will come here. So normally it come into positive, and your investing are always remain in negative, because we, whatever cash we have, we need to invest somewhere. Since we have not changed anything, that is why it is not coming anything. And this one should also remain positive. So what I'm trying to say here is it should remain positive. That is the indication of good company. If it is negative, it is also symbol of good, because whatever cash you have invested, okay. And this one should also be positive. That is the it should, if it is positive, it means people are interested, they are investing into your company. If it is negative, it means you are taken a lot of loan, or you are paying your debt. So I think I have explained you detailed about the cash flow, how to prepare, and what are the uses, etc. Okay. So thanks for watching. We see you into the next session, and I'm again requesting you to do follow me on YouTube, LinkedIn, so that I can share you the valuable contents which you can watch. And if you have any question and any query, you can directly check out to me. Hello students, welcome back to IBS. Today we are going to discuss about financial statement review part 2, in which we will be discussing about our income statement and cash flow. Okay, then we will jump to, we'll take a particular scenario from online. We'll take data of any of the company. We'll try to see, analyze their historical data, and we'll see how is their revenue pattern, how is their expense, how is their income statement, how are their balance sheet, etc. Okay, so we will try to review on online also. If you are going to invest in particular company, what are the major things we need to keep on focus. So as you can see, this is our income statement. Okay, in income statement I have taken the same example, okay, and just change a few things to make this income statement, and so that I can explain it to more accurate way. Okay, so this is the data from last 6 years. Okay, so if you see that by seeing into the number, their revenue is consistently growing, right? So if you can see their gross cost of sales is also consistently growing. So this point also it is good, this point also it is good. If you talk about their expense is also keep on increasing. Okay, but this time it has increased little bit high. If you want, if company want, they can also review like this. That is called year on year or quarter on quarter review. That will be considered as a vertical analysis. Okay, so we will learn this. We will consider this one. We are going to, will give bracket, we'll select this, then we'll select last year. Okay, from this year we are comparing, so this will be your base value. Okay, so you will divide on by the base value only. Okay, so always keep current year first, then reduce your base value, base year. Okay, then you can divide by your base value also. If you want, you can freeze this also. Okay, you can freeze both of these. There is two method, whichever method company may utilize, either this method, or you can use where we will not freeze this. We want to change every base all the year. For this year, for year 2022, we will make the base as in 2019, and for 2022 we'll make this year as a base. Okay, for this year we will make this one as a base. Okay, likewise. But if a company wants, he can make base for particular company. From this year, they want to see how much year we are growing with, how much percentage with the particular base is this. So either you can make this as a base, or you can change your base every year. Okay, make previous year base. If you are making previous year as a base, so you will be able to check year and year how much we have grown. If you are making particular year as a base, like 2020, you are making yourself as a base, so you can compare from 2020 to till now how much we have grown. Okay, so likewise company may do for revenue or for cost, for any item also. So but this all will be considered under horizontal analysis. Okay, so now since we have applied both the formula, this one we are keeping this one as a base. Okay, for all the years, and for this one we are keep on changing our base. Always last year is our base. Okay, you will see the result. Just drag down. Okay, we'll do some formatting. So if we can see year on year, this is year on year. Okay, this one year as a base, first year of when your company has started or something. So the first year both will remain same. Okay, since the base is same. From second year their base will be changed. Okay, for this the base would be last year. For this year your base is D9. Okay, and see this one, your base is E. Okay, so your base is always changing. Okay, here you will see your base would be F. Okay, now your base is F. So every year you are making your last year as an your base. So that is why this is giving your year to year differences. Okay, this is giving you year to year basis. This one is first year is your base. Okay, so you are keeping fixed. Okay, first year as in your base. So from first year to this year your employee expense has increased by 6.5%, and from first year to this year your expense has increased by 22%, then 29%, and then 37%. You can check it like this also, from this minus this divided by this. Let us keep the bracket. Okay, it is 37%, exactly same it is coming. Okay, so this is for entire year. 1 year is base, and but this is normally not in use. So this one we normally everybody is using. Okay, now if you see repair and maintenance, how much percentage is increasing, you can use this formula and you can check it. Okay, so we can avoid this. Okay, so now we have discussed revenue. Gross profit is also doing good, and expense is also increasing. Okay, and not increasing too much high. So it has increased by almost 15%. But if you, as I'm using formula in different manner, we can use like this. We can current year then minus last year. If you do this way, then you will get positive. Okay, so this is the symbol that it is increasing. Okay, since I have used just a different way, that is why. So now you can see 15% is increasing. So you can, by this one you can highlight okay, this one, this is some kind of danger. Why? You can ask question why this expense has increased. You can deep down into this expense and try to find what are the why these expenses happen. Why does, if you can also check your revenue, does revenue also growth year to year in same amount. Okay, so when you will do analysis, you can ask question to yourself first and try to find answer from your income statement. If you are able to find it, okay, the other one you can deep down into the that report and try to find your logic to get yourself satisfied. If you are not satisfied, check the concerned person who is taking care of revenue. Okay, and whoever is taking care of this employee expense. As we can clearly see that revenue has increased not even 1%, just 0.4% revenue has increased. Then why they have increased too much of their employee benefit expense? So there must be either they have paid some indemnity or they have paid some pension to few employee has retired this year or something happened. Otherwise this expense would not have increased. Normally it is increasing 5 to 6%, as we can see 6.5%, 5%, 6%. So similar it should increase. Okay, so by finding this kind of thing, you can put your commentary, you can review, and if you are able to review and you found the issue, so you can put the supporting document. If issue is genuine, we can't avoid it, like pension we have paid, so that will be genuine, so we can't do. If you found some issue which we can resolve and we can reduce our cost, that you can give the narration. Okay, so that management will value your work, because you are not doing just analysis, you are also digging down into the system and finding the issue and giving the solution and giving the commentary. So that is what make you stand out. Okay, likewise you need to review each and every item. Like if you see, this one is also increasing and increasing in line with the sales. It is not something it is increasing huge or something. So like this you can create formula for all the line item, and you can simply keep this revenue figure in your mind, how much percentage our revenue is increasing. Like this I have created. So year on year we have increased like this. So you can highlight this line. Okay, this line we have some issue, so we can highlight this. Okay, we have our revenue has gone down this year, also our revenue has gone down. So we need to figure out if this when you are checking this kind of thing, Okay, so if we can see that in this two period, okay, 2022 or 2021 and 22, normally this company has suffered due to corona. So you can accordingly you can see that that company has revenue has dropped down. Okay, so accordingly you have to see their expense should also drop down. But if their expense is not getting down like this one, we can clearly see their expense has increased. Okay, so that is red flag for us. Also, if we can see this, if you go down and see that revenue has dropped down. Okay, even in 2022. So if revenue has dropped down, then this expense should also drop down. Why this is increased, you have to find the answer. Since if you will go with, but in which cases? In the cases when your revenue is also growing around 7.6% or 8% or 7%, at that time you can increase your expense for employee around 6%. But in case your revenue has dropped down, then why this expense is increasing? Expense should go down. So that is why you can ask logical question and find in problem and try to give solution. Okay, likewise you have to review all these item. Okay, then we will get our operating expense. Operating expense is simply your expense which you have generated from your normal business, whatever your major business is. For example, your business is FMCG, so from FMCG whatever revenue you have generated, that will be coming here. For example, if you have received a gain, okay, any gain you receive from other than your FMCG business, like you have invested, you have purchased some fixed asset or something, and or you purchase land and you have sold it, so then you got a particular gain, so those gain will come below. Okay, so this operating income, always keep in mind this operating income is regular business. Okay, whatever business you are doing, so from that business whatever you are generating, that will be coming here. Okay, another point I would like to say that if in case revenue is not growing consistently, you can see this revenue is not growing. Okay, forget about corona, just take it example, revenue is not growing. Okay, what about their net income? Net income has no impact. Net income is in positive. Okay, even though your revenue is dropped down, but your net income is positive. So you have to find reason why it has positive. So you will come to know that there is a tax related, some kind of tax we have paid this year. You can see tax. Okay, last year we haven't paid. This year we have paid tax. If you have not paid that tax, your revenue has even jumped further. Okay, so let me see one second. We have not put it the formula. Okay, minus. Okay, now we will get the correct figure. Okay, also we will get this corrected. So net income is going good. So why this year our profit has dropped down to 12%? That question you can ask, so that you have to find the reason by finding all the percentage of other expenses, so where we have expense more. Okay, and the major point which I wanted to highlight here, I have 2 points which I wanted to highlight. First one, you can see that revenue is not growing consistently, but in 2023 their revenue has grown enough. What company can do, they have some repair and maintenance expenses. Track the investor and the person who is buying share for that particular company. What they will do, they will not do this kind of expense. They will remove their repair and maintenance expense. What is this repair and maintenance? Maybe painting, maybe buying furniture, replacing furniture or kind of stuff, they will not do. Also, if possible, they will reduce their telephone expense or something. Okay, so like this I'm removing this. Okay, so suppose these 2 expense or this kind of 10 different expenses company has removed. This is recurring expense. If you will do or you will not do, it will not impact to your business. Okay, if you will not do your repair and maintenance, do you think that client will not give you the service or to work for us? Okay, they will give. They don't want your furniture and your painting and your car. They want their service to be done accurately and perfectly. Okay, so company will reduce that. Then what will happen? Your net income will jump. Okay, so you can see the percentage of net income has been increased. Okay, so why does company does this kind of stuff? People do this when they are going to dump their share into the market, that time they do this kind of activity, so that the person who is normal non-finance person, they see just net income is showing in growing trend, so they will think that company is going to generate a huge amount of net income, so we will get good dividend kind of stuff. But in case of revenue, how much their revenue is increasing? So year by year their revenue is increasing 7% and even 4.4% or 1.2% in minus, but their net income has increased drastically. So when you are as a finance professional, when you are going to invest, so you have to keep, even non-finance persons should keep in mind, they see their revenue also as well as their net income also. If they are aligned with the same page, then you need to invest. Okay, so this point I wanted to highlight, so I have highlighted. Another point is when you are studying a company income statement or something, that time you also have data of shareholder. Okay, so if the company has their shareholder who are investing in company, and if you see that investor has suddenly stopped investing to a particular company, so you can find the reason why. What actually I'm trying to say, you can see this. Initially promoter was holding around 42%, okay, and FYI was having 26%, and there was no involvement of government, okay, and direct investment was also around 7%, and public was holding around 23%. Okay, so what happened is, if you see their P&L, yeah, from 2012 to 2023, if you see that their revenue has grown, okay, that is good. What about their net profit? Net profit has gone in minus, okay, last so many years. Even this year is a huge loss, right? So the point here is, if they are going down, you can say that if their net profit is going down, their reserve will also go down, okay, and their return earning will go down. So overall their total equity will go. This too is the part of equity. So total equity is going down, okay. So what happened is, you can see the promoter has reduced their investment here, okay, you can see this 36%, okay. And now if you can see in March 2023, what happened? They have March 2022 and March 2023 and March 2021, they have increased this kind of share. Why they have increased? Do you know that? When your share is on 500, okay, when you showing loss, okay, and you are the owner, you know what going on inside, and you saw that due to this a negative image in market or something, people are selling their share, okay, you can see that all the public has sold their share to 13%, okay. So who has purchased this? Even if you see that foreign direct investor, they have also sold this one has kept the share as it is, but other than that, all the investor has sold their share, public has sold, so they have increased the share. Every year they are keep on increasing. So that time when the market is going down, your market share is going down, owner has buying those 500 rupees of product in just 5 rupees, okay, just 1% rate they are buying from market. Now what happened? After 2022, they might see there might be an increase in their share price. If you can see, might be their profit, yeah, you can see their profit has increased, net profit has not increased, but some news or something might has happened at that time. If you see the data, or this is 21 in 21, which is like 2019 to 2021, okay, 3 years. There's share price was somewhere around $8 or something, okay. Earlier they were having $100, so just 10 times less. So that time they have purchased all the share, owner has purchased all the share on these 3 years, okay. Then they might have planned that share will go up or their business will grow or something, so they will they can easily dump their share later. But since they have not grown much, they have grown just a similar range or little bit they have increased, or they might understood that their business will not grow or something, so they have again, you can see they have dumped the share again, okay. They have started dumping the share from last 2003 2004. they are still dumping. Within a quarter, you can see there is a 48% to 36%, so almost 12% of share they have dumped into the market. And who has purchased this? This government has purchased all the share. Whatever the logic is, I'm not giving this as an example, just I'm trying to make you understand there is a lot of game are going on inside the trading. So you have to be careful when you are you have to have an analytical mind. Okay, if revenue is growing, then net profit is growing, then it is good. If revenue is growing and not growing and your net profit is growing, that is indicator. If owner is selling their share, that is also indicator there's something wrong happen. Likewise, I have explained here, the investor has purchased the share at the time when the market is selling their product, so that time they have purchased in the cheapest. In case Vodafone has grown from 2021 or something, then what will happen, they will have huge amount as in return. If the share price go from 10 to 100, then they will get their value of market share into the 10 times. So that is the plan. But what happened, but business doesn't work, so that is why again they have started dumping those shares. So if a promoter has no trust in their business, then it is better recommended not to invest this kind of company. Okay, so I think I have explained enough on this topic. We were discussing about this. Then after all the operating expense, you will get your OPEX, and then you will get operating income. How will you get? From gross profit, you will minus all the apex expense total of apex expense, whatever it is. This is somewhere around 3,000. Okay. So you will minus from this 6,000 to 3,000, you will get your net operating profit. And from net profit, you will reduce your interest expense. Interest expense is also indicator of a company. Like if their interest expenses keep on increasing, it means they are borrowing a lot of fund. You can also see into this. Might see, where is the income statement? Yeah, interest expense you will see. See how it is jumping 2017 to 2020. It is somewhere around 15,000, around 17, 20, 23, 24,000 crore they have taken as an interest expense. If interest expense is this much, so your loan would be 10 times of that. You will see their loan would be just 2,00,000 or something. You can see. We'll go to balance sheet. Borrowing. As you can see, the borrowing started 2017. You will see the increment 55, 57, 125, the huge amount of loan they have taken. Okay, and not only this, other current liability has also increased. If you see the total liability pattern, it has just more than double. And again, it is slightly same. Okay, same. Okay, so overall, if you talk about borrowing part is keep on increasing year by year, 240. I was telling you now, it is that would be 10 times from your interest amount. So they were paying 24,000 crore in the interest, so 2,40,000 crore they have borrowed the loan. So what happened, their capital is almost negative. If you have 1,40,000 crore your reserve in minus, and 48,000 crore you have equity positive, so around 90,000 crore you have negative in equity. And then you have borrowing has drastically increased. For learning purpose, we can easily review this company and understand this. If you can see, Vodafone overall market share is somewhere around 42,000 crore. They have borrowed how much? 2,40,000 crore, 4 times of their total market cap. So whatever, if you have a share of Vodafone for 10 rupees, but you have borrowed 50 rupees from market, or 3 times actually. So your borrowed money is somewhere around 30,000. So when you are investing 10,000, you are getting depth of 30. So you are not investing, you are getting loan of 36 rupees. Just 3 times you have burden of loan, because when company will go to closer, that time first they have to pay borrower. You will not get anything, because the amount you have invested already have to be paid to all the borrowers. So this is current price, book value, stock P ratio is nothing. Return on capital employed is in minus. You can see face value is 10. Okay, so these are the things indicating about the huge fall. You can see, if you talk about pros, there is no pros, all the cons. Okay, company has a low interest coverage ratio, promoter holding has decreased. You can see promoter holder has decreased their share. If owner has no trust in their business, it will grow. So why we will have such kind of interest to invest in company? Company has delivered poor sales growth. Okay, 8.32 over the past 5 years. Okay, so let us jump to the Excel sheet. Okay, so interest expense is also indicator to know about the company. Okay, interest income, when you invest somewhere, you will get a return from that will be coming into your interest income. Then you will get earning before tax. EBT is earning before tax, or EBIT is earning before interest income and tax. Okay, and then you will get income tax. You will pay income tax after EBT. You will have to pay tax. After tax, you will get your net income. So we can see this year-on-year growth. I did the vertical analysis. If you see the gross profit is going good. Somewhere it has dropped down. So we can ask question and try to find the reason here. And then if you see the cost of sales, cost of goods has increased this year to this year and this year, then suddenly it has increased. 7% cost of goods has increased from sale. This is a huge amount. This will impact directly to your profit. If you can see that profit is comparatively profit is low around that is also just 7%. If you add this 7%, okay, how much it's coming? 18. Okay, around this. So just the rest all are it seems all are good. Just they did some adjustment or something in cost of sale. Maybe they have backlog in their inventory or something. They have moved this year in their cost of goods. So that may be the reason. Or else you have to check with the person who is taking care of this. They will give you the answer. Okay, then operating income. After adjusting all their operating expenses like rent, salary, wages, so their net profit is around 20%. Okay, this is good. Now it is again dropped down by 7% because of cost of goods, as we can easily identify. Now if we talk about EBIT margin is somewhere around 24%. Okay, so also you want to know how to calculate this thing, but that we will check later. So EBITDA margin is also showing good percent. Okay, then EBIT after considering the interest expense. Okay, this is before interest expense, this is after interest expense, that is why it is reduced. Okay, then we have tax rate. Our tax rate is based on revenue. It is 3.4%. okay, now it is reduced somewhere. We might have some deferred tax assets from that. They might have adjusted, but you have to ask question again, check this. Okay, so now net income is 19 and 15%. Again we have to check what is the reason. Again net income has increased, which is good. Again it is good. Now it is reduced. You have to check. If you talk about year on year, so simply you can calculate like this bracket. This is your base year. You will minus your last year and then you divide by last year. Okay, likewise you will be able to calculate. Okay, so we can see year on year it has reduced from last year net profit. This year profit has drastically dropped down by 17%. We can check this. Similarly, if we talk about this year to this year, that has net profit has increased compared to previous year, somewhere around 11%. And now we have this again, it has dropped down. So we have to again check what is the reason where we have expense more or something. Okay, like this. There if you can see it is 35% decrease. Likewise you can calculate. And if you talk about calculation, it is very simple. Just need to select gross profit first and divide by revenue. So everything will be divided here by revenue. Okay, again selected cost of goods, gross profit divided by your revenue, you will get your gross profit. Okay, likewise you can calculate cost of sales. You have to select cost of sales. This is our cost of sales, and now this is our revenue. So we are finding 60% is our cost of sales as compared to revenue. If your revenue is 100 rupees, so your cost of sales would be 60 rupees. So this is the meaning. Likewise operating expense. So these two, if you reduce, you will get net profit somewhere around 20. Okay, then this EBIT margin is considering earning before interest and tax. So but they are considering gain and your income, interest income or something. That is why it has increased. Okay, so you don't be confused, because this EBIT margin has inclusive of your interest income and gain. Now when you reduce your interest expense, then your income would be earning before tax, just before tax your income. So you have reduced all your expenses, that is why it has decreased. Okay, now you will calculate this tax rate. So you will select the tax value and then you will divide by your revenue, so you will get your tax rate. So this is how we have calculated. I think I have explained enough in depth about the income statement. Thanks for watching. See you into the next session. Stay tuned. Thank you very much. Hello student, welcome back to IBS. Today we are going to discuss about performance analysis. First we will try to understand our budget versus static budget and flexible budget and their differences, how to do the variance analysis. Then after we will jump and understand about how actually in company people do the month-on-month review or quarterly review kind of stuff, like horizontal analysis, vertical analysis. Okay, and year to date, how we can actually calculate the variance analysis. Okay, so let us jump to the Excel sheet and understand it in detail. So now we will understand about the flexible budget. Okay, so we have already little bit of discussion regarding this. We'll go deep dive into this. So basically you can see that company has targeted to sold somewhere around 24,000 quantity, okay, of this product. At what rate? You can calculate this simply. This is your total revenue target and this is your quantity. So 120 was the selling price. Okay, so there I have updated. So company wanted to sell every product in 120 rupees. Okay, and then what is actual price? How will you get actual price? Total revenue divided by total actual quantity sold. So you will get 125. So what is this meaning? Simply we have sold product on the higher cost compared to what we have decided. So this is a good indication. Another point is actual quantity variance. Now we will see. So sales quantity variance, what we will do, we will take actual quantity. We will first give bracket. This is my actual quantity minus standard quantity. Then I will apply selling price. What is my selling price? This is 120. So your quantity variance is 4,000, right? Unfavorable. We have planned to sell 24,000, but we have only sold 20,000. So our actual sold product are less than what we have predicted. So that is why that is unfavorable. Okay. We are trying to calculate our quantity variance. So we have reduced standard quantity minus actual quantity, and now we need to multiply by selling price. So this we will get as an quantity variance total. Okay, this is same. Okay, so our quantity variance is unfavorable. Okay, now we want to calculate our selling price variance. Basically we normally always calculate quantity variance and price variances. Okay, so now we will calculate our price variance. What is our selling price? Okay, we'll give bracket, then select selling price minus your actual price and then multiply by actual quantity. Okay, already written actual quantity. So this is our actual quantity, multiply by actual quantity. So we got 1 lakh as a negative. So what they are trying to say is our selling price was 120 and we sold it 125 rupees per product, which is very good. So we are getting benefit of 5 rupees per product. Okay, and how many product we have sold? We have sold 20 product. So that is why 5 into 20, 1 lakh we have sold in higher price. So this is our price variance is favorable. Okay, though it is by using while using formula it is coming into negative, but you have to understand the concept. Don't go by seeing the minus or positive. Okay, in variance analysis, whatever coming into favorable in minus or positive is favorable. No, this will not work. You have to think what formula is. Formula is simply selling price is less than our actual price. So obviously we have benefit because we have sold in higher price. So we charge higher price, so obviously number of quantity, how many you have sold, so then you multiply by that higher amount, so you will get the amount. That amount will be always favorable. So if we adjust favorable with unfavorable, we will get total amount. So since this unfavorable is positive, and then we are getting either here also positive, so we will consider this as an overall negative sales quantity variance. I hope it is clear to you. If it is not clear, go back and re-watch this video. Okay, now we will move to other point. Okay, now we have actual result. Okay, and this is our flexible budget variance. Okay, now we have flexible budget. So flexible budget has been created based on your actual quantity. Okay, so here you can see this is a static, and we can also create flexible budget. If you want, you can also create here. How we can create? Like this: sales total budget divided by quantity, then multiply by actual quantity, you will get actual sales. So actual sales we have 24, but we sold it in higher side, so that the positive you are getting here. So this is the same thing. Okay, this is flexible budget. So likewise we can also calculate this, but no point of calculating, because unnecessary we will waste a lot of time. Okay, so since it is already been created, you can see flexible budget is coming 100 positive. Okay, and flexible budget it is 2.4 million as I have calculated just now here. Okay, similarly, likewise we don't need to calculating again and again. Okay, it's just a waste of time. So now we want to know direct material variance. Okay, so I think you have understood this. This is your actual result. This is a flexible budget based on your actual quantity. We have to change our all the expenses and all the calculation we will have to do as per the quantity we sold. And then this is your static budget, and this is your difference between actual and static. Okay, and this is overall difference, like when you consider flexible budget difference and static budget difference, so the average difference you will get here. Okay, so this is the main case, like how we are getting 380 after considering our price variance and quantity variance, then we are getting our actual variance, so that amount is coming here. Okay, so now we will try to calculate direct material variance. So simply for direct material variance, what is the formula? Formula says direct price variance is equal to actual price per unit. So for per unit, what is our actual price? Okay, and price of direct material, because this is direct material variance. Don't go by price of sales. Okay, this is direct material. So these are the small point when you are applying formula or something, you have to keep in mind, because this is direct material variance. Okay, so actual price per unit of direct material minus standard price unit of direct material, and then you will multiply by actual quantity purchase. Okay, so how we can calculate? Actual quantity we have already, and standard quantity we already have. So standard direct material we can calculate it. Simply we have our direct material total. Okay, this is our direct material. So direct material cost is 1400 on 440123. Will divide by what thing? Will divide by standard quantity is 24000. So you will get your standard direct material price. So standard price you got. Now we want to calculate actual direct material price. So what is our actual direct material is 1243200. Okay, divide by number of quantities sold. So we have sold only 20,000 quantities. So now we will be getting actual direct material. By seeing it to this, you will be able to identify so whether this is favorable or unfavorable. Actual standard direct material price rate was 60, but we have utilized little bit higher side, so obviously this is negative. Now we want to calculate direct material price variance. There I have calculated. Simply your formula is actual price is 62. You will minus your standard price 60, and then you will multiply by actual quantity. Okay, you can see actual quantity. Okay, so actual quantity you will be having how much? 20,000. Okay, so then you will get $43,200 or INR, whatever it is your unfavorable. Okay, based on static budget. You can see in the flexible budget variance it is saying the same thing. Okay, now we want to know a static budget point of view, how much is the volume variance. Okay, so now our material usage quantity variance also being called as a material usage variance. Okay, material usage variance formula is a standard quantity of material. How much is our total standard quantity? Okay, we use in material, and then minus your actual quantity of material, then you will multiply by your standard price per unit of material. Don't forget about material. So what is our standard quantity? Standard quantity is simply we have 24,000 and we'll minus our actual quantity, so we'll get 4,000 is our total material quantity variance. Then we will multiply by our actual standard price. So what is my actual standard price, which is 16? So if you multiply this, you will get 2,40,000. The same thing will come here, 2,40,000. Okay, this is actually a favorable. Why it is favorable? It is favorable because the material we have planned to use, we have not used that much. We have used lesser quantity or lesser material quantity. So we have targeted to use 14,40,000, or we can say 1.4 million around, and but we have used 12.4 lakh, okay, or 1.24 million. Okay, so that is why this is saying this is favorable. Okay, but in reality, if you try to observe this in deeply, you will see that based on quantity, whatever price, based on total quantity, we are supposed to use only 12 lakhs of material, but we have utilized 12.43 lakhs of material. So somewhere we have utilized more, but a static budget is saying we are in favorable. Why? Because they are considering 24,000, okay, what they have targeted. So based on target quantity, if we sold, then only we are supposed to use this much quantity. Since we have only sold 20,000 of materials, obviously material will also be should be used accordingly, right? So that is why flexible budget come into the picture, and they say no, this is not the right amount. We should have utilized only 12,000. Okay, but the flexible budget will come into the picture, and he will say or 1.2 millions of rupees we have material we have to consume. Since we have consumed higher side, so that is why we are unfavorable. So you can see what exactly the real ground situation is unfavorable, but static budget is saying favorable. So this is the concern. That is why flexible budget has been introduced to so fulfill the gap between your static budget and flexible budget. Okay, now we'll jump to the direct labor budget. Okay, so direct manufacturing labor budget. Okay, this is again you can see flexible. Our cost should be 320, but we have invested higher side, so we are unfavorable. Okay, and what flexible budget is saying? Favorable. Again, flexible budget representing wrong picture. We are going to calculate this. First, we need to have direct labor per unit cost. So how we will get? We can simply already written our total cost. Okay, since we are calculating for a standard direct labor cost. Okay, so we'll apply the standard direct labor cost. Okay, this is the standard direct manufacturing cost. Okay, 3,84,000. Same amount we will divide by 24,000 our total quantity. We'll get the standard direct labor hour rate. So this is our actual standard direct labor rate, and how actually we have consumed direct labor, that will be based on the actual amount and divide by actual quantity. You will get actual direct labor rate per hour, whatever the quantity is. Now we will check the variance. So what we will do, actual direct labor, which is somewhere around $19.8 or rupees, and then we'll reduce our standard direct labor price, and then we will multiply by actual quantity as per the formula. So then we will get 76,000, which is unfavorable. Why this is unfavorable? Because as per flexible budget, we are supposed to use or consume only 3,20,000, and but we have utilized 3,96,000, which is higher side. That is why it is unfavorable. Okay, and then if you talk about direct labor quantity point of views, like quantity point of view are normally sales volume. So static budget point of view. Okay, so there what they will do, how much is our standard direct labor hour, okay, which is 24,000, and then what is our actual quantity, and then we will multiply by our standard direct labor hour. As per the rule, you can see standard direct labor hour minus actual direct labor hour, then you have to multiply by a standard direct labor hour. So what is our standard direct labor hour, which is 16. So if you multiply this, or you can also write 16, you will get 64,000. You will have the same in static budget, 64,000. What he is saying? Favorable. Why it is saying favorable? If you see this 384, you will minus this 3,20,000. You will get this value. Okay, so between a static budget and flexible budget, the difference is somewhere around 64,000. Okay, so this is called quantity variance or usage variance or static budget variance. All these budget variances between flexible budget and a static budget, the difference is coming here. Okay, you can see that 24 LPA minus 28.4 LPA, so difference is 48. So all these differences, difference between flexible budget and static budget. So this is the name of this difference is volume variance, or we can say quantity variance, or we can say usage variance. So don't confuse between usage variance, okay, you can note it down, quantity variance and volume variance. They have three different names. So in maybe in examination sometimes they ask different way same question, okay, but meaning is same. Now we will try to understand variable manufacturing overhead variance. No variable manufacturing overhead. First we want to calculate variable manufacturing overhead total cost. Will divide by total quantity. What is our quantity? 20,000. We will divide. So similarly, if you divide here, you will get your actual variable manufacturing overhead cost. Okay, so we can say variable overhead cost for manufacturing. For standard, what we will do? We will take a standard price, okay, and then divide by a standard quantity. So what is our? This is your based on a static budget. This is your budgeted variable manufacturing overhead cost. You will have to divide by actual quantity. So you will get your standard variable manufacturing overhead cost per unit. Okay, so same rate we got, okay, for variable manufacturing and standard manufacturing overhead cost. So now we have the same formula again, actual variable manufacturing overhead minus standard variable manufacturing overhead, then you have to multiply by actual quantity. So similar, this is actual minus standard, then multiply by quantity. Quantity is 20,000. If you solve this, you will get 21,000. This is unfavorable. Why? Because actual manufacturing cost is higher. This is higher. If it is higher, it means it will give you the negative impact. Okay, that is why it is unfavorable. Okay, if we talk about standard, so this is basically your price variance. Flexible budget versus actual budget variance is nothing, just a price variance. Keep in mind again. Okay, whatever you have this different, these are all price variance. Okay, you can see this flexible budget variance. So this flexible budget variance is your price variance. Okay, and this variance is always volume variance. You have written over here. Volume variance is quantity variance. So keep in mind, this is price variance, this is quantity variance, but this is called flexible budget variance and this is called sales volume variance. Okay, also usage variance sometimes, and a difference of these two will be considered as a static budget variance or overall variance. Okay, so price variance we got it. So price variance is your flexible variance. Now we will calculate a static budget variance. So quantity variance. So quantity difference is obviously 4,000 and multiply by your standard price. The standard price is your 12, so you will get 48,000. So that is again your favorable because your quantity is lower. Okay, so since your sold quantity is lower, so that is why your expense would be lower side, so that will be favorable. Where is this? Here you will get. Okay, so a static budget target was 2,88,000, but actually we have consumed 2,40,000 as per flexible budget. So that is why they are saying it is favorable, but the ground reality is we are unfavorable. Okay, so make a note of this kind of thing. So static budget are most of the time they are giving the wrong picture. They are saying we are favorable, but actual result we are not favorable. Okay, now we talk about fixed cost variance. Fixed cost is very simple. Your actual fixed cost. What is your actual fixed cost? This is your actual fixed cost, 5,70,000, and we have, as per flexible, our fixed cost should be 5,52,000 as per the budget. And one more noting point here is static budget and flexible budget have the same fixed cost. Okay, normally don't change. Okay, in between flexible and static, because this is fixed. Whether you reduce or increase your quantity of production, it will remain same unless they cross particular certain limit. So that is why this quantity variance or volume variance between flexible and static is always zero. So there you will get the difference is around 18,000 unfavorable because we have consumed more fixed asset cost. Okay, that is why. Now we have clubbed together all our flexible budget variance and static budget variance. Okay, now see this. So if you see this total, if you consider static budget total differences, so you will get the same amount. This is your static budget variance. Okay, if you consider all the revenue to fixed cost, your total variance is somewhere around. Okay, so this is actually contribution margin is also considering all this variance. Consider your revenue variance, material and labor variance, okay, and variable overhead variance. Consolidating all, you will get total variance is 40,000. That will be considered as a contribution margin variance. Okay, in contribution margin, if you will add fixed cost, you will get your total operating income related variance. Okay, so that is your flexible budget variance. You can see this is the same amount coming here, and if you club your static budget total contribution margin and your fixed asset margin, you will get the same amount over here. If you club both of them, you will get a static budget variance. Okay, you can see this static budget variance this point. Okay, so this is the variance analysis with regard to costing, okay, and between this is the variance analysis with regards to flexible budget versus actual versus static budget. Okay, so I have explained this to you in very detail. Okay, you can go through this. I will also share this PDF. You can go through this. Okay, I have written this in more precise way. You can also take a screenshot and you can review this also if you want. This is same thing, just written in one particular place. Okay, after calculating all this thing, okay, made it in summarized format. Okay, now we will go to our actual and forecasted, okay, and then horizontal versus vertical analysis. So based on sales percentage, whatever we are calculating here, the percentage, this is called horizontal analysis. When you are comparing between actual versus budget and the variance you are getting, that is called vertical analysis. So now we have understand about financial statement as well as costing point of view variance analysis. Now we are going to understand horizontal versus analysis, how actually in company we do. So whatever you have performed here, same thing will be executed here. Okay, so you will see that based on what we have done is here, that is this variance analysis is nothing, just a horizontal analysis. Okay, and vertical analysis is based on sales. We have learned in income statement when we are studying about financial statement review. So based on sales, this is your net sales. Based on sales, what is your revenue? So revenue, and there is other revenue. So 2% is your other revenue and 98% is your main revenue. So based on this figure, you are reviewing every other item. Cost of goods is 70%. That is called horizontal analysis. So income statement we do horizontal analysis, and this variance analysis is your vertical analysis. So we have in depth, we have understood. Also we have understood ratio analysis kind of thing. So we have overall understood everything. Now here we will actually put our actual information, okay, and then we will put our forecasted information, and then we will calculate our variance. Okay, so this we will be learning into the next session. Thank you very much. So again, thanks for watching. See you into the next session.
Hello students, welcome back to IPS. Today we are going to learn about performance analysis part 2. In this section we will be learning about horizontal analysis and vertical analysis, how actually we do in corporate. Okay, this is not we are going to calculate like for particular current asset or fixed asset variance analysis separate. No, this is the place where when you learn your all the ratio analysis and you have idea about the formula and all. Now we are going to apply all our learning to understand about the financial health of the organization. Okay, so there are so many different methodology is available, but few of them we are trying to provide here, and so that you will understand. For example, if you see this one, we are doing vertical analysis. Okay, why it is vertical analysis or common size analysis? Because we are taking net revenue as an base. Okay, based on net revenue we are comparing every single item of income statement. Okay, so similar way if you do for balance sheet, you take current asset and fixed asset total, and then you compare like this way. This is the total of your current asset and fixed asset. This is the total of our total liability. This one, total liability. Okay, so total liability and total asset are always same. This total liability is actually inclusive of your equity. I think you got my point. The right side of balance sheet, whatever we have, current asset, current liability, equity, reserve, everything. Okay, including all, we have this much, and asset side, all the current asset and fixed asset total is this. So this one we will make base as an asset. Asset is our base. Based on asset we are trying to know how much is our trade receivable of it is saying 6.9% of total fixed asset. Okay, so our fixed asset is 36,000 or 37,000 around. So our total trade receivable is somewhere around 7%. Similarly, these all are giving the picture with regard to percentage term. So when we see that our current asset is somewhere around 21% of our total asset. Okay, and our total fixed asset is somewhere around 80% of total fixed asset. So it is looking good, but we will try to keep more asset in our current side, or if it is showing more percentage in is in fixed asset, that may be various reason we need to investigate. Either they have asset which are in the balance sheet for very long time, and they are maybe outdated inventory or outdated asset which are no more useful, or they have goodwill. So there are so many things when you investigate that. If you found something which is not useful or something, we can take provision for 5 year 10 year based on the IFRS or US GAAP, and we can remove those things. That is the thing. So if it is 80%, then you need to investigate what are the thing available. Okay, and this goodwill and consolidation is showing 45%. So why it is showing? Because we have used a leverage buyout model. So in this we have taken a huge loan, and then we have purchased this company. So loan side, you will see that loan will be high. Yeah, bank debt and subordinate debt is also huge amount. Also we have revolving credit amount around 7.5%. So these are the loan side we have. Okay, equity share 40%. So this place we have in 3 different places our total loan has been splitted. Some of the amount has been invested by owner, so that will be coming in equity, and few of the amount are in your current loan, so that is coming in current liability. So likewise we have segregated, but here reverse side, everything is coming into the goodwill. Okay, because we have paid this amount to buy that company. So why we are paying excess amount? Because of that company will generate revenue in future, and we will take benefit of those things. So for that we are paying him extra amount than his asset minus liability. The amount which is coming is the enterprise value, and plus we are paying excess goodwill so that he can sell his business. Okay, so that is why this is coming. So likewise you have to investigate. So our topic was not this, but yeah, I was explaining vertical analysis. So like how we do vertical analysis. Okay, so as you can see, every single item is coming into the vertical analysis. So every formula you might have, how much is the inventory percentage of total asset, those things will come. If you talk about horizontal analysis, there is a difference between 2 period, how much percentage we have grown. Okay, so these are the part of horizontal analysis. We will understand this also, but I will explain you this section, income statement and vertical analysis, and I will, you have all the data, right? So you guys has to be, you guys I'm assuming you guys will prepare this, and you can take a snapshot and try to match it, whether you are able to uh, create similar vertical and horizontal analysis for balance sheet item or not. So I'm making it little bit bigger so that you can, and I will explain it to you later, but now you can stop your video and try to take a screenshot and try to prepare by yourself, because if you will not prepare you will not learn. Okay, this is a horizontal analysis for balance sheet. Okay, now you can try and prepare. Okay, and this one also what we did is we are checking between 2 period, how much is our trade receivable has increased compared to last year. So this is simple formula. 2025 we will minus with 2024. This is historical data should come here, but since we are still in 2024 we don't have, so I have taken a budgeted amount. Okay, so you can assume this is 2023 and this is FY24, and then the difference is coming, and the percentage is how much actually. So this is called year and year percentage change, each line item wise. So this is also company do. Okay, so you can also do all these things, okay, one by one, and see what are the difference, and we are checking between this period to this period, between two actual. If you put a budgeted amount, then you will no, like FY25 and FY25 actual. If you take actual versus budget, then you will get how much we have the difference. For example, we got the difference of 10%, okay, between actual versus budget, okay. And if you are checking between actual versus actual, and then you found some percentage, let's say 8%, okay. So and this what is this they are trying to say, for income statement, if we are comparing, so they are saying we have targeted to increase 10%, because this is actual for 2024 and budgeted for 2024, and the difference is coming somewhere around 10%, okay. So that then it will say, okay, so 10% is the difference based on actual versus budget. So we are not achieve and we are lagging behind somewhere around 10%. The actual versus actual is coming from year to year 8% we have increased our profitability. So I mean to say revenue. So this is indication that we have grown, but we have not grown as much we have anticipated, okay. So we have targeted 10%, but we have achieved 8%. So what is the difference? So different, we can simply check this minus this. So I'm just giving all these things so that you will able to understand what are the things you also can apply in your organization to give insight to management. So based on actual versus you can give insight to management, okay. So based on this actual versus budget, we have not we have targeted 10%, but we have achieved 8%. So how much percentage we are lagging behind? We are inefficient around 25%. So we need to work. So this will raise a lot of question. So either your budget was not good, okay. So what you have budgeted 10%, but actually we have achieved 8%. So they are, it is saying that either this side we have our issue either in marketing or operation or cash shortage, or our market condition has changed, or whatever it is. So either we have issue this side, either or we have issue this side. So this is because of somewhere there is issue, okay. So that you have to rectify and understand where is the issue. Either the budgetary committee is not setting correct target, they are giving higher target which is not achievable or something. So either they have to go down their percentage for next year prediction when they are predicting a new forecast or new budget for FY25. So that time you have to keep this in mind, their variance of budget is coming somewhere around 25%. This is very very huge, okay. So if our actual versus actual was coming somewhere around 9.5%, then we can say that we are lagging behind somewhere around 5%. So our projected budget is nearby the actual result, so we are accurately projecting. So these are the things company do. So I'm giving you all this idea so that you can also apply in your company and investigate and ask a question to yourself. And first you ask question to yourself, then only you can uh, represent your insight to management. So this is the year and year balance sheet variance. Each line item wise, inventory was somewhere around uh, increased by 12%. So if our current asset is increasing, that is inventory. If inventory is increasing, that is also a problem. Either we have damage or obsolete inventory in our inventory system, or we are using some wrong methodology in like LIFO and FIFO, or whatever method we are using. We are increasing inventory. If our revenue has also increased, then our inventory is increasing, that it is acceptable. As you can see there, trade receivable and inventory both are increasing. So trade receivable is also increasing. It will also raise 2 point. Either we are not effectively communicating to our customer to provide money and give us money back as soon as possible. Either AR process is not our process is not effective, or maybe we have increased our revenue by 10-12%, so our trade receivable is also increasing similarly. So if this is the case, so that you have to investigate. You all I'm trying to say here, to you need to develop your skills so that you can link things with each other. Everything is linked. As I'm saying, this is 12% is difference is coming. We can see how much was our you know revenue we have targeted to increase, 24 versus 25. Let me see, we have 24 versus 25. Let's see how much. Yeah, you can see 12%. Our revenue is exactly around the similar. Okay, 12%. Our revenue, if revenue is also increasing, so obviously your other thing will also increase, like your trade receivable as well as your inventory. This thing will also increase. Okay, similar percentage. So that then in these cases, this is not bad. These are good. Okay, so this is how you have to link thing and try to understand if cash and cash equivalent is increasing. So we need to see that either we are effectively utilizing our cash or not. So this question will come if suppose it has increased suddenly to 700 or something. So you can ask question, why we having extra cash in hand, why we are not investing, or we have some issue with regard to our business. We might be not getting new business where to invest, so we are still in the mode of keeping funds. Okay, so that we can decide where to invest or something. So every single item I can keep on telling, it will be 5 hours. I don't want to do all these things. So likewise, you have to understand every asset line item and their meaning, and try to link things for these. As I have explained about all these things, they all have link. Like I have explained for goodwill how it has link. Why? Okay, so these are the things you have to study and link thing with other income statement or cash flow and their impact, so that you can raise good question. So now we will understand about this one. We have done the vertical analysis. I have explained it to you how we do vertical analysis in common size. We will take revenue as in percentage. Based on that, we will calculate everything. For example, this is 13.5%. Let's see it is same or not. Divided by revenue. Okay, 13.5%. Okay, so this is how actual you will you know check what is the percentage of our total other expense. So this is also not created just to see this. We want to see that why cost of goods actually is 48%, and as per budget, how much we have targeted. We have targeted somewhere around 60%. So 60 to 68, it has jumped. So this is again questionable. So actually we have targeted whatever the percentage for our product, but we have targeted to complete our cost of goods within 60% of our revenue. Okay, but we have somewhere around 70%. So this is questionable. Our cost of goods is high, that directly it will impact our net profit. You can see this net profit is very low compared to what we have targeted. Okay, so almost double differences is coming. So these are the thing. For also employee, for finance cost, for depreciation, for everything, you can, for other expenses, we have targeted around 16% would be our 16% would be our other expenses, but actually we have occurred only 30%. So this is good. So these are the thing will give you idea what exactly is having. And another point which I wanted to highlight, so these part I'm coloring it. So these are the revenue part. Revenue part will be compared with actual budget quantity and price. Okay, so this is the actual target, and this part, other than revenue, or your cost of goods and other operating related amount, these all amounts should be changed based on the quantity or activity. Okay, as we have learned in our uh, vertical we have learned here, right? Here we have learned we need to change based on the flexible budget all our operating expense. Otherwise the situation and the result will come will be as you can see, the static budget result what it is saying, it is favorable, it is saying, okay, but as per flexible budget we are actually not favorable. Okay, we are supposed to invest or incurred our expenses somewhere around 1.2 million, but we have incurred 1.43 million, which is around somewhere around 43k excess. So this is both are based on same level of activity. Okay, based on same quantity we have incurred more expense than we are supposed to incur. And if we have sold around 24,000, then we should have incurred this much. But since we have sell less, then our expense should also be, our variable cost should be compared with same amount, same quantity. So this is the point here. So similarly, when you are updating your variance analysis related stuff like quarterly, okay, so that time you need to keep this in mind. Okay, so this point I wanted to clarify. This one will come from through how we are taking this information from formula that I will explain you later. Then we have variance analysis. This is simply we are taking the differences like budget minus actual for again the same point of view, sales, to make this this look correct and look when there is a positive it should come in green, when there is negative it should come in red. So that we can apply through conditional formatting, as you know I have explained it to you. But what if as I have explained in here, there if it is showing minus, okay, or maybe sometime it shows yeah, see this one is perfect example. Direct labor is 320k as per the quantity, but we have incurred how much, higher side, so it is coming in minus. Okay, so if it is minus it is unfavorable, well and good. What about here? Here it is saying 12,000 is the difference. Okay, it is in positive, but still it is saying unfavorable. So for minus it is unfavorable, for positive also it is saying unfavorable. So do you think that this way if we apply here that will work? That will not work, because we can assume based on the situation that whether it is favorable or unfavorable. If it is cost point of view, if cost is higher than budget, that is unfavorable. And revenue point of view, if revenue is higher than budgeted, then it is good. But in expense case it is not good. So this is reverse psychology is being applied in expense side. So similar way I'm trying to say here, similar way when we are calculating this revenue, net net revenue, gross profit, EBIT, okay, earning before tax, net profit, for this we will compare this. Okay, we'll use this formula, will minus from actual to budget. If it is higher it will come in positive. Okay, higher is good. You are getting my point? Revenue if higher it is good, but expense if it is higher it should not be good. Okay, so if we use same formula, if expense would be higher it will come in positive. So that will not give you in conditional formatting, it will not come in negative. Okay, so that is why till these all black I have colored, these are the thing where you will use this way, this formula. Okay, from actual you minus your budget, and for expense side you will minus from budget to actual. See this E11. Okay, budget, in budget we are minusing our actual. So if actual is higher than budget, so it will come negative. Okay, so this is giving correct picture. So this one you have to make sure. And now this one is simply we are trying to calculate a similar logic for all these black color item, okay, or revenue item will divide by budget, and other part we will divide by our actual. Okay, like this way. you should understand this. And I'm also telling you, you should play this again and try to prepare your sheet with me similarly, and what I'm explaining you should understand it. Okay, so expense part we will while comparing we will divide by actual, and for revenue part we will divide by budget. Okay, this one also you can check. Yeah, we are dividing by budget. Okay, so this is how, if you do, you will get good or accurate picture. Okay, so this is the actual frame. Okay, the same frame you will apply in your year to date or data also. Okay, and this for this all this will have the same format. For forecasted budget what we are doing, and for actual what we are doing, that I will explain later. But this variance, for variance analysis, here we are doing, this is your horizontal analysis. Okay, because we are comparing between two figure and then we are dividing with our budgeted value. Okay, so that is why this is a horizontal analysis, and this one, this side, the sales percentage related stuff is your vertical analysis, and this one is horizontal analysis. Okay, so whatever we have learned here, okay, all these things, whatever we have learned here, this all formula is now being applied, consolidated. Okay, so I hope it is clear to you. So now we will understand what is the data. This data we have taken, based on that we have prepared this horizontal, this analysis. Okay, so whatever data we have for all the three statement, we took income statement related stuff here. This is the year 2023 complete year total revenue we are taking, and their total other income, and then net total, gross total, consolidating these two. And then we are splitted this into four part: quarter one, quarter two, quarter three, and quarter four. As you can see this one, I don't have the actual data for that particular company. These are all I don't have that data. Okay, basically, so that is why I have divided it into four part, and then when you club all together it will have the same amount. Okay. So this I have splitted this in quarter 22 8 to 6, 22 8 to 6. So I have splitted all this data in quarterly basis, and the company normally we do monthly basis. Okay, it depends. If company is small, for him it is recommended to use quarterly, but for company if it is big, it is better to go with monthly, so that in the monthly basis you will get the information and you will take the right decision. Okay, so we have the actual data. Now we have split it into quarterly format. Okay, and similarly this one, what we did is, if you can see, this total is same. Okay, so here we have January to March data, and here we have January to June, and here we have January to September. So this is 3-month data, this is 6-month data, and this is 9th month data, and this is entire year. Okay, 12-month data. So how to calculate this? You can simply see that sum, you have to give dollar initial level. Okay, if you put this dollar, me show it to you. So what he will do, he will take data, this one you will update. Either you update this through your income statement, you have to link it, or you have data. It is better or recommended to link this. Okay, always not to do anything hard coded. Okay, as I have explained to you. Okay, this one I just, since this is for education purpose, so that is why I have not linked this, because I also don't have data. And this one I have split it by myself. Okay, that is the reason. So but when you are creating that time, you need to link this with your income statement. Okay, then only you will update, because there may be chances whatever the income statement you have, there may be so many different line item and different name of the GL. So that based on that you have to create this, and accordingly you have to update. Okay, and you have to link this, so similar data will update here. When you are comparing for you are updating for another company, for this, maybe you are this one you are creating for IBS, and now you are creating financial model for another company, so they have different name. So while coming here, before that, when you are updating your income statement, balance sheet and cash flow, that time your all the GL has already been updated, so accordingly you have to update here and then you link it very easily. Okay, so but if you are having this format, everything is ready, so that will not take much time to link. Okay, so now we use this formula. If we use this formula, so what will happen, this one he will take all the column level data. Okay, and when we use the same formula here, he will take column level, he will consider these two. Okay, but he will not change the row. Okay, but if you copy and drag it down, so that time he will collect data from here and he will not freeze for this. He will change his column as soon as we will go down. He will keep on changing the column, he will not change the row. And when you copy this, drag this way, that time he will consider these two. Okay, for this period, and for this period he will consider these two. Okay, like this he will calculate and consider, but he will not change the row. Okay, row level he will not change, but column level also he will keep, no, he will not change, he will keep this plus this, both the information he will keep, but row level it will change. Now we can use this and calculate this. Okay, equal sum, shift bracket, select this, again select this, and for this one you need to press function F4 3 times. Okay, now you can see dollar is in the left side. Okay, or initial point. Now if you drag this that way, it is calculating correctly. Now if you drag this down, it will calculate correctly. Now we can easily copy paste the format. Okay, we'll take one example, this one. Okay, so this one is 3-month data for employee expense. Let's see, employee expense 1152.8, 1152.8. We'll take one more example. For depreciation we'll check 12, 1248, 1248. Net profit, it is also calculating correctly. So this part we have learned how we do this, and this reference we need to give. Okay, because based on this reference we will update here the formula while putting will h lookup. That time I will tell you the importance of that reference, because if you see this one is the date from this period, they will take data from budget, because we will apply this formula in forecasted budget section. You can see this forecasted budget, this one, this tab we are targeting, and in the for the area we have selected, that is info, this area we have selected. Okay, this area. Okay, so in this area he will understand first about the period, and for which period which amount you are asking him to calculate, accordingly he will calculate, and for that he need reference. From his reference number he will pick. Okay, so you need to apply this when I will be explaining it to you. Okay, so now we are done with our actual, and we have explained about the reference and their importance. And after, once you have updated your reference and you don't want anybody to see this, you can make it white. Okay, so now it is not visible, either you print it or you don't print. Okay, but I would recommend you not to give this way, give this way, so that it will not look, but it will still, if you see, when, since you know that there is data, so it will be visible for you, but while printing it will not come. Okay, so now we understood about the actual. Now we will learn about the forecasted. Forecasted, as I told you, for revenue section we will update based on the strategic actual forecasted amount, and this one we will update based on flexible budget actual level of quantity, how much we have actually sold. Based on that you have to update and change your all the variable related costs. If it is depreciation or fixed cost, for those expenses it will not change, it will remain same. Okay, so that is how you, while updating your forecasted related information, you have to be careful. Okay, and yeah, and this part year to date, as I have explained, this is for quarter one, this is including of quarter one and quarter two, this is for all 3 quarter data, this is for all quarter four data, and this reference is also for the same purpose. So this is how you will update your actual and forecasted. Now we will try to calculate, use this formula to learn how actually we can create this variance analysis model. Okay, so first of all I will be updating this one, so you might know that how to apply this filter. Okay, so for example we will create this again. Okay, first we want to create a filter for, because this the filter is useful to create this model. Okay, so first we must be having some data source. Yeah, this is the data source we have. Okay, we'll use this data source. You have to update quarterly or monthly. For company normally it is monthly. Okay, so you have to update month by month data. Okay, because this is quarterly data, that is why I have updated quarter point of view. Okay, so for filter we'll go to data. In data there is data validation, select it. In setting you will see there is drop down menu, there is a list. Okay, now he is asking for source data, where is the list? So we'll give him source list. This is the source list. Yeah, it is coming. So we are taking first quarter data. Now you can say this is not coming correctly, we will change the format. Okay, so this is how we want. Okay. Now it is coming, we can make it bold, or if we want we can make it little bit big so that it will be visible. Okay, now we will use the formula of VLOOKUP. Okay, so now we will use the formula for HLOOKUP. Okay, equal HLOOKUP. And now we have selected, he is asking for lookup value. So basically he is asking for based on which value you want to look for data. So we are asking him for this period, whatever the data you found for as of 31st March, you have to update here. Okay, now he's asking for show me the table tray and where is the data. So we'll go, while applying this HLOOKUP, make sure it is actual, so you go to actual. Okay, in actual also we have two different format, but we want this format. Okay, so we'll select this data. Now we'll freeze this function F4. Now put comma. Let's see what he is asking. He's asking for row index number. Okay, so we'll, this is the revenue. Okay, we want him to pick this data 31st March 2023. So we'll give him this reference. Okay, this, there we have updated our information, as you know. Okay, so this one we will not freeze it, because as soon as we'll go down it should, we want him to change accordingly from O4 to O42. If we go to below for this C5, when we apply the same HLOOKUP formula, he should also go down. But this table we want him to keep the freezed, and date also we want only this data. So that is why these two things we wanted to freeze, so we have freezed it. Now you can copy and you can paste here, and here ESV for formula, you have, you can see there is a dash. So if we apply it, so there is some issue. Let's see, 05, 04, 04, 05, we made a mistake. Making mistake is very good. Function F2, to open the formula. Look, for this one we have not freezed, so we need to freeze it. Also make sure when you are freezing you need to select the complete, okay, then only freeze, otherwise it sometime it create issue. Function F4, it is freeze now. So we wanted to freeze the period as well as table, but we don't want to freeze the reference number. Now you can copy this Alt E S F. Okay, now you can say it is correctly picking the information or not. Net profit is 80. Net profit is 80. Perfect. For June, net profit is 383. Let's see this. If we change this, 383. Okay, so based on this period he has given the argument. As you can see, first he is asking for lookup value. Okay, so lookup value is this. I'm asking him to update data for me for June 30th. So for June 30th he is going to actual, and he is watching all this table in which he found this is the date. From this date he is picking all the information. Okay, and for reference number, in which column we are, based on this reference number, since it is keep on changing. Okay, based on this reference number, when it is going down, so he is picking for same line item. For O6 he is picking this information. For O7 it will pick E7 information. I hope it is clear to you. You also practice simultaneously with me. So same formula will apply for budget also. We'll put H lookup. You also do it with me. Okay, H lookup is asking for lookup value. This is the value we want. You need to freeze this, comma, go to, we are in budget, so go to budget table and select the information. Okay, again function F4 to freeze this. These two we want to freeze. Now give him the reference. Okay, reference we don't want to freeze. Shift bracket and enter. Okay, there is some issue. Alt ESF. Okay, he will paste the information. He is picking the date. So here we will give 04. Okay, now it will pick everything correctly. Sorry, Alt ESF. By mistake I pasted value. Alt ESV, if you do V, the value will be pasted, but we want formula. Okay, changes has again. Okay, now it is correctly picking all the information. For example, we can go and check. We'll change it to September. For September we'll see this. Go to forecasted value for September. Sales value is 5202. 5202. Net profit is 221. Net profit is 221. Gross profit is 2142. Yeah, it is correct. So it is picking the right information. So similar way you have to apply those formula for this. Okay, and for this also. And rest this part I have already explained how to calculate the sales percentage and this percentage. This one, all both are vertical analysis, and this part is horizontal analysis. Basically this one is horizontal analysis formula, and this part we are just taking the difference in amount terms, and here we are taking this thing based on percentage. Okay, so this one I think we are done. Similar way you have to calculate this one also. Same exact same formula, same logic you have to apply and try to calculate this also. Okay, once we are done with this, now I'm explaining this, but I'm expecting for balance sheet you should prepare and then compare with me. Okay, so this one I have taken FY24 data. Okay, this one is similarly percentage of total asset. This is asset side, this is the total asset. So total asset we will freeze through similar function F4. If you want I will do it right away. This one we want to keep on changing. Bracket will go down. Okay, function F4, it is freeze now. Now you can copy a ESF formula. You can see everything is as it is. Now you can copy the formula. Just one place you have to apply, okay? Rest other place you don't need to apply. You can see this 45.7 will be same, 45.7, okay? So this is how you can make it. Another side, you have to update your all the this one is hard coded, but I'm expecting you when you are doing this vertical analysis, that time you must paste all your income statement, balance sheet and cash flow over there, okay, and then in the sheet, and then you do all this calculation, okay? So now first one will calculate simply this, divide by, go down, total liability, reach this function F4. Now copy this, okay, alt es f, formula is being pasted here. We don't want, copy this again, same thing, es, so select all. We'll see this 15.7, second last column, es f 15.7, it is same, so this is working fine. Copy the same thing and paste it, es f, okay, just remove this. Similar way we can. Now for horizontal analysis, as I have explained, with this one, suppose we are comparing between two actual FY23, FY23, let's assume this FY24, okay, between two period you can check year on year changes, or between actual versus budget you can check it, okay. This one is for particular period, okay. This is vertical analysis, in which all the current asset liability for current period and compare with total asset or total liability, okay. And this one is horizontal analysis, so here we will check between two different period, okay. Again, these are the thing I'm keep on telling you, you should link this, sorry, okay. So this all thing, nothing should be hard coded. If you have prepare one income statement or whatever it is, from there you should pick all this information, because this, not only this, also company name etc will come. So whenever you will print, it will look beautiful, because they will say horizontal analysis, then it will give a space like this, and then they will take the name IBS like this, whatever, so it will look good, okay. And a format would be the same. So try to link all these things. This one between two period will change, will check the differences, how much is compared to last year, how much we have increased, okay. Similar way we'll apply the same formula here, and we'll check percentage, okay. Percentage, how will you calculate? Simply you have to take the total of current asset, okay. And similar way for liability, you will take total of current liability including equity, make sure including equity, okay. So like this, first one you have to select this, divide by your total asset, function F4 to freeze this. Now you can copy paste this formula, control C, copy, and then for pasting the formula, alt ESF, like this you can paste, okay. So now I don't want to explain, these all are same, okay. You just need to copy paste formula, it will calculate. Now you have to update similar way how you have updated for this current asset side, and check the differences, okay. Calculate the differences and then calculate the percentage, okay. For reconciliation point of view, you will be keep on checking this difference is same, you can see this, okay. This difference is same, equal this minus this, okay. This difference is always same. So if the vertical analysis variance between two period of liability, between two period of liability, total difference should match with the difference between the two period of asset side, okay. This difference should match. Or not only this, also if you check this variance total, that also match. Okay, 1.73, 1.73. So this is how you have confidence that what you have created is correct. And this one has why we have created this horizontal analysis, how we have calculated our income statement part here. Okay, income statement part, year to date and period to period. Okay, this one also you are comparing between actual to budget, but also you can compare between actual for last year. Okay, last year actual versus current year actual. Okay, these two also you can compare and find the differences. Okay, that also we can do it, but the process and methodology is same. And now you can diversify your thought and create different model, that is separate. But these are the major thing: actual versus budget, actual versus actual. You can also compare for income statement, for balance sheet also, or also for cash flow. That will give you robust information and give you idea of what exactly the financial health of the organization. Okay, I think I've explained enough. These are the things you need to develop your mindset and to understand that if something is increasing from this period to this period, trade payable has also increased. Okay, 9%, but this not 9%, 1%. Okay, 1% of total equity plus liability from this. Okay, and if we see here, trade payable 7%. Okay, no, this is something else. This is a vertical analysis perspective, but if you want, you can check this also. You can create one more line and you can check this. Okay, this divide by last year. Okay, so that will give you the information last year point of view, how much is our trade payable has increased till now. Okay, so this one you can mention, this is the percentage of total, and this one, okay, here we have the same information. Trade payable 12%, 11.97%, year to year change in balance sheet. That part I was discussing. This one is same, 11.97%. So year to year I have already explained it to you. You can separately you can calculate, or if you want, you can also add here one line and you can take it. Okay, it's up to you. So I think I have explained all possible way to calculate uh, different methodology to create vertical analysis, horizontal analysis. Okay, all type of asset comparison, liability comparison, and in ratio analysis we check between these two period, current liability versus non-current liability, how much is the percentage, as we are learning here. Okay, yeah, compared to asset, how much is the liability, that you can check. That is called the current ratio. This is your current asset divided by current liability. So these are the thing I have explained already. So these are the thing we do all this: current asset, quick asset, working capital differences. So these are all the thing we do to understand about the health and the sustainability of company, profitability of company, liquidity related issue or risk. Okay, so these are all the thing we do to help management write a strategic direction. Okay, so I think I have explained in depth, in detail. Anything is missing, I don't know, but as per me everything is explained, what is being used in the corporate and how and what they do. You might will have other possible thing. For example, for revenue there may be, this one I have taken for entire company total quarter revenue, but for revenue itself you can create a separate sheet, and you can either use vertical analysis, horizontal analysis, and you can check between two different period of particular region based on the structure of your company. Your company is in 25 different country, and in which for example your company is in the country of India, and how much revenue is being generated over there. And for that particular country between two period, okay, what is the difference between two actual versus budget, how much is the difference, but the methodology and the process would be same what I have explained here. Okay, you have to split this based on your but I'm teaching you based on, as you are a corporate and corporate finance head, or maybe you are sitting in the head office. When you are getting consolidated information, you are comparing for entire company. But similar thing you can split. Somebody who is sitting in India, he will do all this exercise for India point of view. Okay, so revenue would be for India, and the budget would be for India. Okay, and the variance would be between India. So actual for last year, actual for this year, for that particular country or region, and then they will do all these things. I hope it is clear too. It is purely depend on the company structure, how they are following, but the tracker and the format you have to follow, this is the same. I hope it is clear to you. So if somebody, many student comes to me and ask me for tracker and other things, so tracker would be similar, but it change based on the structure of company. Okay, so I think I'm done for this entire session, and I enjoyed a lot while teaching you. It is my passion to learn and teach as much possible, and I hope you enjoyed it. Please give the feedback and give good rating so that I will generate some revenue, and that will be very helpful from your side. Love you guys. Bye bye. Take care.
Hello student, welcome back to IBS. Today we are going to discuss about top level planning. This is very important, and now we are come to that place where we are able to club all our learning with regard to strategy planning, with regard to budgeting and forecasting. Now we have so many information in our learning, so we are now going to put all our learning into this and creating financial model. Okay, so company may create a master budget or financial model for 5 years, and investment banking point of view, that the same thing has been created while using a different point of view, different psychology. Okay, but also if you are a buyer of company, you will create in different point of view, and that same financial model based on same historical data. And the company who has their internal team with regard to FP&A or finance team, so they will create the financial model. They will be taking thing based on the accurate result. Again, there is biasness. If you want to show management a good result of upcoming 5 years, so you may give more a better result and more better net income. So these are the perspective thought process behind creating such kind of financial model. So there is always a chance and a room for error with regard to either company inside, if somebody is creating, or outsider is creating, or investment banker are creating. Again, most reliable resource and most reliable prediction can be done by only the finance team who has internal access of all the data. That team can create more accurate, but again that may go based on their biasness to create better results, so that management will be happy. Okay, so in those cases they may go wrong, but other than that, internal team can create more accurate and more realistic budget. So I would recommend you to please create more accurate and achievable budget, so that after a year when the variance will come, that time you will have a more accurate budget. So the more accurate budget you will be creating, you can reflect the same thing in your resume, saying that I have created budget for $500 million and the result was also almost same, just 2% of difference or something. So that kind of employee company want to hire, so that management will be willing to hire you because they know you are not biased, you are creating more accurate budget. So keep in mind while creating, and also learn this what I'm going to teach you in with regard to top level planning. Okay, so now we have all our information. Okay, So what we did is we took all the historical data. Okay, you can take this data from any place like yahoo.com. You will search on Google and go to economics rank and many other company who provide all this kind of information. For example, we'll try to search data for Reliance and we'll see can be able to find out data. Now you can search like this Reliance financial data. It is better recommended to use a company report itself because they have more accurate information, maybe updated if there is anything changes. So you can also get information from money control. So like this, you will go there, this balance sheet, there is P&L, you click on P&L, you go down there, it is available based on year wise, March 24, March 23, March 22. So this is completely year wise data. In India, our period start from April to March. Okay, so that is why this is the data as of March 24. So based on that, they have their revenue, they have their all the detail, you will get it. Okay, if you want to get data for other things like quarterly basis, half yearly, okay, 9 monthly, balance sheet and cash flow, also you will get the ratio analysis, okay, and capital structure. So all kind of information. Not only this, also you will be able to get information with regard to owner equity, how much which company hold how much into Reliance. Okay, so this kind of information you will get it. Like now we can see earning per share. Okay, this is 62. So since the company, if we talk, we get the data in Excel sheet. So maybe I'm assuming company has somewhere around their share price is 2700 or something. So your earning is just 2.3% yearly basis. So this is their earning potential. Okay, likewise you can read and understand there is all kind of ratio. We have PBDIT. This is nothing but earning, direct interest and tax kind of thing. So this is PBDIT is nothing, just earning before direct income and tax. Okay, like this EBIT, this is written in India, PBIT like this. So net profit margin is 7.86%. okay, so likewise you will get all the detail. We will also try to calculate this kind of information based on our downloaded data. So you can go to Reliance. Likewise they will be giving you highlight with regard to their revenue in terms of crore or something. Okay, financial result. Now you can click any of the expected, like we want this one, not available. Let's see another one. Now you can click on annual report. We have latest information from 22 to 23, no more information available. So now this is 267 pages, so we have to go to this annual report. Gives you the entire information with regard to company, their investment, their strategy plan, okay, their strategy priority, where they are going to invest, what are their future plan, etc. okay, so they will give you all like this. You can see this is the information. You can read it out when you have time. So when you are going to invest in particular company, you have to go through with all these things. As much information you feel it is giving you more accurate information, you can, whatever information you want to study, you can study from here, and that will be more accurate because this is their own build reported. Okay, so now we don't want to waste our time while searching where their balance sheet is. Okay, so maybe it will be there or somewhere. Okay, so whatever there you can go there and find your balance sheet and all, and then you can check with your money control this particular website and see whether this has same or something else. Okay, so you can have a confidence with regard to this site and you can directly download from here if you don't want to go in depth with regard to reporting. What about in case we want a report for Microsoft? Okay, that is also available in Microsoft website. Okay, also you will get it from Investopedia, but I want report from Yahoo. Okay, here I got the Yahoo related information. That information you can see and review. Okay, you can see that all the information they have: revenue, cost of revenue, and gross profit, operating expense, their net income. Okay, and their also earning per share. Okay, basic, average share, everything is there. Okay, if you want you can go to analysis, you can go to option, you can go to historical data. So all kind of information you will get it. So also you not only this way, you can go and find the detail. Okay, also it is better you go to their own financial statement which they normally have in their own website. Okay, so income statement like this they have. So they also have option to download their financial statement. Comprehensive income, balance sheet, cash flow. Okay, so let me check comprehensive information if they have any information. Yeah, you can see in this Excel sheet they have released for on quarter 1 Quarter 2 report basically, but let me see. You can see this is Quarter 1 report for 2024. They have all the information like consolidated comprehensive income statement. They have their balance sheet. We can see the cash equivalent, short-term investment. Okay, so all the information is available here. So now you got it, how we can download. Also they have some another form like 10Q form. So this is 10Q form. 10Q form is normally for quarterly, but also you have some another form which is for annually. So in this report you will see all their financial instrument, their all the information with regard to their financial, what are the assumptions they have taken to, and what are the for IFRS or as per US GAAP, whatever the method they have applied to calculate their fixed cost and calculate their foreign exchange related stuff. So whatever we have financial notes, you can study like these notes with regard to financial statement. So you can study this, you will get all their internal point of view, what are the things they are doing. That will give you good insight about and build a trust into your report and understanding about the company. Okay, so when you are going to invest, you should study all this kind of thing. Also that will give you about their business, what kind of business they are doing. That also they mention in their report. Okay, so while studying, this is the annexure. In that they have mentioned what are the things they have. Form 8Q or something they have, which have all the report with regard to their nature of business and segment of business and all. Okay, so now as we have understood from where we can get all this information, now we will jump to our Excel sheet. Okay, so likewise I have downloaded some of the report from particular company. Okay, so we are trying to not reveal which company data I am using. Okay, just to keep it confidentiality point of view. Okay, this report is for Indian company, so that entire amount is in CR. Okay, so this is revenue or total revenue, how they are increasing. As you can see, this is increasing in trend. Okay, and we have the percentage of sales growth. As you can see, this year they have increased from 2019 to 2020 around 7.6%, but in 2021 they have not increased much. Okay, so again 2022 there might be a corona, that may be the reason this 2 year has affected. Okay, and now you can see the sudden jump in their revenue. Okay, so once the corona has ended, their revenue has increased. So now since we know that their historically they are growing by 7 to around 7% or something. Now what basis I have taken this is this example is debatable, so we'll not go into this right now. We'll go to income statement assumption. Based on that we will create our income statement. So now first you need to have the historical data. Okay, so as here we have historical data. For balance sheet we have all the historical data. Okay, this is historical data. We just need to keep the historical data first. For cash flow, remove that. So for balance sheet we will have the historical data. And now since we have all the historical data, we need to create our income statement. So after getting all the income statement, balance sheet and cash flow related data, and then you need to understand about the company. Okay, in their website, whatever information available, what are their future plan. But when you are already working inside the company, for same company if you are creating, you don't need to go through the online and find the data, because you already have all the data in your system, so you can download it and start working. But for taking assumption, before once you have all the data, now you have to take assumption for income statement, for balance sheet also you have to take assumption. For other schedule you have to prepare based on the requirement. For investment and debt funding related you have to prepare debt schedule. So like this you have to prepare a lot of schedule, and also you have to do some ratio analysis. Okay, whatever required based on the MIS or something. Okay, so once you have all the assessment related data, so now what will you do? You will study about the company market condition, as what we have discussed in our, like how we have started our discussion with regard to strategic planning. And then in the strategic planning we have discussed a lot of things. So all those things you have to keep in mind, and then you have to take assumption. And then whatever has been discussed, like you did all the study with regard to strategic. Okay, and then the management intention. Okay, management has told to increase 10%. Okay, based on your strategy planning and the forecasting and regression analysis, and whatever you did, you found somewhere around 13.5% we can grow. Okay, management wants somewhere around 15%, and then the marketing team come into picture. They are saying we can create only, we can have somewhere around 11%, 10 to 11% of growth. So based on these three information, whatever has been finalized, you have to take that assumption, okay, here. So this one we have to calculate strategically. So this is the basic method of finalizing assumption of revenue growth. But as we are into the course, so we don't have inside information, so we are taking just an assumption of 12%, but you have all the information. So for example, this company has, all the company has some structure, okay, they are spread in five different countries. So all company, there would be one finance analyst or something, so he will give you the revenue forecast for that country, okay. So based on that, you will get 5 different revenue forecast, and there they have discussion with their marketing team or local marketing team and all, okay. So you will get all this information, and just you need to put the value over here. Based on that, you will get your result, how much revenue is going to grow. So this is how in company you can do it when you are preparing a consolidated income statement. This is also summary statement. Maybe this particular company has 20 or 2000 different product, okay. So based on this product, you need to create a group. I mean, the person who is creating revenue for this company, okay, company 5, whoever is creating that person need to split this 500 product into, we have 2000 products, so he have to figure out and categorize all this product, okay. So they have categorized into 10 different criteria based on whatever the factor is most suitable, okay. So all 10 have different revenue, okay. So all those 10 revenue, they will be having their historical data. Based on historical data, based on their local marketing and the local industry and the local political, economic, social, and all the factor, internal, external scanning, the management, so all the point of view, they will research and they will finally finalize, okay. So that amount will come into this, okay, and this all together will come over here, okay. So this one I wanted to explain, so I have explained it to you. So there is one more perspective. When we are creating as a course, we cannot do this because we don't have the inside information. If I talk about investment banking perspective are different, because buyer perspective, if you are going to sell and the person investment banker is buyer, so they will try to reduce. And if you are given this task to your seller investment banker, who is seller point of view, means you have hired some investment banker to calculate the value of your company, so that he will try to increase, okay. Or you can say buyer side, sell side, okay. So these are the intention, okay. Based on intention, people create their financial model, and the company point of view, I have explained it to you already, what would be the intention for as a finance analyst. So now since we got this percentage finally defined, based on that we have created our income statement. So what I did, I have just added, like this is our old. To calculate this, I will add into this plus this. Either you can do this, or you can do simply 1.12. You will add it 12% of your expected growth, so the similar amount will come, okay. So likewise you have to calculate for these two also, whatever percentage has been decided, or if you are planning, so you can take it based on management or your senior discussion, how much we want in future, okay. So accordingly you can predict for 3 year, or maybe if you are creating for 5 year, you can take it. Now if you talk about operating revenue, so that will be again discussion will happen and then finally finalize. So now since we don't have much information about inside information, so we are taking average, like this, I can say the average is coming somewhere around 10, so we are taking accordingly. Since I don't exactly know what other operating revenue is, so I'm just say, and also it is a very minor amount, so don't go much in detail into this, but that will remain somewhere like this, okay. So now we got the total revenue. So once we got our total revenue, now we will forecast our cost of goods, okay. So how will you forecast your cost of goods? Again, as I have explained it to you here, so I have created this just to make you more understand, okay. So suppose this company has 3 different company. So there may be 3 different finance analysts, okay, so who are actively working with all this company. Okay, so you are consolidating all the financial statements, so you will be in corporate. Okay, so you are the part of the corporate finance analyst team. Okay, so and then you have regional. So this regional finance analyst team head would be there to represent you all the revenue and expense part. So whatever the structure would be, maybe one person is focusing only on revenue if your company is very big, and one person as a within this regional team there is team of 5 or 10 FP&A team or finance analyst team. So one person will be working on revenue, he will give you the insight about revenue, and the person who is working for operating expense and cost of goods, he will share all the tracker and other stuff to local production team or whoever is required, and the BUs who is involved in this finalizing that particular amount. So he will share all the information to those teams, as I have explained it to you in budget methodology. So these are the team who will be actively working, and then you as a corporate head of FP&A or the analyst, so you will have to consolidate all the information which you will get it from local or regional FP&A team. Inside the regional there is so local FP&A guy who will directly associated with all the concerned BU or BU head, whoever it is. Likewise, they will give you the breakup of all these 3 different company, their estimate. Okay, so every single thing has to be justified and reviewed properly by this regional team, because if this is the case, he is representing for company 1, so he will be responsible for all the revenue, all the expenses. He will study the historical data of this particular company and what is the revenue forecasting they are doing. So he will be keep on discussing with the local BU of that particular company, maybe marketing head or the operational head. So those discussion this guy will conduct with this company, and you will be overviewing all these things. Okay, so likewise similar thing will happen with all these teams. So he is the one who is justifying and reviewing all the revenue and expenses. Okay, so you just have been involved in the meeting, and the management will be involved in the meeting, and if they have any issue or something, they will keep on overseeing and helping them to make it more accurate. Because since if I talk about this guy who is in corporate FP&A head, so how will he know all the historical data of all the company? He has data, but he is one person or a team. He cannot understand, he cannot do all this exercise, right? So that is why they have set up their own team in for locally to make it more effective. Okay, so I think I have discussed this enough. We'll discuss this. Okay. So likewise, whatever has been decided based on that cost of goods, we have planned for 60%. Okay, now maybe company or management wants, after seeing this report, they said that they will discuss, we have planned to reduce the cost because we are targeting to reduce the cost and focusing on the internal control, internal process review, or we are going to apply activity based budgeting, so our cost will go to reduce somewhere around 5%. Okay, so now they want to reduce 5% of 60%, so we'll just apply. So like that it got 57%. If company want further, they have potential to reduce 5 or maybe 2%, so they will do 98%. So now we got 56. So likewise, we are reducing our year by year cost of goods. So then we took assumption this employee related, we have already discussed a lot. We need to use learning curve, we need to find how many employee is required, and based on in this regional like BU head will discuss for employee and benefit related, HR BU will be there whom you need to provide tracker, or maybe you are here and your regional team will provide him tracker and all, in which they will give their update with regard to how much in hiring is required based on this revenue, and based on last revenue what was they have, how much they are planning to increase their revenue. Accordingly, they have to increase their cost and number of heads. So for that, he will be creating the in-depth HR related cost, and they will have to justify their cost. Okay, so number of percentage of salary increment, what are the bonus they are giving, what are the government rule regulations. So every perspective they will be creating, and this guy will be taking care of this thing. So now suppose we got 8% of increment. So earlier these are the 7 or 8 or 9% of total revenue. Similarly, we will consider 8% of total revenue. 8% of total revenue, this into Okay, so we got the same amount. Likewise, we have to predict our employee expense, and this one I am doing simply by taking percentage of revenue. But as an finance analyst, when you are actually going to do in company, you will do based on the input received from regional team. Okay. Now other expenses you will do accordingly whatever we have. Now since we have no more information, so we are taking average based on historical data. Okay, depreciation also we have considered. When you have to take data from your system normally provide information how much would be the forecasted depreciation unless we have not planned to purchase anything new. Okay, so depreciation schedule will give you the data, from there you can get it. Okay, or maybe your regional team will provide you for their country depreciation related information. Okay, so once we have created all the assumption whatever required to create income statement, then we will come to our income statement. So now you can directly link this from your income statement whatever we have calculated here. Okay, and then just drag it. Okay, like this. So you will get all your information, and then similarly you have to just link this information, then you will get your total revenue, how much sales has grown year to year, that percentage you will get it. Simply you can see this, we have just considered the last year sales and divided by our current year sales. So and then you will minus 1, you will get the percentage. Okay, so this is the percentage of revenue growth we have calculated. Cost of goods, again you have to link with your assessment sheet, and then you can calculate your percentage. And now again you will get your gross marketing amount, you can calculate the percentage of gross profit. Okay, this cost of sales, how will you calculate? You will keep your cost of sales and then you will divide by total revenue. So this figure is saying how much is your cost of sales percentage in terms of revenue. So based on revenue our cost is around 60%, so our gross profit would be 40%. So if we are reducing as we have calculated and we reduce by 95%, so now you can see our gross profit has increased similar percentage. Okay, we have further reduced our cost of sales, so our gross profit has increased. Okay, and this commentary I have written, you can read it out if you want. Just this line you can link. For operating expense you will have hundreds of line item, you will be able to link through your assumption sheet. Okay, so you will link here, so you will have you have to link it over here. Okay, from your income statement assumption sheet. Okay, so then after calculating all your employee and other expenses, you will be able to figure out how much is your total operating expenses. Then you have to reduce from your total revenue your operating expenses, then you will get your total operating expenses. Now we can figure out after reducing this how much our operating cost percentage of total revenue. So this is what they have calculated. So this is simply you have to, this amount you have to divide by your total revenue. So this will give you the percentage. So this is 23%. So they are trying to say your operating cost is around 23 to 24% of total revenue. So also by looking into your competitor balance sheet and their income statement, you can see that whether they also have the same percentage or not. Okay, if they have some other percentage, if their gross profit is something else, so accordingly you can give the flag and you can make the comment, our industry has gross profit somewhere around 50%, we are 40%, we are lagging into it. So we need to discuss with our operations team and marketing, whoever is responsible for this cost of sales. So those team will be called for action and they will have to reduce their cost. Okay, so likewise when we see this total operating expenses somewhere around 23%, what is the percentage in market and industry? Accordingly you have to raise concern and ask question. Now we will update our depreciation expenses based on our depreciation schedule, which you can easily download in Excel sheet or whatever way you can download from your system easily. That is normally available because this is that doesn't change unless you add the any asset or something. Okay, so after reducing all your operating and depreciation, you will get your total operating profit. Okay, so also you want to know how much is the percentage of your depreciation from your revenue, so that also similar way you can calculate it. Okay, here we can see that our depreciation is somewhere around 6% of total revenue. So similarly you can calculate your operating profit after reducing your depreciation and operating expenses. You will get your EBIT, it means to say earning before interest. Okay, then if you want you can calculate your bid margin. So simply you have to select this and divide by your total gross revenue, you will get your percentage. So our EBIT margin is, or operating profit margin is 10%. Now you can reduce your interest income or expenses. After reducing your interest income and expenses, you will get your EBT. Now you will have to reduce your income tax based on your historical data, whatever your income tax percentage is normally. So same you can apply. Also, if you want, you can calculate based on the local tax rate. So that regional finance head will give you the expected tax rate, and if there is any changes, they will notify you. So you will get all the schedule, and then you have to club together and put the amount over here. So then we can calculate what is the percentage we have as a tax. So this income tax is somewhere around 1.4% of total sales. From EBT, if you reduce your income tax, you will get your net income. So also you can calculate net income percentage by selecting net income amount, and you will select your gross sales. So our net income is somewhere around 895 CR, which is around 4% of total revenue. So now we have changed our we have not changed anything in percentage. We have just changed our cost of sales somewhere around 3%. So you can see that the percentage of net profit has drastically improved. So if you make simple changes, will impact a lot in your net income, specifically when you are targeting cost of goods, because or if company has some other business, a service sector or something, so there would be higher cost would be their employee. So if you make changes in employee cost, so then employee cost, then it will impact huge in your net income. Now last line we have EBITDA. You can simply calculate like this. You have some operating profit. Yeah, this one we have our operating profit. This one will add our depreciation. So this will be your EBITDA 3537. So what we have selected, operating profit. In operating profit, if you add depreciation, you will get your EBITDA. So as I was discussing investment banker perspective, so they want to reduce this. Okay, if they will reduce, suppose we reduce this just 1000. Okay, 1000 CR. If you reduce your revenue, you see your net income, how much it will be impacted. Now you can see your income is only 143 CR. Okay, and your EBITDA has also reduced. So this is how we will be calculating our EBITDA. Okay, for balance sheet and cash flow and other schedule and debt schedule, we will learn in next session. Okay, thank you very much for watching this video. See you into the next session. Hello student, welcome back to IBS. Today we are going to discuss about top level planning part 2. In part 2, we will deep dive into balance sheet preparation. We have already prepared income statement. Now we will try to understand all different level of assumption we take to create balance sheet. And then the third part, we will learn to create cash flow statement. Okay, so let's jump to the Excel sheet and try to understand it. So this is our balance sheet. So these are the information we took from online data with regard to balance sheet for the same company for which we have taken for income statement. Okay, so now we have added this one line. So this one line, why I have added actually, because I have used a leverage buyout model, just trying to buy a particular company. So when you buy a particular company, so suppose you are buying to that company particularly any date. I'm assuming 1st of June. Okay, so you buying this 1st of the June. So my point here is, as of 2023 ending, maybe I'm taking it as an December as a last date. So 1st of the Jan, you will have whatever closing balance as of 31st would be the same as a 31st of the Jan. Okay, so but in FY24, whatever the ending balance would be, that amount will come here, right? And 31st, 23rd ending balance will come here. But in between we have purchased something and we are paying also, so that is why we have created this line. So let me explain it to you again why we have this line. Basically, if you go to summary, so this is the EBITDA value as per FY23. Okay, so you can see this income statement 2327 for FY23, and this is your EBITDA. Okay, so you based on market rate, I'm not talking about that from where this 12x is coming. So let us assume we have targeted that company, we are buying to that company, so we are giving 12 times from their EBITDA. Okay, since we are buying their entire company, so suppose you are running a particular company, you have a net revenue of somewhere 200,000. So if you have set up that company, it took you 5 years or something, and can you sell this to another company on your net profit, whichever you are generating every year, like 200,000? No, right? You will ask him to give me at least 12 times or 30 times something, like 2000k or 3000k or something, because this is the something which you have created. They have cycle every year, you will be going to generate 2000k, or it will be increasing yearly basis. But now you want to sell this company, so you will be reducing your permanent net profit. Okay, so for that they will be give you one time payment which will be higher side for your net income. So that is why they are giving 12x. Okay, so let's assume they are giving 12x. If we multiply from our EBITDA, so we get 27,000. Then we have the company which we are purchasing, okay, or maybe the person who is buying this company has some cash, right? So this cash is coming from balance sheet. Okay, if you go to balance sheet, this is your current investment plus your total cash and cash equivalent. So total cash available you have, like current cash you have, which is 2625. So that 2625 is your cash. Okay, so that also they will consider to pay me. Okay, so you will pay total equity value is coming somewhere around 30,000. Okay, so now we have want our resources from where we are going to pay him this 30,000 CR. Okay, so now also this is amount is coming, total buyout amount, and then some finance cost. Okay, when you are going to buy particular company, you involve your investor or some kind of people. Okay, so for that you must pay some amount. Okay, so I am assuming you are going to pay somewhere around this amount. Okay, 612. You will see in your in balance sheet, this amount will be coming below. Okay, 612, this is the payment amount. So these are the amount which is new, this is coming into the picture. So that is why this line has been created. Okay, so for also you have taken some liability. Okay, for revolving credit, as we have discussed yesterday. Okay, you also have one long-term bank loan. Okay, so this is also coming here. So these all figure are coming from summary sheet. So maintain this summary sheet, we have created another line, so that in mid of the year if you are purchasing something, so our asset and liability are increasing. To maintain that, I have created this line. Okay, so now we have total value of that company which we need to pay to buy that company. Okay, so when you buy that company cash and their liability and asset, everything is yours. Okay, so now we want to pay. So how we are going to pay? Whatever cash we have in that company, that we are going to pay, but we want to keep some hundreds of crore in hands. Okay, so that we have reduced, so balance we are paying to that company. And then revolving credit, whatever we have taken from bank, whatever the interest rate is here. Okay, it is not interest, this is the percentage of total resources, okay, from which we are buying. And now the bank term loan, we have taken long term loan which is around 6399, and then we have a subordinated loan. This is kind of also short term loan, we have to pay as soon as possible. This is a flexible loan, we have to pay principal amount, we have to pay as much we have, and interest you have to pay whatever the rate has been fixed. Okay, now since we have all we have now all the resources from where we are getting the cash and to pay that client, to the person from whom we are buying the company. Okay, now myself, if I am buying the company, so how much I am going to fund to buy this company? So this person is paying around 40,000, the remaining balance. Okay, so around 47% of total fund. So if you add all together, so we will have same amount which is required to buy that company. Okay, so because this is the requirement and this is extra cost to buy that company. Okay, so now we have all the resources from where we are getting the fund. Okay, once we done this, so that is why this line has been created. You will see all this line will come from there only. Okay, and another part is whatever the reserve or surplus we have, that will become zero, and whatever the investor has invested in your company, that amount will come here. Okay, why? Because whatever reserve you have, no more valuable for that company. Okay, so that is why you have to reduce that, and you have to add your whatever the current company has invested, that the owner has invested, that will be considered as a total equity share. That will again keep on added and increase as your revenue will increase, that will be added. So you can see that this amount last in 2024, whatever revenue will be generated, that amount will be added to this 15,685 would be the total equity value. Likewise, again this two will be added, and then the amount will come here. Okay, so now we'll discuss one by one the line item of balance sheet. So first we have current assets. So this current asset is zero because we have paid this plus this we have total paid it, and all the cash we have paid to that person who from whom we have purchased. So that is why this is 0. Now we have a trade receivable. So for trade receivable we have to take assumption. Okay, so the second line is trade receivable. So trade receivable we receive from balance sheet assumption I10. Okay, so let us jump to balance sheet assumption I10. So from this one is I and 10. Okay, so I10 you can see this. So from there we have updated our balance sheet, but now how we arrive and calculated this, that we need to learn. So first what we will do, we will try to take average AR. Normally when you are calculating trade receivable, so for that you need to calculate your average AR. So basically average AR is how much time your average revenue take to convert from account receivable to cash. So suppose you have bill to your client, okay, and your client will pay you after 53 days, 50 days or 43 days. So this is the average AR. Okay, so that is what we are calculating here. So for average AR, this is the formula I have written. Okay, so now we can see that how we can calculate. So since the average trade receivable is something like ending and closing balance of AR, then divide by 2. So we don't have that information. So let us calculate here. Here we have, okay, average AR. First we'll give bracket. We'll take F20, then we'll take F21, and then we'll divide by 2. So now average AR we have calculated. Okay, so now what we need to do? We need to take this, divide by sales. Okay, sales of 2021. So what is the sales? We have sales of 2021. This is our total revenue. Let's take this. So now we have divided by our sales. Now you have to multiply this entire thing with 365. So 365 is our total days. 365. So now we get 51.64 is our average account receivable. So now here I have not considered maybe in this 2. Okay, so that is why it is coming 50. Okay, so likewise once you have calculated that, you can put the F4 or something to freeze whatever you want to freeze, and you can calculate it. Okay, so just I have calculated one. Similarly you can calculate also. So likewise when we have calculated this, and then finally we have seen that in FY23 we have reduced. Okay, we have reduced drastically our average AR. So the more it will be reduced, that will be great beneficial for company, because you will convert your cash as soon as possible. That would be better for company. So now as per discussion or something, management had decided we will keep this average AR. Okay, we will specifically target to reduce our customer, whatever the way they will try. They will keep on calling the customer for payment, or email asking for payment, okay, early payment, or they may give discount or something for early payment. So there are so many methods, so company may apply, and they are trying to reduce this. Okay, so based on that, once you got your average AR, so how will you calculate your trade receivable? So now we will calculate our trade receivable, okay, based on average AR which we have calculated. I have updated revenue figure over here, okay, so that it will be easy for us to calculate. Okay, so simply we'll divide average trade receivable, will divide by our sales amount, will divide by 365 and multiply this with our sales figure. Okay, so likewise you can calculate it. So we can drag it. Okay, so before that, check this amount 2851. We'll see whether this is coming same or not. 2851, so almost same it is coming. Okay, this is how we can calculate our trade receivable, okay, forecast based on our average AR, and average AR we will calculate based on our historical data. And again, if management want intentionally to reduce our average AR, so they can also reduce it based on their target. Okay, so once we done it, we will now move to balance sheet again. So based on this information we will update. Now we have inventory. So now we are going to calculate our average inventory. So for that, what we will do, we will not calculate for this one, we will calculate for this. So for that first of all we'll select these two, and we'll take average of our ending and closing inventory. Okay, divide by 2. This is our total average inventory. So now for inventory we will divide this by cost of goods. Okay, we will not divide by sales. Okay, because inventory convert into cost of goods of 2021. Cost of goods is this. Okay, and then we will multiply by 365. We'll see. Okay, this is coming almost similar. Okay, just two differences, because there I have not considered the average. Okay, that is why. So similarly, when you drag it like this, you will get your all the inventory average days. Okay, so based on these three, we are assuming our inventory would be 108. Okay, so but now company has considered to, now company is considering 120, but maybe I would recommend it is better to reduce inventory. That will be better. Similarly, the income balance sheet will also be changed. You can see 4137, 4137. Okay, so as soon as you will change, the everything will change accordingly, and your income statement, balance sheet, cash flow, all are linked together, so all will be impacted. So now we will try to calculate this. Okay, so how is this calculated? We have taken I14, simply the average inventory number of days, and we have divided this by 365, and then we have multiplied by cost of goods, whatever the cost of goods we are predicting for FY24. That is why first we prepare our income statement, then we prepare our balance sheet. Okay, so without balance sheet we can create income statement most of the line, like revenue, like cost of goods, like operating expenses. Other than interest and some other things which are linked with your balance sheet, those items we cannot create for income statement, like taxation. Okay, so other than that we can create a structure of income statement based on our data. So likewise we will calculate our inventory. Then if you talk about trade payable is simply accounts payable part. So accounts payable, we will take average accounts payable. Okay, so let's see how we have taken. We have considered that our total average trade payable balance due as of FY21, and we have divided by our, so we have divided this by again cost of goods, since, but we are supposed to divide this by our trade credit, trade purchase. So if you go into the accounts payable GL, you will have purchase on cash, you will have purchase on credit. Okay, return. Okay, return for both, for cash or credit, whatever it is. So from there getting data for actual purchase on credit. Okay, and then the return on this kind of credit, the purchase return from trade credit only. Okay, cash credit will not return from cash credit will not be considered. Okay, return from credit. Okay, whatever being purchased by our customer on whatever we have purchased from our vendor based on credit, and whatever we have returned, that we have to adjust. So since we don't have this data as of now, because we have taken dump from online. Okay, so that is why we will not consider this, because if you go into your balance sheet, we will have only trade payable value. Okay, so this is trade payable is something which is due as of 31st of particular period or month, whatever the closing date for this balance sheet. But if you want to know how much transaction are there inside this GL, and for entire year how much is our trade payable and how much is trade return based on credit purchase, so that information we will not have. So that is why we will consider cost of goods. Okay, so likewise we will do the calculation. So again, if it will increase, that will be beneficial for us. If it is decreasing, it means to say we have to pay our vendor as soon as possible, and company want to delay as much possible. Okay, so now we have understood this concept, and now we know how to calculate our average. Okay, so now we will reverse calculate trade payable value. So how we will calculate this? Simply you have to take average accounts payable balance between two closing and ending balance, and then you have to divide by 365 and multiply by your trade payable. Since we don't have average trade payable for entire year, so that's why we are considering cost of goods. So likewise we can calculate our trade payable also. Now we'll go to balance sheet and we'll see. Okay, so inventory we have considered how we have calculated. Same, you will have to link and take the figure from balance sheet assumption. Okay, you can see that this we have taken this data from balance sheet assumption. Now for this cash part, as we know, we have in the summary whatever cash we were having, we have divided into two parts. Okay, 25 and 100, 2625. This is the total cash we were having. So we have already paid this cash to the person whom we have purchased this company. Okay, so now we have only balance remaining are 100. Okay, so this one also remove. And now if I talk about other current asset, we have not touched anything, so it is remaining as it is. Now if we talk about fixed asset part or non-current asset, so this will be reducing based on our depreciation. Okay, so you can see that what figure we have 9445 from the same exact amount, and now we have reduced from balance sheet exemption I-23. Let us check I-23. This one is our I-23. Okay, this depreciation you will get it from directly debt depreciation schedule. From that you can, from that place you can get the data. Okay, otherwise you can calculate also. Okay, you must for that you have to create one particular annexure, and in which you will have to update all the asset value. Maybe your asset value is somewhere around 1000 CR. You have to multiply your depreciation rate or formula, and then so 10 years of total life. So one for every year you have to charge depreciation somewhere around $100. So likewise you have to create your schedule and calculate this depreciation. We can calculate based on schedule, or let me tell you how we have calculated here. So income statement we have calculated this based on our revenue. Okay, so for example our last year depreciation was somewhere around 1200. So this one normally we took average of total revenue. So last year our depreciation was 1137. Okay, and then we have divided by total depreciation by revenue like this. Total depreciation we have historical data, and then we will divide by our total revenue, so we will get the percentage. Okay, so similar formula we will apply in all of this. Once you get all this information, based on that you can take your average or whatever management wants. Okay, so similarly we can apply it. So now since this one I think it should also come similar way, so now it will change. Okay, so just that I have missed this point, so I'm not going to change it. It should also be calculated based on revenue. Okay, so that it will not change our income statement and other thing. Okay, so just to keep it as it is, but it should change as per this formula. Okay, but if you think about depreciation point of view, depreciation are normally remain same, but since we are taking based on revenue, that is why it is changing. Okay, so but it is normally same. So now we took this assumption, and your we have created this debt schedule also. Here you can see our opening PPT, property, plant and equipment, and then we have depreciation. We don't have a depreciation schedule, so that is why we have calculated based on our revenue. So that is the amount I have updated here, and then from this it will minus this, and then you will get your balance like this, minus this point, so you will get this. So same figure will come here, and then again you have to minus this. So same formula you have to apply. I have already created this model because if I will create in front of you, it will take huge time. So that is why I have created it, so that I will invest more time on explaining you the things how we have done it. Okay, so while calculating, applying formula, it will take a lot of time. So but I don't want to waste your time, so that we can be more effective. That is why I am already calculated all these things. Okay, now we move to income statement, what we was discussing. So simply this is your asset, and asset will reduce every year. So how much is this going to reduce? You can see 8160. Okay, you can see this one. If you minus your depreciation value, you will get your depreciation. Okay, so since we have other item also, like this one, okay, and this one. So since we are not exactly the internal part of the company, so we don't know, so I have not considered this. If we talk about goodwill is actually, it was just 21. Now we have added this goodwill. So if I can show it to you how we have calculated this goodwill. Okay, so this is total expected value or total equity value. In this equity value we have fair value of assets. So asset fair value was somewhere around 22,693. From where we take it balance sheet G22. Okay, this is the total value of asset. Okay, so this amount we took it. Okay, and then we have total liability. So we reduce this total liability, so we get our balance. Okay, you can see that our total liability balance sheet. So this is our total current liability, and this is our total non-current liability. So we'll consider both. So total value is 8916. So have considered all our non-current and current liability. We have not considered this. That is why I have created this extra line, as I told you in the beginning. Okay, so if you keep it here, it will be quite difficult to calculate. Okay, so this is the fresh loan we have taken. Okay, so that is why this amount will not come. Okay, so we got our asset, we got our liability. So now we calculate goodwill like this. We have total enterprise value, the total value of company, and then what we will do, we will minus our asset. Okay, because this is the total value and this the asset. so that we will reduce, so that we'll get the exact value of enterprise. Now we will add back the liability, so that you will get your goodwill. Okay, so and now we have old goodwill, so if we consider both, so you will get 16791. That figure is taken here. Okay, here we have taken the exact same amount. Okay, taken the entire amount. If we take only this from summary, if you take this, okay, so now when we add together, we'll get the exact value. Okay, so now you have to take this plus this. Okay, so let us not do the changes, we'll keep it as it is. It has not impacted. If you see that below, there is no change in the financial statement. So till then we have clear, we have discussed this. Now cost of capital and non-current investment and long-term advances. Okay, we have given advances. Okay, we have non-current investment, so we have invested for longer period of time, but we don't know how much we are going to get return. So that is why I have not done anything. I have keep it as it is. Okay, even all this item I have kept it as it is, because I have no information about this. If we talk about deferred financing fee, other non-current asset, so what exactly is this, I don't know. When you are inside the company, you will have all the schedule, so where we have invested, what is our capital VIP, in which how much we have further invested and how much we have. So that similarly it will keep on increasing. Okay, if your project has been completed, then you have to move it to asset. So likewise, when you have inside the information, then only you can do these changes. Okay, so now I'm keeping it as it is. Now we talk about current liability. So most of the item of current liability also we kept as it is. Regarding borrowing deposit, we don't know, we don't have much information, so we kept it as it is. For trade payable, as I have calculated here, balance sheet assumption, trade payable. Okay, so based on this information we have updated here. Okay, this trade payable. And then we have our other current liabilities, so we don't know about the other current liability, what exactly is this, so we will keep it as it is. And now short-term provision, this short-term provision also we don't know what exactly is this. Some company takes short-term provision with regard to liability, kind of contingent liability or something. They are assuming they will have some future charges, some kind of thing. So now since we don't know, so we'll keep it as it is. This one we have taken as per the summary sheet. You will see we have revolving credit. Okay, so same amount I have updated from summary, and then we have reduced, as you can see in our debt schedule. Okay, as we paid our this total balance figure, as we have paid, so balance will come here. Okay, same amount will be updated here. After paying the balance, the remaining balance will be highlighted over here. Okay, so this one also we have discussed. Now we have long-term liability. In long-term liability, we also did not change anything for all these 4 items. Okay, since we don't exactly know what exactly is this and how it is going to change in future. So since we don't know, if you are working in the company, I'm keep on saying you have information, that time you have to prepare schedule for all this item and you have to update accordingly. Okay, for provision, maybe provision you have 219, so you will know inside the information what are exactly the thing for which they have taken provision. So accordingly you will either create schedule to remove this from asset if it is unnecessary or something. Okay, now if you talk about long-term debt, so this is again coming from our debt schedule. As you can see, 6399, we have paid this principal amount, so we have balance 5759, so same amount will reflect here, 5759. So initially when the period had started before merger acquisition, there was no debt. Okay, but in mid of the years we have taken particular debt, but at the end of the period or at the end of the 2023 and before beginning of the 2024, we have already paid few amount in 2023 for our loan, whatever loan we have taken. So that is why in FY24 we will take only the opening balance. So that is why we have taken the opening balance as of 24. So similar thing happened for this also. Okay, and this one is coming from your equity share. As you know, we have summary sheet. This is the equity share of owner. That amount will be updated over there. And then this is your net income. If you see net income, go down, Okay, this is 895. Same amount is coming to your balance sheet as an return earning. Okay, so this is how I have explained this. So similarly, you can also try and prepare this balance sheet. Okay, you take another example, or you can take the same example and you can prepare. So since we have already discussed enough about balance sheet and their entire item, so now we'll conclude this topic today, and tomorrow we will discuss about cash flow statement. Okay, so again, thank you for watching. We'll see you into the next session. Stay tuned. Hello student, welcome back to IBS. Today we are going to discuss about cash flow statement. Okay, so let's jump to the topic and understand it. Okay, so now we are going to discuss about our cash flow, how we need to calculate our cash flow. So first of all, in cash flow we will have our net income. Okay, so net income, whatever we have as for 2024 forecasted. So we have forecasted our net income 895. Okay, 18602550. So if you go to your cash flow, okay, this is the same amount. Okay, 96, 1860 and 2502. Okay, this is the same amount, and then we have added back the depreciation. In always for cash flow, there is always you have to add back your depreciation. Okay, or any other relevant deferred financing related activity which has no non-cash item that you have to add back. Okay, and then we have working capital. In working capital, whatever we have change in our current asset between two periods, so that amount will be added. I mean, that will reduce your in this cash flow amount. Okay, and if you have anything liability related item, whatever your liability has increased between two period, that will be added back here, and whatever the asset has increased, that will be just you need to reduce from your total value. So do one thing, you also need to check this kind of figure whether this is the same figure or not. So depreciation you will check various places, and we will check from income statement. Okay, this is our depreciation. Okay, 1286. This is the three different depreciation value. This is the same. So now we have to check this one, how it is coming. We'll see this, not here, we'll see into the balance sheet account receivable section. If you go to balance sheet account receivable section, have your last year your total account receivable, you will minus this year how much it has increased. So it has increased by 263. Okay, so the same amount we will reduce. So it has decreased somewhere, you can see 4,000, now it has 3,544. so that is why that will be added. So that is why this has been reduced and this has been added to your cash. So after that you will see your trade payable. Similar formula you will use for trade payable. Go to balance sheet, trade payable, here it is. Last year trade payable minus this one. Okay, this is the amount we have increased. So whatever amount you have increased in accounts payable, you have to increase this into cash. Okay, so that is why, so whatever amount has been increased, that same amount we will add back into our cash flow, because this is trade payable. What does it means? We have booked the invoice but we have not paid. So if we have not paid, so it means cash has not burned out. Okay, so cash has not given to vendor. Similarly, so that is why that will be added to your cash flow. And if you talk about account receivable, we have booked the revenue, so but we have not received. So if you book your revenue, your asset will increase, your profit will increase. Okay, so that is why we have to reduce this. So similar logic will be applied in cash flow. Okay, so once we have adjusted our depreciation part and our working capital part, now we arrive into the operating part of your operating cash flow. So if you have any other credit liabilities, short-term provision, whatever changes is there, accordingly it will come with the same exact logic. Okay, now we have cash from investing activity. If in case we have invested anywhere and we got a return or something, that will come here. Okay, so in case you have purchased particular asset, so that will reduce your value. If you have sold any kind of your asset, then amount will come here. Okay, so that is why, since we have not done anything, so that is why it is not coming anything. And now if you talk about financing activity, so for financing activity, suppose we have taken bank loan. Okay, so that bank loan will come into our cash. So here I have taken the difference between whatever the debt we have taken and how much is remaining as of 2024 opening. So again we will go to balance sheet and see. So this time we have considered G value, okay, as you can see. Okay, so if we apply the same formula, that will come very difference. Okay, you can see this. Okay, so why not we have taken the same exact logic? Okay, because this balance is 0, so you cannot take that amount in between this period. Particular date there is your liability has increased, so from that increase how much it has decreased, so that difference will go into your cash flow. This is the logic. Even though your last whatever date is this between this to this period, it is entirely 1 year, but you have to figure out when you are calculating. So if there is nothing, all I'm trying to say, this line was not even available, so how can you check the increment between the line which was not available? So only when it is available and that day, from that day to till now, how much is the changes, that amount will come. Again I'm explaining it to you. When we don't have this line earlier, because okay, when we did merger acquisition, with that time we took loan. Okay, so then it came into the picture of 1st of June. Okay, as I've given this date. Okay, and this is as of 31st March or 31st December. So as of 31st December, this line was not existed. Okay, so if somebody will come and ask you, as per cash flow law, you have to check between 2 period difference, you have to consider. Okay, but the problem here is between 2 period, how will you calculate when that line was not available? So the day this line has been created, from that day how much was the fund, and till today what is the difference, so that amount you will take. Okay, that is why I have considered here, I have considered this amount minus this amount. Okay, I hope it is clear to you. The same amount we have updated here. Okay, and also another logic is whenever you have did the merger acquisition, all this already impacted to your balance sheet in June. So we are calculating as of 1st of 2024. Okay, so now we will consider all this and we will reduce from this. So this is, if you see this total, this is exactly the same 2497 as we have total cash. So that whatever cash we were having, the same we have already paid. So we have left nothing. So we left nothing. So how much we will have? So we will have exactly the same whatever we were having in the opening. So opening we were having 100. So all that is why closing cash balance is again same. For the FY15 we did the same logic. So whatever we were having net income, we have added back our depreciation, then we have adjusted our working capital and current liability. Okay, and after that we got our operating profit, and from operating profit we have adjusted all our dues, okay, and which we have paid. This is the principal amount. Again I'm telling, this principal amount is coming, and interest part will not come into your cash flow. Interest part will go to your income statement. As you know, in income statement your net profit we are taking. Okay, since we are taking net profit, so expense of depreciation already been adjusted here, that after adjustment you are getting your net profit. Okay, so that is why your interest part will not come into cash flow. Okay, you can see that the same amount which is 2195 cr, and we have cash 2195 cr, so same amount we have paid, so we left nothing. So again we will have the same fund as much we have planned. We want to keep cash at least 100 cr, so same amount we have. So last year what happened? So last year we have total operating cash flow after adjusting all our depreciation and all, we have 3626. Okay, we paid our loan somewhere around, let us reduce this, 3626 minus this total due we have paid the principal. Okay, so we have balance 1728. So and then whatever opening cash fund we were having, so that we have just added. So total we will have in hand as of 2026 we will be having 1826 as an our ending cash balance. Why this is coming? Because this will be not that much cash fund. if you go to balance income statement, yeah, so here in cost of sales I have changed that percentage of inventory. That is the reason. So if we take the same percentage, as you remember, we have reduced our cost of goods. We have, while explaining it to you, I have reduced this, and that is why your cash flow and net income has increased too much. Okay, so now since I want to keep it as it is, so now you see, if we change one particular line from income statement assumption, if we change any particular line from income statement assumption or anywhere, it will impact so many places. Now see that income, so your income will also reduce. Now our income is coming 1629, and that was something else earlier. And if we go to cash flow, that again, if you can see that cash is drastically reduced, now it is 282. So you can see that every single line has connected with each and every worksheet. Okay, the majority of issue as a finance modeler or finance analyst face in creating Excel sheet, if you do change any single line and you forget, that will change your entire statement, so then later you will have to invest so much of your time to find that where exactly you have changed. Likewise, seeing this, at that time I has in my mind, when I have prepared this, our cash ending cash balance was not that much. It was somewhere around 300 or 200. So since I saw this, net income was coming something higher side. Otherwise the logic of cash flow was same. So I have remembered that while explaining you income statement, if company want to reduce their cost of goods, so they can further reduce this. If you reduce this again, it will, you can see that reduce this cost of goods, company want to improve their productivity. So if you reduce this, you will see that your cash flow will change again. See this? So this is completely linked with each other. So you are not supposed to do any changes unless it is necessary or compulsory. Okay, so I think I have explained it to you. Just one more point I want to explain. As we have calculated this goodwill, and this was our old goodwill, if you will add together, we'll get total goodwill value. So now one more thing I would like to explain. This is your total asset and this is your total liability. If you reduce asset minus liability, that is your company value. Okay, this is the company value, because whatever asset you have, if you sold that asset, you will get 22,000. Okay, you will pay your liabilities. That is the fund you will have in your hand. So this is the value of your company. But this is not only the case, because company is selling their company which is generating revenue. Okay, this is not something like you sold your asset and you pay your liability and you have remaining fund. You are selling company which is keep on generating revenue. Okay, so you will take one-time payment. So what is the one-time payment you have received extra than your company exact value? So if you add plus this, so goodwill is the extra value which is been paid by the person who have purchased your company. So this goodwill we have updated in our balance sheet also. So from their perspective, they have paid extra, and from your perspective, if you calculate this plus this 30,547, 30,547, this is the equity value they have calculated for your company. Okay, if you change this, so this will also change, and this will also change. Your goodwill will also change. For him, they have paid you extra somewhere around 12,116. Okay, excluding this, I'm trying to say their total cost of buying your company is including this. Okay, but currently for you, they have paid you extra this much. This and plus this, if you add, you will get 25,893, 25,993. This is the value. So this is the point I wanted to clarify. I think you understood that goodwill is something which is been paid extra than current asset minus liability. Total current asset we minus liability, the equity value will come, and from that value, whatever the extra amount we are paying to that person or the owner of the company for selling their company, so that they will get one time payment and they will not have ownership in the company. So later on they cannot come and claim. So for that because they are selling their company which is keep on generating revenue, so that is why they want to get higher amount, so that they can be satisfied, because they will generate their revenue somewhere around 2,000 something. Yeah, this one they are generating their revenue. To generate this much revenue, they will take how much year? They will have to take at least 5-6 years. So okay, 7.2. Around 7 years they will have to invest. After 7 years they will get this much fund. So but since they have got all the fund immediately, so that is why they are paying it. Since they are getting immediate benefit. Okay, and you have purchased this company so that you can take consistent profit for longer period of time. So this is all depend on the perspective of buyer or seller of company. Okay, so I think I have explained everything to you. So we'll close this top level planning and we will discuss a performance analysis into our next session. Thank you very much. Keep watching, and if you have any question, come to me and ask me in question answer. Okay. Also, please don't forget to follow me, and if you have any question, you can ask me on YouTube also. You can ask me on LinkedIn also. Okay. I have also given my email. You can personally come and ask me all your question and doubt. I will love to help you.
So hello everyone, welcome back to IBS. Today we are going to discuss a little bit about leverage buyout and discounting cash flow. Since in previous lecture we have discussed about the leverage buyout model. So just continuing to this topic. So leverage buyout model, obviously from income statement you will pick the EBITDA. Like you can see I have selected I38 in income statement. I column is FY20 and 38 is this EBITDA. So I picked this and then multiplied it by EBITDA multiple. So whatever the industry rate is for that particular business. So since we are learning for education purpose, so we are not aware that which company is this and what exactly the EBITDA multiple is. So we will take 10x and then you will get the enterprise value, which is obviously 35,000 crore or $1 million, you can consider whatever you are comfortable. Then the sources of fund which a founder will gather to buy that particular company. So he has to put his own money somewhere around 15,000 million dollar, or you can consider crore. Okay, and then rest all he will also check the balance available in current company, so that he don't need to take the loan for that, and then he will take different loan, and then all loan will have different percentage, and this is something which we have calculated overall total percentage. For example, subordinated debt is somewhere around 15% of total debt or total source of fund. So we need to gather around 38,000. So it will change if you change this to 9. So you will see that the amount, almost all the amount has changed. So if not all, then obviously your this amount will change. You can also change this by changing this kind of amount, because when you are calculating financial model, that time you have decided that we will take the revolving credit related facility for around 1.5x. Okay, but at the end you also need to figure out how much the person who is going to acquire have fund. So if he will not be having 15,000 crore or something, then he will not be able to say that we can buy the company. So he will say that manage the and increase the debt percentage so that I can only able to pay 10,000 or something. So if he will say in that way, so then you will shortage of funds, so then obviously you will need to increase this. Okay, so this is overall the concept here. So just we have automated this. Then we have further expense with regard to arranging this fund and the merger acquisition related financial fees, and then their transaction expenses. They are charging 1% of EBITDA. As you can see, this is the enterprise value. He is charging 1% of that. Then financing fees they are charging, so that you can see how much they are charging. This is the charges. So this charges is totally depend on interest value plus this percentage whatever you have decided. So this is just for education purpose. It may change based on your actual figure. Okay, so whatever been decided, but I'm giving you idea that this kind of charges, maybe there are 10 different other charges will be applied. Okay, so but now I'm just giving you overall idea that this kind of new charges will also be applied. Okay, and you can keep this format in that way, so that you will see that this is heading, this is subheading kind of stuff. That will make it more beautiful. And then we have further calculation with regard to matching the balance sheet, like how much the purchase price and how much the fixed asset total value as of now, and then their total liability as of now. Then you will get the current value. Current value of company is this, and we are paying extra amount which is goodwill. So if you club together, then total value is 37,996, which is the total equity buyout amount. These are the expense, so it will not be added as in your part of your balance sheet. So it will not go. So these are the thing will go into your balance sheet, but not this one, because this is straight away expense. Okay, so you may charge it to your P&L and all. So now this is how the leverage buyout model works. So basically here we are trying to do reverse engineering and calculating how much investor has to pay to buy that particular company who has EBITDA somewhere around this much. So this is the overall structure. So I will be sharing this Excel sheet so you can also able to further evaluate and further improve this. We have tried our level best to make it more automated as much possible. Okay, so you can improve this further because obviously automation never ends. So now we will discuss little bit about what you understand about discounting cash flow. Basically, to learn this discounting cash flow method, I would say you need to have good idea about time value of money, and you should have good accounting knowledge, and you should have a good understanding of NPV method and calculation in Excel sheet, that also you should know. And you should have a overall idea about what is EBITDA, what is EBIT, and what is EBT, what is NP. So these are the short word of financial which we frequently use. So you should know what is the discounting cash flow and what is the value, what is called terminal value, and why we use terminal value. So I will be explaining this, but I'm just saying you should have this knowledge, that would be better, so that you can also able to connect it, because I'm giving you definition and then I'm directly giving you the practical, so then maybe you lagging behind sometime. Okay, so that is the reason I'm just trying to give you little bit of theory part, and then you can note it down and update your, you can make a note and then you can rewatch couple of times so that you will be familiar with this stuff, and then you can understand the discounting cash flow. So now our topic is discounted cash flow. So first of all, the meaning of discounting cash flow is present value of future cash flow, future free cash flow, which a firm generate from his core businesses. Okay, it convert the expected cash flow into today's rupees or dollar value using the discount rate. So what discount rate you will apply here, whether you will apply WACC or whether weighted average cost of capital you will apply, or you will apply cost of equity. So what do you think? This is my question. So obviously my answer is we will apply a WACC, because we are trying to calculate entire enterprise value. So that is the reason we will use WACC. When you will be trying to calculate equity value, that time you will consider only cost of equity. Okay, that time you will not be able, you are not going to use WACC. Also you might notice many people are using discounting cash flow. So have you ever thought why it matters? So discounting cash flow try to value the business from a fundamental cash generation rather than market sentiment, or I would say comparable. Okay, so core formula behind this calculation of enterprise value is obviously this one. Let me make it little bit bold for you so that you guys can note it down. So this is the main formula. So we have splitted this formula. First round we will be calculating this, so that will be your EBITDA. This part we have calculated 15,000k, so this is just this part of this. Then further we have free cash flow, and then this. So this one we have calculated here. Okay, and then to multiply this to bring this value back to the current level. So this is also, because this one you can see 4966 is not the current EBITDA, this is the current EBITDA, right? Projected first year EBITDA is this, and the fifth year EBITDA is this. So we are using fifth year EBITDA value. Then we are adjusting further thing that we will discuss. What are the thing we are going to adjust anyway? So then this is from fifth year till the, from that period we are calculating termination value. So let's understand the terminal value. What, not termination, sorry for that, terminal value. Terminal value is something when you think that your business will grow continuously, they will never end. So if that is the concept you have, or if you have been thinking that your company will continue for 20 years only, so in those method you will not apply this terminal value. But in case if you have perception that company will continue for endless period of time, then you will use the terminal value. But again, to think in that way, if something will multiply by infinity, so then the value would be bigger than the entire economy of the country or the world, right? So that is not right approach. So that is the reason we are applying the growth as well as, but that growth is not the same exact same growth with the rate of growth this is growing. For example, we can check it, bracket this minus this bracket divide by this. Just one example, it is something, it is saying 52% growth in EBITDA. So we cannot grow continuously by 50 or 20 or 30% or 10%, right? So if you will grow in that way, then you will be bigger than economy or country GDP. So that is not possible, that is not going to happen. So that is the reason we are using perpetual long-term growth rate. So usually it is between 1 to 5%, and it is again you need to discuss with your management, or if you are working in investment banking, there may be multiple other companies, they are also creating financial models, so you can use the same logic, and they can help you to what rate you can apply here. So I have considered 2%. You can check with your peers, your team member, your manager, he will guide you what percentage normally in the investment banking for that particular industry or sector being applied. So same you need to apply. Okay, and then this is discounted rate is nothing, just our WACC, so which we have already discussed in the previous lecture. So that is the amount, that percentage is coming. This one we have calculated based on this company, so this is coming very less, but normally it is 15% or something, but it's okay, it is coming less, so we will consider as it is because we are doing it for learning purpose. So then this is the terminal value. Then terminal value is being created based on 4th or 5th year. This is 5th year. From there we are calculating infinity level of revenue will continue to grow, and then we are dividing this by our R is nothing, your weighted average cost of capital minus growth. So in your fact we are reducing growth, and then we are calculated total value. So that terminal value is calculated from the 5th year till end. So then the 5th year to till year, again we need to bring it back to today's date, right? For that we will use the PV terminal formula. So let me see what I have used. I have used 3. So maybe this one we have used for 3rd year EBITDA. So that is the reason. So now I'm making it side so that you will see other important stuff. Then there is again 2 concept, is a free cash flow to firm and free cash flow to equity. This is 2 different things. So both are being used for different purposes, as I have initially informed. One is used for enterprise value and another one is used for equity method, that we will be doing here while calculating discounting cash flow. So this is what enterprise value has been calculated, then we are reducing debt and cash, then we are getting equity value. Okay, then further we have divided by number of share, whatever share you have, the same millions dollar if we are using, so you need to split this share in $1,000,000 and million number, and then you need to divide that, then you will get the equity value per share. Then there is a different approach. By that we have reached to the enterprise value. So through discounted cash flow method we reach this amount, and leverage buyout model we reach to this amount, and then EBITDA multiple, whatever is going on in the market, by that way we reach to this value, and then total revenue into multiples like this. So then we reach to this value. So when you have different approach and different value you have perceived, so either you give the percentage rating. So if you think that either you take average enterprise value if everybody agree, or else you can give, or you can negotiate and say this one we will consider 90%, or you can say no, 60% chances of that the enterprise's value would be around this. And then obviously they will ask, so what is the chances of, based on leverage buyout model, what would be the percentage? So then you might discuss and decided around 10%. Then for this also you need to figure out what is the percentage. Let's say 15%. Let's say 15%, and then you can again multiply this, you will get another value. Just trying to give you overall different approach, so that your mind will be open, you will have better idea of what to do in what cases. So you will get different amount over here. You can see this much. So why this is higher than this? Because we have given more weightage to higher value. So that is the reason. So that again the discussion and negotiation will keep on going on. So this expected value percentage should always be 100%. Okay. In discounting cash flow method, do you think which one is more serious, or I would say more dominant thing in entire calculation? So let me tell you, this is the terminal value. So total enterprise value is 94,000 crore or million, So out of 94, total value is around 80 million is coming from terminal value, so which is again 84%. So that is what the industry in normal in industry it is being considered. Terminal value are normally 85%, so it is coming correct. So that is the reason terminal value is the most sensitive element of discounting cash flow. So and that impact with multiple things, that impact directly by these two things. So these two rate are very important while calculating terminal value. For that you may create scenario planning or sensitivity analysis, as we have discussed previous lecture. You can use that formula and create multiple using different percentage for perpetual and discount rate, and then you can check what terminal value is coming. Okay, so or maybe your manager want to see these things, then you can easily create. Okay, now let's understand how to create this first part of our discounting cash flow, which is your EBITDA is projected somewhere around age 38 in income statement. As you can see, age 38, this is the projection. So this value to this value we have considered. We have data I 38, it should come instead of h. Okay, everybody make mistake, that is what we are here. I, then obviously it will be ij, then it will be a. Then we have not projected more than 3 years, so we'll take somewhere around, we'll see how much percentage is here. This minus this divide by this, around 12%. We'll take 11% just because we are on the learning purpose, into 1.1. Okay, so this is for total 5 year. So if you add all, you will get 22,000 crore or $1 million, whatever it is. Now we use NPV formula to calculate the current value. So this is the total value. If you can calculate this, SUM. So this is the total value of projected cash EBITDA value, and this is the projected cash we are going to generate in 5 years. Now we are bringing it back to present value, okay, or current value. So we'll use equal NPV. You can select this NPV. Then what he's asking for rate. So what rate you will give? So to calculate EBITDA, you will have to apply WACC, because we are going to calculate for entire enterprise, not for equity, not for debt. So that is the reason we use this. You can link from here or wherever information you have. Then he's asking value 1. Maybe we can miss, then we can revise this formula again. Then value 2, then bracket close. Yeah, it has calculated correctly. So then you can recheck it. So one time we have given the sales data, then we have given period, and then we have selected the percentage. And this one is hard coded, that is why it is in blue color, and these are the linked information, that is why these are all in black color. So whenever you see blue, it means it is hard coded. And now again it is 18%, and this one is 82%, little bit lesser, but yeah, okay. Now we will understand how we have calculated the termination value. For that, simply you can click here and press F2. You will see all the formula, or you can also see here income statement K38. So this is nothing, just our EBITDA. Let's see, income statement K38 is our EBITDA. Then what else we have considered? K38 EBITDA, as you can see, this one. Okay, then we done the sum cash flow. Okay, cash flow from E17 to E26. So you can also do the same thing. Let me open the ChatGPT. You can also use this. I have already calculated this, but I am giving you this so that you will also learn to practice how to calculate. If you are getting stuck, you can get a number of different perspective. So now if you have pasted this, you just write down provide calculate the formula to calculate TV. So he will try to give you the information. So look, he is giving you all the formula. He has mentioned the back, so you can think that we are going a right direction or not. Then he is explaining what is free cash flow. So he is saying free cash flow for last forecasted year. Then he is saying the gross perpetual value 2 to 4%. He is also giving the same logic. And then weighted average cost of capital. So now if you study this, you will still get confused that we are not still clear about the free cash flow calculation. So you can copy paste here and you can ask him, let me know how to calculate this. Then he will give you further information about what are the element will come in your free cash flow. So he is saying consider EBIT, earning before interest and tax. Also he is saying add back the depreciation and add back the tax. So obviously if you consider all of this, it will become EBITDA, earning before interest, tax and depreciation. Okay, so EBITDA. Then he is saying capex expenditure, cash flow from asset. So if you have purchased any kind of asset, so that asset you have invested cash, so that cash you can add back. And then there is working capital increase or decrease. So where you will get this working capital, obviously we will get in cash flow. And then capex related information you will also get into the cash flow. So let's go ahead and see how they have calculated. They have considered EBIT, then they have reduced the tax. So tax we need to reduce. So this part if we have missed, we can correct this. Okay, we go to income statement. We can directly go to EBIT. This is the EBIT value. Okay, then he is asking to reduce the tax. Income tax amount is this, we can reduce. Then he is asking us to add your interest. We'll consider both here. And then what? Depreciation. Add back the depreciation. So now this part is done. Now we need to go ahead and check working capital changes. So working capital changes obviously you will get in cash flow. So you can add this. Rest all other number are zero, so we don't need to consider that. You consider that. Then if you have purchased any asset, so then obviously it will come into your investing activity. So there is nothing. We will again consider this. So this is the total free cash flow for forecasted last year. So this one. Then this is simple, same thing. You can just link the formula. So wherever you have the WACC or something. And then the main thing is this. Okay, we can copy paste here so that we can see how we are calculating. Is it matching or is it not matching? So first select the free cash flow, then into bracket 1 plus growth. This is the growth rate. Okay, bracket 1, then divide, then again create bracket, add your WACC minus growth, bracket close. I think we have perfectly given everything. Okay, this has calculated correctly. So this is how we can calculate the terminal value. This one I have just mentioned as a note. You can remove if you find anything when you will see this financial model. If you see this kind of stuff, you can remove this. Okay, then so we got the current EV for 5 year as of today, and then this is the terminal value for year 3. So from year 3 point of view, we need to bring it back. As you can see, we have K28. K28 is forecasted for year 1, year 2 and year 3 total. So this is total forecasted value. So total 3 year. Okay, so we'll obviously just add the WACC. As you can see the formula again for your reference. 1 divided by 1 plus R. This formula we have already used here while calculating the terminal value. Now we are bringing the terminal value as of previous or current value dated. So that is the reason we will simply, again you can copy paste here as a paste special, Alt ESV, it will come. Then you can simply select terminal value, this, and then what he is saying 1 plus R. Then you need to click divide 1 plus R. R is your WACC, right? And select this, and then he is asking to the power 3. So to the power you will simply click shift 6. As you can see, it has come 2 times, then 3. Okay, now let's see. It has calculated perfectly, right? So when you add both of them, you will get your enterprise value based on discounting cash flow method.
So this is what the discounting cash flow. So for discounting cash flow method, you always need to have cash flow, free cash flow. If you are able to manage free cash flow, then only you can apply, otherwise you cannot apply this. Then for enterprise value, I already discussed, you can remove your present financial related debt and cash will be added back and that will be reduced from this. So if you add together, you will reach to your equity value. Then number of share you need to divide, that you know how to do it. So we got the value based on discounting cash flow and leverage buyout method. Also we have EBITDA multiple. So EBITDA multiple is simply how we have calculated that. You can see this is the calculation, this is the EBITDA. So I have used the average formula. You can use a different approach. There is no hard and fast rule because industry is so wide, there are so many people there, everybody are using different approach. Okay, so any EBITDA you can pick, and I have considered all the income statement related, all the EBITDA, all this EBITDA I have considered, and I have taken the average. You can calculate the mean, as we have learned in previous session how we can calculate mean, medium, mode and all. If you have not learned, so I am assuming that you must know how to calculate the mean, medium, mode. So but I have used the average formula, that also you can use, so that is also simple. So I have taken the average EBITDA, then I have multiplied by 15x. As you can see, this M41 is what? M41 is this. So I have multiplied the average with this. So I got this value. Then also I have reduced the current year, your debt and cash balance. You can also do it here. Let me paste this as an special. Select this calculation, plus here we have our debt plus cash. There is something difference, so maybe I have used different approach probably, or maybe I have used projected debt and cash balances, so that may be the reason. So it is better to use this method, this plus, because we all can make mistake and make an argument on all those things. So there is obviously different approach, so there is no hard and fast rule that you can only apply by this method. So that is the thing which I'm keep on communicating. Again, there is one more method which is revenue into EBITDA enterprise value method. So for that also you need to take the current revenue. So either you can take average of 5 year, and then what you can do is use the revenue for 5 year. Okay, and then use the NPV method and calculate the current value and then divide by 5, and you will get the annual revenue value. So that also you can use. So it is purely your thought process, how you want to calculate and defend your thinking and what you are calculating, why you are calculating. So you can give your input on this. So I have just considered the current year revenue, okay, and then multiplied it by 3x. So normally revenue will get a 2 to 3x multiple, not more than that. So that is the reason I have considered 3x, and 3x are coming somewhere around 50,000 k. So in between this and the leverage buyout based on equity multiple, so this is coming nearby this. So I have considered this, and so you can change it as you want. You can make it 2.5 or whatever suitable for you, whatever your client wants expectation. So he might tell you you can make it 4 to 5x of revenue. So if he is saying you can use that, and then maybe the person who is going to buy your company, he will have to finally decide whether he is ready to pay this average EV or not. Okay, so this is how different approach we will use, and then we will jump to the average EV. And another point which I want to make an argument, that he is going to invest this much of his money. Okay, so if he will go and invest in and do FD, he might get return, or since he has this much amount of money, so he will systematically create his portfolio, he will generate around 12%. I'm expecting minimum 12% he will be able to generate this, correct, if he will go for other than this acquisition of this business. And what profit he is going to generate over here? So as we can see, this is the EBITDA, correct? So EBITDA is not the profit, right? So as an equity holder, he will have to reduce the debt amount, interest amount and all. Interest and tax he has to pay. So net income
interest expense he have to pay, then only he will get money for himself, right? So we'll consider the net profit instead of EBITDA, because ultimately we will reach the same value. 2024 net income is this much, correct? Yeah. So he is generating little bit higher than what he potentially he would generate, even though he can able to generate 1834 CR or $1 million. And if you have go with systematic portfolio management, so maybe he will have to pay some amount to somebody who is managing his portfolio, or if he has acquired this company, so he is making little bit extra money. So what percentage he is generating? So you can see extra he is getting 0.12 is somewhere around 1.5%. So this is what his risk, he's taking that kind of risk to generate extra profit. So there may be chances he may not generate this amount, he may generate more than that. So for that he will calculate himself by all this thing, and he will decide what he need to do. So I think I'm going to conclude my lecture over here. So we'll see you into the next lecture, and stay tuned, keep learning. And financial modeling is something where you must have patience. Patience is the key in financial modeling. So if you are someone who don't have patience, so you are not supposed to enter into this kind of career path, because this is where you need a lot of study, continuous study and continuous struggle, and you will enjoy if you are interested in it. If you are not interested in such kind of things, so you may not enjoy. So that is the reason I'm saying you need to be have a good patience, because there are some time when your financial model will not match. You will have to spare your entire night. Maybe next day you have presentation and your financial model is having some issue, so for that you may need to spend your entire night. So this happen. So that is the reason that this is something where you need to have good patience, which is being tested in this field. Also show some patience in learning as well, because maybe you will see some of my lecture will be not up to the mark, or maybe sometime you will get a lot of cut. So this thing will happen while creating course. I need to learn many things, I need to revise myself. So, and I can also miss something, because nobody is perfect in this world, so everyone make mistake. So all our intention is, and your intention would be, to keep patience and learn the concept rather than finding mistake, rather than making your mind thinking toward the video cutting and video editing kind of stuff and quality of video related stuff. So if you are a studious, if you are someone who want to learn, if you are someone who patience to learn, so focus on learning and concept building, and try to understand as much concept you can. So see you, thank you very much, bye bye, take care.